From their U.S. peers. Also, Nestle for consumer products, they had a beat on sales fueled by price hikes. A little bit of tariff news in there as well. And then finally, pharma will be looking how Roche prices act at the open. They had a beat as well. Anna.
Yeah, absolutely. A lot of other corporates reporting, Lloyds Banking Group, BT, ITV, lots in the UK. So we'll watch out for those as well, Val. And interesting to see after yesterday's gains in the auto space, can that sector factor in more positivity around the trade narrative, the tariff narrative? Let's look at where we are then at the start of this trading day, Thursday morning. How do European equity markets open up? Well, we only have the FTSE 100 to go on, and that's not going to be the pace setter today. If the excitement is around an EU-US trade deal, then we don't look to the FTSE necessarily to show us the limit of our expectations there. Stock 600 up by 0.25%. The IBEX certainly doing a good job of factoring in some of that tariff optimism, up by 0.9%. Could this be a day, Val, where it takes a little time for the CAC and the DAX to open if there is a building excitement and a building expectation of some kind of tariff story, a positive tariff story coming between these two trading partners across the Atlantic? Of course, it is ECB day, and no doubt those in Frankfurt will be keenly awaiting any news flow around tariffs, because that might make their conversations around rate setting in the second half of this year easier or more difficult. Anyway, let's have a look at early days as we wait for the DAX and the CAC to open. What does the sector picture look like? This might be an evolving story over the next 5 minutes, Val.
Yeah, that's right, Anna. Well, it does look like from the sector picture, it is quite positive. We have all but two sectors in the green this morning. At the top of the basket, Anna, is autos. So we are reacting positively still from the read-through from the latest news on tariffs that the EU is assuming a 15% baseline in their framework. Also, banks at the top of the basket, Anna, as well. That sector is up, now 1.3%. Must have a new stock that has opened. We've had a slew of strong banking results coming out this morning from Deutsche Bank and from BNP. Also, some other sectors at the top, basic resources performing well this morning. That's lifting the FTSE as well, Anna.
Yeah, absolutely. So it very much makes sense that we've got the two themes of the morning, earnings and tariffs, lifting those two sectors, doesn't it? So as you point out, the banking sector is doing really well this morning. BNP Paribas is one of those stocks in there, up by 2.6%. Deutsche Bank is also higher this morning, up by around 4.5%. So that positivity around the FIT trading story, something that's really played out well for these businesses in that most recent quarter, and that seems to be something that's supporting their earnings. And yeah, we got a quick answer, didn't we, to that question of whether autos can once again provide some upside. I mean, some of these, Stellantis was up by an incredible amount in yesterday's session, by nearly 10%. And yet we have another day where autos and parts can go higher, just up by 0.9% for the sector. VW is up by 1.3%, so that's something that Guy will be keeping in mind as he makes his way over to Wolfsburg for that conversation. Food, beverage and tobacco, I'm really drawn to the negativity though there, and yes, as expected, that had to be a heavyweight because the sector as a whole is down by a substantial amount. It's down by 1.4%, and Nestle is the big player in the mix there. That particular stock is down by 4.4% on the back of their numbers.
So a mixed picture, at least when it comes to some earnings being on the down foot, with Nestle, as you mentioned, in the red after they did come out with a beat in sales, but it was fueled by those price hikes. And then on the upside, Deutsche Bank climbing, as I'm looking at the movers, up now 4.5%. BNP is not too far behind at 2.5%. Joining us now is Claudia Panseri, France's CIO at UBS's Wealth Management. It's been a busy morning, Claudia, of earnings and tariff news. What do you take of the positivity we're having in this European session?
Good morning. The first positive is all the news flow around the tariff. Everyone was expecting a 30% tariff. We may come up with 15% high. Secondly, I think
You're mentioning results out of the U.S. We did have some pretty strong results from Alphabet in both their cloud business, their Google revenue from their ad business, as well as an increase in CapEx. Claudia, is the AI trade a main part of how you're viewing markets at the moment?
We are still very positive on everything which is linked to AI. And we currently have seen, even yesterday, still announcing a lot of CapEx spending, which also very supportive for the semiconductor sector. People were questioning if after 2 years of good performance, valuation behind, monetization and earnings could keep going. And we currently see that the trend is still there. We also see from a macro point of view that there is a lot of investment. Trump is announcing big investment in US to sustain the AI. So there are plenty of positive news still there. It's true, valuation is not cheap. But we know that we need to expect more return on equity to finalize this trend and to see where this trend can go. But we are still very positive. It's one of our main call since last year, and we are keep buying tech stocks more selectively than we were doing before, but we are still positive on the segment.
Claudia, good morning. From tech, I want to go back to the banking sector because this is a big theme of the morning. Some real positive statements coming from companies around what they've managed to deliver on FIC revenue, for example. If, as an investor, are you assuming that the rest of this year, the second half, is as volatile as the first half? Because that seems to be one of the big drivers of the strong performance for the banking sector. And yet it seems quite difficult to make that assumption. So how do you look at the outlook for the banking sector?
So I think there are two different trends. There is one trend which is in US, where the banking sector has been lagging the overall market. Performance was good, but not outperforming the overall index. And we move recently positive ahead of the earnings season. And we have seen that companies are still surprising on the upside. Net margins are positive. And so there is a lot of activity, even if the M&A activity has been quiet in the first half. Then you have the European one, which has been one of the best performers, a sector on which you didn't have a risk of tariff, a sector which has been benefiting from lower interest rate because the default rate remained low. And the performance has been extremely good, also because we have been some particularly story with some Italian banks, but also relative to this M&A process, which everyone was expecting. And so in the European banks have been performing particularly well. Now, should we expect more performance in second half? Probably not. The results are good, but interest rates are falling. So the capacity to, let's say, to generate additional return on equity will be lower than what we have seen over the last 12 months. So probably a better position in US banks relative to the European ones.
Okay, so that's the banking sector. I want to ask you about the broad theme that's driving markets right now, Claudia, and that's optimism around a trade deal between Europe and the United States. What careful language or enthusiasm would you offer around a rate of 15%? If we get a sort of baseline rate of 15% that maybe includes some of the sectoral, some of the areas we might have seen sectoral tariffs or have seen sectoral tariffs, how good or bad would that be for Europe?
So I think overall 15% is a good news because we were expecting 13%. So the market was expecting. We were rather thinking about a better tariff for Europe than many people were speculating about. But it's still 15%, and so we need to understand what's going on with the pharma sector and with the auto sector. We will keep 25% of the auto sector because this is also very important for Germany particularly. We have seen yesterday and today the auto sector bouncing back, but the risk is still there. On the overall market, I think the sector which are not exporting, which are less impacted, there is still some upside, but is quite on European rather than US. of the 15% of the tariff, we also have a strong appreciation of the euro. The euro has been reappreciated quite a lot since the beginning of the year, and that should impact the companies which are exporting on the top of the tariff.
Claudia, you mentioned that you're cautious on European markets and more positive on U.S. markets. With that backdrop, what do you make of this resurgence of meme stock mania, the surge in retail volumes, call options being traded? Does that make you maybe nervous about these all-time highs that the S&P 500 has reached every day this week, excuse me?
I mean, the market has been very resilient. What we are nervous about is the peak in volatility. So you always know that after a strong market rebound, you have a pause. We didn't have this pause. The market is up more than 20% since the lows of April. So we may have a pause, and probably even a small correction. But the economy, the U.S. economy, is really resilient. And we still have some rate cuts to come. So we are not expecting a huge drop. We just expect more volatility, a bit of consolidation. But for us, which are not exposed.
Okay, yes, I was going to ask you about the Fed. I know that President Trump, we understand President Trump's going to be touring the Federal Reserve later to view the building work. He's had much to say on that subject, of course, and the future of Jerome Powell. You still are expecting cuts. What basis, what do you base those expectations on, Claudia?
So we are expecting the first cut coming in September, 25 basis points, and then another 50 basis points by the end of the year. We are a bit above consensus because consensus is now only expecting 50 basis point rate cut by December. And the reason is that we are expecting a slowdown in the economy. No, we are not expecting recession, but a slowdown in the second half of the year. A slowdown which is driven by the rising impact on consumer of tariff, but also a slowdown which is due to the fact that interest rates are still in restrictive zone. So you have more than 4%, and the data is slowing down. The employment market, unemployment is still very low, but when you look into other variables, we see a slowdown. So that should bring the Fed to cut the interest rate in September, starting with 25 basis points, and then 50 basis points by the end of the year.
Okay, thank you very much, Claudia. Thanks for joining us. Claudia Pansari, the France CIO at UBS Wealth Management. Let's look at the core six, and we know that Nestlé is one of the stocks on the move there, down by more than 3% for the food giant. Nestlé is conducting a strategic review of its struggling vitamin brands, which may result in divestment. That's just one of the things to come out from the earnings story around Nestlé this morning. We have Schneider Electric higher, ASML higher, Ferrari higher, LVMH a little on the back foot. We had numbers from Moncler, waiting for the numbers out of LVMH, of course. Let's get a rundown of some of the individual stocks that are moving this morning. Chloe Melly has an update. And Chloe, we've seen some big moves in the banking sector.
Yes, indeed, Anna. Good morning. So, yeah, as you can see, a wall of green this morning across that European banking sector. We have got really good earnings this morning from Deutsche Bank and BNP. Their fixed income performance was particularly good. That follows in the footsteps of what Wall Street banks have been saying, and the volatility in the second quarter boosted that fixed income segment. Lloyd's also beat estimates. That's on the back of higher interest rates that stayed higher than it was expected, throughout the last few months, and that boosted the shares this morning. But Deutsche Bank and BNP particularly high this morning. Moving on to Nestlé. So as you mentioned, Nestlé is down this morning. The sales did increase, but it was off the back of price increases rather than volume increases, and volumes are still very weak, and that is feeding into the strategic review for the vitamins business, which might lead to a potential divestment, and that is making the shares go a little bit down this morning on the back of that. Moving on, we have got Reckitt. So Reckitt is actually up by quite a bit this morning, 8%. It announced a £1 billion buyback, and it's also raised its revenue forecast. So the investors are reacting very positively to that for Reckitt this morning. And then finally, we have ST Micro. So ST Micro, chip maker, it posted a surprise loss that's due to restructuring charges, and it also flagged weakness in the car end market. So it said said that there was continued weakness there, and that is dragging the shares down almost 12% this morning for that chip maker.
Thanks very much, Chloe. Chloe Melly with the latest on the movers from our equities team, of course. Val, just taking a step back and looking, now we've got the full complement of all the European markets open. So the DAX is up by 1%, the CAC 40 up by 0.5%. So perhaps, I mean, not quite living up to the futures picture and the sort of optimism we were expecting there. It is interesting that autos can once again stage a strong day based on the expectation, the hope perhaps we should call it, that we get a favourable tariff for that sector, because this is a sector that's already tariffed. There's already a sectoral tariff in place. And so if we saw that coming down to 15%, as some of our reporting has suggested, that would be perhaps a positive.
Yeah, we know we hear from Volkswagen as well tomorrow with maybe an update on how they're faring with the tariffs, but it's been two back-to-back days of pretty solid gains for these German car makers. BMW up 1.6, Mercedes up 1.5. So decent day for the autos and also for the earnings story with those banks really lifting the index this morning.
Yeah, absolutely. Deutsche Bank up by more than 5%, BNP Paribas up by more than 2%. So both of those businesses, stories that we've covered, and fixed strength seems to be a feature of both of those. Now, we're just getting the PMI data coming through for France, Valerie, and the manufacturing number has come in a little weaker than expected, but it is a step up on the prior number. And the services number comes in a little stronger than expected, a little bit of a step up on the prior month. So a bit of improvement sequentially, perhaps here, but certainly not blowing the lights out.
Yeah, I think you're right to note that it has been a sequential improvement because last month we really saw a decent recovery, not just in France, but in Germany, in the broader Eurozone numbers as well. So that beat, a slight beat when it comes to French services, maybe foreshadowing what we're going to get from Germany in 15 minutes time, where we could see services enter an expansion territory that's above 50. But for now, it seems like the euro move on the euro is pretty contained, maybe a teeny tiny nudge higher. But we await the German numbers at 8.30 and the broader Eurozone numbers at 9.
Yeah, and if you look at the composite number, the jump up, the outperformance versus estimates looks bigger than if you look at just the manufacturing and services. So clearly something in the maths there. But interesting to note, we're not seeing too much movement, a bit of movement in the euro, as Val points out. Coming up on the programme then, European banks snatched the spotlight today with a raft of earnings, including the beat from Deutsche Bank. We'll dive into the results next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch
Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onin, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Welcome back. This is the opening trade. We are 19 minutes into our trading day this Thursday, the 24th of July, and European equity markets on the rise. And part of the story, part of the optimism is trade tariff expectations, and part of it is earnings, and in particular from the banking sector. Deutsche Bank shares are on the rise this morning. Fixed income traders joined Wall Street peers in reaping the profits from volatility following the U.S. administration's tariff announcements. Deutsche Bank CFO James von Moltke spoke to Bloomberg's Oliver Crook a little earlier.
Well, FX was actually very strong. It was probably the strongest point, and macro generally, so rates as well. Although it was a complex quarter given the way it started. Credit was a little tougher in the environment, for sure. Our performance we're really happy with, a very strong finish to the quarter. And you have to remember in all our results that foreign exchange translation is a burden and a benefit for some of our competitors across the Atlantic.
The strong finish of the quarter, going into the third quarter, what are you seeing?
We're seeing good activity, good performance. Now, it's obviously early in the quarter to talk about it in July, but in terms of both the FIC business, fixed income and currencies, and our origination advisory business, good start to the quarter, and that gives us some real confidence about what lies ahead in the second half.
And what also may lie ahead is a buyback. I know it's sitting now with the ECB. Analysts are expecting something to the tune of about 400 million euros. Is that broadly in the right ballpark?
We can't comment on size, but we're pleased to be in the position to have submitted only a couple of months ago now the application to the ECB. There's a process that we go through, so we can't speak to size at the moment. But we were pleased to be in a place of incrementing the originally announced buyback and executing, in a sense, throughout the year.
And so your base case is to be able to deliver on that buyback by the end of this year?
Absolutely.
Okay. And in terms of tariffs, I'd like to get, we've been talking about tariffs for a while now.
We have.
I'd like to talk to you about the idea that, because you're talking about it's holding back corporates, right? But there's also this underlying kind of bullish sentiment within Germany, a lot of investment and a lot of private investment also coming in that we talked about a little bit earlier in the week. Is there a sense from you that there's a lot of pent-up business that's just sitting on the sidelines? Can you give us kind of an idea of what kind of volumes we're talking about and what it would mean for you?
There is. Hard to translate into volumes because it's a bit of a guess.
But in the event of a deal, do you see just a huge flow?
We do. It's so this uncertainty, it's fascinating talking to clients. The impact on any given client's business of the tariffs, whatever the arrangement will be, can be very varied, depending on the foreign content and what they sell in the United States, depending on where the manufacturing takes place, how much intellectual property, and the supply chain underneath it. So it's a very varied thing. But as a consequence, until people see sort of what the final agreement is, it's very hard to make investment decisions. And so that is absolutely holding people back.
Deutsche Bank CFO there, James von Moltke, speaking to Bloomberg's Oliver Crook. Let's bring Ollie into the conversation, shall we? He has, of course, been talking there to James von Moltke and can give us his reflections on the conversation. Ollie, what stood out to you?
Yeah. So Anna, listen, there's obviously the numbers that stood out with FIC beating up 11%. That is better than anybody really had anticipated in terms of what we were expecting from Deutsche Bank. They've been consistently beating on FIC, which is obviously the sort of investment bank division that everyone's really sort of very focused and preoccupied on. Positive news on giving back a buyback. But I think what's really interesting for Deutsche Bank is there are a lot of these sort of structural tailwinds, a lot of things that will propel this business potentially for a very bullish story in the next couple of months. And you're seeing that reflected in the stock move today. Up almost 6%. 6% today. That's the biggest move since April the 10th, when basically the tariffs from the United States were delayed. And when we go through some of those bullish sentiments, you have the Buy Europe trade. When I spoke to the CFO, James von Moltke, he says that is very much intact. This idea that conversations he's having with clients, not just in Germany, but across the world. He said he was in Australia and spoke to a lot of institutional clients there, looking for ways to gain further exposure to Europe, to reduce a little bit of that exposure to the United States in the wake of all that volatility. Of course, there is the question of a tariff deal, which we may be potentially approaching for the Europeans, getting a trade deal with the United States. That, again, would see a huge amount of money that is currently sitting on the sidelines in Germany, and sitting on the sidelines for a very bullish story in Germany, where we've talked about the government unleashing hundreds of billions of euros potentially in spending. So all of these are sort of very structural tailwinds for Deutsche Bank going forward. And again, that is something that seems to be cutting through to the market there, up about 6%. And let's say nothing of course, all of the macro uncertainty. One of the things that certainly will get a lot more spending over the next couple of years is the defense sector. And that is a sector that Germany is quite exposed to with a number of different stocks. And that is something that Deutsche Bank is trying to gain additional exposure to going forward.
All right, Bloomberg's Oliver Cook on the latest on Deutsche Bank. Let's broaden out the bank's focus now. We've had many banks reporting this morning: BNP Paribas, Sabadell, and Lloyds also out with results. Joining us now is Tom Metcalf, who leads Bloomberg's EMEA finance coverage. Tom, do we have a decent overall picture now of how European banks are faring?
Yeah, well, we've had plenty of banks reporting, and I would say, yeah, a bit like Deutsche Bank, most of them probably pat themselves a bit on the back, with the shares across the board are up. And, if you take Sabadell, they've come out with a very clear plan for how they should stay independent. They're obviously fighting off a takeover attempt from BBVA. And then in Lloyds, great bellwether for the UK economy. Again, very, very benign. They're not seeing any kind of big losses sort of bubbling up from consumers. And so broadly speaking, again, positive news story there.
Yeah, we're going to have a conversation with the CEO at Lloyds Banking Group a little bit later on. Sticking with other banking themes, we had numbers from BNP. We spoke to the CFO there. That stock up. A great deal of confidence about the trading revenues that they have achieved and what can be repeated into coming quarters. I mean, I guess nobody knows, because we don't know what kind of volatility we'll see in markets. But we do seem to, we heard it from David Solomons as well, quite positive about what's repeatable in those businesses.
Yeah, very bullish sentiment, I thought. And again, on the fixed income side, for me, the BNP Paribas results, again, very strong. The only interesting thing there was they also have an equities trading division, and that actually declined, which is completely counter to all the US banks were doing. So that was kind of an interesting sort of outlier. But again, broadly for BNP Paribas, it's positive news.
Okay, thank you very much, Tom. Thanks for joining us. So we've got mixed fortunes, perhaps, for the banking sector in terms of where their share prices are moving. So BNP is up, Deutsche Bank is up really strongly, up by 6%. Lloyds Banking Group down by 1.5%. And as I say, we will be speaking to the CEO of that business a little bit later on. Now, sticking with the UK, coming up on the programme, the former star trader Tom Hayes joins us next, following the decision by the UK Supreme Court to overturn his conviction for rigging LIBOR benchmark rates. This is a story that goes back more than a decade. It resulted in the abandoning of LIBOR as a global benchmark. It had far-reaching consequences for the financial services sector, and certainly, personally, big consequences for Tom Hayes because he went to prison initially. So we will certainly look forward to our conversation with Tom Hayes. That's coming up shortly. This is Bloomberg.
Bloomberg launches our inaugural 25 African startups to watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator and pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
This is the opening trade. It is 8:30 on this Thursday morning. And this is a picture across European equity markets then. Really quite positive. A lot of expectation around tariffs seems to be building into markets. Although maybe we're off earlier highs. But expectations around tariffs seems to be the big driver, and earnings. Valerie, we've got some breaking news coming through from the German market.
Anna, let's take a look at how these PMIs are faring. We had the French ones. There was a slight beat in those numbers, but it does look like we are having a miss when it comes to German manufacturing PMI, rising 49.2. The forecast was for a print of 49.5. The composite also coming in weak, Anna, falling to 50.3. The forecast was for 50.7. So at least the composite is in expansion. Oh, services PMI also entering expansion. A slight beat on the services figure, Anna, rising to 50.1. The forecast was for 50. It does seem like there is not a lot of movement in FX space off of these numbers. We do await the broader Eurozone numbers to come in around 30 minutes time. We also get the flash PMIs out from the UK and the US later. Anna?
Yeah, absolutely. So waiting for further data, also waiting for an ECB rate decision later on today. So no doubt those trading euro are watching that very carefully and closely. Now, let's change pace slightly on this program. Tom Hayes, the first banker to be jailed over the LIBOR rigging scandal of 2015, has won a bid to overturn his criminal conviction, clearing his name a decade after he was sent to jail. In a stunning reversal, the UK Supreme Court yesterday quashed the convictions of Hayes and ex-Barclays trader Carlo Palumbo. The court allowed both appeals, stating that the juries had been misdirected by judges at both criminal trials. Tom Hayes, I'm pleased to say, is with us now here on set. Good morning.
Morning.
You've had a really busy time, talking a lot post this decision from the Supreme Court. It must. Have you found the words? Yesterday you said it was difficult to sum up how you felt outside the Supreme Court. You'd had a lot of time to think about it, but have you found the words to describe how this feels?
Well, I've had 4 hours sleep now. It's sinking in. I actually found out the decision 24 hours ahead of the announcement in court, so I didn't quite have the drama of the announcement in court and going wow, because I knew what it was already. But yeah, I mean, I'm still wondering whether I need to email my probation officer to see whether I should be meeting her next week. But it does feel a little more real today than it felt before. I think actually having the piece of paper in your hand makes it more real. Yeah.
And so this has made a huge difference to you. Clearly, it will perhaps make a difference to others who found themselves in a similar position. Have you talked to any of the other traders who were also convicted at the same time?
Yeah, all of them. I mean, yeah, all the other 7 convictions, they all need to go. And I really, this is a battle in a war and we've won the first battle. I don't see really how the SFO and the prosecution can contest the appeals of the other 7, because none of them should have been convicted. None of us should have been convicted. So,
and are they going to challenge them in the same way? Do you think?
From speaking to them and without wanting to sort of, preempt what they might do, I would be very, very, very surprised if they don't.
Okay, so that's the conversations you've had, and I know you've also said it's too early for you to say what comes next, because you're still dealing with the news flow, thinking about this decision. Do you have any thoughts about where it goes? I mean, do you have a future in trading, a future in banking? Is that where your aspirations still lie?
I've got friends who run funds over in Hong Kong and stuff who I might be able to go and work with, whatever. I've got no idea right now. I mean, to be honest with you, I don't quite know my regulatory position, because the last thing I had from the FCA was they tried to ban me for life, and that was stayed by the courts. That should not now go ahead because I've had my conviction overturned. But, I just don't know where I stand from a regulatory point of view, certainly in this country, even though actually the Japanese regulator where I worked didn't actually sanction me on any basis. So it's all a little confused at the moment, I would say.
Are you looking to get to the bottom of that, about where you are allowed to work? You mentioned Hong Kong. Are you looking to get some sort of resolution? Because maybe that sounds interesting, to stick in the financial services sector.
I don't know. I've worked out in Asia for a long time, in Japan. And, I need to really sit down and have a think, because I've been out of the markets for 15 years, so that is basically a lifetime. I talk to my friends who are still in the markets, and they tell me things that, I just think, I didn't even know that, I didn't know that, I didn't know that. I mean, markets move so fast, and we've gone from, from what I understand, is a lot more. It's a lot more automated market making, algorithmic stuff than it was back in my day, when Microsoft Excel was king. So
it's changed a lot.
Yeah, would need to catch up.
You've been through so much in the last 10 years, 15 years even, Tom. Do you ever wish that? I mean, you changed your plea early on in the process that might have led you to go to prison for less time. Do you ever look back and think, maybe I should have not done that and played it differently, and this would have been over a lot sooner?
I mean, it's a thought process I've had a lot, because I was on a cooperation programme which would have entailed me giving evidence against my co-defendants and pleading guilty, and I did that, and I made false confessions in respect to that to avoid a 200-year indictment and extradition to the US, which ironically I would have been better doing, because I would have been exonerated at a far earlier date. But I don't regret that decision, because it was a contributory factor in all my co-defendants getting acquitted at a separate trial. If I'd had to lie about those guys and they'd gone to prison, I don't think I could have lived with that. So, when I was in prison, I felt like I was doing 1 year for each of my co-defendants. It also meant I was in a conspiracy of one to manipulate a rate that I didn't even choose. So it made it sort of a bit even more nonsensical.
Do you feel, you use the word exoneration there, do you feel exonerated by what happened in the Supreme Court yesterday? I mean, clearly the conviction has been quashed, so that's, victory. But in terms of the language that they use and some of the wording, do you feel exonerated?
I do, because the issue in our case was falsity was never put to the jury, and we never put rates forward as submissions or asked for rates to be submitted that were false. Were they commercially influenced? Yes. We can have a morality trial about that. That was a system. The benchmarks were set up by the banks for the banks. Every bank had, a commercial interest in the rate that it submitted. Every trader who submitted a rate traded products that was attached to the rate. The whole thing was just badly set up. And it's all very well after the event 10 years later to say, well, we don't like the look of this and somebody's got to go to prison for it. But no one lied. When people talk to me about, what about your managers and this, that and the other? But I'm not running a Nuremberg defence. My managers shouldn't go to prison either. I mean, because nobody lied about the rates. I mean, they were all rates that were offered and you could borrow at. So what would you do? Roll a dice? Toss a coin? Or just say, well, I've got a fiduciary duty to my employer to do the best for them.
And has this whole thing left us with quite a lot of grey area, I suppose, is my question, Tom? Because what the jury said, what the Supreme Court said yesterday is that in each case there was ample evidence, and you know these words, on which a jury properly directed could have found the appellant guilty of conspiracy to defraud, but the jury was not properly directed. So the judge should have left the jury to decide, but he didn't, and so now we don't know what the jury would have decided. Would you have hoped for something that was a bit less grey?
No, I think that's fine. I mean, because we made commercial requests, and if the jury had taken the inference that commercial requests was in some way false, they could have convicted us. But the other evidence points squarely away from that. The other evidence where I actually say in emails, you know, I don't want something that isn't a true number, is there. And so one thing is I think instructive, which is the fact they haven't sought a retrial. Because I sort of actually wanted a retrial, to be honest. A retrial with fair directions and a whole load of things that happened in my trial beyond that, including people who subsequently changed their evidence, unqualified experts, which the prosecution knowingly instructed and paid £400,000 to. All of those things would not be in another trial. And so I think they're perfectly entitled to say that there was ample evidence because there were lots of requests. Yeah. And how the jury interpreted the request would have been up to them.
Yeah, and the SFO has said that no retrial will take place, as you say, because it's not in the public interest. So, will you consider taking other legal action, Tom? Is that something you're exploring, talking to lawyers about?
I've had so many lawyers in my life for the last 13 years, and I've still got lots of lawyers in my life. There are discussions about what avenues are open to me in that regard. I mean, certainly in the US, the guys who were exonerated by the Second Circuit in the US, they all took their former employer banks on a civil basis, and there's been settlements reached in all of those cases. So I don't know. I mean, look, I'd just best to leave it to the lawyers. That's the go-to words of my last 13 years.
Yeah, and stepping back from what you've been through, Tom, and what the industry has been through, I suppose, because it isn't just you, it's others. Yeah. And as we've just discussed, there's still this. Maybe there's too much grey, although you say it's fine. I mean, what lessons should we take? This was all post-GFC. This was a very heated political environment where people wanted answers and people wanted somebody to pay a price for what had happened. That's the context in which this took place, I suppose.
Yeah, I mean, we were vilified. All bankers were vilified. It was ridiculous. If you look at this, you know, the so-called FX fixing scandal, you've now got 0 convictions on the back of that. Soon, hopefully, we'll have 0 convictions globally because of LIBOR. You know, we were scapegoated. We were accused of causing the global financial crisis, which we had nothing to do with. How, you know, Japanese yen LIBOR moving around by 1/1000th of a percentage point had anything to do with the global financial crisis is completely beyond me. But the narrative that was driven and the false narrative that's been so hard to turn around from a public perspective, not necessarily in the markets. Anyone in the markets generally knew this was just, you know, ridiculous. Because anyone who's traded in the cash markets knows that you've got a number of offers and you can choose one of those offers. And, you know, like the mechanism for choosing them isn't prescribed. And actually, the banks, the other derivatives traders setting the rates, you know, and it was sort of par for the course to set the most commercial advantageous rate. So I just think that, yeah, we were definitely scapegoated.
Yeah, I mean, you weren't surprised to see the back of LIBOR then, given what you've been through and how you describe it worked.
Well, actually, the replacement they made immediately after, which is where they placed the submission process, you know, behind the Chinese wall, that person had no idea of the bank's commercial positions, was totally fine. And I don't think they didn't need to move to SOFR, the secured overnight funding rate. I thought that was not necessary, because now you've removed that element of credit, of bank credit, that LIBOR always carried inherently. Yeah. You know, so swap spreads and stuff like that have all sort of disappeared. So I think it's a shame. And it's interesting, you know, Euribor didn't go. They kept Euribor. So yeah. I think, obviously, the US wanted to pull their benchmark. To do with it.
You sound like a person who's still... To go back to where we started the conversation.
I think they never leave you, do they, really?
It gets in there somehow. Can I just ask you, we've heard talk that somebody might be making a drama out of this. There might be plans to film it in some way, a film or a TV series. Is this something that you've heard about?
Yeah, there's stuff going on in that regard, but yeah, I can't talk about that at the moment. So,
okay. Any thoughts on who might play you?
I don't know. They'd have to be in their early 30s or mid-30s, because it started for me when I was sort of 26, so they'd have to go through from 26 to 46.
Okay.
So I wouldn't mind who played me.
We're looking for someone with that range. Thank you so much for coming in, Tom. Very good to speak to you. Nice to have you with us on the programme. Tom Hayes, former UBS and Citi trader, of course. Coming up on this programme, we'll get back to some of the corporate earnings stories. Charlie Nunn will be with us, the CEO of Lloyds Banking Group. We'll get into what that business has reported this morning, what it says about the UK economy. This is Bloomberg.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look at what's happened is because the interpretations of AML, Anti-Money Laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to the opening trade. 46 minutes into a session that looks really positive, up by 0.9% at least on the Xetra DAX. The FTSE a little bit weaker than that, and in fact the CAC came on a little weaker, but there's still this optimism around trade and the earnings story certainly permeating. Let's get to that then. We've had numbers out from Lloyds Banking Group, second quarter pre-tax profits coming in above estimates of £1.99 billion, and the guidance reaffirmed for 2025. Also talking confidently about 2026 guidance. The stock down a touch this morning. Let's bring in Charlie Nunn, the CEO of Lloyds Banking Group, who's with us this morning. Charlie, a very good morning to you. You say you're confident about 2026 guidance. You're reaffirming the guidance today. Any weak spots in the earnings at all then, or is it an entirely positive story you're telling?
No, I think it's a strong performance over the last quarter and, in fact, over the last year. I think critically, we announced a strategy pivoting back to growth, really innovating for our customers, winning market share. We've seen 6% year-on-year growth in revenues, 9% on other operating income. And in the core businesses, mortgages, transport, pensions, infrastructure investments, we're winning. So it's a good foundation for the next 2 years, and we reiterated our confidence for 25 and 26, as you said, and also announced a 15% increase in our interim ordinary dividends. So good capital generation and returns to shareholders.
When I think about your business, I don't necessarily think about tariff impact, but of course any banking group that serves an economy is going to face tariff impacts in some form. You say in your release today that the tariff-related £100 million central adjustment was released. Tell us a little bit more, if you can, about what that is, how the tariff story impacts you.
Yeah, so just the broader economy, maybe just start there. We've announced today slightly updated forecasts. We've for a while had what we call a very resilient but slower growth economy. We're predicting about 1% growth in GDP this year. The tariff impact since the start of the year, mixed with some other factors, probably had about a 0.2% reduction for the UK in that context. So meaningful but not huge. And the adjustment we were talking there was around the accounting adjustments for our ECLs, our impairment line, which is a smaller part of that view. Look, underlying that, what we're seeing is the UK economy has some real strength. So UK households have increased their deposits and savings 6%. Businesses, small and large, we're seeing stronger cash flows, and there's actually quite good business confidence in the UK. So our hope is, and sort of our ambition, working with our customers, working with the government, is actually we can get to a higher growth trajectory, building on those strengths.
Charlie, you sound quite positive about UK growth, about your business. Why didn't you raise guidance at this time around?
Well, we already had very stretching guidance for this year and next year. We've always had a view, working with our board, that we wanted to be realistic and stretching in our ambition. Our 2026 ambition is for our investors to get to 200 basis points or more, greater than 200 basis points of capital generation, and a 15% return on tangible equity. So we're heading in a very good pathway towards that, and we very much believe in setting ourselves stretching ambitions, which we then deliver, and that's what we've done again this quarter.
Charlie, I guess one overhanging concern for investors is the provisions you've set aside for motor finance. I see that you haven't changed that provision. It still stands at £1.15 billion set aside for those remediation costs. We're yet to hear from the UK Supreme Court on this ruling. They're due to rule on it this month. Is that reflecting positivity, the fact that you didn't necessarily increase your provisions set aside?
No, I think it's what you said. Actually, the new information we're waiting for is both the Supreme Court, maybe next week or the week after, is what is most likely. And then critically, actually, our regulator, the Financial Conduct Authority, has said that they will then come out with their view, which is probably even more important for what it means for customers and what it means for us. So no new information at this stage. The provision we've done, we think, is our best estimate. It could be higher or lower than that. And we'll update if there's any new information and when it's right to do so.
Charlie, we've heard quite a bit from the government on its plans for financial services recently. There were the announced Leeds reforms on the same day as the Mansion House speech. The detail is interesting, but in terms of the bigger picture, we spoke to Nigel Wilson recently, who said we don't live in an investment culture in the UK. We have a savings culture, and we need to pivot more towards an investment culture. Is that a sentiment that you recognise? Does your thinking fit along those lines?
Yeah, I mean, so first of all, I really welcome, and we really welcome the Mansion House reforms. Having a government thinking about longer-term growth and competitiveness for the real economy, and then also for financial services, as one of the most important sectors, we think is going to be really good for the trajectory of the UK over the next few years. Now, in terms of investments, we definitely agree there's an opportunity to support more people in the UK with investments. Some of the changes since the financial crisis have meant that advice around especially equity and debt investments is really limited to those who are wealthier. And actually, everyday people need to have more access to that service. So there's some specific changes within the Mansion House reforms that we think can extend that. And we, of course, also have a leading pensions platform, over £200 billion worth of pensions money being managed for our Scottish Widows business, which is growing well, which is a brilliant way to provide access to customers to take risk appropriately and manage their longer-term financial resilience. So very much welcome the focus on that. The one thing I would say is, people need to have a holistic view of their wealth, savings alongside investments. And then in the UK, real estate is such an important part of wealth. if you just take a step back, there's about 7 to 8 trillion pounds worth of real estate which isn't mortgaged. And that's by far the biggest investment and wealth asset in the UK. There's about 2 trillion of defined benefits, 1 trillion of defined contributions, and then cash and investments are actually smaller than that. So to really support customers, you need to be thinking across those areas. And the great thing for us is we're a leader in all of those, in mortgages, in pensions, as well as helping manage cash and bring investments to UK society and UK households.
Charlie, you mentioned pensions there, and we can talk about this proposed pension reform that the UK is looking at, maybe forcing pensions or tempting pensions to hold more UK assets. I see you've been quite critical of that kind of reform, calling it capital controls. Do you have any words of advice for the government of what kind of pension reform you think would be useful for the British people?
Well, we think the real focus here needs to be on helping people invest appropriately, and that's what we've been focused on. And we really welcome the government's focus on trying to invest more and invest more in the UK. And at Scottish Widows, that's exactly what we're doing. So we have over 21.5% of our Scottish Widows assets invested in the UK in both public and private equities. And we think actually providing choice to our pensioners and trustees is at the core of that, and that's very much what we're focused on. Now, as you know, the UK probably represents, it depends on the asset class, 2 to 3% of the world's investable assets. So there's a great opportunity already that we're taking advantage of to create a bias for our pension customers to the UK. And we've just announced the launch of our long-term asset fund, which is going to provide additional opportunities for our pension customers to invest in the UK going forward. So welcome the direction of the government's plans around this. We think we can do that as a competitive pensions provider very successfully, and we're proving that so far.
Charlie, thank you for joining us. I know it's been a busy morning for you. The CEO of Lloyds Banking Group, Charlie Nunn. The European Central Bank is set to leave interest rates untouched at 2% for the first time in more than a year as it awaits clarity on what President Trump's tariffs will do to inflation. Bloomberg's Lizzie Burden is outside the ECB headquarters in Frankfurt. Lizzie, set us up for this decision.
Hey Val, well, it looks like if you look at our survey, all but 2 economists see a hold from the ECB today because by September they'll have more detail on trade, hopefully, more data and certainly those new forecasts. So they should have more clarity by then. But this US-EU trade deal that's potentially just around the corner, according to our reporting, could be what decides whether today starts a hold or the end to rate cuts. Economists at Berenberg and RBC say that if you get a 15% tariff deal, you wouldn't need to cut again. But our economists at Bloomberg say that even if you got 15%, that's higher than the 10% that was in the June forecast from the ECB, which had suggested you'd still have a cut in September. And you've still got to factor in the sectoral levies. So our economists say that you'd still need cuts in September and December. Look, there's a lot of uncertainty out there. I think, Val, that Christine Lagarde is going to keep her cards very close to her chest today. I'll be interested to hear what she says on the euro, particularly after Luis de Guindos told us at Sintra that 120 is the level that complicates matters for the euro area economy. I don't think Christine Lagarde will be as precise as that. And she's also making this argument that the euro needs a bigger role on the global stage, so hard to put the two together. But what I will be listening for is if she's a bit more humble about how good a position the euro area economy is in. The last time sounded a bit like a victory lap. If she emphasises the downside risks to growth, the market is going to seize on that as a sign that a September rate cut could be on the table.
Lizzie, thank you. Bloomberg's Lizzie Burden outside the ECB. So, Valerie, the end of the programme, time to take stock. You're disappointed by the performance of chips this morning.
I am. ST Micro down 12%. This comes alongside, we just heard from Alphabet about their increase in CapEx spending, boosted NVIDIA and Broadcom in the session yesterday, but doesn't seem to have that much of a fall through to the European chip makers today.
Yeah, absolutely. But European stocks are moving higher. The stock 600 up by 0.5%. That is it for the opening trade. I'll be here with the pulse next. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Global stocks continue their record-breaking run on signs the US may soon strike a trade deal with the EU. Fixed income trading boosts Deutsche Bank and BNP Paribas as both lenders benefit from market volatility. Plus, the ECB is expected to pause rate hikes for the first time in over a year as it awaits clarity on Trump's tariffs. Welcome to the program, everybody. It is 9 o'clock this Thursday morning. Let's have a look at a host of assets for you and how they're trading. S&P futures entirely flat, not doing much justice to the news flow, I have to say, because there is a lot to talk about this morning. It's not really reflected in US futures. It is reflected in European stock markets. We'll come to that in just a moment. Euro dollar pretty flat at 117.64. We've had some data on PMIs. That's been building as we've been going through the morning. We'll come to that in a moment as well. And oil prices, generally supported by the tariff narrative, it would seem, up by 0.8% this morning on the Brent price. I mentioned that there's been plenty of news flow. Let's have a look at the European equity market map to see how it's been responding. Well, it's a pretty positive day. The Stock 600 is up by 0.5%. The CAC 40 is a bit of a laggard, actually. The FTSE up by 0.6%. The Xetra DAX up by nearly 1%. And this all on the combination of tariff expectations. Will it be 50% for EU-US? And also the earnings stories. Let's get to some data that's been breaking. The Eurozone July composite PMI completing the picture of what's happening in Europe. That composite number rising to 51. The forecast was for 50.7, so perhaps at the margin that's a little bit better than had been anticipated. We've seen a little volatility in the euro as we got the French number and the German number earlier on this morning, but nothing to really move the dial on what is ECB day, of course. Let's move to some US pre-market stocks. We've got Tesla for you. We had comments, of course, from Elon Musk about how there's going to be some rough quarters ahead. That stock took a dive post-market yesterday and continues in pre-markets, look a little bit weaker, so down by 6.5%. On the other hand, Alphabet is trading higher this morning.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Anna Edwards in London, in for Francine Lacqua this morning. Now, the European Commission president has described relations with China as being, quote, at an inflection point. Ursula von der Leyen was speaking at the opening of a summit in Beijing that China has cut short amid simmering tensions over trade and the war in Ukraine.
As our cooperation has deepened, so have the imbalances. We have reached an inflection point. rebalancing our bilateral relation is essential. Because to be sustainable, the relations need to be mutually beneficial.
Let's bring in our EMEA News Director, Rosalind Matheson, who's been following this and all of the other news flow this morning for us. Ros, good to have you with us, of course. So tell us about the mood music and what's the backstory to this EU-China summit. I mean, the timing of it is pretty weird, isn't it? Because it fits, you know, we're all talking about deals with the US, but this has been in the calendar for a long time, truncated versus earlier expectations. So what's the backstory here?
Well, yeah, this is all about the relationship changes that are going on everywhere. And there has been a desire for a while, both between China and the EU, to improve ties, including around trade, investment and business. And that's motivated by the desire to diversify, essentially, the EU away from the US and China also away from the US. So there's a common, you know, understanding there. But equally, there are so many complexities underlying this relationship, be it on the business and trade front. You heard Ursula von der Leyen talking about cooperation, but also imbalances. Obviously, issues around rare earths are front of mind, which we've written about quite a lot this week. So that's an issue. But also beyond the trade business climate, there's also differences around things like the ongoing war in Ukraine, Russia's war in Ukraine, and China's support, military or otherwise, for Russia in that. So there are tension issues, and they kind of overshadow that. And the natural question is, like, how close can you draw when you have a bit of natural suspicion of each other, in the sense that Europe wants China to open up its economy. China says, we've opened up for you already. And a difference of, like, who's actually the one who's causing the imbalances here.
Yes, and I think our expectations are pretty limited as to what really is delivered by this particular trade conversation because of the complexities you describe. Meanwhile, it's not long until August the 1st. We're focused on the US-EU trade conversations. I know our reporting tells us that a deal could be in sight. Let's just have a listen to how President Trump has been talking about this potential deal.
We've offered such a deal to the European Union, where we're in serious negotiations, and if they agree to open up the union to American businesses, then we will let them pay a lower tariff.
So he's talking quite positively about what's on the table, and certainly our reporting suggests that Europe is really aiming for this 50% baseline tariff, and importantly with some key sectors like cars included there, and cars already have a much higher tariff, don't they? So what are we expecting to see here on trade?
Well, that's right. So maybe 15 is the new 10, perhaps, for everybody. And you can see a lot of countries now saying, well, actually, 15% we'd consider that a result. I mean, it's still, by the way, a 15% tariff, so it's not nothing. But that seems to be what the measure of success, and not just for the EU. But as we know from our reporting, as you say, there is this, they are coalescing around 15%, potentially also for the EU. But there are also those sectoral tariffs, and the question is, can you navigate those down, or can you navigate the parameters upon which they start at 50%? I mean, we're talking cars, steel, aluminum, copper as well. I mean, Donald Trump is still talking about pharmaceuticals and chips. So a lot of important sectors there for the EU that may still face higher tariffs. And as we've seen with the UK-US example, they agreed on a trade framework some time ago, but they still haven't agreed on steel. And that's still bubbling away. And so, you know, you might get a framework understanding, but there's a lot to keep unpicking in that. But it does seem for countries in Asia also, as well as the EU, now aiming for 15% and seeing that perhaps as the, you know, the least worst option for them in all of this.
Yeah, it seems we've moved a long way from full trade deals to framework deals, and from zero tariffs in some cases at least to baselines of 15. Yeah, a lot's changed in the last 6 months. Ros, thanks very much. Ros Matheson, Bloomberg's EMEA News Director. Let's continue this conversation. Natalia Lipakina joins us, Head of EMEA Equity Strategy at JP Morgan Private Bank. Very nice to have you with us on the programme then, Natalia. So how do you greet this news around tariffs? The fact that, well, we're reporting that the Europeans are really aiming, really pushing and hoping for this 15% deal. That would be pretty well received by the markets, or we're already seeing the markets digest that expectation, I suppose, this morning.
Yeah, good morning. Thanks for having me. I think the market is quite optimistic about a potential deal, and we saw the market reaction yesterday in Japan, and the market really perceived the deal very positively, especially on the auto sector. So I think if we do have the deal, the market would welcome the certainty, and potentially that may also mean that the earnings downgrades may stop, because we will know what the path going forward would be, and maybe the market would be able to focus on what happens next in 2026, which is stimulus, more investments in Europe, rather just on tariffs.
Yeah, does 15% feel like the kind of level that might draw a line under this? So it's high enough for the Americans to make some tariff revenue. It's low enough that Europe perhaps does not feel it wants to retaliate, and we get certainty and try to move on. Is that our expectation for the second half of the year, Natalia?
Yeah, I think the tariffs, between 10 to 20% is something that will be welcomed by the market because it's a reasonable enough expectations, but also gives investors the certainty going forward.
Yeah. The other big theme in markets, of course, this morning is around earnings stories, and we're starting to piece together where we see tariff impact coming through. What's interesting is that there are the businesses that are very much exposed, and we're hearing a little bit about that. But actually, away from that, we're hearing a lot about FX impacts on businesses that aren't really exposed to tariffs. And there, the FX impact seems to be quite substantial. Many CEOs always brush off these kinds of questions and concerns and say, well, we don't set the FX rate, so we just have to manage our business on a sort of constant currency basis. Are you expecting that to be something that management needs to start working around the business, change the business to reflect FX, or is that line of argument from CEOs, is that valid?
I think we're already starting to see that with the previous earnings season and now, given the moves in FX. And this is the reason why you see very different guidance from companies that are more domestically oriented in Europe, because they are just less exposed to FX, and those that are the exporters, because the exporting businesses, they do have exposure not just to tariffs, but to FX. And we're seeing that with the companies reporting, they're now stating what the FX impact actually is. Some companies will be hedging their FX risks, some companies will not. But it's definitely a very big theme for the European corporates, because for a very long time we had a strong dollar, and strong dollar was a very big tailwind for those exporters. And now things have shifted, meaning that now the strong euro is actually a bit of a headwind for those businesses.
Yeah, and what's your overall conclusion so far for the European earnings season? It's still early days. We haven't got all the pieces in place, of course, but just this morning we saw quite a lot of companies confirming guidance. Last quarter we saw some of that, but we also saw some companies withdraw guidance completely. Does this feel a little calmer, this quarter versus the last one, or is it far too early to make that kind of bold statement?
I think it was fascinating to see that actually a lot of companies confirmed their guidance in the previous quarter. So coming into this quarter, we actually expected a very similar playbook, that a lot of companies may confirm their guidance, but just make some assumptions about the tariffs. And it's fascinating to see what is happening in two specific sectors, because if you look into financials, both in Europe and in the US, we're seeing very strong numbers. We're seeing good trading, we're seeing deregulation in the US, and in Europe and the US, the AI trade is ongoing. We heard from industrial companies in Europe, the data center growth is very strong. We heard overnight from the mega cap companies in the US about raising of CapEx guidance. So overall, that leads probably to another positive earnings season, and we think that companies will beat their expectations.
Yes, going into this earnings season, once again, looking for reassurance around the AI theme, I suppose. And I guess the takeaway from Alphabet is that we have that reassurance, is it? Because yes, there's a huge amount of CapEx that they need to invest, but they justify it by saying, well, it's because consumer demand is so high. Does that underscore, or does that set the stage for something pretty positive from tech names? It hasn't been the case from all of them, has it? Some of the chip names have been a little weaker.
Yeah, you clearly see the difference between the AI trade and the rest of the market, for example, in auto segment. But in terms of the AI, that we already had this actually positive news last week when some of the industrial companies reported in Europe. They hinted that data center growth is very strong. And that is a great takeaway from the tech companies, for the industrial companies, and also for some of the utility companies as well that are exposed to the AI. So overall, all the companies that have exposure to the AI theme are reporting quite solid numbers.
Yeah, okay, so that's the tech theme. I want to ask you about the banking sector, because that's a sort of standout theme today. From the earnings reports, we had strength, in particular around FICC revenue from some of the big banking names here in Europe. I mean, our first question when we see real strong performance around FICC is to ask the CEOs, is it sustainable? And we often get quite positive responses to that question from senior management at some of these banks. I mean, what kind of volatility assumptions are you making as we go into the second half? Because that's got to be a key driver, a key metric to watch for the banks.
Absolutely. And we saw that volatility in April, May, June. And that's why I think a lot of banks are actually reporting very strong growth numbers this quarter. But I don't think it's just about trading, right? Because going into the second half of this year and the next year, we expect growth to stabilize in Europe and in the US. And that should fit really well for the European and the US banks. And if you look into Europe, there is a lot to actually look vote for the next year is the German stimulus, is the German investment, and the European banks can be very positively impacted by that.
And what are the big themes that you're investing around then, Natalia? I mean, you mentioned some of the German themes, and they've clearly done very well already this year. Is there still that global enthusiasm for that theme, for German defence, German industrials, or do others stand out to you?
I think it's fascinating what's happening in Germany specifically, because just this week we heard the confirmation that the private investment will be 631 billion, which is twice of what the market was expecting before. So if you look into the overall stimulus from public companies as well as the government, we're looking for more than 1 trillion of support over the next couple of years. This is massive. This is really big. And we think that this is the theme that is likely to be dominant in the markets in the next couple of years in Europe. So therefore, our preference for the more domestically oriented businesses in Europe.
Yes, I mean, it sounds like a really positive theme from an investor perspective, something to get behind. The doomsayers say, even when Germany has a big budget, it struggles to spend it. It struggles to get the money out of the door. Is that something that stands in the way of success?
Well, I think that will be a way to see story for the next year, because this year the market focuses on FX story, on tariffs, and we're not really seeing the impact of the fiscal stimulus yet. And that's why I think the market is still looking forward to what happens next. Absolutely, there are concerns around how much will actually be spent, but overall, given the numbers that we're seeing, we're quite positive.
Okay, Natalia, thank you very much. Thanks for joining us. Natalia Libakina, Head of EMEA Equity Strategy at JP Morgan Private Bank. So we talked about some of the earnings stories there. Well, one that was very interesting late in the day stateside was Tesla, of course, and that stock continues to deteriorate a little bit in pre-market this morning, down by 5.8%. Elon Musk, of course, warning of a hard year ahead. Could we have a few difficult quarters? Yes, was the answer to that question on the call yesterday. And analysts noting that the company's near-term outlook then does look pretty difficult. Of course, the big, beautiful bill changed the incentives that exist to buy electric vehicles in the United States, and that still is a big part of the business in the US for Tesla. Now, coming up on the program, the ECB is expected to pause rate moves for the first time in over a year. We'll discuss that with Point 72 Soren Rad. That conversation next. This is Bloomberg. Loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
This is The Pulse. I'm Anna Edwards. Now, the European Central Bank is set to leave interest rates untouched at 2% for the first time in more than a year, as it awaits clarity on what President Donald Trump's tariffs will do to inflation. Joining us now with a preview, Bloomberg's Lizzie Burden outside the ECB in Frankfurt. Set the scene for us, Lizzie.
Well, Anna, as you say, a hold expected today by all but 2 economists in our survey. But what's changed between now and the last meeting is that threat of a 30% tariff on the EU from President Donald Trump. Now, our reporting suggests that actually EU officials are just around the corner from a 15% tariff deal with Washington. But according to our economists, that would still necessitate cuts in September and December from the ECB, because 15% is still higher than that 10% base that was in June's forecasts, which suggested that they would still need a cut in September. And then you layer on the sectoral levies, and so that's why they see 2 more cuts this year. It becomes even more complicated if you have 30% tariffs, of course, because then you have to factor in the EU's retaliation and the inflationary impact of that. It could actually counter the disinflationary impact of the US tariffs. Look, we await the details, as does the Governing Council, which is precisely why I would expect Lagarde to keep to this language about a meeting-by-meeting, data-dependent approach. I'm very interested to hear what she says about the euro. I don't expect that she'll be as precise as Luis de Guindos in pointing to 120 as the level for caution, but listen out for how much she says about the downside risks to growth, because at the last meeting, it sounded to many like a victory lap, where she was saying what a good position the euro area economy was in. Is she a little more cautious this time? If she is, the markets is going to latch onto that as a sign that September could be open to a rate cut.
Lizzie, thank you very much for that. Lizzie Burden in Frankfurt, setting us up nicely for our next conversation. Let's bring in Søren Rader, who is Head of European Economic Research at Point72, and so a good person to speak to about what to expect from the ECB. Søren, very nice to have you on the programme. So I'm guessing that, well, are you one of the economists or the voices in the market that expects a hold from the ECB today? Lizzie was saying there are a few dissenters, but are you with the crowd?
I'm with the crowd. Good morning, Anna, and thanks very much for having me. I do think that, given the tariff uncertainty, there is a compelling case now to wait until the September meeting rather than to act today, given those uncertainties. Also to wait for a new staff forecast, as your reporter Lizzie was saying, that will probably, as things stand today, nudge down the inflation forecast. And so then the interesting conversation will be, is that lower inflation profile something that the Governing Council will still feel comfortable to look through and still keep rates on hold, or will they act on the additional downgrade, which is what we believe?
What's driving that weakness in inflation in their estimates? Is this to do with tariffs and more Chinese product coming to Europe, or what will they use to argue for that downdraft in inflation? I mean, clearly they're back to targets, aren't they, on inflation? It's come down a long way.
It's come down a long way. We expect it to stay probably below 2% also in July at the headline number. The disinflationary increments relative to the June staff forecast, I would say at this stage, are mainly from tariffs, as you say, so a higher effective tariff rate, even on a 15% deal than the ECB staff had assumed in the June projection. And secondly, and probably more importantly, FX, so the euro appreciation.
Yeah, talk to me about the euro appreciation. So Lizzie was saying that, some of the Governing Council members have been quite outspoken about where the pain point is, naming 120 maybe as the area. We certainly hear from a lot of companies this reporting season about what that FX move, the weakness in the dollar and the strength in the euro, what that's doing to them. And these are big global businesses, and it's hurting in the cases that we're hearing about pretty loudly. Does that get through to the ECB? Do they think about that?
Yeah, I do think it does. It gets through to the staff forecast. I mean, if you look at the PMI print out this morning for July, in the commentary, there is some concern among firms, or some mentioning of FX driving down prices. So those disinflationary factors, I think, are starting to show. In the projection, I think, euro is up about 4% against the dollar, 3% on a trade-weighted basis relative to the assumptions in the June staff forecast. We think that's worth about 1/10 on core and headline inflation. So that's about the elasticity that we're working with. It's not at a level where there would be outright concern of missing the target, for too long and having to go accommodative, but still something that, combined with the negative tariff news, we think the ECB will want to lean against if things don't change from here.
Yes, and let me ask you about that potential for negative tariff news. As Lizzie was saying, there's been this threat of a 30% tariff. A lot of our reporting suggests that, both sides are trying to come to some terms, agree some terms that look more like 15%, and maybe even taking in some big important sectors like autos. What would that mean, a 15% tariff baseline? What would that mean to the ECB?
So to the ECB, I think like I said, the staff forecast in June was predicated on a 10% rate. So relative to that, it would be worse. It wouldn't be, I think, the end of the world. And also we need to see details, obviously. Like, for example, there were a number of categories that may or may not get exempt: aircraft, spirits, medical devices. So what fraction of trade gets exempt? What's the effective increase in the tariff rate? Is it going to be closer to 10 or closer to 15? My hunch would be the latter. Then there are some questions about sectoral tariffs. Will that be known by the time of the September Council? I'm not sure if we'll know what the pharma tariff rate will be, for example. So I think relative to the ECB, it's probably still bad news. Relative to market expectations as they were shaping up last week, it's probably good news.
Yes, indeed, and that seems to be why the market yesterday and today has responded so positively after the Japan deal. So are you expecting 2 rate cuts then from the ECB? I mean, we've just talked about a whole range of things that might happen, so maybe it's difficult to have a base case. But Lizzie was talking about September and December. For some people, they see rate cuts then.
Yeah, I think that at this point is probably the minority view. I think at 175, which would be the rate they're at with one more cut, they would feel they're sort of towards the lower end of what they consider as neutral. Going beyond that, I think, would require them to see really downside risk and, maybe recession risk or persistent undershooting that would prompt them to go into accommodative level, and don't see them going there. So one more cut.
Yeah, I mean, what's the link between the tariff number we get and recession? I know recession and 2 quarters of negative growth is a very academic exercise because you can be nearly in recession and that still feels pretty gloomy. But what's the link between the rate of tariff that we get and how quickly or for how long we end up in recessionary conditions in Europe?
Yeah, so I can talk about my own forecast. We have a drag from tariffs of 0.6% on the level of GDP in the euro area, condition on a 15% tariff rate, which has been our post-Liberation Day assumption as it happens. I think the ECB has a slightly bigger drag from tariffs, and they would have to go a little bit higher, so maybe revise down by a couple of tenths, the growth profile. So that will be mildly disinflationary, but it doesn't get you to a place where there's fear of recession, particularly looking ahead at 26 and the fiscal stimulus that was discussed in the previous segment.
Yes, and does that leave France as the sort of weak link in Europe then? Because Germany clearly has the firepower to try and do something about the challenges it's facing, and we're seeing a lot of that in terms of fiscal spending. Spain and Italy had been telling very positive stories over the last year or so, whereas the French narrative is a bit more complex. Is that the weakness at the moment for Europe?
Absolutely. So, if I had to place a bet today, I'd say Germany is going to grow well above 1% and above the current Bloomberg consensus. France is going to grow below 1%. Certainly, if they were to enact the fiscal consolidation that Prime Minister Bayrou is proposing, I don't think that will happen. But even if they consolidate by 0.5% of GDP rather than by 1%, I think that would be enough to push growth below the current assumptions that the government is making, below 1%, and that gap opens up between France and Germany.
Yeah, and you don't think they do that fiscal consolidation because you just don't think the politics will make it work?
It won't go through in Parliament, is my assumption. So that is one. I think, secondly, it will be very hard. It would be an unprecedented fiscal consolidation.
Okay, Soren, thank you so much for joining us. Soren Rader, Head of European Economic Research at Point72. Great voice to speak to ahead of the ECB meeting then today. Coming up, Tesla boss Elon Musk warns of rough times ahead for the EV maker following lackluster earnings. More on that next. This is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
the theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows, up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Welcome back to the programme. Good morning. This is The Pulse. I'm Anna Edwards in for Francine Lacqua here in London. And these are your top stories. Global stocks continue their record-breaking run on signs the US may soon strike a trade deal with the EU. Fixed income trading boosts Deutsche Bank and BNP Paribas as both lenders benefit from market volatility. Plus, the ECB is expected to pause rate cuts for the first time in over a year as it awaits clarity on Trump's tariffs. Let's get to some breaking news around the UK economy then. We've had numbers coming through in terms of the PMIs for the UK. I can see the composite number has come in a little below where the prior number was, still in expansion territory, so it's come in at 51. That's below the prior. It's also below the survey, so that perhaps a little bit disappointing from a composite perspective. Looking at the services number, that does look to be the area of weakness. Of course, that matters most for the UK economy, being predominantly services, 51.2. So again, services still expanding, but not as much as before and not as much as had been anticipated. Manufacturing actually doing better than prior and better than survey, but that's not where the balance of action is in the UK, no doubt. So you can see a bit of movement in the pound, the British pound against the dollar, a little bit weaker this morning at 135.56. Other things on the move, bank shares certainly on the move. Shares in Deutsche Bank jumped as earnings beat expectations. Deutsche's CFO, James van Moltke, says clients are delaying investment decisions due to trade uncertainty.
So this uncertainty, it's fascinating talking to clients. The impact on any given client's business of the tariffs, whatever the arrangement will be, can be very varied, depending on the foreign content and what they sell in the United States, depending on where the manufacturing takes place, how much intellectual property, and the supply chain underneath it. So it's a very varied thing. But as a consequence, until people see sort of what the final agreement is, it's very hard to make investment decisions. And so that is absolutely holding people back.
Let's bring in Bloomberg's Oliver Crook, who was speaking there to Deutsche's CFO and joins us now. Ollie, what stood out to you from your conversation there with Deutsche Bank?
Yeah, I mean, I think the question of tariffs is really dominating discussions all over the world, and certainly for the banks across the world. I mean, it's certainly helping the trading desk, a lot of the volatility. That's what we saw at Deutsche Bank with the investment bank and FICC trading up 11%, really beating estimates. That's really a large focus for the market, and obviously the market taking that very positively with the Deutsche Bank up about 6% today. One of the biggest moves we've seen this year in terms of the stock. But again, it's not just the sort of quarterly numbers that were quite positive. There is a longer term, and I think a longer structural sort of tailwind tailwind that Deutsche Bank is enjoying right now, while the issue of tariffs is holding back corporate spending. If you do get a deal, when I was speaking to the CFO with the United States, there is a huge amount of money that is sitting on the sidelines from the corporates that is being sort of bolstered by the fact that we know the German government is going to put hundreds of billions of dollars of work. The private sector wants to match that and sort of build some of the momentum that the government is putting out there. That is sitting on the sidelines. That is something that could come in a little bit later in the year. He was saying that also Deutsche Bank is benefiting from this buy Europe trade, sell America. The clients he speaks to all across the world, he said he was in a long trip in Australia talking to a number of institutional clients who are looking to gain more exposure to Europe and less from the United States. There is the question, of course, of defense spending. Deutsche Bank is singularly well positioned to benefit from that with a lot of the large defense players here in Germany. So these are all sort of very structural sort of tailwinds pushing forward, for Deutsche Bank, able to tell a fairly bullish story this morning, and something that the government, the market is certainly supporting, with the stock moving so much to the upside of more than 6% right now.
So the reaction in market is really positive, and in the near term, a lot of focus on that FIC revenue and doing really well there. What's the longer term story then, the longer term plan around Deutsche Bank, Ollie?
Yeah, so this is something we've been talking to the CFO today about, but also the CEO a little bit earlier in the week. And the question is, can they capitalize on some of this momentum, some of this tailwind, to kind of springboard looking forward in terms of making Deutsche Bank sort of a bigger player in one of these European champions that we keep hearing about from Mario Draghi that you absolutely need coming out of Europe? Can Deutsche Bank be that in the world of banking? Christian Zaving earlier in the week was pointing to the fact that this is a bank that has a lot more offerings than some of the other competitors, has a full suite. But again, Anna, when we look at the scale and the sort of difficulties that the Europeans have had at scaling, you go back 25 years, Deutsche Bank's market cap was about half or a third the size of what it was at JP Morgan, which is now an $800 billion company. Today, it is 13 times smaller than JP Morgan, the biggest bank in the United States. So again, is this an opportunity basically for Deutsche Bank to start looking and capitalizing on the business that is going to be coming in, potentially looking at acquisitions within Germany, potentially looking at acquisitions around the rest of Europe, for it to become a true European champion in the way that it might have been, before the financial crisis? That is something that I'm not getting quite the purchase that I would like from the CEO and the CFO. This is maybe a fantasy of the sort of the financial journalist, but increasingly I think this is a fair question when you think about the volume of money that is going to be flowing into Deutsche Bank over the next couple of years with the initiatives from the German government.
Okay, the creative minds of financial journalists. Ollie, thank you very much. Oliver Crick with the latest there on Deutsche Bank. Let's stick with the banking sector. BNP Paribas shares are also up after it reported better than expected profit, largely thanks to the company's fixed income traders. Once again, that's an area of strength. They offset a 15% fall in equities revenue. Here's what the CFO told us about the potential impact of US tariffs.
In our central scenario, we have taken up that there would be tariffs of, let's say, around 15%. So the main thing is that that uncertainty tapers off. And then if it is something around these kind of levels, it should intrinsically be manageable.
Let's get to Tom Metcalf, who leads our EMEA finance coverage here for Bloomberg. We had the CFO there talking about their central scenario. I spoke to the Roche CEO earlier on today, told me they had 20 scenarios. I don't know how many scenarios the banks are running. But what stood out to you then from the BNP earnings, Tom? I mean, it's the same story around fixed strength, I suppose.
Yeah, fixed income strength. I think possibly an interesting aspect was their equities trading being so far down. That really runs counter to what we saw with the big Wall Street banks. So that's kind of interesting. It seems like their clients either went to other banks or perhaps were not as interested in kind of playing the equity markets. But yeah, absolutely. Really strong fixed income strength. And I think just the messaging as well from that bank, very bullish, much like Deutsche Bank, looking ahead to second half and saying, things are looking quite rosy for us, despite all the kind of geopolitical turmoil and uncertainty that, of course, lies ahead.
Yes, and a sort of sense of stability coming through in my conversations, our conversations on the earlier show with the Lloyds Banking Group CEO. I mean, the stock's pretty flat this morning. What was the story out of Lloyds?
Yeah, it looks to me very benign, right? Again, bellwether for the UK economy. They're not seeing any sort of painful kind of loan loss provisions coming through. I think the big story there for Lloyds is they're just waiting for the Supreme Court decision on the motor finance case, because that will probably dictate how the sort of year they have, I suspect.
Yes, and they took some provisions, didn't they? And they didn't increase those today. And I mean, that was everyone's expectations that they wouldn't, but they didn't. And so maybe at the margin, that's something good. Thank you very much. Thanks for bringing us the update on the financial services sector. Tom Metcalf then with that for you. Let's pivot from the banking space to cars. Elon Musk is warning of a hard year ahead for Tesla, adding to the car maker's woes after it reported one of its worst quarters of the last decade. The CEO pointed to the pending loss of electric vehicle incentives in the United States, saying it could be late 2026 before Tesla will see the fruits of its work on driverless cars.
We probably could have a few rough quarters. I'm not saying we will, but we could. Q4, Q1, maybe Q2. But once you get to autonomy at scale in the second half of next year, certainly by the end of next year, I think I'd be surprised if Tesla's economics are not very compelling.
Let's bring into the conversation Bloomberg's Global Autos editor, Craig Trudell, who's with me on set here. We just set out that size and scope, worst in a decade in terms of these numbers by some measures. Craig, I mean, what stood out to you about Tesla?
For me, it was all of this sort of contradictory commentary around how exactly this robotaxi business can be stood up or will be stood up. In one breath, there's the emphasis on just how their technology allows for them to scale up, and then in the next breath it was, but we're being paranoid. They also acknowledge that they have a safety driver in the vehicles that they have deployed. In next markets where they want to bring vehicles, they'll actually have people behind the wheel in supposed robotaxis. That's not very robotaxi.
If someone,
yeah, exactly. So it is of course real potential here in terms of if you are able to put cars on the road that legitimately can drive themselves. Also, if just a sort of regular consumer as opposed to company-owned cars can do this. Absolutely, it would be a major deal. The issue has been that for years and years now, Musk has said that this is just around the corner, and he has not been able to realize what he's predicted.
Yeah, this is a business in transition. I was reading Liam Denning's piece for Bloomberg Opinion this morning, and he was talking about this is a company that's currently about EVs and renewables because of the credits. So they sell EV cars and they get these big credits, and in the future it wants to be one that's about AI and robotics. But bridging that gap is difficult. Any sense that they can deliver on robotics and autonomous driving?
Yeah, I mean, I think you can put together sort of slick demos that can get people excited. I think people are really geeked when they see their humanoid robot handing out popcorn at this diner that they just opened in LA. That's cool, but when is that going to be a business? When is that actually going to do, in Musk's words, useful things? And even he is very iffy about when exactly those robots will be able to sort of generate any revenue anytime soon for the company. Full self-driving has been successful in the sense that it's additional revenue for each customer that they can convince to pay for that. But the sort of percentage of people who are buying Teslas and willing to fork out as much money as they're charging is quite small.
Yeah, okay, that's interesting. And then in other autos news this morning, we had a big fall in EU car registrations. You wouldn't think that, though, from the performance of car stocks today, because it seems that the car sector yesterday and today is all about the tantalizing prospect of 15% tariffs, which in this weird world we're in sounds like good news. So take us back to the car registrations, and do they tell us anything new?
Yeah, a more than 5% drop. That's the steepest in almost a year. It is by no means a sort of disaster. We're roughly flat year to date in Europe, but that's off a pretty low base where we're still struggling to get back to where we were before the pandemic. In terms of why stocks are moving the way they are, as you say, it's a bit of a head scratcher because 15% is by no means welcome development, and yet it is better than the alternative, which right now is 25% on top of the 2.5% that the U.S. was charging before the Trump administration came in with its reciprocal tariffs. And so, a big sort of bet going on within the markets that the deal between the U.S. and Japan will essentially be a template for the rest of the world, that we may see South Korea, Europe follow suit with something similar.
And I'm sure a lot of the detail will be important here, won't it, Craig, in terms of that? If we get 10 or 15, does that include the 2.5 that we previously had, or is that additional? You know, all of that will no doubt feature in our reporting, and we'll be looking for that detail. Thanks very much, Craig, for joining us. Global Autos editor Craig Trudell. Let's pivot to earnings from the tech space, and Alphabet shares are up in pre-market trading after the Google parent reported second quarter results that beat expectations. It also boosted its full year 2025 capital expenditures forecast to $85 billion, adding $10 billion to earlier guidance.
Q2 was a standout quarter for us, with robust growth across the company. As you saw at I.O., we are leading at the frontier of AI and shipping at an incredible pace. AI is positively impacting every part of the business, driving strong momentum.
A positive story there being told on AI. Let's speak to Bloomberg's Shirley Zhao, who's with us in Hong Kong. So a good set of results for Alphabet, a positive response in the stock, even though they announced this big increase in capital expenditure, which spooked people for a moment, Shirley. What did you make of it?
Yes, so Alphabet's result was, contributed by increasing demand from AI and Alphabet's cloud computing business. Its revenue exceeded analyst expectation due to rising demand for AI from the mass market as well as enterprise clients. And there's no lack of competitors in the AI field. We've already seen companies like Microsoft, OpenAI, and Meta all increasing their investment in this area, and Alphabet has to step up its investment in this area as well. Already, we're seeing a lot of users using chatbots to replace search engines, and that's creating a lot of pressure on Alphabet's flagship product, which is the search product. So Alphabet needs to keep investing to keep its edge in this AI race.
Yeah, technology stories are very diverse these days, aren't they, Shirley? And we go from one area, AI, where there's a huge amount of excitement, to an area where we've seen lukewarm results, maybe that's the way to describe them, from the likes of IBM. What did you take away from those numbers?
So interestingly, IBM's result is also a little bit AI related, because overall IBM's revenue increased about 8%, which exceeded analyst expectation. But specifically, its software business increased about 10%, which is slightly below analyst expectation. And investors are increasingly enthusiastic about its software business, which because of the growth potential from AI tools and quantum computing. And IBM is facing a lot of pressure of meeting investor enthusiasm, and perhaps that helps explain why there's a lukewarm reception of IBM's results for the latest quarter.
Shirley, tell me your thoughts on this other story, which I think is really fascinating. We heard from President Trump overnight. He was at an event that was setting out America's plans in terms of AI, and he was talking about the AI tech race as if it's the space race. He was using that kind of big language, I suppose, to talk about the battle here. He also admitted that he had considered attempting to break up NVIDIA. He did that in a room where we had tech bosses, including Jensen Huang, the CEO of NVIDIA. I mean, what did the market take away from that story?
Yes, what a revelation. So basically, President Trump's reason for considering this is that he wanted to increase some competition in the AI chip making field. But he was soon reminded by his aides that it would be very difficult to do that because NVIDIA has a multi-year lead in this field, and it's way ahead of any other competitor globally. And during the AI summit in Washington, Trump also praised Jensen Huang for doing a good job. And this came after the U.S. allowed NVIDIA to resume exporting AI chips to China. So for now, it's perhaps a little bit difficult to interpret if there would be any follow-up on this episode. I guess a lot of investors and observers are just waiting and seeing if this leads to anything else material coming forward.
Yeah, Shirley, thank you very much. Because Shirley Zhao reporting there from Hong Kong. And staying with President Trump, he is planning to visit the Federal Reserve later today. He'll tour the construction site. He's criticised many times for cost overruns amid his attacks on Fed Chair Jerome Powell, of course. In recent days, Trump has said that he does not plan to fire Powell before the end of his term, but the US president has not fully closed the door to removing him over his handling of that $2.5 billion renovation project. So we'll see what President Trump has to say when he is on site at the Fed. Coming up on the programme, what do nations need to do to ensure they strengthen their defence sectors in the long term and in a sustainable way? With the industry very much in the spotlight, we'll discuss that with our next guest. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Welcome back. This is The Pulse. Now, the defence sector remains as a focus for investors. There's been a wave of defence announcements this week, from Germany's new plan to accelerate military planning and procurement to Japan agreeing to buy defence equipment from the United States. But what do countries need to do to ensure they strengthen their defence sectors for the long term and in a sustainable way? Joining us now to discuss is Fenella McGurty, Senior Fellow for Defence Economics at the International Institute for Strategic Studies. Fenella, very nice to speak to you. Thanks for joining us. So, I mean, lots of European countries are trying to do this, and they're thinking about what money they spend on which kinds of defence. How are they taking the people with them on this? Are European countries all managing to convince their populations of the need to spend more on defence? What's your thoughts?
Good morning, Anna. It has been very interesting to see the approach that countries have taken to try and increase spending for defence. Obviously, there's now this pressure to continue these increases, but we're now at a time where it's after a period of very strong growth in 2024. So the options are becoming increasingly limited, and countries are finding, yes, they do have to communicate the real drivers behind this because it's become a very fiscally constrained environment. There are other public spending priorities. And I think what we'll increasingly see is countries highlight the industrial impact that increases in defence spending can have. So that's, again, why we're seeing coming into 2025, growth was going to be a bit more moderate, around 3.5% in real terms. But because of the raft of uplifts that we've seen from countries like Germany, the UK, Denmark, Belgium, Norway, the Netherlands, we're now looking at growth matching 2024's bumper rate of nearly 13% in real terms. So it's really looking at how countries are going about doing it.
Yeah, we used to talk a lot about there being a peace dividend, Fenella, and that was something that delivered and allowed countries to tell a growth story. Now, do you think, are we going to find the right ways to tell people, to tell voters that actually this can be positive for growth? Is that going to be something that's focused on and material?
Certainly, that'll be part of the messaging, and it largely varies upon the country. We're seeing significant increases in Germany and across the Nordics, where I think the communication has filtered down, and it's a whole of society approach, or certainly in the Nordics, this total defence concept, where you do have that approach to defence, where increases incorporate the whole of government spending effectively. So it's not just how much funding is going to defence, it's how much funding is therefore going into other sectors that also promote growth or promote the wider security of the country as well. So there's this very interesting shift in European defence economics at the moment. So it's not just the level of revisions, it's the extent, it's how vast they are and how wide-ranging we're now seeing the increases in the impact that they're having on other sectors as well.
Yeah, and perhaps no surprise that the Nordics are leading in terms of that shift in storytelling. Fenella, in terms of who is supplying these products and the types of companies that are doing bigger and bigger orders and big business here, are we seeing still a lot of the budgets going to the larger names in defence, or are small startups, tech-focused defence companies also getting a look in on these big government budgets?
I think it's been fascinating to see the approaches that countries are taking to try and both bolster public financing for defence, and that's major contracts, that's the funding that will go through to the primes, but they're also looking at targeting SMEs and startups and how to incorporate them into the wider procurement system. There are reforms, they're looking at simplifying the process. France has really taken this approach as well, with various kind of creative measures of fostering the defence industrial base and the supply chain and trying to support that innovation ecosystem, because France is very fiscally extended, obviously, and they're looking to make these increases for defence, but they're having to find other ways of finding other avenues of funding, so issuing bonds or accounts through the National Bank, for instance. And we're seeing those kinds of approaches come through as well. And there is that targeting of the innovation and of startups, and seeing how to support that space, because at the moment we're seeing a lot of heightened VC activity, but it's the role that government plays in terms of supporting those startups and really trying to speed up the procurement process, because a lot of these companies don't have the underlying capital to withstand these laborious, long procurement processes. And there's that recognition now. So there are moves to try and speed it up. It's just how fast those moves are made as well.
Yes, and for the sector as a whole, how quickly can it scale up, Fenella? A lot is talked about, a lot is said about the need to do this very quickly.
There's absolutely the need, but when we talk to industry, there's still some hesitancy. So we're seeing these increases in funding, we're seeing this increase in activity, but what industry is really looking for are long-term plans for defence. They're looking for actual concrete orders and when they're going to happen to be able to make that investment. So it's a question of risk and where it falls. So you may have this increased funding, but there's also that risk that potentially falls to the individual, even within a Ministry of Defence, who has made this decision to proceed with the significant programme or a new technology that perhaps hasn't had that legacy experience. And there's maybe still that unwillingness to undertake the risk in the public sector. So then the private sector then has to take it on, but they're not getting these long-term plans. They're not getting the clarity in terms of industrial strategies and things like that. So they're just really seeking the long-term view, basically, to be able to make that investment and ramp up production.
Okay, thank you so much, Fenella. Thanks for talking to us. Fenella McGuirty, Senior Fellow for Defence Economics at the International Institute for Strategic Studies. Quick look at US futures as we head to a commercial break here. Pretty flat, actually, across European markets. A bit of strength coming through on the NASDAQ. Maybe that's the Alphabet effect. We also think about Tesla, though, that having a tougher time of it pre-market. That's the US session that still lies ahead. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. In
Insight with Haslinda Amin, only on Bloomberg.
A cidade estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know this morning. Another record. Global equity hits a new high as the EU and U.S. progress towards a trade deal. And Elon Musk warns of a few rough quarters ahead after one of Tesla's worst earnings results in over a decade. And a win for Alphabet. Sales get a boost from significant AI demand. So how your indexes are performing this morning really depends on how much Alphabet you have and how much Tesla you have. It's Alphabet up, Tesla down in the pre-market, and it is little change for the S&P, while NASDAQ 100 futures outperformed by about 0.3%. It is this hope that we're going to get a 15% tariff on the EU, that is the baseline, that we will get an agreement. Scott Bessent saying yesterday that there was progress towards a deal with the EU. Now, for this bond market, it is a second day of losses, at least how we are headed this morning. Though little changed, I should say. Attention for this bond market will turn to an ECB decision in about 3 hours' time. But yesterday was a 20-year auction. That was smooth sailing. Your 10-year yield, that stands at 4.38 this morning. Let's get some stocks moving this morning. With that is Valerie Teitel. Good morning, Val.
Good morning, Danny. Let's start with Alphabet. Beats across the board in its cloud revenue, in its Google ad revenue. It also went on to increase its CapEx guidance an extra $10 billion. Alphabet shares up some nearly 3%. It's also giving a boost to some chip makers, Danny, the likes of NVIDIA and Broadcom, also trading strongly this morning. Let's move on to Tesla because there is a bit of disappointment there. The CEO, Elon Musk, warning of tough times ahead. This comes after their results showed a steep drop in revenue, and they basically posted one of the worst quarters that they've had in a decade. So Tesla shares have been sinking further in the pre-market, down 6.2%. Let's end on a positive note. European banks doing very, very well, out with earnings from BNP and Deutsche Bank. Both of these names, big beats when it comes to fixed income trading revenue. We're seeing the stocks in the green off the back of that. Deutsche Bank, one of the best performing stocks in Europe this morning, up some 6.4%. Danny.
Valerie, thank you very much for that. We'll catch up with you later in the hour. Also this hour, a great lineup for you. We're going to be speaking to RBC's Elsa Linos on FX, Jim Zenny of ZCG on private equity giants and the industry, and Stephanie Brinley of S&P Global on Tesla. Back to trade, though, our top story, President Donald Trump's tariffs may now have a floor. He suggested that rates for nations that aren't in line for a trade deal would not drop below 15%.
We're going to have a very, very simple tariff for some of the countries. There's so many countries you can't negotiate deals with everyone, so we'll have a straight, simple tariff of anywhere between 15 and 50%. A couple we have 15 because we haven't been getting along with those countries too well, so we just say, let's pay 50, and that's the way it is.
For more, we're joined by Bloomberg's Brendan Murray, who leads our global trade coverage. Brendan, does it look like the EU might be getting that 15% floor?
Well, the mood sounds optimistic from both sides. As you said, Treasury Secretary Bessent said things are moving in the right direction. And the real sticking points for the Europeans are these sectoral tariffs, the ones on autos and steel and aluminum. And Japan seemed to break through on at least autos. And so that was a significant concession on the U.S.'s side. And so the EU would be looking at something like that and saying, you know, we could live with a deal like that potentially. But of course, there are other sectorals, steel and aluminum, pharmaceuticals, and chips that the European Union would want some visibility on. What are they going to be paying eventually when those tariffs come into effect? We also have South Korea, which has some talks ongoing over the next couple of days. They would be looking at a similar deal to what Japan got, because they're, of course, you know, a large auto exporting nation, a steel producer as well. So 15%, the reciprocal rate, as well as some relief on those higher sectoral rates, the 25% on autos and 50% on steel and aluminum, seem to be on the table as well. So the European Union would be fiercely negotiating something along those lines for themselves.
And there's this question as to whether all of this pushes the EU towards China. Brendan, you had flagged to us that this week we're getting one of the first meetings, at least in person for some time, between Chinese and European leaders. And on that, Ursula von der Leyen told Xi Jinping that the ties between the two are at an inflection point. What is that inflection point, Brendan?
Well, it's at an inflection point because the EU's biggest trading partner after the U.S. is China, and they depend on each other a lot of interdependencies in the same way the U.S. depends on China. But China is violating a lot of the old rules of the global trading system with overcapacity. It's hoarding of rare earth minerals a few months ago, and that just raises the concern in Brussels that China is working against the European Union. So this summit this week between Brussels and Beijing is an important point at which they're going to try to reset those on a positive direction instead of the sort of deterioration that they've been on for a couple of months.
Brendan, thank you very much for that. That is Bloomberg's Brendan Murray. And despite more trade deals and more progress, it's a dollar that's either fallen or reacted little. That's the reaction this morning. We're joined now by Elsa Linos, Global Head of FX Strategy at RBC Capital Markets. Elsa, I wonder what you make of that. After a trade deal was inked with Japan, it was a dollar that fell despite front-end yields moving higher. What does it tell you about the direction of where we go from here?
And I think there's a broader theme of dollar weakness that nobody is willing to give up on, and for good reason. You know, the dollar is coming from a very strong starting point. We know for a very long time global investors have been overweight US assets and underhedged on those assets, and that's part of the process that's unwinding now. And so almost regardless what happens on the tariff front, that's a dynamic that would be playing out in any case, and has further to run.
Does that dynamic, though, pause with U.S. equities at an all-time high? Elsa, it seems that this is a market that investors are happy to jump back into at the moment.
Yeah, I think that's a fair point. There are two sides to this dynamic. One is the hedging on existing assets, and the other is rotation out of U.S. assets into rest of the world, in particular European assets. The latter really took place in the first quarter of this year. You saw that very strong surge into European assets, particularly after the German fiscal announcement. But that actually didn't follow through in the second quarter, and the early signs from Q3 similarly are not as strong. Whereas the hedging dynamic, you know, the change in behavior around FX hedges on existing US assets, that is underway, and that I think has further to run, because, you know, we haven't even seen the Fed start to cut rates yet.
And of course, that is one of the risks, not the Fed cutting rates, but what's happening at the Fed and the threat to Fed independence with Jay Powell. President Trump is set to visit the Fed building at 4 p.m. for about an hour today, local time. Jim Bianco of Bianco Research writing, if they want to find reason to fire him with the building renovation, they could, because every D.C. government building renovation tends to be rife with mismanagement and cost overruns. Elsa, is this a real concern for this market, or is it something that, as Trump continues to brush it off, saying that they won't fire Powell, is just palace intrigue?
I mean, it's something people certainly have on their radars, and with good reason, right? But at the end of the day, Trump's term as chair does end in May of next year, and I suspect that Scott Bessent will be strongly advising Trump against going down such a route. You know, you hear Trump saying, well, if rates were at 1% rather than 4%, we'd be paying so much less interest on our debt. It's not true, right? Because the Fed controls the front end, the market controls the back end. Unless, you know, they have talked about shortening the duration of debt and so on, but at the end of the day, it's a dangerous path to go down to question Fed independence like that. And I suspect that the more rational voices within the administration will probably win out on this, not least because there's not that much long to go until Powell's term ends as chair.
Even so, when you heard from the Commerce Secretary Howard Lutnick yesterday saying that Powell should resign or called for him to be replaced, there was a clear reaction from the dollar. Elsa, what do you make of the sensitivity of the currency market to this?
Absolutely. I mean, central bank independence is a core tenet for DM central banks and even increasingly EM central banks since the late 90s. So when that's called into question, it's part and parcel of this broader questioning of the institutional framework that we had grown accustomed to in the US that appears to be being questioned under this current administration. I mean, I would say, though, that it's pushing on an open door to some degree, because the Fed was already on the path towards cutting rates and was already on a starting point with very low hedge ratios that did have to increase. And so what we're seeing at the moment is a dynamic where those hedge ratios are just naturally going up in anticipation of those cuts, whether or not they're sped up by, you know, palace intrigue, as you called it.
Well, at the same time, we're going to have an ECB decision later today, Elsa. Widely expected no change. But we have heard from various ECB officials, De Guindos being one of them, saying, I am looking at the currency. If it goes to something euro-dollar like 120, that's when we begin to get worried. At what point does a stronger euro start to tilt the balance in favor towards another ECB cut?
It's an interesting question, because I think there are varying opinions within Governing Council. And you've heard comments like that from De Guindos, but at the same time, other Governing Council members see the strength of the euro as a sign of the optimism surrounding the euro area and investment into the euro area. I mean, I would say that it's not just euro-dollar. We tend to focus a lot on euro-dollar in markets. It makes sense. But the one thing we've been looking at RBC, in particular with our European rates and economics team, is euro-renminbi. You know, the fact is that as the renminbi has kept pace with the dollar on its path of decline, euro-renminbi is at the highs, and so trade-weighted euro has strengthened quite a bit. That's got more meaningful economic impact. I do think the ECB will be watching that, but I don't think we're yet at levels where it's going to change their approach to policy setting or push them into a rate cut they wouldn't otherwise be delivering.
Elsa, really wonderful to catch up with you this morning. Thank you so much for joining. Elsa Linos of RBC Capital Markets. Let's now get you some other stories that are trending on the terminal this morning. Tom Hayes, the former UBS trader, cleared of manipulating LIBOR by UK judges, says the other traders convicted to rigging interest rates should have their cases overturned. Hayes spoke with Bloomberg's Anna Edwards earlier.
Never put rates forward as submissions or asked for rates to be submitted that were false. You know, were they commercially influenced? Yes. You know, we can have a morality trial about that. That was a system. The benchmarks were set up by the banks for the banks. The whole thing was just badly set up. And it's all very well after the event 10 years later to say, well, we don't like the look of this and somebody's got to go to prison for it. But no one lied.
And as we mentioned earlier, President Trump will visit the Federal Reserve in person today to tour a construction site that he has criticized for cost overruns. The president's daily public schedule released by the White House notes that the visit is planned for 4 p.m. Eastern. He has been attacking Fed Chair Powell for not cutting interest rates. And Goldman Sachs has decided against a second round of performance-based job cuts this year. That's according to the FT. This comes after a better-than-expected recovery in investment banking. The lender has declined to comment, the report said. Coming up, a tale of two quarters. We're going to recap earnings from both Tesla and Alphabet as their fortunes pre-market diverge. You're watching Bloomberg Brief.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Let's get a check on Alphabet shares this morning because they are moving higher in the pre-market by 3%. A beat in the second quarter results. Let's get into those numbers with Bloomberg's Shirley Zhao. Shirley, what was your takeaway?
So Alphabet's result for the second quarter was mainly boosted by increasing demand for AI. Revenue from the company's cloud computing business, which includes the AI model Gemini, exceeded analysts' expectation due to rising demand among the mass market as well as among the enterprise clients. And because the market is so big and there is no lack of competitors in this market, we've seen companies like Microsoft and OpenAI and Meta all investing more and more in this area. So Alphabet has to invest more as well to keep up its edge in this market. Already, we've seen many people using chatbots to replace search engines, and that's creating a lot of pressure on Alphabet's flagship search product. So increasing investment is necessary for Alphabet to further grow its business.
Yeah, and that investment increasing first concerned investors, and then it seemed to turn around. Shirley, we're also going to get second quarter earnings from Intel after the bell today. What are we expecting?
So Intel is in the middle of an effort to turn around its businesses, and its new leadership has said that it needs more time to fix some of its problems, including a rather stale product lineup, and to get more orders for its factories, and to get more competitiveness against companies like NVIDIA in AI chip making. And I think a lot of investors would want to know more details about these plans and the company plan to improve its revenue and profit. Some investors are concerned about the second half of the year in the personal computer market, which provides the majority of revenue for Intel. That's because there seems to be a rush for customers to make purchases before President Donald Trump's tariffs take effect. And that may mean that demand may dip in the second half of the year and affect the company's earnings.
It's a pull-forward effect we've seen across many industries. Shirley, thank you very much for that. That is Bloomberg's Shirley Zhao. Now, shares of Tesla, on the other hand, are sinking in the pre-market trade this morning. The EV maker saw one of its worst quarters in over a decade.
We probably could have a few rough quarters. I'm not saying we will, but we could. Q4, Q1, maybe Q2. But once you get to autonomy at scale in the second half of next year, certainly by the end of next year, I think I'd be surprised if Tesla's economics are not very compelling.
Joining us now is Bloomberg's Craig Trudell, who leads our global autos coverage. Craig, what distinguishes between a period of transition and just a rough patch?
Yeah, I think that's the question, right? I think in addition to just the real concern, legitimate concern about the demand outlook that I think Musk was a little bit more honest about last night than we've heard him be in the past, the sort of outlook for this autonomy at scale, as he put it, is clouded by the fact that, back in 2019, he said Tesla was going to get there in 2020. So, you have to sort of take him at his word that he means it this time when he says that, Teslas will actually be capable of autonomous driving. And this is something that, he not only has to prove to consumers, but to regulators. And I think that was part of the sound we just heard from him, was this idea that, part of why he's sort of alluding to the idea that Tesla may not be able to scale so quickly is regulatory approvals, which, here in Europe, not only are they not able to put driverless vehicles on the road, they can't even deploy full self-driving to their customers, a driver assistance system.
Yeah, and a lot of the timelines have been squishy, Craig. Craig, thank you very much. That is Craig Trudell on Tesla. Now, along with more earnings this morning, we're also waiting a rate decision from the ECB. We are live to Frankfurt, where Lizzie Burden will have the preview for us coming up next.
Bloomberg launches our inaugural 25 African Startups to Watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator, a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Watching Bloomberg Brief. I'm Danny Berger in New York. It's ECB day with a decision just under 3 hours away. The central bank is expected to leave rates untouched at 2% after a cutting cycle that's lasted over a year. Joining us now is Bloomberg's Lizzie Burden on location in Frankfurt. And Lizzie, this decision off the heels of reporting that it seems like the U.S. and EU are more closer to a trade deal. How does that change what we might hear from the central bank this morning?
Well, Danny, for some economists, that would mean that you don't need any more cuts from the ECB this year. But I was speaking to our economists at Bloomberg Economics last night, and they say that even if you had a 15% tariff deal, following in the footsteps of Japan, it would still be higher than that 10% levy that was baked into the June forecast, which suggested that you'd still need one more cut from the ECB this year, and then you've got to layer on the sectoral tariff. So our economists would still see cuts in September and December, even if you got a 15% tariff deal. I asked them as well, what would happen if you got no deal? Because, of course, 30% tariffs weren't even in the ECB's most severe scenario in June, and they say, interestingly, that you may not even have that different a picture, because while you have the disinflationary impact of US tariffs, you'd have the inflationary impact of the EU's retaliation. So you could still see 2 cuts in September and December. All of which to say, Danny, is there's a lot of uncertainty out there. By September, hopefully they'll have more clarity on trade, definitely more data, and crucially more forecasts. So that's precisely why all but 2 economists in our survey say today they're going to hold.
One of the other dynamics that's unfolded with this, Lizzie, in the uncertainty, as you say, is a dollar that keeps weakening and a euro which has been strengthening. What's Lagarde likely to say on that?
Well, of course, as you well know, that euro strength is largely a dollar weakness story, and that largely comes down to the president's threats on the Fed chair, which Joachim Nagel, the Bundesbank president, has commented on. He said that you could see global ripple effects of that meddling with Fed independence. But the euro's up 13% against the dollar so far this year. It's going to come up at the press conference. I wouldn't expect Christine Lagarde to go as far as Vice President Luis de Guindos in pointing to 120 as the level that is the complicating level for the euro area economy. But let's see how much she emphasises how much it's feeding into the disinflation story, the euro strength. Let's also listen to how much she is more humble, shall we say, than at the June meeting about how good a position the euro area economy is in. If she emphasises the downside risks to growth today, then many in the market are going to interpret that as a signal that the door is open to a September cut.
Lizzie, really appreciate that. That is Bloomberg's Lizzie Burden. Again, we're going to get that rate decision about 8:15 here Eastern time from the ECB, with a press conference to follow from Christine Lagarde. All right, coming up next, we talk about private equity and deal making. We'll speak with James J. Zenny Jr. of Z Capital Group on this environment. That's coming up next. This is your Bloomberg Brief.
is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Thursday. Another record, global equity hits a new high as the EU and U.S. progress towards a trade deal. Elon Musk warns of a few rough quarters ahead after one of Tesla's worst earnings results in a decade. And a win for Alphabet, sales get a boost from significant AI demand. So here we are gaining, depending on what index you look at, after another record high for the S&P, a record high for global stocks fueled by headlines that the U.S. and EU are closer to a trade deal. But the results will vary on what index you are, depending on how exposed you are to Alphabet and to Tesla. Tesla down sharply this morning. Valerie will get into that in a moment. But NASDAQ 100 futures outperform, up 1/3 of 1%. For the bond market, it is yields mostly higher for a second consecutive day, up just about a basis point for a 10-year yield at 438. It was a smooth 20-year auction yesterday. Focus now turns to an ECB decision in less than 3 hours' time. Let's get you those stocks on the move this morning. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start with the positive news from the Mag 7s, and that was Alphabet's earnings report yesterday, coming in strong, beats in their cloud revenue and also beats in their Google ad revenue as well. The one key thing here, though, for broader markets is Alphabet is increasing its CapEx guidance another $10 billion. That's seeing Alphabet rise some 3% in the pre-market. We're also seeing chip makers in the green as well, such as NVIDIA and Broadcom, really liking what they hear from that extra CapEx spending. Let's move on to the more negative news from the Mag 7 earnings last night, and that is Tesla. Pre-market Tesla down over 6%. This comes as their revenue saw a very steep decline in the quarter, one of their worst quarters for their performance in this decade. The CEO Elon Musk also warning that this is not just the end to the tough quarters. He sees a few more ahead for the EV maker. Let's end in Europe. We did have some solid earnings from the banks. BNP Paribas and Deutsche Bank both posting beats in its fixed income trading unit. Deutsche Bank coming in with a decent beat, up 7% for Deutsche Bank, one of the best performing stocks in Europe this morning. Danny.
Valerie, thank you very much for that update. Now, another set of earnings we are going to be getting today is Blackstone, with the big private capital giants kicking off earnings. It'll be reporting before the bell as the sector deals with a tough first half. In the first half of 2025, deal making took a major dive as a result of uncertainty in the markets. Joining us now, I'm pleased to say, is James Zenny Jr., founder, president, and CEO of Z Capital Group, which has investments across private capital strategies with about $4 billion of AUM. Jim, thank you so much for joining this morning. Really wonderful to see you.
Thank you.
And look, it's probably a period that a lot of your peers maybe would want to forget as a really tough deal-making environment. In a period that's been marred by dislocation, what's your read on how well this industry has coped with it?
Well, I think there's a lot going on. Obviously, a lot of the discussions around realizations, lack thereof. If you look at the data since the financial crisis, there was sort of during that time period, there was about 40% of net asset value that was returned annually. Now we're in the 10% range. Roll forward, call it 20 years from now. So we're really sort of at a record low as far as distributions to investors, which is very topical these days. And that has sort of spawned the whole secondary market for continuation funds. In some cases, they're continuation funds squared, where it's actually a redo of another continuation fund, which I think is actually going to be something that's going to be a big business going forward. You're going to see, in fact, the last 6 months, year to date, the amount of secondary flow deal-making, new funds, was about $100 billion. 40% of that was continuation funds.
So for a lot of funds, though, there's been this idea that they're just in this period of extend and pretend, that they maybe bought assets before interest rates really started to go higher, they overpaid, and they can't find buyers for what they want. For those that are doing that right now, are they about to almost get a get-out-of-jail-free card? If we are going to get rate cuts later this year and early next year and things like tax benefits from the One Big Beautiful Bill, are we about to get this period where the jamming up of markets comes unstuck?
The thing that's not being discussed, and you could argue whether the Fed should cut rates or not, what's not being discussed is the high capital cost. Deal-making, the L in LBO is leverage, and deal-making is completely dependent on the cost of capital. So prices of transactions, multiples to EBITDA, have not gone down enough. And basically, you've got a logjam of deals to do, either for sale or to buy. But the problem is if you run traditional LBO models, the capital costs are very, very high. And it's hard to justify making acquisitions with high cost of capital. And think about it. Our balance sheets, were basically put in place, or debt structures 4 or 5 years ago. And now interest rates are higher. So all private equity firms are getting squeezed on free cash flow because of higher interest rates. And you can't reinvest in the business in that case.
Well, one of the things that we've seen a lot of the big players do, and Jim, ZCG is really among them, is branch out. And you've been doing this for some time, but not just do private equity, but have private credit in your arsenal and other strategies too. Does this mean that the business model has changed going forward, that if you're a smaller, pure private equity player, that you will struggle to exist right now?
I think the answer is it has to. I mean, if you look at traditional private equity, started back in the 80s, and the key really is where are your returns really being driven from? Is it just financial leverage, or is it actual operational expertise and resources? And in our case, we've developed a whole consulting practice internally. And we also have a technology affiliate that drives a lot of value through tech enablement in a variety of ways. That wasn't whiteboarded 20 years ago. But over time, you realize you're deficient in some of the toolbox tools. And we've developed, and very fortunate to have these, and you have to have resources today to drive value, and you've got to assist and work with management teams to optimize their businesses. And we just happen to have a pretty interesting business model today.
I would love to know, because I know a lot of the in-house consultants and your exposure with different companies is some kind of consumer-related companies. And we've seen a bit of an unevenness in earnings. Coca-Cola's of the world are able to rise prices. The GMs of the world absorb those price increases from tariffs. What have you seen? Is this a consumer that's still willing to pay more, or are you seeing pockets of weakness?
I have a really interesting seat in the sense that I sit both on the IC of our credit business as well as I head it on the private equity business. So I see a spectrum of businesses. Specifically in private equity, we're in a 10-11 industry. So I see a spectrum of what, from manufacturing to consumer. The consumer trends have changed dramatically during COVID and then post-COVID dramatically. And there's winners and losers in that scenario. Consumer is, especially on the lower end of the economic spectrum, very, very picky as to what they're spending their money on. The shift has been to things like experiences, things like we have a company that supplies medical supplies to the maritime industry. The cruise business is exploding because of the experiences. And it's a relatively inexpensive vacation. So we're seeing a mix of haves and have-nots. On the other hand, you are seeing, consumers, yes, they're being picky, but they're also looking at value as well. It's not just what's the cheapest price.
Jim, before we let you go, I would love to get your take on private capital in 401ks and the administration making changes and potentially allowing things like private equity to be in retirement funds. Does it make sense to you for this to be the wrapper of assets that are more risky and less liquid?
I think if they're properly disclosed, if they're properly marketed, I think certainly it makes sense. And I'm surprised it hasn't developed earlier, to be honest. It is a windfall for the industry. The big guys will take advantage of it earlier. Good for them. But I think it's inevitable it's going to happen.
Can I just get your thoughts on that? If it is a world that's shifting more towards wealth, more towards retail, how do you compete with the big guys that have crazy marketing forces that can go out there and try to capture that?
That's an interesting question because it to some extent, especially the public companies, which are great businesses and super success stories. But we have a bit of an advantage in the sense that we don't need to go out and raise tens of billions of dollars to be effective, right? We're in the middle market space and can do very well with billions of dollars of funds. The larger guys have it harder because they have an AUM story when they're, as you mentioned, Blackstone's earnings. They're a little bit in a different business today as a public company. In our case, we're just fine raising X number of dollars to execute on our strategy. So to some extent, it's a little easier for us. The other thing is you're seeing the secondary activity, which I mentioned. Most of that activity, if you look at the portfolios of those sales, is most of it is on the large cap private equity funds. In fact, I was just with a CIO of a state fund the other day, and they're arranging a sale of some of the larger names, selling down and reducing exposure, and there has been a shift to sort of the middle market space. The theory there is that it's just less competitive, and if you have the right tools, you can drive returns.
All right, Jim, we're going to have to end it there. This has been so wonderful.
Really good to see you.
Thank you so much for joining. Wonderful to see you as well.
Thank you.
It is James J. Zenny Jr. of Z Capital Group. Let's quickly now get you some other stories that are trending on the terminal this morning. And President Trump will visit the Federal Reserve in person today to tour a construction site he has criticized for cost overruns. The president's daily public schedule released by the White House notes that the visit is planned for 4 p.m. Eastern. He's been attacking Fed Chair Jerome Powell for not cutting rates. And Columbia University has reached a deal with the Trump admin to restore federal funding for research. The school will pay a $200 million penalty over 3 years to resolve civil rights investigations in order to restate the majority of more than $400 million in canceled grants and contracts. And the FT reporting that Goldman Sachs has decided against a second round of performance-based job cuts this year. This comes after a better-than-expected recovery in investment banking. The report said that the lender has declined to comment. Coming up, a rocky road for Tesla. Shares dipped more than 6% this morning, with Elon Musk warning a rough patch ahead. We speak to Stephanie Brindley of S&P Global Mobility. That's coming up next on Your Brief.
Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing. Yep, now we're playing.
First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day. 5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Probably could have a few rough quarters. I'm not saying we will, but we could. Q4, Q1, maybe Q2. But once you get to autonomy at scale in the second half of next year, certainly by the end of next year, I think I'd be surprised if Tesla's economics are not very compelling.
One of the worst results for Tesla in over a decade, and those comments there adding to the decline in shares this morning, more than 6%. Joining us now is Stephanie Brindley, Associate Director of Auto Intelligence at S&P Global Mobility. Stephanie, great to see you. And look, we didn't exactly see the few rough quarters translated into any formal guidance. So what is your assumption as to what this period actually looks like for Tesla?
Oh, I think it still does look like a bit of a rough period. While he's focused on the robo-taxis, the sales were not doing as well as they would have liked. They're down from last year, up from last quarter, but last quarter was quite difficult as well. And I thought it was interesting that it was one of the rare quarters where they produced significantly more than they sold for Tesla. It was about 76,000 units more that they produced than they sold. And traditionally, their production and delivery numbers are much closer than that. And I think there's still some softness in the market for the vehicles right now.
But the executives on the call, Stephanie, spent relatively little time talking about EVs. Instead, to your point, it was about robo-taxi, it was about a new Tesla diner. In order for Tesla to get and continue to have the valuations that it currently does, is this a Tesla that needs to convince investors that it's not a car company, and has it successfully done that?
Oh, I think that it needs to convince everyone that the robotaxi is going to deliver in the time frame in terms of the financials that they want. Whether it does or not remains to be seen. It's certainly great technology. It's certainly technology that is being explored by a number of companies in a number of places around the world. But we haven't got to a commercialization point that actually demonstrates the profitability yet, and that's probably still a little bit elusive.
How troubling is it to get those deadlines? I mean, there's some bold ones. Expand a robo-taxi service in a couple weeks is what Musk said. A cybercab in production by 2026. Having people able to add their own Tesla to a mobility fleet by next year. Autonomous ride-hailing service by the end of next year. Stephanie, these are really big projects. And he's given himself a timeline of about 1 year. What happens if we don't get them in that time period? And we know timetables and deadlines tend to be a little bit squishy for Tesla.
they do tend to be squishy. I think that it'll be difficult, especially if you're looking at what the market does in reaction to it. But the company's been valued high for a long time. And, you know, when we look at this too, he always keeps, and rightfully so, has to point out that, you know, all of these ambitions have a lot to do with regulatory issues, and not necessarily addressing kind of what those are going to be or how hard they're going to be to get over. One of the things that I think is interesting is how is it really, what is it really going to look like from a regulatory perspective when you start having people add their own vehicles to the robotaxi network? You know, is that easy? What are our governments going to want to see on a state or a national level before you're doing that? They did address some of the concerns that might come up in there, and saying that to have a vehicle on the network, you would have it checked out, you would have it approved and reviewed. But there's a lot to unpack there, and I think that what we might find is that the appetite for robotaxis is there, but to have it develop as much as he needs in the next 12 months might be a bit of a stretch.
Stephanie, as we're talking about regulatory impacts and trying to get approvals for things, how much damage has there been done from Musk's foray into politics? And of that damage, how much of it is irreparable?
Well, that's a tough question. I think that it's been fairly significant. You know, what I would like to see out of Tesla in some ways is actually to behave a little bit more like a car company, in the sense that they're addressing product issues a little bit more directly, and really trying to figure out how to sell cars. That doesn't seem to be a priority, and that's been fairly consistent for the company in some respects. And it's always been the next technology. It's always been something else to look forward to, and you need that. But the fundamentals of the basics aren't really there. And in the sense of trying to expand your car market, you aren't expanding product lineups all that much. The changes are incremental, and consumers don't always respond to incremental change in the way that he expects them to. I'd like to see a little bit more of the car company, and it pop up a little bit.
Stephanie, judging by the reaction to the results, I don't think you're alone in that. Thank you so much for getting up early for us and joining us, Stephanie Brindley of S&P Global Mobility. By the way, Dan Ives writing on Tesla with solid progress with autonomy and AI future. Musk is now acting as a wartime CEO. Well, Tesla wasn't the only set of results we got after the bell last night. We also got Alphabet. Those shares are rising 3.5%. It demonstrated strong demand for AI that helped boost sales. But now that requires more spending to keep up with competitors. Joining us now is Matt Bloxham of Bloomberg Intelligence. And Matt, here you saw shares waver at the beginning of the announcements, whether it's more important that they're advancing on AI or spending a whole lot of money to do it. What was your read on the dichotomy between the two?
Yeah, I mean, also this is a big move. What, $85 billion of capex this year, so that's about 45% up from where estimates were at the beginning of 2025. So it's a really big move. You know, I think one of the reasons we're seeing the positive reactions so far is they talked to a growing order book from their enterprise customers on cloud, and so I think that there's perhaps some confidence that the investment they're putting into AI is actually supporting real demand that's coming through. And I think helping we saw their cloud business actually post better than expected profitability, and that's been a bit of a sore point for many quarters in the past. I think the other aspect here that's perhaps encouraging is obviously the big worry about Google is whether their search business, which is really the core of their revenue right now, is under threat, or how big the threat is from AI-based chat alternatives. I think actually what we saw a beat across the board for Google this time, including a better than expected search revenue number. So I think that was also reassuring that if there is going to be a threat to that search business, it's not coming through yet. And again, perhaps the investment they're making is a good way for them to kind of strengthen the moat they have around that business.
I just wonder if at some point this ends in terms of investors being okay with all the spending that's happening, because it's not just Google, it is Meta too. We're going to get their earnings later in the month, spending enormous amounts, not just on AI itself, but on the talent around AI. Is this an investor base that's patient?
It's a question of patience, and I think also uncertainty. You're right to question whether these huge capex numbers are ultimately going to pay off with real returns on investment. But I think it's a pretty stark choice for all these businesses. If you don't spend the money and keep up with your rivals, then you're essentially waving the white flag, and that would have an even bigger detrimental effect on your share price. So I think these are kind of essential investments that they're all making to stay in the game.
All right, shares up just under 3.5%. Matt, thank you very much. That is Matt Boxham of Bloomberg Intelligence. Coming up, we're going to get you set up for your trading day, including President Trump's visit to the Federal Reserve. We'll have your trading diary for you next on The Brief.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg. Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Let's get you set up for your trading day. First up, we have an ECB rate decision that comes at 8:15 a.m. Eastern. Then jobless claims at 8:30 a.m., followed by PMIs at 9:45. Then we also have President Trump, who's scheduled to visit the Federal Reserve construction site at 4 p.m. We'll see if that brings anything with it. Now let's get some individual movers this morning. Tesla falling after Musk warned on the earnings call that they're going to face a few rough quarters ahead as they try to transition from EVs to robo-taxis. ServiceNow, those shares up 7%. earnings. That was a beat and a raise with subscription revenue forecast. And Chipotle shares down sharply. It cut its sales forecast for the second time this year. So those shares are down just about 10%. All right, that is it for your Bloomberg Brief surveillance. We'll take things ahead from here on this Thursday. You're watching Bloomberg.
Had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we can do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Aqua in Sintra, Portugal, and this is Bloomberg.
We're looking at the riskier parts of the market. They can't get much better than this.
Technology companies driven by artificial intelligence is going to be where you get your earnings growth this quarter.
On the whole, things are quite nice, but the fact is there are a lot of potholes.
The pullback would be healthy.
With continued clarity on tariffs, we've got a calmer market, hopefully.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, investors ignoring the drama. As President Donald Trump prepares to visit the Federal Reserve Building, the European Union and the United States are said to be closing in on a trade deal. And big tech earnings are delivering. Alphabet is plowing billions of dollars into AI investments. It's more fuel for a record-breaking rally.
So there used to be questions about how long this investment cycle into AI infrastructure could continue. Some people speculating maybe it was plateauing. Well, wonder no more. Alphabet comes out. Not only did they increase their spending by 11%, but you have discussions around Sundar Pichai saying, if we don't do this, we'll fall behind. If we don't do this, we can't meet our customers' needs. And what you're hearing from around the street is that this AI investment cycle is longer and deeper than most people had expected.
Alphabet's one story, Tesla quite another. down hard in the pre-market. Elon Musk saying this: we probably could have a few rough quarters. Revenues down, vehicles delivered down, average selling price down. The transition from pre-autonomy to post-autonomy is a tricky one.
When it comes to Elon Musk, too, what is happening in policy in Washington is also hurting his business right now. He's concerned about the EV tax credits that have been pulled out with the One Big Beautiful Bill, and then also tariffs on the horizon. They admitted yesterday that not knowing the tariff story, the fact that there are going to be higher tariffs, especially when it comes to China, where everyone is getting their batteries and their raw materials, that is going to really complicate their trajectory. So they're in a tough position right now, and he was honest about that.
Stock is down at the pre-market by 6%. Let's talk about trade. The prospect of a deal between the EU and the US. We played this game yesterday. The bad news is it's 15%. The good news is it's not 30.
To me, I'm still trying to wrap my head around what's good and what's bad. Because right now I was looking at the ECB, which is going to meet later today, and their expectation was for a 10% baseline tariff, and that was going to slow growth, but not that badly. The worst case scenario was a 20%. Okay, well, we got 15. So is this, okay, it's fine, we've got certainty, let's all just shrug it off. This is the beginning of yet another negotiation. What's the end point to these negotiations? And that's really my ultimate question. Are these deals true certainty?
Well, these deals, I think, could be a bit fluid, and the Treasury Secretary said that last night, speaking to Fox News, the fact that, like what Japan is doing, say the tariff rate could go up. What I would say, though, is very clear hearing from the president last night, because I was with him at the AI summit, 15 is the new 10. If you think you're getting under 15, you're not. 15 is now the floor. And then the president went on to say that they are close to an agreement with the European Union. He said everyone's going to get between 15 and 50%. And then he said there's over 200 countries. He was talking about countries, some of them he even admitted he hasn't even heard of. And he says it's a lot of deals, quote, even if you're like me, a deal junkie.
Europe in focus a little bit later this morning, 8:15 Eastern time, that ECB decision. 30 minutes later, we'll have a news conference with President Lagarde. In between, jobless claims at 8:30, and just before that, earnings from American Airlines. This morning, futures positive, building on all-time highs. Coming up over the next 60 minutes or so, Andrew Sheets of Morgan Stanley, warning of slower growth still ahead. Ed Mills of Raymond James, as President Trump says countries will face tariffs anywhere from 15 to 50%. And Dan Ives of Wedbush, as Elon Musk is expecting a rough few quarters. We begin this hour with stocks trading at all-time highs. Morgan Stanley's Andrew Sheets warning of a tougher second half, warning of slower growth, stickier inflation, and no Fed rate cuts. Andrew joins us now for more. Andrew, good morning, sir. Stocks at all-time highs, credit spreads incredibly tight. Are you making the case that perhaps second half dynamics won't support these markets?
Yeah, good morning. So I do think investors do need to prepare for what could feel like a very different second half. I think a lot of us are looking at these markets, incredibly strong credit markets, incredibly strong equity markets, and there's a temptation to think, well, maybe tariffs don't matter. Maybe everything that's been happening just kind of doesn't matter in the face of all these other positive forces. But I think what the market kind of needs to deal with is that we haven't really made contact yet with what we think are going to be the main inflationary or growth impacts of those tariffs. And a lot of those are going to come in the second half, not the first half of the year. And so specifically, we're going to get kind of a core PCE number at the end of this month that will show the start of an uptick. I think markets may really start to care about that kind of next month, mid-next month, where you get the next CPI number, another uptick of inflation, 2 upticks, that's a trend. And then as you get deeper into the second half of the year, that's when our economists at Morgan Stanley are forecasting growth to continue to decelerate and kind of get down to kind of sub 1% in kind of the fourth quarter of 25, first quarter of 26. So, that's a very different combination than where we've been. And so I think while it's tempting to think markets are kind of resilient in the face of anything, I think they still need to be tested in the face of that changing mix. And that's why I think we could get a little bit of rockiness, not severe rockiness, but a bit of rockiness in the third quarter.
So far this year, Andrew, how much of the bad economic data has been masked by the good investment cycle that we've seen with respect to AI?
Yeah, so I think that is a positive story. And look, you alluded to this, earlier in the show, that the investment story in AI is real and it's going to be significant. I mean, we're forecasting roughly $3 trillion of spending on AI data centers and hardware just through 2028. These are enormous numbers, and there's a lot further to go. But, I also think what's notable is that with a lot of these factors that investors have been focused on, tariffs, immigration, there's a large lag in all of these things. I mean, again, if we look at kind of tariff collections, they've only recently begin to accelerate rapidly. And so if we think about kind of final private demand within the GDP numbers, that's probably the fairest number. It's not distorted by the big swings in imports and exports. That number has still been running at a pretty healthy kind of 2% type of range in the first and second quarter of this year. It starts to step down a lot in the back half. So again, the AI investment story, that's secular, that's going to continue in the background. But I also think part of the masking has just been in the delay, and that delay is going to start to give way in the second half.
How much, Andrew, when you talk to clients, and this is something of a psychology question, do you feel that people just shrug off what you're talking about, that stagflationary mix that so many people were talking about a couple months ago, saying, look, if you cry wolf again and again, I'm not going to believe you. How much is that kind of what you get met with when you talk to clients?
Yeah, I think that's a huge issue because these issues of higher inflation, slower growth from tariffs, these have been in the conversation now for a while. And I think investors are understandably kind of tired or frustrated of kind of dealing with these issues that month after month kind of continue to be kicked back. And even the non-farm payroll number we think we're getting on August 1st, Morgan Stanley is expecting 140,000 jobs. We're expecting a pretty good number. So something that we think is going to be still showing some resilience. Again, the growth weakness is a little bit delayed. So again, I think investors are understandable of why they're skeptical of this, but we do think that slowdown is coming. And this is, again, where kind of that CPI number is so important. I mean, I think a second straight uptick, that should start to get some attention.
When it comes to AI and that eye-watering number you're talking about for 2028, how much is that dependent on deregulation? Yesterday at the AI Summit said the most important person in the room was not NVIDIA's Jensen Huang, but actually was the EPA administrator when it comes to making sure that they can get these contracts through the U.S. government.
So, yeah, the power side of this is enormous. There's, maybe a 45, gigawatt shortfall of power, over this period of time, over this funding cycle. So, getting the electricity into these plants, that's going to be huge. I think that's the biggest bottleneck we face. We think the water issues are maybe less significant, but the power issues are huge. And there's a big regulatory element of that. There's a big production element of that. And that regulation is also not just federal, it's state, it's local, it's very complex.
So this is going to be a complex environment over the next few years. When you talk about tariffs, I just would love to understand from your point, do you think the administration has conditioned the market to accept these higher rates they're now talking about?
I'm not sure they have, actually, because these higher rates are still pretty new. And I think when we also are listening to commentary from companies, I think companies don't know how long they're solving for the tariff duration. Again, because it's still possible to believe that these tariff rates are still only going to be temporary, that they'll come back down, that this is all kind of part of that art of the deal, that even the 15% rate will only be temporary. So I think that is still a challenge. I think it's the cumulative effect, right? I think the U.S. collected $26 billion of tariffs in the most recent month we have data, which is June. You had $26 billion annualized is over 1% of GDP. That's a big number. Over a given month, it's not that big of a deal. But the more time that goes on, the more this cumulative effect piles up. I think that does have a grinding larger issue that's going to be felt by companies, felt by consumers. And so, the duration on this stuff matters. And again, I don't know if there's been, we don't think there's been full adjustment. And that's a reason why we do think growth slows down, that there is this cumulative effect of change that we have not seen yet, that's happening on both the tariff side and also on the immigration side of the economy.
Andrew, thoughtful stuff, as always. Andrew Sheets there from Morgan Stanley on the U.S. economy and on global markets. The next test is the economic data. What does the pass-through look like? If we get weaker data, how forgiving will investors be? And does it complicate the easing bias at the Federal Reserve?
And on the contrary side, if you don't see that kind of pain filter into the economic data, how much do people double down on bullishness and then get potentially smacked in the face when some of these potential ramifications come through? I know that sounds really dramatic, but that's kind of what Andrew was talking about.
I'm with you. Morgan Stanley not alone. Goldman Sachs talking about something similar, that these dynamics, the growth inflation mix will sour in the back half of this year. We'll see.
Yeah, but if you cry wolf too many times, times, nobody's going to really believe you. And I think that's part of what's going on here, is that the bears have been wrong for so long that people are just saying, stop being so pessimistic. AI will solve everything. And that's sort of the dynamic right now in the market.
We're all massively desensitized, so desensitized that this headline here isn't shaking anyone. The president visiting the Federal Reserve later on today.
No one's really surprised because of this issue. He's almost told the market what he plans to do and conditioned them that he obviously has a problem with Jay Powell. Also, I would say the Treasury Secretary made it very clear that they are just going to let him serve out his term, and they are not in a rush even yet to name someone, to have this idea of a shadow Fed chair. I think a lot of people also, especially on the heels of the Wall Street Journal report last night about Epstein and what's going on at the DOJ, that they view this strictly as a distraction tactic.
So what's the trade? Jordan Rochester will join us a little bit later from Mizuho. He's making the case that just price in more cuts for 26. Forget the games in the theater, the drama of 25, just price in more rate cuts for 26.
And that's what a lot of people are saying. That's what we heard yesterday from Bank of America as well, from Aditya Bahave, saying essentially whoever they put in the office next year is going to have an inclination to cut rates. Whether that's going to be challenged by some stagflationary type data, I don't know. People aren't even considering that, because ultimately that is going to be a predicating factor for whoever gets that nomination.
If you are just tuning in, welcome to the program. Equity futures this morning positive by about 1/10% on the S&P 500, following another all-time high at a close yesterday. With an update on stories worldwide with your Bloomberg Brief, here's Yahara Anand. Hey, Yahara.
Good morning, John. We are just over a week away from President Trump's August 1st trade deadline. Last night, the president said he would set reciprocal tariffs between 15 and 50% for countries who do not make a deal. The EU and U.S. are moving toward an agreement that would set a 15% rate. Trump said the EU can pay a lower rate if it agrees to open up to American businesses. Meanwhile, shares of Tesla are falling 6% in the pre-market after the EV maker reported second quarter results that missed already lowered Wall Street expectations. Revenue fell 12%, its sharpest decline in a decade. CEO Elon Musk warned of a few rough quarters ahead as Tesla loses EV incentives in the U.S. And on the flip side, Alphabet shares are rising 3.5% in the pre-market after its second quarter sales beat estimates. The company said it's raising capital spending by $10 billion to $85 billion this year, citing rising demand for cloud and AI services. Google is weaving its flagship AI model Gemini into its product portfolio as it confronts competition from both Meta and Microsoft. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, 15 is the new 10.
We're going to have a very, very simple tariff for some of the countries, a straight, simple tariff of anywhere between 15 and 50%.
Up next, we'll catch up with Ed Mills of Raymond James, live from New York City this morning. Good morning.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television. We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance. Check out the euro this morning. Euro dollar 117.48, down by 0.2%. An ECB meeting later on this morning. After cutting borrowing costs by 200 basis points over the last 12 months, the ECB and Christine Lagarde are expected to hit pause at a meeting later today.
Yeah, and if they do, that would be the first pause since its July 2024 meeting. And the big question is going to be, how much further are they going to go? Will they cut again, or are they going to remain on hold for a prolonged period of time?
Expected to remain on hold and then figure out what policy looks like. We're all in the same boat. We're waiting for a deal between the US and the EU. Equity futures positive by about 0.1% on the S&P 500, up a third on the NASDAQ. Under surveillance this morning, 15 is the new 10.
We're going to have a very, very simple tariff for some of the countries. There's so many countries you can't negotiate deals with everyone, so we'll have a straight, simple tariff of anywhere between 15 and 50%. A couple we have 15 because we haven't been getting along with those countries too well, so we just say, let's pay 50, and that's the way it is.
It's the latest this morning. President Donald Trump suggesting tariff rates will not go below 15%, as Europe is said to be closing in on a deal ahead of his August 1st deadline. Bloomberg's Akela Gardner joins us now for more. Akela, welcome to the program. Just how close are we to an agreement between the EU and the US?
Well, we still are not sure exactly how close the U.S. and the EU are to a deal. But as you said, we do know now that the new floor is 15% after President Trump and his top cabinet officials have continued to say that 10% was the floor. That seems to be shifting, but that number is particularly important to note because that is the figure that Japan just secured this week for their tariff deal. They also secured 50% for automobiles, which is a huge question for them. They really wanted to see that tariff go down from 25%. But with the EU still in focus, the president said yesterday that their conversations are very serious. But something that Commerce Secretary Howard Lutnick said in his interview with Anne Marie just yesterday is he really touted that $550 billion fund that Japan is now touting for the U.S., an investment fund. They say it's all new capital, and it really shows that they're looking for these big, shiny objects from countries. They want to show that they're securing a deal that, in their eyes, is good for the American people, and that is something that they could be looking from the EU and other countries going forward.
We're slowly getting some clarity on what these trade agreements might look like over the next several months. Where we're not really getting any clarity is the future of Chairman Powell. To have this on the schedule today, Kelly, you've been following it. The president will visit the Federal Reserve. What's the objective of this visit?
Yeah, we've been talking about this visit all week, but we did not know that President Donald Trump was also going to be on the visit. That was a surprise to me. This came in last night that he is expected to visit the Federal Reserve. We knew that his top aides, including his budget director, Russell Vought, were expected to make that visit. Also some other top officials. But now the president is going there, and this is a really interesting contrast because the Federal Reserve, of course, is an independent entity. You do not typically see presidents visit the buildings, and we know that they're looking at the renovation projects. There's been a lot of skepticism about the cost overrun, which they estimate to be about $700 million. But Federal Reserve Chair Jerome Powell has continued to push back to say that they are handling their finances responsibly and push back against these allegations that he is wrongly handling the finances of the Fed.
Akela Gardner, down in Washington. Akela, thank you. To extend the conversation, Ed Mills of Raymond James joins us now for more. Ed Mills, a tour of the Federal Reserve HQ. What's the purpose of this tour?
Well, John, Donald Trump's a builder. He loves a good tour of any construction site. He loves theatrics. He loves to keep this pressure campaign on. I don't think that President Trump is going to fire Jerome Powell, but do they like to keep that pressure on? Do they like to have conversations about who the next Fed chair could be? Absolutely. Do they kind of think that this could potentially get people to focus on what that next Fed chair could do, how dovish they would be, how they could deal with kind of the long-term interest rates that Scott Bessent always talks about, but a little bit of theatrics because he loves theatrics.
I'm envisioning now the president with a hard hat this afternoon at 4 p.m. when he takes that tour. Ed, is it working, though, this jawboning, these tactics when it comes to the Federal Reserve?
Yeah, Anne-Marie, when I talk to clients at Raymond James, they get concerned about the independence of the Fed. They get concerned that this could have the exact opposite effect. Ultimately, if you saw Jay Powell resign early or you saw him fired, the concern there would be, you'd actually see the long end of the curve blow out a bit. There is a concern already in the market that we just lifted the debt limit. And with the lift of the debt limit in 2023, the last time we used a lot of extraordinary measures, you had the 10-year go up 100 basis points. Now, we're not calling for that this time, but there is concern that there's a bias higher in long-term rates. And to do anything that could affect that in a negative way is not welcome news by this market.
Our colleagues in Washington caught up with Speaker Mike Johnson yesterday, and he said he was disenchanted with the Fed, but he wouldn't say whether or not he thinks the president should fire them. He said it was unclear about the legal authority that the president has to dismiss the Fed. Could that give the market some comfort, given the fact that the Federal Reserve comes with the purview of Congress?
Yeah, I mean, I think what we've seen throughout Jay Powell's term is that he's actually gotten a lot of good relationships built on Capitol Hill. It was actually unusual how well he has developed some of those relationships. And I think that gives him a bit of insulation right now, Anne-Marie. I do think that if we see coming out of today that Trump calls for an investigation, we already had Bessent call for an investigation last week, that's actually positive news because investigations take time. You always need a verb in Washington, D.C. If you're not going to fire, what else are you going to do? Let's investigate. Let's tour. These other verbs extend out the timeline of his ability to stay there. And then it kind of goes to that next question of who's next? Is it going to be Waller? Is it going to be Warsh? Is it going to be Bessent? Is it going to be Hassard? Those type of conversations is where the next verb goes after we have that quote unquote investigation into what's really going on here.
Ed, in the beginning, people were talking about Fed independence. It seems as though the market's moved on. How much do clients call you and take this seriously versus say, how much is this a distraction technique, as Anne-Marie was mentioning?
Yeah, Lisa, I do think that the part of the reason why they have moved on is because there's been multiple times where the president's kind of has said that he will not fire Powell and that others in his cabinet, especially the Treasury Secretary, has come out and said that that is not going to happen. He's going to let him play out his term. And the fact that each of the individuals I've mentioned are viewed as credible next Fed chairs. There could be a debate among the group as to kind of who the market would like more and who would be the more traditional one, but we're not seeing candidates so far that are so outside the norm that they say, all right, well, at least once we get through this, who is in that seat was in the kind of lane of normal candidates, and therefore they're okay with this.
Which is a reason why a lot of people are just parking the apprentice, the Fed style, to the side and taking a look at what the tariff rates are and the next policy step. And when it comes to the tariffs, it does seem like people are welcoming this degree of certainty. How much certainty are we getting from the deals that are being announced, given the fact that they're fungible? It seems like they're still in a negotiation process.
Lisa, I thought we were in agreement that this was Love Island, not Apprentice, but we'll move on from there.
Game of Thrones.
But on the,
we can debate that later.
Yeah, on the tariffs, I do think that there is a lot of folks that are saying, all right, these deals are not real deals, that these are memorandums of understanding. They're kind of easy to kind of come up with in a abstract sense right now. The real work comes later. And therefore, there's an expectation that come August 1st or soon around August 1st, we'll get the vast majority of our main trading partners to sign that MOU, live to fight another day. The U.S.-China relationship, it seems like that August 12th deadline is going to get extended because Bessent is meeting with his counterpart next week. And so to the extent that we've had positive things, even though the bar is being kind of moved once again from that 10 to 15, as long as it doesn't seem as if something completely unexpected comes, they're okay. If there's a bit of nervousness out there, though, Lisa, is the sectoral tariffs. Most of my week this week has been answering questions about what's happening with semiconductors because they're at 52-week highs and a unexpected outcome there is what could rattle the market.
Nothing beats a trashy UK season of Love Island. Ed, thank you, sir. Ed Mills.
That was your takeaway?
There's no way you watch Love Island.
Of course I do.
Oh, you know he watches Love Island.
Love that
The
stuff.
British version or the American version?
The British version.
All of them,
So
probably.
you switch off from financial markets and everything going on here.
But do you? That's the question.
Up next, I'll get dialed in. Dan Ives of Wedbush as Elon Musk warns of a hard year ahead for Tesla.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO? It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Three days of gains on the S&P 500. Incidentally, the longest daily winning streak of the month so far. Equity futures this morning, just about positive on the S&P. On the Nasdaq, up by 0.25%. Earnings validating the rally of the last several months. Beat and raise has been a theme over the past few weeks. American Airlines out a little bit later. The airlines, for me, very interesting because the airlines were the first to warn and the first to signal the all clear over the last few months.
Yeah, although which airlines? And this actually is going to get increasingly important. We heard from Delta, we heard from United, a raise and a beat and the sense that there was this resurgence of customer demand. Southwest, not so much. And how much is this a tale of two different customer bases?
Let's get some single names for you. Anna, look at some of that. 3 hours away from the opening bout with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. Yeah, some of these big tech names impossible to avoid this morning, Alphabet being one of them, reporting after the bell. It is getting that AI demand that is exciting investors, despite the fact it talked about $85 billion in capital expenditures, $10 billion more than it had forecast previously. First shares dipped post-market off of that, but considering the type of demand it's getting and it needs to spend that much, investors are okay rewarding it. On the other side of things, we have Tesla this morning. Those shares falling quite a bit, just under 6%. The quarter itself was really difficult. It was the worst revenue in over a decade in terms of growth there and dropping there. And then it was also a rough quarters ahead that Elon Musk warns as he tried to frame this as a company in transition from EVs to robo-taxis. I know you're speaking to Dan Ives in just a moment about that, so I wore my brightest jacket in honor of that. Finally, wrapping things up with Chipotle, they also reported earnings after the bell yesterday. Easily the worst performer in the S&P pre-market, down 10%. They cut their annual outlook for a second time, something that's very rare, or had been rare for Chipotle. They said it's economic anxiety. The CEO saying that customers want value over what he called freshness and quality. He says they're not going to offer any discounted type offerings. Instead, they just need to do a better job communicating that Chipotle meals are a good deal, John.
Danny, thank you. Appreciate the update. More from Danny in the next hour. On a radar this morning, President Donald Trump declaring countries will face tariff rates between 15 and 50% as countries race to make agreements ahead of his August 1st deadline.
Yes, I keep coming back to it. People are rallying around this idea of certainty, even though it isn't the 10% that we initially thought was the floor. My ultimate question is, how much certainty do we actually have, given the fact that you've heard a number of trading partners that already have deals come out and say, we're looking for a little bit of a better rate, and you have the president saying, well, if they don't behave well, we're going to raise that tariff rate. So again, how much certainty have we really gotten?
There's not a lot of certainty because there's going to be uncertainty throughout the entire administration. We are 6 months in, and we have another 3.5 years to go. What I will say, though, it is clear that no one is getting under 15%, really no one, in terms of how I viewed yesterday's discussions with a number of cabinet officials and also other people at the White House. Also, when the European Union comes out saying that they have these lists and they're going to go for a 30% retaliatory rate on the United States if there's no deal in place, basically everyone in Washington is shrugging this off, and they're just like, yeah, whatever. They have to say this. They're taking cues from us. It's a negotiating tactic.
And if you don't strike a deal, maybe the floor comes up. If you wait, maybe the floor comes up from 15 to 20.
Yeah, at what point does the market care? Here's the ultimate question. Has the market really moved on, and is it legitimate to just move on from this idea? Or could we see something that actually rattles people again and gets the sense of a trade war brewing once more?
Got to see it in the data. We've talked about this over the past few weeks. Don't see it in the earnings in a big way. Seen some great earnings, seen some raises to guidance as well from some cyclical names. When you start to see it in the data, if you see it in the data, then we've got a different story.
And then all of a sudden 15% becomes a little bit more punitive. I'm very curious about what the ECB says about this rate and how they bake that into their growth estimates for the region and what that means for their projections going forward.
The ECB meeting today, that concludes at 8:15 Eastern Time. Let's turn to this, another central bank. President Donald Trump making a round visit to the Federal Reserve this afternoon. He'll tour the construction site being criticized for cost overruns. Trump's visit marks the first of its kind in nearly 2 decades.
You don't normally see this, and we did know, to Akayla Gardner's point earlier, we did know that administrative officials were going to head over to the Fed today. We just didn't know the President of the United States was going to be joining them. I like what Ed Mills was saying. This is someone who, loves theater, loves a little bit of drama. Also, public confidence in a recent Gallup survey shows that the chairman, Federal Reserve, Jerome Powell, is at a low right now. So maybe the president, maybe it's a distraction tactic, but at least he's leaning into, I think politically, what they would say, maybe where the American people are. And he could say, you guys don't trust him, I don't either, and I'm going to go take a look at this renovation myself.
The president's got expensive taste. He might make the case to spend more. You never know.
I was actually wondering that. Is he going to say, I don't like the marble, I want better marble? Here, a little history lesson.
Put some gold on this.
Exactly. I would like gold plating, and I'd like some angels. I am curious about just the history here. I was looking, 2006, George W. went to go visit and go to the then Fed chair's swearing-in ceremony of Ben Bernanke. Before that, Gerald Ford, 1975. Franklin Roosevelt in 1937. Those are the previous visits from presidents to Fed officials.
But those visits, the tone was different. I'm going to see the swearing in. I am welcoming this person. I am excited about this Federal Reserve and independence. This is about, I don't like what you're doing. And even you have senators now calling for this investigation into the renovations. The renovations are above budget. But at the same time, this is not going to be one of those George W. Bush exciting visits. This is going to be something the president is going to, you know, put the Howard hat on and say, this is terrible.
They weren't real estate developers. He is.
Yeah, exactly.
I love this
Big
later on.
condos.
This afternoon, in the building.
In the building.
Yes,
pay for the renovations.
Lease them out to Fed governors.
Exactly.
Who knows?
Save money.
Let's get to earnings. Alphabet reporting stronger AI demand alongside surging capital spending. The tech giant raising its capex forecast for the year by $10 billion to $85 billion.
And they're not done. The commentary was saying that they're going to keep raising next year because ultimately, if they don't, they're not going to keep up with customer demand. On top of that, they have to offer compensation that also was significantly higher than expected. Why? Well, thank you, Meta and Mark Zuckerberg, and how much they're paying people to get talent on board. They're increasing their compensation packages over at Google as well because they need the top-tier talent. This just shows it is a war for talent. It is a war for prowess in the AI world, and it is not going away.
Almost a year today, the risk of underinvesting is dramatically greater than the risk of overinvesting for us here, the Alphabet CEO, 12 months ago.
And it seems like that hasn't changed. And I will just say, OpenAI, ChatGPT, how much is that the threat that keeps up Sundar Pichai at night? Because ultimately that is an existential threat to their business model at a time where they're still highly dependent on advertising revenues.
The stock is up by more than 3%. Let's stick with the Mag 7. Tesla CEO Elon Musk warning of some rough times ahead after one of the automaker's worst quarters in over a decade. Dan Ives of Wedbush is the biggest Tesla bull on the street with a price target of 500 and an outperform rating. Dan joins us now for more. Dan, good morning.
Great to be here.
Revenue down 12%, vehicles delivered down, average selling price down, and yet you're at $500. Tell me why.
Yeah, I mean, look, the quarter itself, nothing to write home about. But I mean, our view, it's about autonomous robotics. AI is the future for Tesla. So to me, yeah, it's a rough few quarters ahead. But I believe autonomous, we are in the beginning. What's going to be $1 trillion valuation alone for Tesla. So that's why I don't get so concerned when we talk about deliveries, which actually were kind of in line. You know, when we look at what's going to happen in the second half, the story here, when it comes to physical AI, two best ones out there, it's going to be Tesla and NVIDIA.
Moving from a pre-autonomy to a post-autonomy world, did he do enough on the call last night to convince investors that it's going to be smooth sailing?
Look, I mean, obviously the call, you know, definitely some could have criticism in terms of, you know, promising so much. Look, my view is if 20 to 30% of what he promised you see in the next year, this is a stock that's up 70, 80% from here. So that's why when I look at Tesla, I don't focus, and we've talked about it so much in the show over the years, I don't focus near-term deliveries, what that means in terms of, you know, EV tax credits. This is an autonomous robotic story. And I think, look, the AI revolution, as we saw from, you know, from Alphabet, I mean, we are just in the early days of this playing out.
Maybe I'm Chicken Little, but I was looking at this press conference. I was reading this, and I was thinking, this is a disaster. I mean, essentially, this was a dream stock, and suddenly they're talking about tax credits and things of that nature. They used to talk about an affordable vehicle. Now they're talking about a stripped-down Model Y that doesn't sound that sexy at all, and they're going to expedite production of other vehicles and put that on hold. What would it take for you to get bearish?
Yeah, look, I mean, you bring up great points. And that will be the bearish points. And when it comes to the affordable next vehicle, is that just going to be a stripped-down version? Look, Lisa, my view is that it comes down to like robo-taxi. If you're in 25 cities in the next year and you actually start to get volume production of Optimus when it comes to robotics, I think 90% of the future value is going to be in the AI story, not on the actual deliveries in terms of cars out there. You have 10 million vehicles in terms of Teslas out there. It's all about the data. And I believe the big thing is going to be at the shareholder meeting where they'll have a significant investment in XAI. And I think that's where you get more of a wartime CEO in Musk. And I think that's really going to be the difference.
Were you satisfied by his answers about XAI, about the investments there, the crossover with Tesla? Because there was a lot of ambiguity. Yeah. And he was asked that directly, and he wasn't able to explain that connection and how it really does rebound over, other than some people who are in this industry don't really want to work at a car company. I want to offer them an opportunity to.
Yeah, I wouldn't say, like, that conference call is not, you wouldn't put him in the Neary Hall of Fame, that conference call, okay? But again, we know, like, with Musk, it's never going to be, you know, it's not going to be Microsoft-like. But my view is, and we've talked about it, like the board, they need to get them 25% voting. I think that's key. That starts what's going to be a significant investment in XAI. But we've said also, are there guardrails there that they need to put on? You've seen them become less political since the July 4th third party. too. So I think, look, you want to see him less focused on that, more focused on being CEO, because it comes down to, like, the biggest asset for Tesla is Musk.
The press secretary yesterday was asked, does the president support federal agencies contracting with Elon Musk's AI company? Her answer, I don't think so. No. Can he do this without contracts?
Look, I think, but then it comes down, look at Grok. I mean, when it comes to Grok, and a huge part of the DoD deal, look, the reality is that Trump administration could say what they're going to say, but they need Musk. Of course, they need Jensen. I mean, they're going to need leaders when it comes to, of what this AI revolution. I think, look, that's the reality. And I do think at one point you'll start to see them, I wouldn't say necessarily become friends again, but sort of mend fences given what Musk needs to do going forward.
Elon Musk, Sam Altman were not called out yesterday when the president was giving shout-outs at this AI summit. Is Jensen Huang the new first buddy?
Look, he's at the cool kids table. I mean, right now, like, if you look where Jensen is, like, he is the first buddy for Trump. Because
he's almost running policy, Dan.
Look, and the reality is there's one chip in the world fueling the AI revolution. And that's why when it comes to the Middle East trip, who's to the right of him? Jensen. When it comes to anything, when it comes to China negotiation, the biggest poker chip that you have is NVIDIA. I mean, when it comes to, so first buddy is wearing a black leather jacket, his name is Jensen.
Final word, Alphabet. What did you think of the numbers?
I thought this was as bullish as you could see in terms of the actual numbers from search, from YouTube. And this is no longer an Alphabet in the corners, like, crying. This is one coming out being like, we're on the offensive.
You think they can make the transition from that ad model that's dominated the last several decades in Silicon Valley? We can make the transition away from that?
I think it's going to be a renaissance for Alphabet. I believe from a large cap perspective, it's one of the best risk rewards out there. That's why it's a table pounder. We went 225 in the price target. And look, haters hate on this, and I get it. But the bears in hibernation mode, there was nothing on that call that they're going to grasp onto. And I want to see them increase CapEx. It's an arms race right now in AI. You want to see them in the left lane.
The good news is the market's willing to support them, Bremo. That the stock is up off the back of this CapEx boost and it's not down, because then they'd have very different problems.
Well, initially it was down, and that was interesting because people had the knee-jerk reaction of stop spending so much before you can give us a sense of how you're going to monetize it. But as he spoke and he talked about customer demand to change, right now I am ChatGPTing, is Google search in its decline? And I will let you know what it says.
But I'd also say the bears, when they're in hibernation mode in the caves, they can find AI in the spreadsheets. And that's part of, I think, how they've missed so much of this AI revolution. Look, get the popcorn out. This is just a precursor of what's going to be a bullish tech earning. Microsoft, Meta, Palantir, and others.
Dan Ives of Wedbush. Dan, appreciate it.
Great to be here.
What did ChatGPT say?
Yes, there's a strong case to be made that Google search is in a period of noticeable decline. Not in usage necessarily, but in quality, user trust, and effectiveness.
Is this the future of this program? Is this what we're going to be doing?
Hopefully not. We're going to move on.
Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. President Trump signed executive orders to boost AI development in the U.S. by loosening regulations and growing power supplies for data centers. Measures will address energy and permit issues for infrastructure, the promotion of AI exports, and a call for models procured by the government to be both neutral and unbiased. Trump says the U.S. will lead the world in AI. Meanwhile, Deutsche Bank shares are rising 7.5% in Frankfurt to the highest level in a decade. The German bank reported better than expected trading results, mirroring the strength we saw across Wall Street. CEO Christian Sewing says the results put the bank on track to meet its targets for the year. And back here in the U.S., IBM shares are falling 5.5% after the company reported weaker than expected sales in its software segment, an area central to its long-term growth strategy. Sales for the unit grew nearly 10% year on year to about $7.4 billion, but that was significantly lower than what analysts were expecting. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara in the next hour. Up next on the program, taking the fight to the Fed.
Why in the world do we have such a high interest rate? It's got to be cut. Donald Trump is absolutely right. It's got to be cut. This guy's got to go. He should either resign or be replaced.
Up next, Jordan Rochester of Mizuho, live from New York City. You're watching Bloomberg TV.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we don't want to lose you, Emily, in all of this?
Stargate, put that name down in your books.
What we're undergoing right now is sort of the largest infrastructure bill in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Record highs coming into Thursday. Equity futures just about unchanged this morning on the S&P 500. Positive on the Nasdaq, up by 0.25%. Under surveillance this morning, taking the fight to the Fed.
We are the most important country in the world with the greatest economy in the world. Why in the world do we have such a high interest rate? It's got to be cut. Donald Trump is absolutely right. It's got to be cut. This guy's got to go. He should either resign or be replaced. And we've got to have rates lower.
Here's the latest this morning. President Donald Trump preparing to visit the Federal Reserve as Commerce Secretary Howard Lutnick calls on Chair Powell to resign or be replaced. Jordan Rochester of Mizuho writing the following: that's a tale risk markets can't ignore. It reinforces our view that more rate cuts will be priced into 2026. Jordan joins us now for more. Jordan, welcome, sir. Let's talk about market pricing, what the Fed's projecting, implied by the median dot for 26, and where you think things will be a year from now.
Indeed. Well, John, good morning. What you can see in terms of the numbers, they've got 2 cuts for this year, more cuts for next year. For us, the view from Mizuho, John, is actually the risks are to no cuts this year as long as Powell stays in place. So that's why it's a key part of that story. And so we'd like to trade Z5, Z6 flatteners, which basically says price out cuts this year, price in more cuts next year. Whoever will be at the Fed following Trump's change in Fed chair when Powell does step down will be more dovish and lead the direction of markets that way.
So, Jordan, push that through foreign exchange. How does that shape a short-term and medium-term view for the US dollar?
Well, we've had pretty significant sell-off in the dollar so far year to date, thanks to Liberation Day, the FX hedging flows, the European Renaissance trade with Germany. So we're going a bit sideways in the dollar more recently, but I think, John, there's tactical short dollar yen and long euro dollar trades will work. The view from us is we get to 122 in euro dollar by year end, 138 in dollar yen by year end. I think the dollar yen trade of the two is better. Euro's been a bit more exposed to tactical views, where yen had a bit of an unwind in the long yen trade over the past 2 weeks. We're starting to get a bit more yen strength more recently.
Jordan, how do you factor in some of the AI discussions and the strength that's been really on the heels of that we've seen in the economic data as playing into this? The idea that, sure, de-dollarization makes sense when you take a look at monetary policy, but not if you're trading off the relative strength of various economies.
Indeed, the AI capex could be something close to 2% of US GDP. It's quite incredible, the numbers that you see from AI, capital spending expectations. So that actually argues for growth to hold up better, despite all the fears of what Liberation Day means for corporates and lower investment intentions you got from that. The AI theme has kicked back in, especially with the US administration relaxing their H2O export restrictions. So, Lisa, in answer to your question, it means US exceptionalism could come back, and this whole sell US theme, we call it the de-dollarization theme because some people simplified it to sell America, and for us that was just too simple of a theme and not true. The US has a dynamic economy, a strong labor market, and it will outperform a lot of peers.
At this point, we're going to hear from the ECB later this morning. Potentially, we could hear their projections for growth on the heels of the tariff rate that is being talked about, the idea that it's a 15% floor, not 10%. How much does that impact the growth trajectory of a region that's already had a lot of optimism baked in?
They had a lot of optimism baked in, a bit of a jammy dodger in terms of they looked at their forecasts. They had the fiscal from Germany fully in their numbers, but from the tariffs, they didn't really put in the more severe scenarios that Donald Trump was throwing out there. So at this press conference today, it'll be interesting to see if Lagarde reflects that. We won't have an update of those numbers in the forecast because that only comes at the September meeting. We won't get them in paper, but I suspect she'll have to say, actually, our base case, which was 10%, could be more like 15 or closer to the severe scenario that the ECB had at 20. But I'd like to remind everybody, Donald Trump is actually saying it could be 30. So the ECB needs to weight their forecast a bit more on these tariff impacts. You had a 0.7% hit to GDP between the severe and the baseline expectation for the ECB. It will lower their CPI forecast perhaps by 0.1 to 0.2. So it's not too severe for their inflation forecast, but it can mean quite a lot for their GDP.
Jordan, I'm just going to translate just briefly. Give me a second. Do you guys know what a jammy dodger is?
No, but I assumed that it was something very significant.
What does it sound like to you? What do you think it is?
Jammy dodger?
Yeah, what do you think that is?
A jammy dodger sounds like a party at, backyard barbecue.
It's a biscuit. It's a biscuit. But it also means
British people.
It's slang for like getting lucky.
Oh, what is it? Jammy
dodger.
So the opposite of sticky wicket.
Possibly. Okay, Jordan, let's continue the conversation. Let's talk about dollar yen. There's a segue. Let's talk about dollar yen. Dollar yen this week, what's more important for Japan? The trade agreement or the future of the Japanese Prime Minister? And with the future of the Japanese Prime Minister in mind, just how wide are the range of outcomes for fiscal policy?
Number one, it's the trade deal, John, because that's fact. We know what the trade deal is. We know it's a big positive surprise for Japanese autos. I don't think anyone really expected the Japanese to get as lucky as they did in getting a 15%. I say lucky, it's still worse than what they had before. But the UK was the only good example of getting close to 10, and the UK exports way less autos to the US than Japan, a factor of 12 times less than Japan. So it's a big deal for Japanese corporates, especially in the auto sector. And then when it comes to the actual leadership of Japan, that's the unknown. We don't know if Ishiba is going to resign. The speculation is rife that he will. The sort of polymarket projections, the sort of betting odds were close to 80% probability he will step down this year. And if that were to happen, then, John, it opens up all these tail risk scenarios. But we don't know who will be the front runner for that leadership nomination. And rule one of Japan politics is don't assume you'll know who wins. Because I remember being quite shocked when Ishiba won last time round. So let's see who comes to the fore there. And if you get Shiba being replaced by a dove, that could be a big thing for the long end in Japan. And that is the big story for later this year.
Jordan, appreciate it. Just make a note next time you speak to US clients. No idea. Jordan Rochester of Mizuho. Jordan, thank you, sir.
You just taught us all.
Appreciate it.
I mean, we all now know, and I've actually been looking at it.
Been researching biscuits.
They look very pretty. Yeah, they do. They're like Linzer tarts.
Kind of things that you like when you were a kid. Anyway, his view on the Federal Reserve. Price out 25, price in more for 26.
And this seems to be increasingly a consensus. I mean, we heard this yesterday from Aditya Bahave of Bank of America, who sees no cuts this year, but potentially 100 basis points of cuts next year. Why? Because essentially whoever comes into the Fed will have an inclination to cut.
Let's close out this segment. Up next on the program, What was that? We'll catch up with Darren Cannon at Clear Harbour.
You did that.
Libby Cantrell at PIMCO. I was just wondering. I was trying to translate.
Oh, yeah.
He said it, and I saw you being like, I've got no idea
and I was
what
laughing, and I was
channel
laughing because you reacted, and I knew that I did not know.
And then Zero Bants over there starts talking about sticky wickets. You know, conversation killer. The second hour of Bloomberg Surveillance up next.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
A cidade estava sitiada.
Nisso eu começo, eu não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner. I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being a billion-dollar business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
We could continue to see threats of tariffs.
There's a long list of scenarios as to how tariffs get better and a very short list as to how they get worse.
We're in a little bit of a purgatory on negotiated trade deals.
Do you think we're going to get more deals in the coming weeks?
The deadline is serious. The market should cue to this. Trading partners should cue to this.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Everyone knows what zero bants is.
No.
Like no banter.
We're going to start on this.
Zero bants. No banter.
Banter is a British word as well.
But doesn't that translate now? I think people understand what banter is.
That does translate. I mean, yes, but I think I'm going to stay out of this one.
No banter.
I think I'm going to, I'm going to definitely stay.
You're on this show. It's
Welcome to New York.
Zero bants.
Let's move on. Ask
All right.
the audience.
Your scores this morning look like this. Equity futures on the S&P unchanged. Record highs at a close yesterday on the NASDAQ, up by around about 0.3%. Later this morning, attention on a different central bank, the ECB decision, 8:15 Eastern time, and then some economic data, 8:30, jobless claims. We're starting to get a feel for the tariff rates. How well understood are the consequences?
Yeah, and how much patience will people have before they can really just say we're not going to see that weakness? It really has been a chicken little market where people have said that any kind of tariff rate, even a 10% tariff rate, would cause a slowdown in growth. Now you have 15% floor, and people are saying we can look through that. At what point does the data really come to surprise?
Get that economic data at 8:30 Eastern time. Look out for jobless claims. We might get a deal as well between the US and the EU. Lisa said it yesterday, 15 is the new 10, and it certainly feels that way in the last 24 hours.
Absolutely, and they really only have a week to go when it comes to trying to finalize this deal with the European Union. They're going to have a tough few days ahead because, remember, Treasury Secretary Scott Bessent, Howard Lutnick, the Commerce Secretary, are going to Stockholm to meet with their Chinese counterparts, so they need to really wrap up the European Union trade negotiations basically in principle before Monday. It's very obvious, though. The European Union, which a few weeks ago was willing to eat and tolerate a 10% tariff level, really focused a little bit more on the sectoral tariff levels, are now going to have to eat and suck up 15% because that's where this administration is with Japan, and they're not getting a better deal than Japan.
The White House focused on something else later on this afternoon. The Federal Reserve, the president, said to take a tour of the renovations. And this is the kind of headline this president would like to see. This from Turkey, cutting the one-week repo rate by 300 basis points. That's the kind of headline the president wants, right?
How much are banks actually looking around to see who's traded in Turkey to try to bring them on board so that they can understand better the dynamic? This is a question. At what point is this too much? And at what point do you get the opposite ramification of what you're hoping for, which is longer-term rates going up? Look, the market isn't taking this that seriously because Scott Bessent came out and said we're not in a rush. And I think that his conversation with you put to bed a lot of the concerns that the pomp and circumstance of putting on a hard hat and going and commenting on the marble won't necessarily do.
The pressure is going to keep on building. Let's talk about the earnings so far. We'll get to Alphabet and Tesla a little bit later in the hour. American Airlines just dropping. We've heard from Delta. We've heard from United. They're all reinstating guidance and talking about a better second half.
Yeah, and American Air also reinstated full-year guidance. However, it sees its full-year guidance as being either down 20 cents to up 80 cents, and the expectation had been for guidance about 72 cents a share. So here's the question. How high is the bar for other airlines to meet? And given the fact that there was a really optimistic tilt to what we heard from Delta, affirming up, from United saying that our estimates right now are conservative, how much is American Air now challenged to show why it is not seeing that type of strength, even though we all were surprised by some of that really positive commentary coming out of the other majors?
Stock is down by close to 3% in the pre-market. Futures are doing okay, just about positive here by close to 0.1%. Coming up this hour, we'll catch up with Aaron Kennan of Clear Harbor Asset Management following another record high. We'll speak to Libby Cantrell of PIMCO on the latest trade threats out of Washington, and Chris Casso of Wolfe Research on President Trump's AI plan. We begin this hour with stocks on a 3-day winning streak. Aaron Kennan of Clear Harbor Asset Management writing the Magnificent Seven are expected to grow about 15%. Though notably, this is less than half the growth rate seen in full year 2024. Aaron joins us now for more. Aaron, welcome to the program, sir. Is that you pushing back against some of the euphoria?
No, I actually think it's maybe an argument for the broadening that we're seeing in the market. You know, going to this year, we were writing about how it was maybe going to be a bit easier for the sort of 493 stocks outside the Mag 7 to play a little bit of catch up in 2025. Now, equal weight S&Ps is lagging just by about 90 basis points year to date. I think the S&P's up, call it 8.99%, and equal weight's up, call it 8.1. So, you know, they're moving along more in sync. I think it speaks to the broadening of the market. I think the tariff debate and the reshoring of capital and manufacturing probably will augur well in the back half of the year for maybe mid-cap, small-cap. And in fact, we're already seeing sectors in the United States, which typically over the last couple of years have underperformed that tech run, like industrials and utilities, really perform quite well this year. I think industrials are the most positive performing sector on the year for the S&P.
Meanwhile, the NASDAQ just posted its 63rd consecutive day above its 20-day moving average, which is the longest streak going back to 1999. We hear these types of measurements, 1999, 2000. Does that kind of comparison worry you, that maybe things are getting just a bit ahead of their skis, even as you see potential positivity under the hood?
Well, always a little concerned when one sector, in this case technology, is such an overwhelming force in the performance of the market, Lisa. But if you look at forward multiples, yes, they're extended and they're sort of top decile. But relative to where we were during the .com era, and if you looked at just sort of the attention to revenue during .com versus the attention to earnings and underlying fundamentals, I think we're sort of in a different regime here as it pertains to where we are in the cycle. And I think there's also sort of a trickle-down effect, right? So we're looking at artificial intelligence, and of course that has an immediate impact on technology, but it's having an impact on utilities, on industrials. We're thinking about electrification. Where's the next electron going to come from? Nuclear takes 10 plus years to come online, if it can even be approved. So where are we going to find that? Is it going to be solar and battery support behind it? So there's just a lot going on, I think, in a positive way that is a different setup than we saw in the late 1999s.
We say every single day, Aaron, that the economy is not the market's not the economy. What you're talking about is very much the market and sort of the optimism of the investment in AI that might be felt in the economy in a very real sense, maybe a couple years out. In the near term, you expect there to be some turbulence coming from the tariff rates and potentially a slowdown in growth. Does it matter if we see that slowdown in that economic data for the rally that we're seeing in a market that's looking beyond?
Yeah, it's really interesting. I mean, I think there are a lot of big questions out there as it pertains to this rally, as it pertains to AI. We believe it's going to ultimately accrue to probably strong supporting margins, maybe even growing margins, but we think there will be disintermediation in the employment market. So from an economic perspective, you could see areas within the economy, both sort of less skilled as well as highly skilled, that become soft from an employment perspective, while we're seeing earnings continue to move in a very positive direction. That's a political challenge for sure, but it could accrue still positively to the market.
Not just a political challenge. What does the Fed do with that type of data?
Yeah, it's challenging, Emery. I mean, I think at the end of the day, the question the Fed has to do, which is, I think, where they're keeping their eye on the ball. They have a mission and mandate. There's a political conundrum that the Fed faces. Right now, they're damned if they do cut, they're damned if they don't cut. Yet they're keeping their eye on the North Star. And I think as long as they continue to do that, they'll be in good stead. But certainly just a lot of noise around that. I do think if you look at the inflation pressures of late on the margin in the last CPI report, it was on the good side, and it's not clear to me that raising or cutting rates is going to have any impact really on the good side. Those are, food products, gasoline, transportation, things like that. It's more on the service side. So if we saw inflation on the service side, I think it would prompt the Fed to make an even stronger argument that they need to hold for longer.
Well, politics is definitely going to be at the Fed's front door today when the president personally heads over to the Federal Reserve at 4 p.m. later this afternoon. Why is the market just shrugging this off?
It's a good question. I mean, I think at the end of the day, it seems clear that Powell will remain in place until the end of his term. And I think the market may be slightly unsettled. I think observers are perhaps, I guess some are jeering, some are cheering. But I think the consensus now is that Powell will maintain his job. But I find it somewhat ironic, too, that we have a building cost overrun of $2.5 billion at the Fed, and yet we don't have a politician in Washington that cares about the 2026 expected deficit of $1.8 trillion. I guess it's where we are in the political atmosphere and environment right now. It's somewhat unfortunate, in my opinion.
Aaron Cannon of Clear Harbor Asset Management. Aaron, appreciate it. To Aaron's point, if reckless spending was going to keep people out of a job in Washington, nobody would have a job in Washington, would they?
Look, I think that nobody's parsing through all of these details right now. Yes, you are correct. Right now, it seems kind of comical or light to think about $2.4 billion of a renovation that was up from some $1.9 billion back in 2019 when you're talking about, $3.5 trillion hole in the budget deficit.
Trump wants also options just on the table, and he is just trying to undermine at the end of the day the Fed chair's credibility, even if he decides he's not going to fire them. And part of that is because also I'm really struck by this Gallup poll about how the Fed chair is at a low when it comes to confidence with the American people. And Trump is just needling at that a little bit, and today's performance will be part of that.
The pressure keeps building. Speaking of pressure, look at this from the Financial Times. At least $1 billion worth of NVIDIA's advanced artificial intelligence processors were shipped to China in the 3 months after Donald Trump tightened chip export controls. That dropping from the Financial Times just moments ago.
So this is concerning if, especially, that China's getting their hands on these high advanced chips that the United States was really having these export controls and trying to hold on to. My question, though, here, seeing the dynamic play out in person between Jensen Huang and the president yesterday on the trip to the Middle East, was the administration aware of this and they're sort of turning a blind eye? Jensen Huang has been having these conversations with the president, and he is really the reason why they decided to make this U-turn when it comes to the H20 chips. But if not, potentially, this is going to be meaning Jensen Huang is going to get at the crosshairs of this administration.
It also goes to the whole idea of transshipping and transnational interference and exactly where these chips are going through, because this would be the B200 chip. This isn't the H20 chip. And this actually speaks to what actually went into the DeepSeek moment. And that will go to a lot of questions that people have about how advanced they've gotten and is it on the heels of U.S. technology.
Remember that phrase that came out of NVIDIA at the time, export compliant? Was it? Was it export compliant?
This is a great question, and how is it going to be enforced at a time where there's a lot of fungibility and a lot of moving parts on the rules side of things?
Stock is up at the pre-market by about 1 full percentage point. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. We start with some other NVIDIA news. President Trump said he considered breaking up the company to increase competition in AI chips, but changed his mind because it would be hard, according to him. At the White House AI Summit, Trump praised CEO Jensen Huang, while Huang commended the president's AI approach, saying America's unique advantage that no other country can have is President Trump. Meanwhile, Treasury Secretary Scott Bessent says he plans to bring up the Microsoft SharePoint hack with Chinese officials when they meet in Stockholm next week. Cybersecurity firm iSecurity says the flaw in Microsoft's SharePoint software hit 400 global organizations, including both U.S. nuclear and health agencies. Microsoft blames Chinese state-backed hackers. And you talked about this one earlier. American airline shares are falling 3.8% in the pre-market. The company reported second quarter earnings that beat analyst estimates, and it also reinstated its full-year guidance, but it said possible scenarios range from an adjusted loss of 20 cents a share to a profit of as much as 80 cents. American also forecasts a third quarter loss exceeding analyst estimates. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next, 15 is the new 10.
We're going to have a very, very simple tariff for some of the countries, a straight, simple tariff of anywhere between 15 and 50%.
Up next, Libby Cantrell of PIMCO, live from New York City this morning. Good morning.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Equities just about positive by 0.1% on the S&P 500 after closing at another record high in yesterday's session, up by a third this morning on the Nasdaq. Check out the euro 60 minutes from now, call it 59. We'll hear from the ECB, looking for them to hit pause after cutting interest rates by hundreds of basis points over the last 12 months. What's 17.50 on euro dollar?
Yeah, and how much do they indicate that they are ready to pick up rate cutting at some point with one more rate cut? That really is going to be the question. The other question I have is, how do they project out some sort of growth trajectory now with 15% being the floor for tariffs, not the 10% that they had baked in as their base case?
Do they push back against some of that euro strength as well, I wonder?
Yeah. Is it becoming increasingly complicated? Wasn't that the word that they used?
What they usually do, if you're the ECB president, you say something like, we don't target foreign exchange, but it has implications for our price stability mandate. That's how you navigate that issue.
Thank you. Are you writing your
scripts? I imagine that maybe they'll do a version of that later on.
Yeah, but we heard from them before saying it's getting complicated once it reaches 120. Well, we're getting pretty close. And if you look at the targets, what, Jordan Rochester, 122?
Yeah.
There we are.
117.50 on euro dollar. Under Savannah's this morning, as Lisa said, 15 is the new 10.
We're going to have a very, very simple tariff for some of the countries. Have so many countries you can't negotiate deals with everyone, so we'll have a straight, simple tariff of anywhere between 15 and 50%. A couple we have 15 because we haven't been getting along with those countries too well. So we just say, let's pay 50. And that's the way it is.
It's the latest this morning. President Donald Trump suggesting tariff rates will not go below 15% as the EU is said to be inching towards a trade agreement ahead of the August 1st deadline. Bloomberg's Akela Ganda joins us now for more. Akela, welcome back to the program. Just where will we be in a few weeks' time?
Well, it seems like the goalpost is moving regardless. We're seeing President Trump now say the floor is now 15%. That's up from 10%. But we understand that the EU, which is still a trade deal that we're waiting on here, is inching closer to a deal that would see them at that 15% level, including for automobiles. That's down from 30%, a tariff that Trump threatened not too long ago. And they badly want to secure this before August 1st, which is the day that the administration says that they will impose tariffs and start collecting that revenue. But the real caution here is this comes all down to President Donald Trump, who is the ultimate decision maker. He is hard to predict when it comes to which way he will go. He has also been incredibly critical of the EU and its relationship with the U.S. when it comes to trade. So we're going to have to see if he's okay with, again, this floor level. But the EU is preparing countermeasures in case they cannot reach a deal with the U.S. We knew that this is something that they threatened back in April when the U.S. first imposed these reciprocal tariffs, and those could target American cars, Boeing, bourbon, whiskey, some really key American imports.
Akela Ganda with the latest down in Washington. Akela, thank you. With us around the table, Libby Cantrell of PIMCO. Libby, good morning.
Good morning.
August 1st. Are we going to wrap this up, or is that the new July 9th?
Yeah, I mean, look, I think what we've been telling our clients is that we are going to be living with trade policy and tariff policy uncertainty for the duration of this administration. So maybe we get a little bit more clarity. I would agree that 15% is the new 10%, 10% is the new 0%. Kind of the best that a country can hope for, those with trade surpluses, is going to be 10%, and then everything else is going to be higher. I mean, Japan got, I think, arguably a pretty good deal here. But again, if we just take a step back and go back to December, right after the election, and we were just saying we're going to be sitting here and talking about how 15% seems pretty benign on one of our closest allies and trading partners, I don't think anybody would believe it. So I think that the Overton window, if you will, has really been expanded here, kind of shattered in terms of what is acceptable in the markets and in Washington. And again, I think from an economic and markets perspective, we do think this will start having a bite at some point, even though
maybe markets are just, willfully ignoring the reality here.
Or are the markets numb? Has Trump basically conditioned them to accept 15% because they're not as the sky-high April 2nd tariffs originally this administration came out with?
Yeah, I mean, I think, what we have been talking to our clients, the sort of like the taco man versus tariff man, this idea of Trump always chickening out. And if you actually look at the tariff level right now, it would not suggest that he is chickening out. Yet, yes, he has softened his most extreme stance. So will the effective average tariff rate go up to 30%? Not likely. But where we think it probably will land is between 15 and 20%. 15 and 20% tariff. I mean, that's, that's not insignificant. So yes, I do think that in some ways, again, this idea of, the Overton window, sort of what's possible in Washington, he's expanded that so much that the market is somewhat desensitized, but we do think this will start having actually real economic effects at some point.
When it comes to these negotiations, I was really struck by the Japanese one because of that $550 billion fund, and I'm still kind of confused about exactly what it is, because the Prime Minister of Japan is talking about that these are basically loan guarantees, and Howard Lutnick, the Commerce Secretary, is saying it's much, much more than that. Almost sounds like a bit of a slush fund. Do you understand what the administration is looking for when it comes to trading partners?
Yeah, I think we are like everybody else is waiting for the details. I mean, I think a couple of things on this. One is that for another country to be funding our industrial policy, that could actually have some implications. So I think there's one of just sort of, is this sort of politically realistic that you're actually relying on another country to actually make investments in things that are important from a national security or from an economic perspective for the country. The other, which is a little bit technical and a little bit wonky, but I think also important, is if the objective for the administration is to reduce the trade deficit, you can't reduce the trade deficit with a country and increase the capital account. Those things are supposed to be offset. So, I think that you're trying to have kind of both ways here. So we'll sort of see what the details are. I think our suggestion to our clients is just to focus on what we do know, though, which is the 15% tariffs. And again, that's an increase from the 3% that we had in January.
You have the joy and the opportunity of going around the world and explaining this to everybody. And I'm curious how different the reaction is for people not in the U.S. versus the United States, and how they plan to sort of operate around that.
Yeah, I was just saying before the segment that I was in Canada yesterday, meeting with some of our large institutional clients. I've been all over the world. We have the benefit of having long-standing relationships with clients, again, outside of the U.S. and inside the U.S. And the perspective is different. I think that. Some ways there's sort of asymmetry around the information. So I think there's some assumptions that are made that maybe are not necessarily right for our foreign clients. But I think more importantly, our clients were already over-indexed to sort of U.S. equities, to U.S. dollar-based assets coming into this year, right? The sort of the narrative of American exceptionalism, the expectation for just blockbuster growth in the U.S. and sort of languishing growth elsewhere come in January. That obviously has changed. Those expectations have changed. So our clients, in some ways, were already reevaluating some of their dollar-based asset allocation. And I think this probably has accelerated that. Certainly, the tariffs, I think, again, maybe they're impervious to that, maybe a little bit more desensitized. Some of the knocks on the Fed, some of the questions about the strength of the institutions, sort of the political, functionality of Washington. I think those all are still questions front in terms of in their minds.
Sam Zeef of JP Morgan Private Bank was on earlier, and he said initially people just work in the derivatives market to hedge their dollar exposure, but the actual reallocation happens over time. Is that something that you're seeing too, that there's a lot of reallocation away from dollar-denominated assets in the pipeline that hasn't fully come to the fore yet?
Yeah, I would say with our clients, we are seeing exactly that. We're seeing them sort of being taken out in the FX market, hedging their dollar-based exposure. Broadly speaking, there was some discussion around the tax bill. There was a Section 899, the revenge tax, which was definitely, I think, would have had some significant implications on actual asset allocation. I think now they are maybe sort of taking a step back and not necessarily divesting from the U.S., but I think sort of maybe hitting hitting a little bit more of the pause button in terms of new allocations to this. But of course, it's different for every client, so I don't want to sort of generalize, but I do think that there is more of just a reevaluation of some of their dollar-based assets.
Libby, it's good to see you. As always, thanks for being here. Libby Cantrell there of PIMCO. To pick up on Libby's earlier point, if you think 15% is chickening out, then you've been played and you don't even realize. Because he's set expectations to the extreme so far that you're willing to accept something that bad.
Maybe he won, right? Because right now the market's accepting it, and the market has essentially said we can live with that. And so the ultimate question is, what would it take? How high is the bar for the market to feel differently?
Up next on the program, we'll catch up with Ajay Radhayaksha of Barclays, with President Trump planning a rare visit to the Federal Reserve. Plus, we'll catch up with Danny Berger with your morning movers as the Mag 7 kick off with some mixed results. Tesla down 6%, Alphabet up by close to 4%. From New York City, this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
3 days of gains on the S&P 500, the longest daily winning streak of the month so far. Looking to add some weight to it this morning, up by 0.1% on the S&P, with 2 hours from the opening bell. Let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. We're getting the big tech earnings trickling in. Yesterday after the bell, it was Alphabet that had really strong AI demand. But to keep up with that demand, their capital expenditures, $85 billion, $10 billion more than they had originally estimated. When that number came out, first shares dropped. They reversed, though, really just talking about that strong demand for AI. 3.6% is where we stand. To the downside, there is Tesla this morning. The quarter itself was a difficult one. The worst fall in revenue in over a decade. Free cash flow evaporated, but it was an Elon Musk that tried to frame the company as one in transition from EVs to autonomous driving, saying that in that transition, there'd be a few rough quarters ahead. Shares down 6% this morning. Also heard from IBM after the close yesterday. The focus was on their software unit, and their growth in sales also disappointed. The hope was that AI features, AI tools, quantum computing would help lift it up. Unfortunately, the bar was high and the company didn't make it. Management there saying that they would have more AI revenue to come. Evercore, though, skeptical that software sales can continue at pace into the second half. Shares down 6%, John.
Danny, thank you. More from Danny in the next hour. On our radar this morning, one of our top stories, President Donald Trump floating a tariff floor of 15% on U.S. trading partners, saying his so-called reciprocal tariff rates will fall between 15 and 50 percentage points as countries race to make deals before the August 1st deadline.
And the market's accepting it. So right now, if he was looking for something to hold him back, well, he's not getting that from the markets. This is definitely something that is being welcomed as a relief. And I do wonder whether the relief from certainty is enough to overcome what the ramifications of a 15% floor to tariff rates actually means economically.
We've talked about it all morning. We know the rates in some places. Do we fully understand the consequences? So far, we don't. Got to be open-minded about how this plays out, but will growth slow? Will inflation firm? Will the Fed's easing bias be complicated going into next year?
Well, the difficult aspect with this is just on an absolute basis, maybe, right? Just if you look at one side of the equation and then the other, you could understand why there would be a stagflationary tilt to this. But then you overlay that with AI investment, some of the other sort of secular themes, and it becomes very difficult to make that blanket statement, which is the reason why people have been surprised by the resilience of the economic data so far.
Also, the Treasury Secretary said yesterday that if Trump is unhappy, say with a country like Japan, the rate can go back up from 15% to 25%. So how do you even plan for that future, especially when he is a self-described yesterday negotiator junkie. He said a deal junkie. So he constantly wants to be in negotiating mode. So who's to say by August 1st, even if they have these deals done, like with the European Union, which seems to be next in line, that it's going to end?
Libby Cantrell said the same thing of PIMCO just moments ago. Get used to it. We're going to be doing this for the next several years. Let's take a look at Tesla this morning. Shares are lower. The CEO, Elon Musk, warning of, quote, rough quarters ahead. The EV maker would be in a transition period for the next year or so. His comments coming after the company posted one of the worst quarters in over a decade.
The more he talked, the more the shares went down. This was a disaster of an earnings release. And some people dismiss all of his earnings release calls, as we heard from Dan Ives. It's just this is what he does. That said, real questions about bringing forward production of the more expensive vehicles, holding off on potentially creating that more affordable kind, making it just basically a stripped-down Model Y. Real questions also about his leadership going forward. How much is the onus shifting from a dream stock to one rooted a little bit more in reality?
When it comes to what's going on in terms of also how he's dealing with policy in Washington, not even the personnel issue of no longer being the first buddy and obviously the acrimony between him and the President of the United States, the one big beautiful bill calling back those EV tax credits, and the CFO yesterday putting the cost of tariffs on the company, saying it increased to around $300 million, a third of impact hitting the battery division. Of course, these batteries coming from places like China.
It's real money. Stock is down by close to 6% in the pre-market. Let's talk about the airlines. Southwest cutting its 2025 outlook, expected to take a $1 billion profit hit due to tariff uncertainty. Elsewhere at American Airlines, beating on earnings and reinstating its annual forecast with a wide range of -20 to 80 cents per share.
So both of them trying to quantify the potential ramifications from tariffs. You saw Southwest trying to say that they're going to lose as much as $1 billion off its annual pre-tax profit this year. Then you have American coming out, and yes, they have this really wide range, but what's notable is how different their tone is than United. United and Delta. United, Delta, stability, strength, recovery. Maybe we're underestimating the optimism. American corporate travel generally flat. Doesn't have much large capex in 2026. Third quarter more difficult with a bigger than expected adjusted loss being expected now in their forecast. Just not the same kind of picture, which speaks to execution, client base, and how much is really baked into the premium versus the rest of the cabin.
You nailed it. Execution. Americans had a problem for a while now. That problem seems to be persisting.
Which is the reason why they're being held to a higher bar, and the reason why you're seeing the shares lower, even after reinstating their earnings expectation.
That's the latest on American Airlines this morning. Let's turn to the Federal Reserve. The Trump administration piling the pressure on Fed Chair Jay Powell.
The president said he is not going to fire Chair Powell. It would do Chair Powell a favor, and he would be doing the institution a favor if he did an internal review. This mission creep from the Fed is endangering their independence of monetary policy.
President Trump making a rare visit to the Federal Reserve this afternoon to see the $2.5 billion renovation. Ajay Rajayaksha of Barclays writing, concerns about Fed independence persist, but we expect status quo to prevail. Ajay joins us now for more. Ajay, good morning.
Good morning.
This market has shaken off a lot. Threats to Fed independence, trade, tariffs, threats, actual tariffs. Can this economy keep shaking it off?
Yeah, I think as long as you don't get a policy mistake out of Washington on the magnitude of actually trying to fire the Fed chair, which I don't think will happen, I think we are past the worst of it, and we are looking forward to a big boost in growth over the next few quarters.
So this is really important because some people still fear that the worst of the data is ahead of us. What gives you confidence?
The fact that there have been virtually no second-order effects. Now, remember, I agree with your previous guest. Libby made the point that there have been substantial tariffs. If you told me we are at 2.5% entering the year, we finished at 17, 18, I would have been shaken. But part of the reason I would have been shaken is that because I would have expected business investment to pull back. I would have expected consumer precautionary savings to go up. Fact of the matter is, John, none of those things have happened. And that's to do with the, if they were going to happen, they were going to happen with the headlines. They were not going to happen when it actually plays out. It's very, very hard for me to see big new second-order effects now, the consumer pulling back hard. And without that, you do not get a lasting, like a recession, a lasting hit to U.S. growth.
Are we measuring the economy correctly? And I ask that because there are pockets that are clearly suffering. And you're seeing that in numbers like from Southwest, where consumers who don't have as much money aren't able to travel as much. But then you have this industrial revolution, this renaissance, this huge investment in AI technology that's generating efficiency and profitability at the biggest and the most powerful companies and individuals. Is this showing up in the data, or is this just changing the way we understand our economy?
I think it's the latter. I think we are measuring it correctly. There's no reason to believe that we've suddenly changed. The fact of the matter is what you said. The United States is two different economies. One is the old economy. We all grew up believing housing is the business cycle, for example, and housing is struggling with mortgage rates staying where they are. The durable goods sector, you mentioned airlines, they are struggling. Doesn't matter. You have the large tech side and the AI dividends starting to kick in. And I think that matters far more at an index level, at an economy-wide level. The fact that the hyperscalers just never pull back on spending. You might have worried as an importer into the United States about Mexico, Canada, whether I can make my business work or not. Who cares when Google is spending another $85 billion at a macro level?
Well, at the same time, back during the pandemic, it was sort of the revenge of the physical world. That was something that John said every morning as we walked in, and it was sort of the reality of trying to get toilet paper, although he had stacked up. I am just wondering whether we're going to end up with revenge of the physical world once more. We're talking about investment in the cloud, in all of this sort of technology that's for companies, the way we think, the way we do work in white-collar businesses. What about the goods and services that have to go over on ships?
I don't think there's going to be a revenge of the physical world. I almost think it's the other way around, meaning that right now we are all focused on LLMs. You put in text and you get out a bunch of information. That is the AI models, and that we think will hit services jobs. The fact of the matter is I think we are 3, 4, 5 years away from the same thing happening where you put in a bunch of text and you have a robot doing subtasks. I'm not kidding. This is not sci-fi. This is, I feel the way I did about NVIDIA 5 years ago. None of us thought it would get as big as it is. But the fact of the matter is, that Moore's law, the fact that things are twice as cheap, every 18 months they're twice as powerful, does work in the semiconductor world. It doesn't work in the physical world. fusing AI and robotics is powerful, and I almost worry that you're going to have more of the profits continue to go to capital. We always grow up believing, plumbers, you'll always need plumbers. Well, you might not 5, 7, 8 years from now.
What you're saying could ultimately mean the market is okay, but the employment market gets a whole lot worse.
It does, and...
Are there limits to that?
The limits are put in by society. At some point, there are 70 million knowledge workers in the United States. I've had a person I consider the single best investor of all time make the argument to me that he's looked at this upwards, downwards, 5 years from Sunday, and he's telling me that 10 million of these workers will not be needed in 5 to 7 years. He's not saying they won't have jobs. The economic activity that they do now, the value add will be done by machines. We see it in big tech, right? 40% of coding. You realize Microsoft's let go of 20,000 people. They have money coming out of their ears. There's a reason why this is happening. Eventually, society pushes back. It's happened in every technological revolution. But the difference now, John, is that in the past, when you had this, right, we were okay with debtors' prisons. We were okay with child labor. Well, 100 years ago, the transition, we didn't make noise. This time it'll make a lot of noise.
I'll share with you what concerns me, and I'll be open and personal about it. For children of Thatcher and Reagan, I'm highly concerned that if you concentrate capital and wealth in the hands of just a few, that the political movement, the corrective course of action on behalf of the people will be for the state to get a whole lot bigger, to go forward with higher taxes, universal basic income. And for people like me who don't really believe ideologically in that view of the world, that scares the living daylights out of me.
It should, but that is a very real risk. Now, until we get there, you're going to have corporate earnings flatten, for years to come. You're going to have operating margin leverage. And then the other side of it will be society pushing back. It's happened before. I mean, 6 of the 7 big oil majors came out of one company, Standard Oil, remember? So this is not every 15, 20, 50 years, if you have a big technology change, where all of the advantages go to capital, which is what is going to happen, I think eventually society will push back. But until it happens, it's actually a very nice ride.
But building on John's point, should we just expect higher deficits then?
No, I think the OBBA and the tariffs from revenues, the total deficit from that is not higher than if just the Trump tax cuts that were expiring had been extended. And we all thought they would be extended, if nothing else, right? The problem, the reason why the long bond in the United States refuses to come below 5% is not because the OBBA is more profligate, it's because it locks in. It makes it clear that we are not going to go away from 6.5% to 7% deficits, which is where we were this year, last year, for at least 10 more years. You mentioned Rachel Reeves and the conversation from 3 weeks ago. The significant part was not that she got emotional in person. The significant part for me was Labour has a big parliamentary majority and cannot pass a simple change, a small change to the welfare bill. That was the significance of it. There's no political will.
Ajay, appreciate your time. Enjoy the ride of the market right now, seems to be the message, and we'll catch up in 5 years' time.
Cheers.
Ajay, thank you.
Can I just say, yesterday I was speaking with someone who headed employee engagement for artificial intelligence at one of the biggest companies in this country and frankly in the world. And what they were saying is they'd been doing this for 40 years, looking at changes in technology. They have never seen anything like this. Yeah. And it changes every single day. That was a pretty stunning statement.
I hope my fears don't play out. I hope I'm wrong. I think you want freedom and upward mobility, and people might say that sounds super cliche. Look, that's what I believe in, personally. You might believe in something else. I fear what would come down the road if Ajay's view of things plays out.
Especially because you've got agents talking to each other, discussing how to make things better, and Xing out the human altogether. And guess what? Humans tend not to be that efficient. We have desires. We want to go to the bathroom. We want to talk with our friends. We want to let our minds wander. AI agents don't have that problem. And so at a certain point, yeah, you've got better efficiency. But if someone's going to be a pain in the neck, why do you need them?
Enjoy the ride. Future's positive. Stocks at all-time highs. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. Staying on artificial intelligence, the Trump administration unveiled its AI action plan meant to boost development in the U.S. by loosening regulations and growing power supplies for data centers. Measures include addressing energy and permitting issues for infrastructure and the promotion of AI exports, as President Trump says the U.S. will lead the world in AI. Meanwhile, Chipotle shares are plunging 11.7% in the pre-market. The company cut its annual outlook for the second time this year, saying sales at established restaurants will be about flat after previously forecasting a low single-digit expansion. Its new honey chicken offering and burrito giveaways failed to bring enough customers through the door. And Goldman Sachs has decided against the second round of performance-based job cuts this year. The Financial Times reporting the bank made the decision following a better-than-expected recovery in investment banking and continued strength in its trading division. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, a new standard for AI.
From this day forward, it'll be a policy of the United States to do whatever it takes to lead the world in artificial intelligence.
Up next, we'll catch up with Chris Casso of Wolf Research. Live from New York, this is Bloomberg.
Bloomberg launches our inaugural 25 African startups to watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator, a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Minutes from now, an ECB rate decision. 15 minutes after that, so at 8:30 Eastern Time, jobless claims. All of that still to come in the next hour or so. Equity futures positive by 0.1% on the S&P. On the Nasdaq 100, doing okay, up by 1/3. Under surveillance this morning, a new standard for AI.
From this day forward, it'll be a policy of the United States to do whatever it takes to lead the world in artificial intelligence. America is the country that started the AI race. And as President of the United States, I'm here today to declare that America is going to win it. We're going to work hard. We're going to win it.
It's the latest this morning. President Donald Trump signing executive orders to boost AI development in the U.S. The plan includes loosening regulations and expanding energy supplies for data centers. Bloomberg's Ed Ludlow joined us now for more. Ed, that was quite an event. What stood out for you?
Yeah, it's really a question of what is actionable within the action plan, right? You talked about deregulation, but at all of those pillars of it, basically expediting permitting, both so that mega cap tech, hyperscalers can build data centers faster, but the energy component's really critical. Basically, all of the cabinet members that spoke and the president himself framed this in the context of what China is doing. China moves very fast and aggressively to ramp up its supply of energy, largely through coal-powered power plants, but sourcing electricity nonetheless. And, you know, the executives on the ground and the officials that I spoke to all basically agree that all America wants to do is be able to move faster, and now seems more sanguine about exporting technology globally, including to economic adversaries, which is a big change, not just in tone, but in policy position, right, from where we were at the beginning of the year, let alone in the last 4 years.
Ed, who's driving that change, the State Department or the NVIDIA CEO?
Yeah, it was a very interesting moment. I mean, Anne-Marie and I discussed it, whether Jensen Huang is now the first buddy or not. There's a cautionary tale in that, of course, with Elon Musk about the relationship with the president. But I would also point out something that was missed. The president asked Mr. Zeldin from the EPA to stand up and said that of everyone gathered, he was the most important person in the room, even though he also invited Jensen Huang to have a prompted standing ovation, because it will fall to Mr. Zeldin and the EPA to enact this kind of cutting of red tape and the expedited permitting process that basically underpins all of the big picture pledge that's in the document.
We need the energy. We need tons of it.
You know, kudos to the administration, to be completely honest, for really analyzing what's needed and to understand what the sort of landscape is and to investigate it and highlight it, because from every economic individual who comes on the show, they highlight this as well.
Ed, thank you, sir. Ed Ludlow, down in Washington, D.C. this morning. Chris Casso of Wolf Research has an outperform rating on NVIDIA with a 170 price target, and he joins us now. Chris, welcome back to the program. A lot of people come on this program and act as if it's just winner takes all. This one name takes all. Are there other names that are doing well in this theme as well?
Yeah, and you know, we still think NVIDIA is the best way to play AI because so many of the concerns that were had at the beginning of the year have now gone, and clearly they're the leader. With regard to the other way that we like to play it is with memory as well, because the HBM memory that goes along with AI chips, the NVIDIA chips, the custom chips are a big driver as well. There's a big inflection point coming in 2027 for that, and we think Micron in our coverage is a prime beneficiary of that as well.
Meanwhile, we got this reporting out of the Financial Times today, and I do wonder how much the regulatory problems are going to throw some sand in the gears. That at least $1 billion worth of NVIDIA chips that were of the highest order had been shipped to China in the 3 months after some of the constraints had been put in place by the Trump administration. How concerned are you about some sort of crackdown or additional caps or bans by this administration and how it affects semiconductors?
Well, of course, it was just a couple of weeks ago that the administration reversed the ban on the H20, the chip that had been NVIDIA had been permitted to ship into China. Again, back in April, they stopped that, and now in July, they've actually allowed that again. And we think that's a sensible policy because the chip that is permitted to be sold in China is designed to be equal to what China can do themselves. So the concept there is that you're still restricting China. They can't get the best technology, but yet you're not pushing the Chinese customers to buy local, that you still allow them to buy U.S. technology and NVIDIA. And we think that's the best technology. Now, smuggling is always going to be an issue. People are going to figure out a way of getting it. But, you know, actually in AI, $1 billion is actually a small fraction of what the larger market is right now. So actually $1 billion is not as big of a number in AI these days.
Trump last night described the government's support for AI as a national security priority to prevent allies turning to rival technology, not as a national security priority to prevent our chips going around the world, but for partners to look elsewhere, i.e. China. How do they balance the two?
Well, and you know, there's an important point too with regard to China, and that's the restrictions that we have in place in Chinese manufacturing. So Huawei is the Chinese leader in AI. but they're also restricted in where they can manufacture their chips. Huawei can't go to TSMC and manufacture, unlike NVIDIA, unlike AMD. So that already puts China at a disadvantage. In addition, the U.S. companies, and frankly, all the companies, ASML included, are restricted in what they can sell into China. So from a manufacturing standpoint, we already have some restrictions which, kind of constrain what happens in China. But again, I think in terms of promoting U.S. technology, a two-pronged approach is probably the right way, is restricting what can be produced in China and then promoting the U.S. solutions such as NVIDIA.
With the administration now making this U-turn from April on the H20 NVIDIA chip, what's the new negotiating chip they have in their hands when they sit across from their Chinese counterparts next week?
With regard to the broader trade discussions?
Yeah, do they have something that the Chinese really want when it comes to export controls and semiconductors that they can use as a negotiating tactic?
Well, again, one would be, as I said, the equipment that's used to make the chips. I don't expect that to be the case, and I think that it's still going to be policy that we're still going to restrict what China can, what we can sell to China to make chips internally. So my guess would be that the chips that would be on the table, if you will, would probably be outside of semiconductors in terms of the negotiating.
Hey Chris, appreciate your time. Thanks for breaking it down. Chris Casser there of Wolf Research on NVIDIA and a whole lot more. That company, that CEO, is in the driving seat.
He seems to be, as Anne-Marie said, setting policy at a time when that really is the ultimate American exceptionalism. Just think about it. Who's driving who, given the fact that that is the ultimate driver of so much of the optimism around the U.S. economy?
Stocks at record highs, futures positive. Up next, Tom Kennedy of JP Morgan Asset Management, Pooja Kumar of TD Securities, Neela Richardson of ADP, and Terry Wiseman of Macquarie. Just moments away, an ECB rate decision, and later, jobless claims. From New York, the third hour of Bloomberg Surveillance. Up next.
Let me break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that three-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
survive the day?
I did. It was a busy day.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
We're looking at the riskier parts of the market. They can't get much better than this.
Technology companies driven by artificial intelligence is going to be where you get your earnings growth this quarter.
On the whole, things are quite nice, but the fact is there are a lot of potholes.
The pullback would be healthy.
With continued clarity on tariffs, we've got a calmer market, hopefully.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Okay, so this hour, a busy one. At about 15 minutes' time, an ECB rate decision. 15 minutes after that, jobless claims in America, 8:30 Eastern Time. And then later, you'll hear from the ECB President, Christine Lagarde. Into all of that, futures just about positive by 0.1%, coming off all-time highs on the S&P 500. And we add some weight to the NASDAQ. Positive this morning by 0.3.
Futures are dancing to their own music, and it doesn't have to do with tariffs. It has to do with the fact that they don't have to think about tariffs as much because maybe we've got a little bit of certainty. And we've got earnings that have been pretty positive, particularly from some of the Magnificent Six. And I say Magnificent Six because Tesla is the outlier here. But when it comes to AI innovation, that was just doubled down on by Google. And that certainly is helping to fuel what we're seeing this morning.
Earnings decent. Earnings decent for most of these players. Will the data hold up? 8:30 Eastern Time, jobless claims, 226,000, the estimate in our survey. We're around the 220s at the moment, and we've hung in there. The data's been okay. Will it stay that way through the summer?
What if it does, right? Then does everybody who is pessimistic and talking about the ramifications from tariffs called chicken littles and rejected, kicked to the curb, said, you're just a big bear, get over yourself, let's get on the bullish train. And how much is it just going to be delayed that much further? And I think that that really is the ultimate question. Have we just extended the timeline, or have we suddenly overimposed something that is much more positive on an otherwise pretty negative narrative earlier this year?
I talked about an interesting hour coming up. I left this out. Later on this afternoon, the president visits the Federal Reserve, a tour of HQ.
He's going right to the doorstep of Jay Powell, who he's been job voting for months now. And this really comes down to not this argument that just the Fed, he's annoyed they're not cutting interest rates, but the fact that this administration has been really going after the Federal Reserve for being over budget when it comes to their renovations. And we know that officials were going to take this visit. We didn't know until last night that the president himself was going to join it. This is going to be a lot of theater and a lot of drama.
Theatre, that's the word. Drama, that's another word. Will it actually move this market in any way, shape or form?
It seems like every time President Trump mentions Fed Chair Jay Powell now and calls him stupid, do nothing, too slow, the market's going la, 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 because they have moved on, and we've heard from Scott Bessent, who seems to be much more of a directing hand, saying we're in no hurry to replace him, and he doesn't need to step down.
A series of all-time highs in this equity market, this stock market has moved on. Coming up this hour, Tom Kennedy of JP Morgan Asset Management following a fresh record high. Pooja Kumar of TD Securities with an ECB rate decision just around the corner. And Terry Wiseman of Macquarie on the impact of tariffs on global interest rates. We begin this hour with stocks notching a fresh record high. Tom Kennedy of JP Morgan Asset Management writing, earnings are surprising to the upside, but the rally is mostly a PE expansion story. Tom joins us now for more. Tom, good morning.
Good morning.
Forward multiple elevated, north of 20, has been for a while. Anything to worry about?
I do think there's a statement of pause here, right? We have to see these earnings come through. So far, we're 2 weeks into earnings season. You're seeing surprises to the upside and wide breadth of surprise. So it is a positive in there, but you're pushing up against a limit where how much can earnings actually deliver for you? I think we've had a great run. I think investors should feel good about that and start to look around and say, are there other things that I should be adding to my portfolio to maybe diversify that exposure?
It's another way of saying you don't think this continues in the second half.
Look, I think we're all in our business, in JP Morgan Asset and Wealth Management. We're in this to be for the long run. So like you're going to hear from people like us that consistently say that, but you have to add diversification when you have these great runs there.
What is diversification? I was looking at a note from HSBC that said that you have to re-examine what diversification means, and increasingly it means the euro and gold. Is that how you see it?
I think diversification can have many faces, but to the point I think that they're trying to make is diversification in the pre-COVID era may be different in this era. And when you have a low interest rate environment, bonds become an excellent diversifier, and it's simple. You just add the Barclays Ag to a portfolio. Why do you do that? Well, if you're fighting inflation below 2%, any growth scare means rates come down. But now inflation across the world, whether it be in Europe, whether it be in the US, has inflation upside risk, and you need new diversifiers. So what do they look like? Gold, for sure. Also real assets, things like real estate and infrastructure, because those will nominally reset if inflation surprises you to the upside.
Do you ever get clients saying to you, you've been talking about diversification and you've missed out because ultimately it's been a one-way train up, and you have all this discussion about artificial intelligence, it's going to deliver me the world and it's going to really consolidate it into the capital holders, so why are you still telling me this?
Yes, we consistently get that recency argument. But we don't have to have that recency argument as big right now, in that we did have a shock. This year we did have a 20% correction. It wasn't, or nearly a 20%. It was very short-lived, for sure, but volatility in the market is there. So recency bias doesn't feel as strong. That argument before COVID was even harder to deal with. I have this diversification on income, but rates are so low, and my income stream is so low. I think it was harder then. Now I think it's clients are more engaged in the diversification conversation.
When you're talking about volatility, I can't think of Liberation Day on April 2nd.
Yeah.
I was there in the Rose Garden. The market started to rally when it was just 10%. Then that big chart came out, and then the market started to tank. You say 15% tariffs are positive, apparently. Has Trump changed the psychology of how we view tariffs?
Look, if we sat here on Liberation Day and said, we're going to settle at a 15% tariff, I think we would have felt good. But compared to Liberation Day to today, 15% was no one's expectation. The apparently is the stock market seems to really be happy about this. And I think we have to go a little deeper. If Japan is setting the standard for what deals will look like, a 15% tariff is being financed with either equity or debt from Japan. If Europe follows up with that, this is not an isolation or deglobalization story. It's the tariffs are meant to lock in a relationship with specific partners. I think what we're not talking about enough is the Indonesia deal is very interesting in that they'll make a deal, but if goods come through Indonesia and they have China related to it, that has a different tariff rate. Right. All things are circling back to there's new relationships that are being built, and China seems to be left out.
A carrot and stick approach. Do you think we're going to see more deals like Indonesia or more like Japan?
I don't know. There are different economies in that not a lot of goods get routed from China through Japan the way that they do for Indonesia. Vietnam will be interesting how that comes about. But this relationship about what's happening with tariffs, the bigger picture, I think, is the market's coming around to. It's less about the tariff, and it's more about how the new era of globalization comes to fruition. And it seems to be less about China and America and more about America and who else.
That's far too nuanced. I think market's just interested in better or worse. And these numbers are better than they were on April 2nd. That's it for me. Now we have to work out the consequences. How well understood are the consequences?
So I agree with you, but I think the way we need to get through that recency bias is, yes, it's better than 25%. But if we look back 2 months ago, no one thought 15%. So as we've navigated through this, what has happened? The economy has held up. Pass-through to consumers has been slow so far. But if we land on a 15% tariff, we will have more meaningful inflationary pass-through. I think nuance is the critical piece of this. It is very nuanced. And the things that I think we know are the connection with China is separating. I think we know that.
Yeah.
I think we also know that the American economy is resilient, but yet slowing. So what's the Fed going to do about that? That's going to be, as we head up to the September meeting, will be critical discussion.
Do you think it complicates the easing bias at the Fed? The Fed still has an easing bias.
No, I don't. We've been through this before. In Trump 1.0, you had tariffs, and they were able to cut. When you look at the momentum in the labor market right now and the U.S. economy, it is slowing. I don't really see any way around that. You look at labor demand, and when you look at ADP, which is giving you really interesting data, small and medium-sized businesses are contracting their employment. So, and this is a 3 or 4 month trend now. This is critical data I think the Fed will look at. Then you can look at construction spending, last 6 months contracting. And you can also look at what's happening in the real estate market where absorption of industrial capacity for the first time in Q2 was negative. What does that mean? There were more people vacating industrial space than there were adding industrial space. That's the first time since 2010. So the real high value or high productive pieces of the economy are showing you things are slowing. I think the Fed is set up quite well to start on some semblance of cuts, whether that be 100 basis points or so over the next 12 months.
So that's the destination, you think, maybe?
Yeah.
3.25%, 3.5%?
Yep.
Okay, so this raises the question. You said investing in real assets is something of sort of of a diversifier. And I wonder how you can get excited about real estate if the only option for lower rates is a slower economy at a time where affordability is already an issue.
So I think we talk about affordability a lot in the single-family housing unit, and this is true. Take a 3-bedroom home in America. If you want to buy it, it's 50% more expensive than if you rent it. That is a historic spread ever. Commercial real estate owns this rental property, and there is certainly an affordability gap. But you, Lisa, as an individual, get to make a decision. Which one am I going to do? And if prices come down, I still want to own the rental. And if, let's say, the economy grows great, I still can push prices and push rents. The setup for real estate is the asset, commercial real estate, has reset prices over 20%. You can look across the market. Yeah, so on a relative value basis, you could stop there and say, oh, that's a good setup because the prices have already contracted. High interest rates have constricted supply, and yet demand for this product is only going to pick up in that housing formation is still happening. So I think from a commercial real estate rental perspective, you're better off than owning that favors owners of multifamily properties.
Tom, can I just pick up on this point? You said Trump won, the Fed was able to cut even with tariffs, but that was directed squarely at China. Now it's the entire world. Don't you think that's a little bit too optimistic, looking back in the past?
No, I don't think so. I mean, I think we have to take the nuance to this. The tariffs are a negative in of themselves. I agree, because the consumer is going to feel higher prices. But what is the goal of the tariff? I think originally we thought it was just America's going to be an isolationist economy. And if we get more of the Japan deal and the Indonesia deal, that's actually not true. The tariff is meant to maybe level the playing field on the relationship, but now you're getting financing capital that's coming into the economy. The way that the capital and current accounts work in America, it has to work this way. If we're going to import goods, the financing has to come from somewhere. And if it's not going to come from America, it's better to come from somewhere else.
Tom Kennedy of JP Morgan, a lot to think about. We've asked this question a few times. We don't want their exports, we want their capital. How sustainable is that situation?
Well, it's not necessarily mathematically feasible. So you have to create these sort of instruments to create some mechanism for that to be feasible where both you are exporting, but you're also getting their investment and how that offsets each other. You know, it's going to be complicated and nuanced.
The ECB decision, about 3 minutes away. We'll get to that ECB decision in just a moment. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. We're just over a week away from President Trump's August 1st trade deadline. Last night, the president said he would set reciprocal tariffs between 15 and 50% for countries who do not make a deal. The U.S. and EU are moving toward an agreement that would set a 15% rate. Trump said the EU can pay a lower rate if it agrees to open up to American businesses. Meanwhile, a check on Tesla shares there are falling 6.2% in the pre-market after the EV maker reported second quarter results that missed already lowered Wall Street expectations. Revenue fell 12%, its sharpest decline in a decade. CEO Elon Musk warned of a few rough quarters ahead as Tesla loses EV incentives here in the U.S. And Treasury Secretary Scott Bessent says he plans to bring up the Microsoft hack with Chinese officials when they meet in Stockholm next week. Cybersecurity firm iSecurity says the flaw in the tech giant's SharePoint software hit 400 global organizations, including both U.S. nuclear and health agencies. Microsoft blames Chinese state-backed hackers. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Up next, Pooja Kumar of TD Securities with an ECB rate decision just around the corner. From New York City, this is Bloomberg.
a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance. Live from New York City this morning, good morning to you all. After cutting interest rates 200 basis points in the best part of the last 12 months plus, the ECB hits pause. Interest rates unchanged. That decision just dropping 2% on the deposit rate, widely expected, in line with the previous decision.
Yeah, they're not going to pre-commit to any particular path. They're going to take it meeting by meeting, but they are saying that they are determined to ensure that inflation stabilizes. That said, there are so many questions. Does this mean they're done, or does this mean there's one more? And what will it take for them to really begin cutting rates again?
The news conference 30 minutes away on the ground in Frankfurt. Bloomberg's Lizzie Burden. Lizzie, welcome to the program. Your first takeaway on this decision this morning, and then what to look for with President Lagarde a little bit later.
Well, John, this is exactly what we expected. All but two economists in our survey saw a hold coming because they're waiting for more data, they're waiting for more forecasts, and crucially, they want more clarity on trade. They want to know whether Brussels and Washington can get that trade deal over the line. And indeed, our reporting suggests, as Yahaira says, it is just around the corner. But even then, it isn't clear whether there'll be, how many rate cuts there'll be from here on out. Berenberg, RBC, for example, saying that you wouldn't need any cuts if they get a 15% deal. But our economists at Bloomberg Economics saying you'd need more cuts in September and December because 15% is higher than 10%, which is what they saw in June, and they saw one more cut then. But you've got to throw on the sectoral levies as well as that. Look, we're half an hour away from that press conference. I am really interested to hear what Lagarde has to say when it comes to the euro. I don't think she's going to be as precise as Luis de Guindos in saying 120 is the level that complicates the disinflation narrative from here. But I really want to hear how humble she is when it comes to talking about how good a position the euro area economy is in. Because last meeting in June, to many, what she said sounded like a victory lap. And this time, if she emphasises the downside risks to growth, many in the market are going to take that as a green light to a September cut.
And also the downside risk to inflation as well, Lizzie, which is something increasingly they've got to think about. There's a line in the statement, it's always there. The Governing Council is not pre-committing to a particular path. But just before that, they say the Governing Council's interest rate decisions will be based on its assessment of the inflation outlook and the risks surrounding it in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. Just reading between the lines there, Lizzie, what do you think they're getting at?
One of the issues, John, is potential dumping of Chinese goods into the euro area economy. And a lot of that will come down to the talks between China and the EU. The second thing is, as I say, euro strength, up 13% year to date against the dollar. And of course, Christine Lagarde in the press conference isn't going to say that they target the exchange rate, but they will be minding it as a channel to influence disinflation. I don't think, as I say, she'll go as far as pinpointing a level, but the more she comes back to that point, the more the market will be minding it.
Lizzie, appreciate the update. Lizzie Burden there of Bloomberg on the ground in Frankfurt. That news conference about 25 minutes away. That's got to be the focus, hasn't it? The disinflationary shock that could come from excess capacity in China, one. And the euro strength has been building now for a number of months too.
Right, both competitive disadvantages for domestic firms. The disinflation coming from China, very interesting at a time where there just was this meeting between European officials and Chinese officials. And there clearly is a resetting, an effort to try to come to some sort of new agreement with this very much in the forefront. How much are they going to bear the brunt of all the goods, the overcapacity that China has to sell?
Ursula von der Leyen is sitting down with Xi Jinping, briefing the press just now, and she's talking about this exactly. We need to see progress on Chinese overcapacity. I have to say, that is music to the ears of Scott Bessent, who continuously talks about this, continuously talks about China just dumping on the world and how they need to start transitioning to a consumption-based economy.
They need to rebalance. And if America's putting up the walls to those exports, the pressure is on Europe big time. We've said this so many times. Who's going to eat it? The Europeans will have to eat it.
And so at some point, if they put up the walls, how much does it have to come in tandem with the United States? I mean, this goes to something that Tom Kennedy was talking about. We talk about the United States being more isolationist as a result of some of these tariffs. Is that true, especially if there is a rearrangement of trade lines and trading partners as a result, and that really does have China very much in the forefront?
To explore some of these issues, Pooja Kumra of TD Securities joins us now for more. Pooja, welcome to the program. How much of a challenge is euro-dollar at 117.50 to this ECB?
I think 120 is a number that's been flagged by quite a few of ECB officials. But I think one thing that we need to note is what is driving the strength in euro. And if it's coming with strong capital flows, which is something that we are also seeing, I think that's why ECB members are not really scared of just concentrating on the negative impact of strong euro on inflation. They are looking at the positivity when it comes to de-dollarization trade and how it's supporting the European economy. And I think that's the kind of message they want to actually focus on rather than the disinflation part of the currency impact.
There's a question about overdumping, overcapacity from China and what that does in terms of inflation, but there's also a question about some of the trade levels that we've seen in terms of tariffs coming from the United States. How much do you expect them to address the ramifications from an inflation standpoint, but also, more importantly, for a downside risk to growth?
I think that's a great question, and that will be the focus for the press conference, whether they are actually focusing on the domestic resilience or the trade wars. When it comes to China wars, I think they are trying to take a step back right now. I think everything is fluid, but a 15% number is not something that should make ECB nervous in terms of the Europe-US tariff. Again, it's very early in the stage in terms of getting a deal, and we know these numbers are very fluid. But at this stage, I think they would address the uncertainties. They will actually give us some template, take us back to the June forecast where they had actually given us the mild and the severe scenario as well as the baseline scenario, which is based on a 10% retaliatory tariff. So at this stage, I think they want to be neutral. And as you suggested, data dependency is the mantra for all central banks right now.
Pooja, I'm struggling to really see the inflationary risks here. We're talking about the disinflation from a stronger currency, the disinflation from China dumping overcapacity on Europe. We're talking about the potential for a contraction in economic growth. Where does the inflation pressure come from?
Yes, that's also a big good question. I think the inflationary impact will only come if EU is ready to retaliate. And I think that's the key risk, because then you will actually see the acceleration in core goods, which is actually absent in terms of inflation in Europe right now. So for us, the inflationary impact is kind of limited, but it's limited to how EU responds to tariff policy. But I think one thing also we could get inflation back to Europe is how this fiscal policy works, right? Germany is going strong with the fiscal reforms. We don't know how it's, at this stage, it's just one of the ingredients towards growth, but does it have an inflationary impact? I know it's a medium-term question, but when it comes to ECB members, they need to put everything together when they're forecasting their inflation.
Pooja, here in the US, we talk a lot about a divided Federal Reserve. They meet next week. There could be some dissent. On this governing council, how united are they?
I would say a bit more than Fed. I think there is general unanimity about that the policy is in a good space, and I think they still are waiting. And I think you can see in terms of general data, we are holding up well. I know France is the weaker spot when it comes to Europe, but other nations are still doing well. So I don't think that there's that much juggle within the committee as we have seen in Fed or even in the case of BOE. So I think making decisions seems much more simpler for ECB, and primarily because disinflation came in very easy for Europe. It wasn't a task, as we are seeing in both US and UK.
Pooja Kumra of TD Securities. Pooja, appreciate your time. Thank you. 200 basis points of cuts from the ECB in the last year or so when they hit pause. That word pause, though, they might avoid that word. They might prefer the word skip. They want to be agile, nimble, open-minded about the future. They seem to avoid the word pause, don't they?
Right now, traders are picking up on that, and they are still pricing in about 22 basis points of rate cuts for the remainder of this year. The expectation that sometime in the fall they'll resume it. This is the first pause, or skip, I should say, the preferred rhetoric coming since July of 2024. So a notable departure as they assess the landscape.
What's the landing zone for the ECB? They're at 2 already.
Good question.
What are they coming down to?
Is it 175? What is the bigger risk, and where is the inflationary pressure coming from? Is it truly retaliation, as Pooja was just saying?
You can see this disinflationary shock building from the policy front. I don't know what's going to happen in the future, but that's the direction of travel at the moment.
I'm looking for where the inflation is going to come from, and if it doesn't come from China, it doesn't come from a stronger currency, it doesn't come from reaccelerating growth. The only thing that could potentially be is if some of the industrial investment starts to pick up, but we haven't seen that being particularly inflationary either. So very curious how she's going to answer that question.
A news conference with Christine Lagarde, the ECB president, 20 minutes away. Up next, breaking jobless claims data here stateside. We'll catch up with Nita Richardson of ADP, here to react from New York City. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The opening bounce about 60 minutes away. Your scores look like this. Equity futures positive by 1/10% on the S&P. 3-day winning run coming into Thursday. It's a series of all-time highs. On the Nasdaq 100, positive by 0.3. The economic data just seconds away. Check out the bond market. 2-year, 10-year, and 30-year bond yields look like this. Yields higher by 2 basis points. 440 on 10s, on 2s up a basis point. Just short of 390 at the very long end of the curve. Your 30-year at the moment is up 3 basis points to 496.36. Let's get you some economic data. Let's kick it off with jobless claims. That data hasn't dropped just yet, but the estimate we were looking for was 226. It's out now at 217. The previous week was 221. 217 is the right kind of downside surprise, and jobless claims have just hung in there, haven't they, over the past few weeks?
So anyone looking for the bad news to start showing up in the number of people filing for benefits after losing their jobs, you're not going to find it here. Pretty much across the board, you can see initial claims 4-week moving average moves lowered 224,000 rather than staying at the 220, almost the 230,000 from the prior week. There just is a question here. Are we not seeing something? Has the labor market changed? Right now, the market is seeing, honestly, that resilience feeding into the ongoing strength that so many people are pricing into the equity market.
There are subtle signs, though. Continuing claims are still elevated, and this has been a theme now for a number of weeks, and we've talked about this. If you're without a job in America right now, it's getting harder and harder to get a new one.
I'm glad you mentioned this, because actually continuing claims did go up from the prior week. So exactly counterintuitive to what you had been seeing at the highest right now going back to June 20th. So still not necessarily going through the roof, but still the sense that you're right. It is definitely a stagnant market, and you're not seeing that activity really pick up.
Let's catch up with Ira Jersey of Bloomberg Intelligence. Ira, welcome to the program. Next week, the Federal Reserve will put out a statement. In the first paragraph of that statement reads, the labor market or the economy is solid. They use this word solid. Can they keep referring to it as solid?
Well, I think when you have data like we had this morning, you could certainly make that case. I do think that they'll probably moderate that slightly, just because when you look at the payrolls data, you know, it was good, but it wasn't great, and you do see some of the details make things look not quite as strong as they had been in the recent past. But the job market still is not an impediment to the Federal Reserve keeping rates on hold, right? Like, if the Fed really wants to cut rates, they kind of need to hang their hat on something, and it's not yet inflation, and it's not yet the jobs market cracking. So I'm not sure if you could really make the case that the Fed needs to be cutting right now, just given the incoming data. Governor
Waller might make that case next week. He might dissent. Others are saying they'll be on hold all year. Bank of America, Morgan Stanley. We spoke to Mizuho earlier this morning, Ira. Jordan Rochester said you can price out the cuts in 25 and price more in 26. What matters here is Chairman Powell is going to be replaced. What do you and the team think about that?
Yeah, well, I mean, Chair Powell, one way or the other, is not going to be the chair come next May. I think the question is, does he leave before that, and you know, firstly, and secondly, is he going to have continued angst from the administration, where the administration continues to say that rates need to be cut and cut more quickly? But again, like from an economic perspective, that doesn't seem to be the case right now. And I do think that the Fed will probably cut this year, but not until the very end of the year. And that's been our call since February, because the incoming data that we have now, you really need to see it slip over several months for a bulk of the committee to cut. Keep in mind, even if Jay Powell were to leave today, you still have other members of the committee and a bulk of the committee that still thinks that the Fed needs to be on hold for this year, or it will only cut once or twice. So you still have relatively hawkish, compared to what the administration wants, members of the committee overall.
Ira Jersey of Bloomberg Intelligence. Ira, thank you, sir. With us around the table, Nita Richardson of ADP. Nita, good morning.
It's great to be here with you.
It's good to see you. Let's talk about this jobs data. We've heard a lot from a lot of people who say this labour market is no longer a reason to be hawkish. Is it becoming a reason to be dovish?
I think you can't say that this labor market's not in transition if you look at the last 3 months of hiring. They're slowing. It's clear. And so whether hawkish or dovish, the labor market is an issue on the table to consider. And I think when we look at next week, which will be jobs week, we'll see a continuation of a slowing trend. And I'd like to mark that trend with something that you can see clearly in the ADP data. The slowdown isn't coming from goods. It's coming from services. And that is the turnaround in the labor market. It has been that services have held the water for the labor market. It's really the goods sector that's suffered. And with tariffs in play, still, you would think it would be the goods sector that is bringing down the momentum. It's not. It's services, which points to a whole different case study on what's really going on in the U.S. economy.
So talk us through what that case study is in terms of, are we just seeing the cycle shift from goods to services, but goods hiring will pick up significantly, or does it speak to a broader type of trend?
You know, there's so many megatrends right now, and I like to look at the first 6 months of 2025 and compare it to the first 6 months of 2019 before the pandemic. This was actually inspired by something Jonathan said about getting a pay raise. Because if you look, I thought it was a great question. I wasn't satisfied with my answer, so I went to the data, and it turns out that there hasn't been an increase in new hire average pay in over a year. Wow. $18 it's been. And that's because the supply and demand dynamics have held firm. It's a really balanced labor market. I think it breaks because we're seeing lower supply. The labor force participation rate now is lower than it was 6 years ago. There are fewer people working and looking for work, and that's what's going to keep pay a little bit higher or a little bit more stable for new hires than it was 6 years ago.
So this raises a really good, interesting question. Even if we get numbers that look pretty good on the jobless front, not that many jobless claims, on the job creation front, more than some people would expect, is there anything about this labor market that's inflationary with wages increasing?
Well, this is a very deep labor market. We talk about whether it's solid. I think of it as deep. Still waters run deep. And what you're seeing is that, yes, if you look at job stayers and job switchers, which we look at all the time at ADP, pay growth is elevated. But when you look at those new hires, they're pretty stagnant. And I also look at the job openings by the U.S. government, which shows 500,000 more jobs now than there were 6 years ago. But the hiring rate, the rate at which employers are hiring is lower, 3.4 in May compared to May 2019, 3.8. There is less urgency to fill those positions, and that's what's leading to this no hire, no fire stasis in the jobs market. I think it breaks because of labor supply issues, not necessarily labor demand issues.
Governor Waller was sitting in your seat last week, and it seemed to really weigh on him, the unemployment rate on recent college grads, 7%. What's going on? Why are they not able to get a job?
Well, I think it bends back to the data we just saw. Continuing claims. It's harder to get a job in this labor market where supply and demand are in balance. And for young people coming out into the market, this is not their older brothers or sisters' labor market. In 2022, they were snatched right up. They have that expectation. Their older sister told them that they were snatched right up, and that was the expectation. It's not that labor market anymore. It's a labor market that requires patience and networking. It's Gen Z. It's going to take a little bit longer. And where these college grads are coming out is what exactly is slowing. Professional businesses, services are slowing down. Finance is slowing down. If they were coming out in construction, I think they would see that kind of snatch up in the labor market, but they're not seeing it now.
Neela, it's great to see you. Thanks for breaking it down. Appreciate it. Neela Richardson there of ADP. Jobless claims are holding on, but the rest of the labor market just starting to crack. Some fragility there starting to brew. Just slowly, but you're seeing it.
Well, you're just seeing just not a lot of motion. In fact, that the ongoing, continuing jobless claims is so high and going higher tells you a lot. What Neela was saying there is fascinating, the idea of what kind of wage growth are we seeing? And you're seeing wage growth actually decelerate in Europe. At what point will that justify in its own right what the Fed decides to do if they decide to cut?
That decision a week away. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. President Trump is heading to the Federal Reserve today to tour the construction site he is criticized for cost overruns, as the renovation is estimated to cost $2.5 billion. Trump could use any evidence of mismanagement or fraud related to the renovation as a pretext for removing Powell. Meanwhile, take a look at Alphabet shares. They are rising 3.8% in the pre-market after its second quarter sales beat estimates. The company said it's raising capital spending by $10 billion to $85 billion this year, citing rising demand for cloud and AI services. Google is weaving its flagship AI model Gemini into its product portfolio as it confronts competition from Meta and Microsoft. Meanwhile, American Airlines shares are falling 6.5% in the pre-market. The company reported second quarter earnings that beat analyst estimates, and it reinstated its full-year guidance, but it said possible scenarios range from an adjusted loss of 20 cents a share to a profit of as much as 80 cents a share. American also forecasts a third quarter loss exceeding analyst estimates. That's your Bloomberg Brief. John?
If you don't guide confidently right now, you get absolutely punished. Yahara, thank you. Saw that earlier this week as well, didn't we?
Yeah, pretty much. That seems to be the way forward. I mean, Texas Instruments, the idea that they talked about, we're not sure if this is just a pull forward. And those shares were down something like, what, 12% in pre-market trading before the open?
They got hammered. This stock's getting hammered too. Up next, Terry Wiseman of Macquarie, plus ECB President Christine Lagarde, her news conference moments away.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
Chief Future Officer, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
The opening bell about 47 minutes away. Equity futures unchanged on the S&P. If you check out euro-dollar, the euro negative, the dollar stronger. The data in America okay. Jobless claims hold on. The ECB and that news conference just moments away. We can catch up with Terry Wiseman of Macquarie. He joins us around a table. Terry, good morning.
Good morning, John.
This from Deutsche Bank just moments ago. Mark Wall, the question is, will this be a short pause or a long pause? How are you thinking about this ECB meeting?
Well, you know, the statement seemed to suggest that the ECB is still very data dependent, but I want to broaden that definition a little bit to suggest that it's not just about the data that's going to come out. There are a lot of crosswinds, obviously, besides the data going on with the EU, and tariffs is that biggest crosswind, right? We don't know what the deal will be between the U.S. and the EU, and I presume that even before any data that emits from that deal will become known to the ECB may have to be forced to make a forward-looking decision based on what that deal is. Now, the ECB has been very plain, I think, especially if you read between the lines. Maybe plain is not the right word, but you can certainly infer from what they've been saying that if the only thing that happened was that the U.S. imposed import tariffs on the EU and the EU did not retaliate, that would be disinflationary for the EU. It might be inflationary for the US, but disinflationary for the EU. So if we do get those 15% or 20% or maybe even 25% or 30% if there's no deal, I think that the EU will see that, the ECB will see that as disinflationary, and it may compel them to cut again, even if the data is lagging. On the other hand, if there's retaliation, right, well, then it's not as disinflationary for the EU as they may have presumed, and maybe they'll do nothing. So, you know, I have to interpret what she's saying very broadly here to include what's going to happen on the policy front with tariffs. Having said that, I suspect that she's going to reiterate today that the ECB is in a good place, that 2% is neutral, and of course, when you have inflation running at 2%, that implies a real interest rate of 0, effectively, which is probably not that different from the per capita growth rate of the EU, and it feels like the right number.
It's interesting listening to you talk about trade. As that news conference gets underway in just a moment, we'll head over there in a second. You're talking just about the agreement between the EU and the US, and I wonder whether for the Europeans the more important agreement is between the Chinese and the US, because if the walls go up here, they've got to eat the Chinese exports.
Right. So there's potentially another source of disinflation in the EU. If the walls do come up here and the Chinese are unable to sell product into the U.S., obviously they'll be forced to dump their products into the EU. But effectively, it's the same situation as the walls in the U.S. being built up against the EU. If the Europeans can't sell product into the U.S., they're forced to redirect those products into their home economy. That will be disinflationary there. So effectively, anything that builds walls around the U.S. imposes some disinflationary pressure on the rest of the world, almost no matter where you happen to be.
Given all the potential disinflationary forces, is Friedrich Merz going to go down to Frankfurt and try to get Christine Lagarde to talk about her renovations and what this means about why they should cut rates sooner?
No, I don't think so. I think what's interesting about the ECB and the nature of the governance of the ECB, where there is all these countries that are represented, means that it's very, very difficult to impose, for a head of state to impose their will on the governing council. It's a very different structure than we have here, right? You have, and of course, you know, some people complain about that from time to time. They'll say the EU is inertial, in part because you have to get agreement from so many countries to do some things. But in some cases, that becomes a good thing, right? You can't have one head of state doing what he wants and imposing his will on a presumably autonomous agency.
The Treasury Secretary said it. They've got a collective action problem. That's what he said to you just yesterday. Terry Wiseman of Macquarie. Terry, thank you, sir. The news conference in Frankfurt is underway. The pause has started. How long will that pause be after cutting interest rates by 200 basis points in a little more than 12 months? Let's take a listen.
The economy has so far proven resilient overall in a challenging global environment. At the same time, the environment remains exceptionally uncertain, especially because of trade disputes. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. And I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. In the first quarter, the economy grew more strongly than expected. This was partly because firms front-loaded exports ahead of expected tariff hikes. But growth was also bolstered by stronger private consumption and investment. Recent surveys point to an overall modest expansion in both the manufacturing and services sector. At the same time, higher actual and expected tariffs, the stronger euro, and persistent geopolitical uncertainty are making firms more hesitant to invest. The robust labor market, rising real incomes, and solid private sector balance sheets continue to support consumption. Unemployment stood at 6.3% in May, close to its lowest level since the introduction of the euro. Easier financing conditions are underpinning domestic demand, including in the housing market. Over time, higher public investment in defense and infrastructure should also support growth. More than ever, the Governing Council considers it crucial to urgently strengthen the euro area and its economy in the present geopolitical environment. Fiscal and structural policies should make the economy more productive, competitive, and resilient. Governments should prioritize growth-enhancing structural reforms and strategic investment while ensuring sustainable public finances. It is important to complete the Savings and Investments Union and the Banking Union following a clear and ambitious timetable, and to rapidly establish the legislative framework for the potential introduction of the digital euro. The Governing Council welcomes the Eurogroup's commitment to improve the effectiveness, quality, and composition of public spending, and supports the efforts by European authorities to preserve the mutual benefits of global trade. Annual inflation stood at 2% in June, after 1.9% in May. Energy prices went up in June, but are still lower than a year ago. Food price inflation eased slightly to 3.1%. Goods inflation edged down to 0.5% in June, whereas services inflation ticked up to 3.3% from 3.2% in May. Indicators of underlying inflation are overall consistent with our 2% medium-term target. Labor costs have continued to moderate. Year-on-year growth in compensation per employee slowed to 3.8% in the first quarter, down from 4.1% in the previous quarter. Combined with stronger productivity growth, this led to slower growth in unit labor costs. Forward-looking indicators, including the ECB's wage tracker and surveys on wage expectations of firms, consumers, and professional forecasters, point to a further decline in wage growth. Short-term consumer inflation expectations declined in both May and June, reversing the uptick observed in previous months. Most measures of longer-term inflation expectations continue to stand at around 2%, supporting the stabilization of inflation around our target. Growth remain tilted to the downside. Among the main risks are further escalation in global trade tensions and associated uncertainties, which could dampen exports and drag down investment and consumption. A deterioration in financial market sentiment could lead to tighter financing conditions and greater risk aversions, and make firms and households less willing to invest and consume. Geopolitical tensions, such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, remain a major source of uncertainty. By contrast, if trade and geopolitical tensions were resolved swiftly, this could lift sentiment and spur activity. Higher defense and infrastructure spending, together with productivity-enhancing reforms, would add to growth. An improvement in business confidence would also stimulate private investment. The outlook for inflation is more uncertain than usual as a result of the volatile global trade policy environment. A stronger euro could bring inflation down further than expected. Moreover, inflation could turn out to be lower if higher tariffs lead to lower demand for euro area exports and induce countries with overcapacity to reroute their exports to the euro area. Trade tensions could lead to greater volatility and risk aversion in financial markets, which would weigh on domestic demand and would thereby also lower inflation. But by contrast, inflation could turn out to be higher if a fragmentation of global supply chains pushed up import prices and added to capacity constraints in a domestic economy. A boost in defense and infrastructure spending could also raise inflation over the medium term. Extreme weather events and the unfolding of climate crisis more broadly could drive up food prices by more than expected. So looking at the financial and monetary conditions now. Market interest rates have increased since our last meeting, especially at longer maturities. At the same time, our past interest rate cuts continue to make corporate borrowing less expensive. The average interest rate on new loans to firms declined to 3.7% in May from 3.8% in April. The cost of issuing market-based debt also came down, falling to 3.6% in May. While the growth rate of loans to firms moderated to 2.5% in May, corporate bond issuance was stronger, growing at a rate of 3.4% in annual terms. Credit standards for business loans were broadly unchanged in the second quarter, as reported in our latest bank lending survey for the euro area. While banks' concerns about the economic risks faced by their customers had a tightening impact on credit standards, this was broadly offset by stronger competition among lenders. Meanwhile, firms' demand for credit increased slightly, benefiting from lower interest rates, but they remained cautious because of global uncertainty and trade tensions. The average interest rate on new mortgages has barely changed since the start of the year and stood at 3.3% in May. Growth in mortgage lending edged up to 2% in May in the context of a strong increase in demand, while credit standards tightened slightly in the second quarter. So in conclusion, the Governing Council today decided to keep the three key ECB interest rates unchanged. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. And in any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions.
And the first question goes to Annette Weisbach of CNBC. Annette, please.
President Lagarde, thank you for taking my question. The first one is on the euro exchange rate. So we've heard from your dear colleague, the Vice President Luis de Guindos in Sintra, that anything beyond 120 might be complicated. So what's your assessment? When does it start to get complicated, and when do the deflationary effects from that higher euro do start to worry you? Second question is on the tariffs. If we were to get that 15% trade deal with the United States, is that according to your baseline, and would that lift the uncertainties in a way which is good enough for the euro area to grow? Thank you.
Thank you very much for your twofold questions. Let me just tell you that in relation to exchange rate, we do not target any exchange rate. Second, we monitor exchange rate indeed, because exchange rate matter for our inflation forecast. And I'm here quoting my dear friend, colleague, Vice President, who said recently, we take into account exchange rate to forecast inflation. We are exactly on the same page in terms of our message regarding exchange rate. Your second question had to do with conjecture as to what will be the outcome of ongoing trade negotiations. And I know that there was a newspaper yesterday who sort of hinted that we were at a particular closure. It was a closing in, not a closure, right? And required very careful reading. We are attentive to where the negotiations are heading. We are not in a negotiating position. We are operating on the basis of the work that we do to forecast, to anticipate. We have a baseline on which we are basing our decision of today, which is our June baseline, which holds. You know, that baseline is generally confirmed by all the recent data that we have received. But we take things one day at a time. We decide meeting by meeting, but we take news one day at a time. And for the moment, we are relying on our baseline, relying on the scenario that we have done back in June, which we have published, which you all have had a chance to look at, and that's what it is. But one thing I will add to that is that the sooner this trade uncertainty is resolved, so I think we use the word resolved swiftly, so the sooner it is resolved, the less uncertainty we will have to deal with, and that would be welcome by any economic actors, including ourselves. Thank you.
Next question goes to Alex Weber of Bloomberg. Alex, please.
Good afternoon. Thank you very much. I've got two questions on your statement. So you highlight the resilience of the economy so far. Does this resilience reduce the need to deliver another rate cut in the autumn, even if this was part of the baseline scenario in June? And the other question is on your reaction function. So you added that future decisions will also be based on the risks surrounding the inflation outlook. Could you just explain why this addition was necessary? Thank you.
Sure. Thank you very much. And thank you for noticing the addition. You're right. So I'll start with that one. As you know, we concluded our strategy assessment. We had a strategy review that we concluded in 21. We had committed to review that strategy on the basis of new economic development and certainly in view of the process through which we had gone, namely facing those incredible shocks and going full cycle in many ways. So we did that, and as a result of that strategy assessment, it was determined that we had to amplify, enhance, and probably give a slightly higher focus to risk assessment. And obviously, scenarios, sensitivity analysis are part of that exercise that is conducted on a regular basis, that is published occasionally, but conducted on a regular basis. But it is certainly very opportune that this focus on enhanced risk assessment is agreed at a time when we have a higher level of uncertainty. So that's the reason why it is, you have the usual risk assessment section in our monetary policy statement, which focuses on growth and inflation. And we thought it was appropriate, given the enhanced focus that we want to give to the measurement of risk, the assessment of risk, to have actually that element included in the first part of our monetary policy statement. You know, we are, I'm going to repeat myself, we are in a good place. And we are in a good place because inflation is at 2%, but we're not focused on data points. We're looking at all sorts of data, and our target is the medium-term inflation, which is at 2%. So I'm saying that we are in a good place because our projections point to inflation stabilizing at target in the medium term. As you will remember, I have often mentioned the importance of wages. Wages are heading in the right direction and are showing this downward trend that we were expecting. The unit profit is continuing to buffer in a little bit of that wage increase, which is the natural result of an element of catching up and adjusting to the development of the economy. And we have seen, and I'm coming now to the specific point of your question, we have seen growth developing in a relatively favorable way. Of course, if you look at Q1 in particular, we will have Q2 in a week's time. But if we look at the numbers we have, Q1 was a surprising 0.6%. Now, of course, because we like to look under the hood, 0.6% is partly attributable to Ireland. And then if you look at what was actually driving this growth increase, it's partly front-loading because economic operators anticipated the rising of tariffs and decided to front-load. But it's not just front-loading. It's also increased consumption and increased investment, and not only attributable to Ireland, which is often an outlier for all sorts of intellectual property reasons and what have you. But so growth is developing mostly, if not a little better than in line with our expectations. So we are looking at development. As I said, you know, last time around, we are now confident that the inflationary shock of the past few years is now behind us. And our job now is to look at what's coming and to try to, first of all, wait, because there is a lot of elements that will pan out in the next few months, and see what impact it will have on our economy. Thank you.
And the next question goes to Balazs Korani of Reuters. Balazs, please.
Good afternoon. Thank you for taking my questions. Two, of course. The first is about the risk of undershooting the target. Talking to some of your colleagues and reading more economist notes, it seems to me that there is a greater discussion about undershooting. In your discussion today, was there anything about this? Do you think over the last 6 weeks, the risk of below target inflation has increased? The other question is about the scenarios you published 6 weeks ago, and especially the more severe outcomes, which seem to suggest that even in case of retaliation, the whole package would be disinflationary. Now, I'm curious, is there consensus in the Governing Council about this, or is there perhaps still a discussion that such a scenario could turn out to be inflationary rather than disinflationary?
Well, thank you for your two questions. Concerning the risk of undershooting, I just want to remind you and colleagues that we are at 2% latest reading, but more importantly, because that's what we have to look at, we are at 2%, which is our medium-term target. So is there a risk of undershooting? There is actually a forecast of undershooting in 26 for all sorts of base effects reasons and consequences that we are forecasting today. But as has been mentioned by some of my colleagues in their various speeches, we are not going to be moved away by some minor deviation. And we are looking at the medium-term targets that we have. And we will proceed on the basis of that 3 elements to determine our monetary policy stance. So that is the result of our strategic assessment, but it's also the approach that we are taking inside the Governing Council. Now, you will always find 2 or 3 governors who are very concerned about the undershooting. But what I say to you is undershooting is actually in our projection, in the staff projection. It's there. But what matters is our medium-term target, because this is the objective that we have reaffirmed in our strategy, and which is definitely 2%. And when I look at my inflation expectations, it is strongly anchored around 2% in the short term, but also in the longer term. So that's as far as undershooting is concerned. Now, we have conducted that exercise with our scenario, and as you know, we have this sort of rosy scenario where everything is at 0, it's perfectly symmetric and reciprocated. We have the baseline, which is at 10%, which is the current rate that the economy is taking in, and we have the 20%, which is the severe scenario. Some of those scenarios have retaliation measures, not all. And I think that as we observe the interesting negotiations and what leaks out in various form, retaliation is optional, doesn't seem to be a definite element. But the ultimate net off result in terms of inflationary forces or disinflationary forces cannot be determined at this point in time. Why is that? Because it's a very complicated set of factors that we will have to analyze, take into account to determine what the impact will be. We currently have a list of different rates. You have the hypothetical 10 or 15 or X%. We have some sectoral rates as well that apply to either the automotive industry or the steel and aluminium industry, a big question mark on pharmaceutical. And to add to that complexity, you also have the indirect impact on our economy of tariffs that are decided in relation to other countries that will induce some redirecting or rerouting, which themselves will have an impact on our economy. For the moment, we assume that this impact will be inflationary, and staff has worked on that. But equally, and this is very difficult to assess for the moment, there will probably be some bottlenecks issues as a result of the trade disruption. There will probably be, just as there will be some rerouting and redirecting, there will be some supply chain significant changes. And that will have also an impact on inflation, more likely to be inflationary than disinflationary. So it's not just, trade one way, retaliation in response, but it's also the rerouting, the redirecting, the supply chain disruption, the bottlenecks that will all come together to impact prices. Now, the next question you have to ask yourself as well, and that we are asking ourselves and will be asking, is that going to be a level effect? Is that going to be an ongoing consequence of a new paradigm? There is a lot of uncertainty out there. We are mindful of all that. We are going to monitor, factor in, model as much as we can, but at this point in time, conclusion is not in my view, definite as to which of those forces will prevail.
Next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you for taking my question. Good afternoon. My first question is on tariffs and interest rates, in the sense that the Federal Reserve would have cut interest rates if it weren't for tariffs, and Chair Powell said in Sintra, we went on hold for tariffs. Can you explain how far is the ECB today on hold because of tariffs? And my second question there again has got to do with the United States again, because Donald Trump called the signing into law of the Genius Act on US dollar-backed payment stablecoins a giant step to cement American dominance of global finance, the greatest revolution in financial technology, and secures the dollar status. But on monetary policy, there is a concern that the growth of stablecoins for trillions would have an impact on the short-term rates in the United States because of how much T-bills is going to be used as a back to the stable coins. So there is a big debate on impact of this on monetary policy, on central banks, and I wonder if you can say, if you share these concerns of these innovations on monetary policy tools. Thank you.
Well, thank you for your two questions. I think it's a good expression that my colleague and friend and esteemed central banker has used to refer to being on hold. So we ourselves at the ECB, we have left our rates unchanged, and you could argue that we are on hold. We are in this wait and watch situation, and any monetary policy decision will, for the future, be decided on the basis of data, will be decided meeting by meeting, is not predetermined by any particular path, and I think that the jury is out as to how quickly the uncertainty will be cleared under present circumstances. So a large part of that uncertainty is itself caused by trade and tariffs, as well as non-tariff barriers, by the way. It's tariff barriers and non-tariff barriers, which obviously matter. That has an impact. The uncertainty in and of itself is also playing a role in relation to the level of risk that we see. So it's trade-related, caused by tariffs and non-tariff fear or expectations, depending on how you look at it, and it's the overall uncertainty about the outcome, which obviously induces different behavior on the part of consumers and investors. Look, on the Genius Act, first point I would make is that having a legal framework is helping understanding what the risks, benefit, and prospects are for these instruments. Number two, I think that it's a little bit early in the process to really have a clear and good understanding of what the consequences will be. Number three, we have to be focused on what we do here at home in Europe. We have to make sure that we are strong in terms of currency, issuance, protection. We are the curator of the euro, and we are ultimately focused on that. So, of course, we are mindful of what's happening elsewhere, what the dangers could be, but we have to make sure that at home we take all the necessary measures to protect and preserve our currency. And in that respect, we are very decisively focused on developing the digital euro and doing everything that we can to be on time and prepared to make this digital form of sovereign money available in the shortest possible time, which doesn't mean that it's going to be tomorrow, rest assured. And cash will always be there, and banks will be part of the game and will be intermediary in the process. But our duty is to make sure that as Europeans' preferences evolve over the course of time, the digital euro is a possible reality. Thank you.
And now Olaf Stolberg of the Financial Times. Olaf, please.
Thanks. I do have two short questions. One is on this interview Isabel Schnabel gave a few weeks ago when she said that the bar for further rate cuts is very high. Do you share that view, or do you have a different view on that? And my second question refers to views expressed by analysts who said that if the trade tensions will be resolved quickly, the question could relatively soon become when the next rate hike will happen rather than the next rate cut in the euro area. Do you think that's a relevant framework at the moment, or is this not relevant from your point of view? Thanks.
Well, thank you for your two questions. You know, each and every executive board members and each and every governor has their preference and their views. And I think it is the beauty of this institution to allow for diversity of viewpoints and for allowing the expression of those viewpoints. Now, my job as president of the ECB is to harness all the views of the governing council members, and on the basis of our staff work, projections, proposals, to elicit as large a majority view as is possible. That's my job, okay? So what I can tell you as far as today is concerned is that the decision to keep interest rates unchanged was a unanimous decision. I can also tell you that the risk assessment, which is nicely spelled out in the monetary policy statement, was broadly shared by members of the Governing Council. Now, as to future path, I think it's also widely shared by members of the Governing Council that we have to work on the basis of the data as they come in, that we have to decide meeting by meeting, and that to predetermine a path or preset the level or the material and significant development that would trigger one thing or the other is prospective and not part of the job that I do. Okay? I think my response is clear enough. Look, if trade tensions are resolved in short order, it will clear some of the uncertainty that we have weighing on the decision-making of consumers, of investors, of enterprises, and it will, of course, help us as well anticipate and model what the outcome of those tariffs will be. Could it lead to different movements? Future will tell. Our work will tell. I would not exclude anything, for sure. Thank you.
Next question goes to Santi Pignol of Market News International, MNI. Santi, please.
Thank you. Good afternoon, Madame Lagarde. My question is, we are now less than a year from the time when reserves are expected to slip from excess to ample. My question is, are you happy that banks are in a position to deal with the reduced reserve? And is the ECB happy that all the tools are in place for any early signs to stress in the interbank market? Thank you.
Yeah, I suppose you're talking about liquidity and the volume of liquidity. Yeah. Well, first of all, there is still plenty of liquidity in the system. The volume has reduced over the course of time, and it has reduced as a result of the reimbursement of TLTRO, which is now completed. It has reduced as a result of the discontinuation of reinvestment under the APP first and under the PEP second. But despite that, and the fact that our balance sheet reduces on a monthly basis, regularly, predictably, the volume of liquidity in the system is still north of 2 trillion euros. So to talk about limited liquidity in the system, I think is not the appropriate characterization. There is still plenty of liquidity. Added to which, there is probably more liquidity in the system than we had anticipated, because there has been less demand for banknotes, and that has an impact. And there are other technical reasons caused by the fact that governments eventually moved their own reserves away from the central bank to put them to better use somewhere else, which has, as a result, increased the volume of liquidity out there. But liquidity abound. Thank you.
Next question goes to Carlo Boffa of Politico. Carlo, please.
Hello, good afternoon. Thank you very much for taking my questions. I've got two. First one, the EPP lawmaker Fernando Navarrete, the parliament appointment for the digital euro, told Politico in an interview this week that the digital euro is a nuclear threat to force banks to act. Do you agree with the statement? And the second one is on the strategy review. Some analysts say that the bar for QE is now higher. Do you agree with this? And do you think it will have any influence on next year's assessment of the operational framework? Thank you.
Thank you for your very perspective question. The latter one I'm not going to address, actually, because you are jumping ahead. We have a review of the operational framework that will come in due course in 2026. So we'll take those matters as they come. The operational framework has been approved a few months ago. Let us just see how things work, draw conclusions from that, and then we shall see when we reassess in due course and in due time, that is in 2026. Now, on your first question, I have a pretty simple understanding of what the digital euro is. And for me, this is the digital expression of cash, right? I mean, we all have cash. Well, most of you, I suppose. I do. I like cash, whether it takes the form of coins or banknotes. This is cash, and this is central bank money, if you will. It's sovereign money. But as technologies evolve over the course of time, and as the preference for payment evolves as a result, we need to respond to the demand of our European compatriots. And I see digital euro as the digital expression of cash. It's like digital cash. You can argue at the margin that in terms of, absolute privacy, we're not exactly on the same page. You could argue that the cost of cash is higher, blah, blah, blah. But in essence, that's what it is. So to argue that digital cash is a nuclear bomb, I think that's a little bit over the top. We're not holding nuclear bombs in our pockets, as far as I know. Thank you.
And the last question today goes to Mario Savova of the Bulgarian news agency BTA. Oh, I thought you had raised your hand, sorry. Okay, well then it goes to Marta Pilar of Econostream, please.
Thank you very much. Good afternoon. Thank you for taking my question. Madame Lagarde, what do you think of market expectations calling for another cut, independent of when it is, especially given that the June projections already incorporate one more cut? Thank you very much.
Well, thank you so much for your question. Markets do what they have to do, and we do what we have to do, right? So what I said earlier is still valid. We are in a good place. We are well positioned to deal with turbulent waters and to deal with the risks that will develop over the course of the next few months. And I'm here referring particularly, but not only, to the risk related to tariffs. But you can include geopolitical risks as well. You can include a vast uncertainty, which might partly clear as a result of whatever tariff certainty we receive. So we are well positioned. We are in a good place. We have essentially closed that disinflationary cycle that we battled over the last months and which has led us to move from 400 basis points to 200 basis points with 8 cuts in a matter of 9 months. So we are in a good place now to hold and to watch how these risks develop over the course of the next few months. And we will have a new projection in September, and later on, we reassess at each monetary policy meetings. We do projections and we publish them on a quarterly basis, but we do that on a regular basis, and we will continue to do that in September, in October, in December, and on and on. And it's on the basis of that work that the Governing Council will decide what is the appropriate monetary policy stance. So I cannot tell you much more than that because it's been repeated twice in the monetary policy statement. I've tried to avoid repeating it too much, but our collective determination is, number one, keep inflation at 2% medium-term target. Number two, operate on a meeting-by-meeting basis. Number three, be data-dependent, and there will be plenty of that in the coming months. And not have any kind of predetermined rate path. Some people would like it. I understand that markets would like to have, more anticipation of that possible rate path. No, that is not possible under the current circumstances. But, as I said, we are well positioned to wait and see. And with that, I wish you all a nice wait-and-see holiday. And I hope that you take time to rest, enjoy family moments, friend moments, and have a good time in this.
That was some great advice there from ECB President Christine Lagarde speaking in Frankfurt. Take a nice restful holiday and enjoy some friend moments.
Friend moments.
This is Bloomberg Open Interest. I'm Matt Miller alongside Katie Greifeld. Let's get a quick check, shall we, on the major averages.
Here we go. We're 90 seconds into the trading day. You can see we're up very slightly. We had actually a big rally to close out yesterday. We got some big earnings report from the tech sector, and you can see that reflected in the NASDAQ 100, Matt Miller.
Yeah, absolutely a blowout in terms of CapEx from Google, raising in another $10 billion. Big American companies are still spending an absolute ton of money, and that drove stocks higher.
That is an up arrow story. Let's get to a down arrow story. Underneath the hood, we're keeping an eye on Tesla. Elon Musk warned of difficult times ahead for the EV maker after the one of the automakers' worst quarters in over a decade. You can see this wipeout developing in Tesla shares, now down 8.6%, Matt Miller.
Yeah, Alphabet, as I was saying, said demand for AI products boosted quarterly sales. It will now spend $85 billion in total on AI development. That is an increase of $10 billion.
And I know you're excited to talk about what's going on with Alphabet's AI strategy. So let's get over to Ed Ludlow joining us, Bloomberg Tech co-host Ed Ludlow. And Ed, I do actually want to start with Tesla, though, because that is a dramatic move that you're seeing in shares this morning. And you think about what Elon Musk said, that, okay, maybe the second half of next year, maybe the end of next year, things are going to look very different. But we know that he has a tenuous relationship with timelines.
He does. He often overpromises on something happening and then misses the timeline, but gets there in the end. I mean, this drop on the stock puts it on track for its biggest decline, I think, since the first week of June, on a closing basis anyway. That Tesla wants to be judged by investors on its future as an AI and robotaxi company. But in the here and now, the factors that impacted earnings were that it is a company that builds EVs and sells them to consumers. The biggest year-on-year sales decline for more than a decade. The numbers overall roughly in line or just missing estimates, and then clearly a quantifiable impact, $300 million of costs from tariffs. And by Elon Musk's own admission, this is a transition period where they're trying to convince Wall Street that they are moving from this legacy of selling vehicles to consumers to a very different operating model in the future.
I have to say, Katie's the better journalist. She's more skeptical than I am, Ed. I'm a cheap date, so for me, the more exciting story is Google, right? 10 billion more in CapEx, 85 billion. This is just a feel-good, big tech American story. Am I reading that right?
Yeah, it's AI-fueled growth. In other words, you see on the top line and actually the bottom line through its cloud computing business and operating income that the investment to date is starting to pay off, but at a higher cost. Raising CapEx is really interesting. Most of the time in recent quarters, investors have taken that signal that a commitment to investing in AI is really good. What's so interesting, not just in Google's own print, but in the third-party data that we have for advertising markets, is that the core bread and butter business, which is search, is still doing really well, and they continue to grow in that area. But you know, other threads to pull on are like Google is committing to fight in this talent war, something that came up during the course of the earnings call and is a notable expense for them as well. But cloud momentum is really important. Just like with Amazon, it's highly analogous. They go, okay, there's all these regulatory and litigation threats to Google's core business, but cloud computing is going to be the growth driver going forwards. And in the quarter gone and the limited outlook we got, they gave us evidence of that.
And Ed, before we let you go, I do want to throw a little bit of a curveball and talk about NVIDIA. We got some interesting comments from President Donald Trump yesterday saying that he weighed an NVIDIA breakup, but was told it would be, quote, hard. I know that you are in Washington right now at the Winning the AI Race Summit. What was the reaction to this headline?
Right. The reason I looked down at my terminal, by the way, is that I think NVIDIA, as it stands, is on track for a fresh record high. So the president basically said, and I'm paraphrasing, go and look at the full soundbite, he had looked at breaking up NVIDIA because it was so big, because it had a monopoly in the market. And as we've reported at Bloomberg, we basically technically view a monopoly as anything greater than 70% ownership in a single market, which NVIDIA has. But when he got to know Jensen Huang, he decided he was a great guy. He changed his mind. But the story is getting a lot of readership. I don't know that it's having any bearing on the stock in the here and now. Jensen Huang was very prominent in the room yesterday. He sat immediately in front of the president during the president's speech. He was invited by the president to stand, a prompted standing ovation. But, you know, the biggest thing for NVIDIA is that the AI action plan, the 23-page document, it changes the tone and policy position, which is that America's technology companies, it seems, will be allowed to export their technology globally, including to economic adversaries like China, which is the main focus of investors right now. Right. The president's relationship, I don't know. There's a cautionary tale in Elon's relationship with the president.
Well, we're just seeing a tweet from the president that he wants Elon to thrive, but he says that, you know, every few days. And I think it's interesting that the president may wake up one morning and decide to break up one of America's biggest, most successful, most dominant technology companies, you know, and he could do it.
It's a little bit ironic that those comments did come at, again, a summit all about winning the AI race, and NVIDIA is winning the AI race on a number of different measures.
But he's not going to break them up for now.
It would be
Bloomberg Tech co-host Ed Ludlow definitely would be a special edition of your program if that happens, so we'll watch for it. Thanks so much for joining us. His show starts at 11 o'clock, so an hour and 22 minutes from now. Oppenheimer Chief Investment Strategist John Stoltzfus joins us now, and it's funny, John, I was actually having kind of a dream about you the other night. Because I was dreaming of, we have on the Bloomberg terminal a list of the strategists' forecasts, and you used to be at the top of that list.
Don't tell me I'm a used to be. I don't want to hear that.
7,100. Now, your year-end forecast is for closer to 6,000, and a big bear like Mike Wilson has a higher target than you. So what do you think now? It looks like the U.S. economy and the U.S. corporate universe is firing on all cylinders.
Well, you know, the big question is, what the question is composed of is, what is your year-end target? And when we came in, the target that we put in last December was 7,100. But when April 2nd happened and those wild percentages, 50%, and then eventually with China, 145% threatened tariffs, that kind of stuff made us think we better pause with our target. We took it down to 59.50. Based on where the market wound up on April 8th, we looked really pretty optimistic with a 59.50 target, actually. And then it got exceeded. And the reason why it's exceeded is because there's been progress made in this, but we want to see some, we'd like to see something with Europe, ideally, something with Korea in addition to Japan and the UK. That would make us feel more confident that there won't be dislocations within the sectors in primary names that could make the end of the year number not look so good. But we have to say this, we're very pleased, and we never changed our recommendation to be overweight cyclicals versus defensives.
Right.
Favorite sectors remain technology, communication services, industrials, consumer discretionary, and financials, which I think of those four out of those are among the 5 top performing sectors since the low on April 8th. And we in the piece that we wrote, we said that we thought likely we would have to change this because we didn't think that the April 2nd numbers were actually.
You're welcome to do that on this show, by the way.
Okay.
You can front run yourself, front run your publication. For those following along at home, you can follow the horse race by typing SPX Index ANR on your Bloomberg terminal. So it sounds like this is subject to change. You mentioned trade as being a big factor there, but what about earnings? We're really getting into the meat of earnings season.
And that's the thing. It's I don't think it is nothing like what some people expected in second quarter earnings season, where you see the effect of tariffs. There's some effect, and some effect of just the way companies are changing how they're positioning that affects earnings when they change where they're sourcing things from or what have you. But we think that's further out. But if the numbers come down and it looks like 15% is the new 10%, and people seem to be kind of happy with it around the world because they look at it and they think, well, it'll affect the exporter, the importer, and the consumer, but it's diffused among the 3 and to different degrees depending upon what is the input cost affected, or is it a product or a service, what have you. So, we think this is so far so good. That's the remarkable thing, and we like our call where it is in terms of being bullish, but at the same time recognizing that there's still some risk within this tariff regime and where it arrives at. But yesterday, the news on Japan, or was it the day before? I mean, time gets compressed these days.
Circle.
Yes. This is good stuff. And I think that the ECB essentially, just in today, what we heard today, their actions shows they're looking at this. Perhaps they would come to the table too. And ultimately, we think it's fair for the U.S., fair for global trade. If you charge me a tariff, I'll charge you a tariff. If you want no tariff, let's go no tariffs.
Well, if that second option were on the table, I think a lot of countries would take it. It doesn't seem to be.
No.
What about the U.S. consumer? Yesterday, we were talking with Anastasia Amoroso, and her assessment, I think she cites the Tax Foundation, is that most consumers are going to end up with 5% more after-tax income since the one big beautiful bill. That would be a great thing for consumers, right?
I think that's part of the thing about what the OBBB, the OB,
1B3.
It's when you look at that, you think there's a lot of things that are designed to offset negatives on this, and if it works out. And I think it's got a really good chance because trade is so important. The whole world is so interdependent on trade. The big news of this thing, I think, ultimately is what we've been saying for years now, is its diversification from one country centricity in terms of the global supply chain coming out of this. We're going to bring some businesses back here, those that are important for national defense, to make sure we have all kinds of drugs if we got another pandemic accessible. We don't have to be desperately waiting for a foreign source to ship stuff to us. But I think the reality is both the U.S. consumer and U.S. businesses like to buy globally because they get better deals that way. And Americans love to shop, and shoppers love good deals. And whether it's for quality or just on a commoditized product. So I think this is, this has been a year that has most certainly brought the Tums and the Pepsid back to the trading desk. But what we must say is it looks like the future looks substantially better than the bears would predict.
Yeah, we're all dealing with horrible acid reflux. John, unfortunately, have to leave it there. Hope to speak to you again soon.
Thanks.
That is John Stoltzfus from Oppenheimer. And it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Oppenheimer is upgrading Spotify to a buy, citing many tailwinds ahead. The firm sees significant opportunities for the company to monetize user shares, up 2.4%. Next up, we have Deutsche Bank upgrading rail giant CSX to a buy, citing the increasing potential for consolidation in the railroad space. We heard from the CSX CEO saying that he's open to merger talks with other companies amid reports that Union Pacific and Norfolk Southern are in advanced combination talks. We'll have more on railroad deals later ahead. And finally, Wall Street is weighing in on Tesla after CEO Elon Musk warned of a hard year ahead. Wedbush analyst and Tesla bull Dan Ives describing Elon Musk as a, quote, wartime CEO who is sharply focused on high-stakes initiatives. He joined Bloomberg TV earlier today.
AI is the future for Tesla. So to me, yeah, it's a rough few quarters ahead, but I believe autonomous, we are in the beginning. What's going to be $1 trillion valuation alone for Tesla. So that's why I don't get so concerned when we talk about deliveries, which actually were kind of in line, you know, when we look at what's going to happen in the second half. The story here, when it comes to physical AI, two best ones out there, it's going to be Tesla and NVIDIA.
All right, Dan Ives there, and if you're, well, I hope you're watching, because what a fantastic outfit. Let's talk more about Tesla right now with Jed Dorsheimer, William Blair Group Head of Energy and Power Technologies. He recently downgraded Tesla to a market perform rating with a $333 price target. Jed, great to have you on the program. You didn't dress up.
Yeah, thanks for having me back.
Yeah. I wonder what you think about the difficult quarters ahead, as Elon Musk put it, for the company. As a car maker, they certainly face problems. Is that true also as you know, an AI firm, as a robot maker, as a robo-taxi operator? What is Tesla actually doing?
Well, they're doing a lot of things, but I think the challenge, you know, with what Dan was talking about is the question is, how much patience will investors have? And I think there's a willingness to look through for those future opportunities, in particular robotaxi. Now, that being said, Elon last night put out, you know, a very aggressive, really, you know, I think most investors are going to have a tough time believing that they're going to be able to address half of the U.S. population with robotaxi from a very small sample set of Austin by the end of the year. So that kind of egregious target, combined with what you're going to see is a cliff on margins or profitability, is the, by the way, I like the OB3. I'm going to steal that now. So as you look at the OB3 impact on the tax credits and the regulatory credits, which hit in Q4, that's going to be the time frame that's going to be tough. This quarter, we expected things to be a little bit better, you know, or last quarter and Q3, you're also going to get a pull in on demand. The issue is going to be Q4, Q1, and how long it's going to take to scale robotaxi.
Jed, it feels like we're potentially reaching a really interesting precipice for Tesla, the stock, because for so long, I mean, this is one of the companies out there where the CEO is so able to sell the future vision, even as the fundamentals in real time worsen. And now you think about some of the things that people are most excited about, a lower priced model, perhaps humanoid robots. It just feels like it's getting to be a tougher sell when you start to line up these timelines.
Sure. And listen, we've been through this before with Elon and with Tesla. You know, I covered the stock back in 2018. So I remember when, you know, it was the S and X, and the challenge was, can you go from a high price, low volume to a low price, higher volume on the 3 and Y? And it was really challenging. Remember, there was a lot of questions back then, and Elon ultimately prevailed. And we're not betting against the company long-term or the stock long-term. I think, you know, the position is there going to be an opportunity? Is there going to be an air pocket that allows the stock to come in to lower levels? And we should be more tactical about just sort of, buying and closing our eyes to what the fundamentals show. And that's probably an area of differentiation. I do think that there are very promising, Elon talked about the energy business. That's an area that we focus on. It didn't get a lot of attention, but very profitable. And we're going to need more of that. We're going to see the
grid strain. But it didn't do well, right, Jed? It didn't do as well as had been expected.
Well, the profitability is coming in much higher than expected, and the need for those mega packs and the Powerwall are only going to be increasing. That being said, it's not large enough, to offset what you're seeing in autos. And the real driver is going to be robotaxi. That's the meat of the valuation in their ability to scale.
Why is robotaxi so important? You've said this in the past. Dan Ives has been beating this drum forever. Why don't I get that? Because, Waymo already is there with a much more successful platform with much more experience. And once that nut gets cracked, everybody is going to be there. Why does Tesla have some sort of advantage?
Well, it's a vastly different approach. So if I look at Waymo is, 6 years into this process, and they have a cost structure that is very high. So when you look at that vehicle, that cost is going to be up $120,000, $150,000. When you're looking at what Tesla is doing by removing the LiDAR systems, removing the pre-programmed maps, that they can get to 1/10 the cost structure. So it's a much more aggressive, and so if you can get 1/10 the cost through the neural net and through the vision only, and keep the safety and meet regulatory requirements, then your ability to weaponize price and scale and take market share is much greater. And so that's the real opportunity and the difference. So you're not going head to head with two of the same technologies. You have vastly different approaches here. And there's some questions over, if you look at Waymo has to partner with Uber. We look at Tesla, they're trying to do the vertically integrated with a lower cost structure. So will they be successful? If they are, to the victor goes the spoils, and that's the opportunity.
And Jed, we don't have much time left, but we spoke to you earlier this month because you downgraded Tesla to a market perform. And I'm curious, now that we're through the earnings, we heard from Elon Musk, what would you need to see to bump you back up to a buy equivalent?
Well, we need to see better data on the scalability of robotaxi, to get more comfortable with the time frame. In our model, we have material revenue coming in 28, and we have that, ramping in 27, but that leaves a year and a half as a gap on the profitability. So we need to see that come in a little bit so that there's not as much of, you can't have a year where it's a complete redo in terms of, reset of expectations. And street numbers are still too high. So as street numbers get reset, we get better visibility on robotaxi. That would get us more comfortable with being constructive on the name.
All right, Jed, great having you on the program. Hope to get you back soon. Jed Dorsheimer there of the William Blair Group. Let's take a look at what's going on in stocks right now. On our dashboard, you can see the S&P 500 is putting up a gain of 0.2%, 6372 would be obviously a new high there. The NASDAQ today, it wasn't this way yesterday, gaining more than the benchmark index, up 23,000. By the way, we're going to talk to the NASDAQ CEO, Dina Friedman, in the next hour. Definitely an interview you don't want to miss. They had the best first half for listings since 2021.
Yeah.
Which I think is a pretty amazing story. You can see Alphabet, Google shares in the corner there, up about 2% right now. So investors like that. They don't like Tesla, but that's a very volatile stock. So a 7% move in Tesla is like a...
It's a sneeze.
It's like a 2% move in a normal stock. $307, so still about $25 below Jed's target, and he lowered that. So United Health Group and American Airlines both down. Union Pacific and Norfolk Southern are interesting, moving in different directions, and this is something that we're going to talk more about because a deal in the railroads industry, I think, is more interesting. The actual sentence makes it sound, right?
Yeah, no, and this is a huge one in particular. So let's welcome in Lee Klasko. He is Senior Logistics Analyst for Bloomberg Intelligence. So combining Union Pacific and Norfolk Southern, this would be the sector's biggest deal ever. Before we get into potentially who's next, just talk to us about how this combination might reorder the industry.
Yeah, hi, thanks for having me on. You know, the rail industry is relatively consolidated right now. You have two large Western players, Union Pacific and Burlington Northern, and two large Eastern players, which is CSX and Norfolk Southern. Union Pacific this morning confirmed that they are in fact in talks with Norfolk Southern. This is confirming news reports that have been going out over the last, I guess, week now. And so what that would do is that would create a trans-con railroad, which we don't really have. We saw a recent acquisition of CP, Canadian Pacific, and Kansas City Southern, creating a single line NAFTA network, combining, you know, connecting Canada, the U.S., and Mexico. So this will be, you know, a very transformational merger, assuming though, and this is a large if it can get regulatory approval, and there's certain rules by the STB that makes it a very high hurdle for them to get over. So it could take a long time before we find out whether or not you know, they do get that approval, even if they, you know, ink a deal in the coming weeks.
Lee, explain to us, like if you're sitting next to somebody at a dinner party and say, I analyze railroads, and they, you know, doze off, the importance of these networks to the U.S. economy is just massive.
Absolutely, and no one ever falls asleep when I talk. So that's first and foremost. You know, it obviously is important. It's the lifeblood of the economy. You know, all freight modes, whether it's railroad or trucking. You know, railroads are great because they are, you know, more fuel efficient than trucking. They're 3 to 4 times more fuel efficient than trucking. So it's lower emissions. Also, they tend to be cheaper than trucking. So, you know, for shippers, it tends to be a good product. The trade-off that you have is service, and you know, railroading, just like anything else, like a lot of the railroads like to say, it's an outside sport, and they have to deal with severe weather and issues. And you know, the real big difference though, if there's an outage on one of their main lines, it really can have ramifications for service across its whole network. And so, you know, the rails have been great with, you know, intermodal, which is very truck competitive, and they're also, you know, very key to move heavy stuff like coal, ag, that sort of stuff across the country.
All right, Lee, I think you have a cool job for what it's worth. That is Lee Klasko of Bloomberg Intelligence. Should also mention quickly, shares of CSX also higher. A lot of speculation about whether they're next to be bought.
You weren't gonna
mention Crazy Train?
Crazy Train.
Crazy.
What an important.
Rest in peace, Ozzy Osbourne.
Coming up in the next hour, Nomura is chairman of investment management for its on its plans for U.S. expansion. Then we're going to talk to the CEO, as I said, of the NASDAQ. This is Bloomberg.
Estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Aqua in Sintra, Portugal, and this is Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. The largest health insurance company in the country confirms it's under investigation by the Department of Justice. CBS's Stacey Lynn has our top story.
United Health says it's facing a federal criminal and civil investigation over its Medicare billing practices. The company says it is complying and has also launched a third-party review of its business policies and performance metrics. This comes after the Wall Street Journal reported in May that federal officials had launched an investigation into the healthcare giant over possible Medicare fraud.
United Health stock down 2% right now. Congress has gone home for summer break, but House Speaker Mike Johnson is still focused on the Jeffrey Epstein scandal and a push by both Democrats and Republicans to get the Justice Department to release the case files. This week, reports said the Attorney General told President Trump his name appears multiple times. Our Major Garrett asked the Speaker if he agrees with the President that it's all a hoax.
Oh, it's not a hoax, of course not.
More from correspondent Natalie Brand.
The White House, the communications director, issued a statement about this new report, saying in part, the fact is that the president kicked Epstein out of his club for being a creep. This is nothing more than a continuation of what the White House calls fake news stories concocted by the Democrats and the liberal media.
Turns out those messages shared by Defense Secretary Pete Hegseth in a Signal chat in March had been labeled secret.
Sources tell the Washington Post those plans to attack Houthi rebels in Yemen were first shared with some defense officials in a classified email system. Hegseth then posted those details in an unclassified group chat on the Signal app. Director of National Intelligence Tulsi Gabbard told Congress days later,
as the President National Security Advisor stated, no classified information was shared.
The Signal leak came to light because the editor-in-chief of The Atlantic was mistakenly included in one of the chats. Michael Wallace, CBS News.
A deadly heat dome still making much of the South and Midwest uncomfortable. CBS News meteorologist Rob Marciano.
The heat and humidity over the next 3 days will feel like up and over 100 degrees in Memphis, a break in the Northeast, but St. Louis, D.C., Charleston, Dallas all remain hot and humid in a dangerous level through the weekend.
Despite all of the controversy over books found in schools today, a just released report from the National Council of Teachers of English finds the most taught books in American classrooms, still the classics.
Every allied government gave me a decoration. Major J. Gatsby for Valor Extraordinary.
Yep, titles like The Great Gatsby, Romeo and Juliet, and Of Mice and Men. Dow down 238. This is CBS News. A court win for the guy who founded MyPillow.
A federal appeals court has ruled that Mike Lindell does not have to pay a $5 million award to a software engineer. As part of an event Lindell hosted 4 years ago, he offered up $5 million for anyone who could prove that information he released there was not valid data proving Chinese interference in the 2020 election. Robert Zeidman entered a 15-page report that said proved the data wasn't what Lindell claimed. Arbitrators, including one hand-picked by the MyPillow founder, awarded him the money. The court said the arbitrators went too far in interpreting contest rules. Steve Kathan, CBS News.
Guys at South Park aren't letting their new bosses hold them back.
Mom, my favorite show just got canceled by the government.
Season 27 premiere takes aim at Paramount's decision to bring an end to The Late Show with Stephen Colbert.
The government can't cancel the show. I mean, what show are they going to cancel next?
Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we are streaming live on YouTube as well, so head over to youtube.com, search Bloomberg Live Radio, and that's where you'll find us. Coming up, we're going to check in with Brendan Murray. He's a Bloomberg Global Trade Editor. Get the latest on tariffs. Seemingly a very fluid situation, as always. Shelby McFadden, Senior Analyst at the Motley Fool Asset Management, will come on and give us her thoughts on these markets. Paul Goldberg, Bloomberg Intelligence Senior Equity Analyst. He covers all the big asset managers. Blackstone profit jumps 25% on fees. So we'll talk to him about what's happening at Blackstone and in the world of private equity broadly defined. Steve Mann, Bloomberg Intelligence Autos Analyst. He's going to come on and break down the Tesla earnings. Disappointing to say the least, a revenue decline there. Get the latest there on the biz. But right now, let's reset this thing. Lisa Mateo and Paul Sweeney live with you. We're going to kick it all off with Charlie Pellet.
Thank you very much, Paul. Lisa, you mentioned Tesla. That stock down now by 8%. This Bloomberg Business Flash brought to you by IBKR. Will the median new home sales price exceed $430,000 in July 2025? At IBKR Forecast Trader, the yes was recently at 34%. Check the data, spot the trends, and start predicting today at ibkr.com/forecast. Last trading day for this contract, August 25th. Right now, we have got the Dow Jones Industrial Average slumping 175 points. Certainly shares of IBM after earnings weighing on the Dow. IBM down now by 9.4%. The Dow is declining 0.4%. The S&P higher by 13, up by about 0.2%. NASDAQ up 43. That is a gain of 0.2%. 10-year 4.40% with a 2-year 3.90%. Gold down $19 the ounce. Spot gold down 0.6%, and West Texas Intermediate crude oil now up 1%, $65.92 for a barrel of WTI. Union Pacific confirms it is in advanced discussions with Norfolk Southern about a potential combination of the two rail giants. Union Pacific down 1.6%, Norfolk Southern higher by 1.4%. Elon Musk is warning of difficult times ahead for Tesla, saying the company will be in a transition period for the next year or more. Dan Ives is with Wedbush Securities. He was on surveillance this morning. He does remain a Tesla bull with a $500 price target on the stock and an outperform rating.
This quarter, next few quarters, there's nothing to write home about, right? In terms of actual deliveries, demand, gross margins, EPS. But if you look at the story over the long term, I believe 90% of the future value is about robo-taxis, autonomous, eventually it's going to be Optimus. That, when it comes to physical AI, and Jensen talks about this all the time, the two best physical AI plays are Tesla and NVIDIA.
Dan Ives of Wedbush. Tesla shares again down by 8.2%, now at $305. Again, recapping, S&P is advancing up 13 now, gain there of 0.2% for on-demand news 24 hours a day. Subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pello, thank you so much. We appreciate that. Lisa Mateo, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. As Charlie was just saying, got a mixed tape out there. But let's take a look at some of the stocks on the move today. I'm Paul Sweeney with Lisa Mateo, and we're joined by Bloomberg's Vildana Heinrich. Vildana, what are you looking at?
I'm taking a look at shares of American Eagle. That's ticker AEO, and they're up roughly 6% today after the apparel retailer announced a campaign that's being headlined by the actress Sydney Sweeney. And,
no relation.
And no relation, right? The campaign had been announced on Wednesday. Shares actually closed up some 6% on Wednesday, so today's move really is an extension of that. In the press release, they said something along the lines of Sydney Sweeney has great American Eagle jeans, and now you can too, and apparently people are really liking this.
I also think American Eagle might be a meme stock.
Yeah, well, it was on the Reddit platform. People were talking about it, and it just went, went
people
crazy
are,
after that.
People are talking about it, so we're tracking that as well. We'll
okay. Also, Tesla shares really taking a hit. They're down, 8%? And what's worse is Elon Musk said there could be even tougher times ahead.
Right. So shares down some 8%, down 25% year to date. The CEO did warn of a hard year ahead for the EV maker. He said Tesla will be in a transition period for the next year or more, and that's after losing its electric vehicle incentives in the U.S. and also needing some more time to roll out autonomous vehicles, which obviously the company has been talking about for quite a while. But he did say that the company could have, quote, a few rough quarters.
See, if I were back in my investment banking days, I would say, let's just spin out this car company and let investors focus on all the other stuff that's still to come, whether it's the robo-taxis,
that's
autonomous
can you do
car.
That? I mean, you see the bigger companies
absolutely. I could
Kellogg and all these kind of splitting into how many different companies.
Plus, I'd get paid to do that. All right, Chipotle, where I went yesterday, had my 2 hard tacos with chicken and all the fixins, which was awesome, but not so good today with the stock.
Was it BOGO, buy one, get one? Because
I don't know.
You missed the BOGO off.
I had a BOGO off. That's why I was taking a look at this stock, because I go actually pretty frequently. I like Chipotle, but shares are down 13% today after the company cut its annual outlook for the second time this year, and it's just suggesting to analysts that the honey chicken that they are offering now and also the burrito giveaways haven't really been enough to offset the traffic slump that Chipotle is attributing to economic anxiety. But yeah, they were giving out buy one, get one a couple days ago, and I took advantage.
Yes.
I don't. I stick with my brown rice and my steak, and I get the little avocado and everything, and I'm good to go.
No like chicken or
no,
beef?
just the steak. That's it.
Oh, the steak. You get the steak. Okay.
But now they're emailing me like, we missed you, come back. So maybe that's a sign of
they're trying.
things.
They're trying.
All right, very good. Vildana Heinrich, cross-asset reporter for Bloomberg News. Thank you so much. For more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Tariffs front and center yet again. Had some news over the last couple of days out of Japan. Maybe a little bit of movement from the European Union. Who knows? Let's get the latest on this fluid situation. Brendan Murray, Bloomberg Global Trade Editor. Brendan, what's the news du jour on tariffs today?
Well, the big question now is, will the European Union get a deal like Japan got, the 15% reciprocal tariff rate and a 15% rate on auto exports? Those mean a lot to the European Union, as they do Japan. Of course, German automakers, want to keep access to the American car market. So the tariff that they're staring at right now is threatened at 25%. So 15 is looking a lot more likely if Trump can agree to what the Europeans would want out of those negotiations. Now they're complicated. There are other industries, steel and aluminum, that are facing 50% tariffs, and semiconductors and pharmaceuticals that matter to the Europeans. So there's a lot of fine print to go through to pull one of these deals off. And of course, there are 27 nations in the European Union, whereas you just have to deal with one Japanese government to get something over the finish line. So it looks like they're making progress. The European Union collectively is the biggest trading partner with the U.S. So this is a consequential decision for both sides. The deals that we've seen so far, the 5 or 6 of them, they have been generally smaller economies, with the exception of Japan. So the big deals are starting to come closer to the finish line here as we get near the August 1st deadline.
Now, Brendan, you mentioned Japan, so let's go there. I mean, there's some concern that the president may have given away too much. I mean, we're still working through that trade deal, correct?
Yeah, there's some details. They announced kind of the broad outline of it, but there's still some things that they need to work out. The 15% tariff for Japanese automakers makes things difficult for American automakers who have to contend with a higher tariff for their supply lines between Mexico and Canada. So there's some sense that this could even disadvantage American automakers. So the goal for the Trump administration is for all of these companies to move their production to the U.S. and avoid tariffs altogether. But there's some when you try to negotiate individual trade agreements across dozens and dozens of countries, you're going to create these sort of arbitrage opportunities when the tariffs are different. We've lived in an era for the past several decades where tariffs are pretty consistently low across the board, and when you start bringing these higher tariffs in at different levels, then it really it really makes things complicated for the production lines that extend across the world.
So is part of potentially, like the Japan deal, there's many parts of the Japan deal were very interesting, one of which was setting up this fund in the U.S. It seems like, how much is it going to cost this U.S. government to kind of get this 15% rate? How many billions of dollars do we have to kind of invest in your country? Is that something that is now, I guess, table stakes for these big trading partners if they want to get a deal with the U.S.?
Yeah, I mean, the Americans came away from the Japan talks saying, look, Japan brought this really innovative new approach, this mechanism, this fund that the Japanese government would sort of provide credits and funding for investments in the U.S. And Japan's already a big investor in the U.S., so there's some questions about whether they're just repackaging stuff that's already been in train, but that seems to be the model that the White House likes, is bring us something, a big headline number, a big amount of purchases of American goods, LNG, whatever your country needs, put it on paper so we can announce it, and you'll get a break on that tariff, which the floor last week was 10%. Now it looks like it's 15%. So everybody's getting 15% or higher from here forward, it looks like.
And Brendan, the last 30 seconds or so we have here left. Commerce Secretary Howard Lutnick just said South Korean officials will be in Washington today to discuss possible trade agreements. I mean, is that something that could move forward as well?
Yeah, that's definitely one that they're trying to get over the line. South Korea obviously would be under pressure now to get something like Japan. Their rival is as a big tech exporter and auto exporter and steel exporter. So once these dominoes start to fall, they can all kind of come pretty quickly. So the South Koreans, they've been shuttling back and forth between Seoul and Washington for months now. This would probably be a routine meeting that takes on a whole new importance now that Japan has its deal.
All right, we move forward. Brendan Murray, Global Trade Editor, Bloomberg News, joining us from our London offices there. Again, Japan getting a trade deal done. I'm not sure what getting a deal done actually means. Is it a term sheet? It is a big 1,000-page agreement. I have no idea. But that's done, and now attention turns to the European Union, another huge trading partner for the U.S., and we'll stay on top of that. We're going to have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks hovering near records. This Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses. Oracle's offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. S&P 500 index right now up another 763.66 where we stand. That is a gain of 0.1%. That is a record right now. The Dow retreating by 201, down 0.4%. IBM certainly weighing on the Dow after earnings. IBM down 8.5%. We've got NASDAQ up 12 now. That is a gain of just about 0.1%. 10-year at 4.40% with the 2-year 3.90%. Gold down $14 the ounce. Spot gold down 0.4%. And West Texas Intermediate crude oil WTI is advancing now by 1.4%, 66.15 for West Texas Intermediate crude. Lots of earnings news in airlines today. American scaling back its earnings outlook amid a persistent slump in consumer demand. Shares of American down 8.3%. Alaska Airlines also out with earnings. It provided a new profit outlook for the year following an upturn in demand from business travelers. Alaska down by 2% right now. And Southwest Airlines expects economic turmoil to erase as much of $1 billion of its annual pre-tax profit this year. Southwest plunging by almost 11%. Mixed picture for a lot of the meme stocks today. GoPro shares down 1.3%. Krispy Kreme down 0.1%. Beyond Meat down 5.8%. And heading in the other direction, Open Door Technologies up by 21.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie. Well, he was just talking about the markets, right? And a lot of things affecting it. Tariffs, trade talk, consumer sentiment, spending, geopolitical tensions, you name it. Here with more insight into that is Shelby McFadden, investment analyst at Motley Fool Asset Management. Shelby, thanks for joining us. First off, get more into this market volatility, what you're seeing and how that's changing the way you approach your clients.
Yeah, absolutely. First, thanks for having me. Always a pleasure to be here. When we look at this market, one thing it doesn't make us do is jump out of our boots. We are absolutely staying firm in our approach. There are sort of 4 pillars to quality that we look at in our active investing approach. But the volatility it's no shock to anyone, right? When we sort of look at the headlines that we can very easily categorize as noise, but in many circumstances, it is something we should actually listen to and not just hear. So we should at least try and filter it. It's not surprising. So we're having questions about what is the path forward for interest rates and the US dollar? What is the path forward for tariffs, which are going to affect everything from a tube of toothpaste to tires and full-out cars? And so it's no surprise to sort of hear these things. But then if we also want to drill into what's really providing a lot of the froth in the market, and that's AI, even bigger, because now we have something that needs to prove itself in terms of are the fundamentals displaying worth for these prices, but then also that's wrapped up in tariff issues as well. So when you're looking at global trade moving around the way that it is, it's no surprise to see quite a bit more volatility in the summer than we have if we want to look maybe before 2020 when things get usually quieter in these months. But now I don't think you can really depend on that.
Shelby, we're trying to get a sense of kind of how the consumer's doing out there. And we had a report from Chipotle saying, their consumer base is challenged and they're seeing it in their traffic numbers. How do you guys think about the consumer from your stock selection perspective?
Yeah, when we're sort of looking at a new idea or even our existing ones, we approach it with the 4 pillars of quality, which are going to be management, culture, incentives, economics, competitive advantage, and trajectory. And so that's something that we apply in our active selection, whether that's going to be in TMFC, which is the Motley Fool 100 index, which has much of the Magnificent Seven and some of those big consumer stocks, or some of our other model portfolios. And what that allows us to do is choose companies that are going to fare better than their peers, regardless of what situation that we're in. So sometimes when we're looking at consumer, the better bet, especially in times like this, would be to find the stickiest consumer. So that could be in something like a Walmart, where you're realizing that they can capture people from higher rungs of the ladder when they decide to float down, but then also realizing that Walmart provides more value than some places like the dollar stores, where they're more reliable. They're able to really dig into that scale. On the other end, we might look at the premium side of things, where people are looking at things like LVMH, or they're looking at more affordable luxury, tapestry brands, things like that, because they're realizing that that consumer, ever since probably around 2023, when we had a bit of a sort of separation between spending and income groups, that consumer is really, really sticky. They're able to have a bit more flexibility in where in the income sort of ladder, again, that they are able to spend. And so those are some of the things that we're looking at. Those things lie in higher competitive advantage, higher trajectory scores, and that allows us to feel more comfortable with where the business cycle is going to take the entire market while we have chosen those conviction positions.
All right, so Shelby, let's shift a little and shift over to the Fed. Now, you say you're anticipating a frozen Fed summer. So does the eco data that we've been hearing, does it support that? And then what happens after that frozen Fed summer?
At this point, the data that I have seen does support a stronger likelihood of seeing rates be still for the summer. And the reason I say that is because the Fed still has quite a bit to anticipate. So at this point, even though it feels like we've been in this tariff ordeal for several months, it's just been a few. And the environment has moved pretty frequently. The deals have come on and off the table. There's still a lot to shake out. And then once those deals have firmed up, we have to actually see it come through the data. So we're only just getting into a point where we're going to see that sort of the effect from the air gap of container ships that sort of stop coming through the ports. We're only going to be rolling into that soon. The higher prices will only be coming in probably around this fall. And so the idea that the Fed would have probably cause to say, let's go ahead and lighten the load that's on the economy right now from these higher rates from the current data seems unlikely to me. But the thing is, the end of summer quickly approaches, right? We are at the end of July. It's really just August. If you're in the mid-Atlantic, summer likes to roll into September and October. But realistically speaking, we could maybe still see something in the fall. But I don't really have my hopes on anything through July, given the robustness of the consumer.
Is AI, how do you guys play AI in your ETFs? We got some good numbers out of Google last night talking up AI. Even Tesla, despite the fact that it's disappointing car business news, they continue to talk up AI there. How do you guys get positioned for that?
Yeah, so you can sort of take the idea of scale. I think that's one of the best ways to play it at this point. And then there's also some of the indirect applications. So you can play it with companies like Meta, which we've always known, not always known, which we've known in the recent history to sort of be placing themselves first in line. Meta and Microsoft able to do that, positioning themselves very well to have access to what they need for growth. So if you know that you need to build a foundation, but you can't get cement, you can have the best blueprints out there. But if we know that you are last in line to get the materials that you need, then you're not going to be rewarded for that. So one of the rewards that we've had in the portfolio is positioning ourselves early in these companies when they've had a vision and gotten themselves in line to get the chips that they need to do so. But an indirect take of that would be something like a Netflix, right? Where the stock has run up tremendously. They unfortunately decided they're going to stop reporting some data that we found really useful, which is that subscriber count, but or users rather, but realizing that they have taken an approach where the inner workings of ad technology in Netflix and the sort of microeconomy that they're building there, the ad platform that they are building within that business is something that also comes from AI and also from all the things like data clean rooms. There are so many sub businesses that are required to make something like that run. And it's a great way to play innovation without being directly involved in chips.
Great stuff. As always, Shelby, thanks so much for taking the time to join us. We really appreciate it. Shelby McFadden, Senior Analyst at the Motley Fool Asset Management. You know what? It's a good business. Private equity.
Oh,
they're pretty good. And you think about it, I mean, just one of the, I grew up with the KKRs of the world. Blackstone is just the beast out there. And I can't even remember how much gajillions of dollars they have in assets under management. They reported some numbers last night. Let's break it down with Paul Goldberg. He's the Senior Analyst at Bloomberg Intelligence, covering a lot of these asset managers here. Paul, talk to us about the behemoth of Blackstone. What did they report last night?
Morning, Paul. They actually reported this morning, but it was a very strong quarter, better than expected. A lot of that came through the fee-related earnings because the exit activity and the performance fees they get from realizations were kind of muted, as was across the industry. But if you look at the fee-related performance revenues, fees were up double digits, which is very good. Assets under management, you did mention the large amount. They're up to $1.2 trillion with better than expected 52 billion of inflows. So up 13%, solid double-digit growth. And one big area where I think they sort of differentiated this quarter was fee-related performance revenues. Those are the performance fees that get on the funds that they don't have to exit from. So they just accrue those revenues. And there was a very strong quarter in private equity in particular.
So if you can explain, maybe I'm selfish in asking this, but if you can explain to me, Paul, why are those areas, why are those ones so crucial?
Because those fees come from the perpetual funds, the funds that they don't have to return the money to the investors and raise a new fund. So those are the funds, especially they're very tied to retail investors through their very large vehicles, BCRED that does private credit and BREIT that does private real estate investments. And those funds don't have to be returned to the investors. So as long as the performance is good, they can crystallize a lot of those fees. And this is what came through in the second quarter very strongly.
Paul, what's the investment call here for Blackstone? I mean, it just feels like you have to own it. If you have exposure or if you're benchmarked to anything on the financial services side, don't you have to be just super long a Blackstone? I mean, stock's only up 3% year to date, but on a trailing 12 months, up almost 30%. It just feels like one of these things you just have to own.
I wouldn't make a call of have to own or not, or differentiate necessarily to their largest peers. But the private markets, the private investments are growing very substantially. The growth has been very solid over the last few years in the double digits. And this is where Blackstone is the largest one with the 1.2 trillion of assets under management that I mentioned. So a big chunk of their money is in private credit, one area that grows very substantially. They did talk about over $100 billion of investment grade credit, and this is where they go into more head-to-head with traditional markets. And they have well over $250 billion of retail money, the wealth management channel, which is the largest one amongst their peers. And this is the area that's growing very substantially. So yes, the performance has lagged because the exits were soft in the first half. They did talk about much better environment, as was kind of similar to the other large banks that reported last week. So the expectation for the M&A, the deals that will probably give them some opportunity to exit and collect some of those performance fees. But it will take some time. So
yep. All right, Paul, thanks for joining us. Always appreciate it. Paul Goldberg, Senior Equity Analyst, Bloomberg Intelligence, covering those big asset managers. I'm looking at just the kind of the business of Blackstone. Again, he said like 1 trillion of assets under management, just extraordinary. But their big three big lines of business from a revenue standpoint are private equity. That's kind of what we all know Blackstone about. Real estate, also huge, almost as big as a private equity business, and credit and insurance. So three big revenue streams for Blackstone, and that's what you see. Again, the stock up about 3 or 4% this year, up about 28% though on a trailing 12-month basis. Looking at this market, we got the S&P up 10 points, the Dow's down 150, and the Nasdaq's up 13. We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow lower, the S&P, NASDAQ there, both moving higher. Dow being weighed down by IBM after earnings, down 8.7% on IBM. The Dow down 0.4% right now, down 165. Investors sifting through a whole lot of earnings. We got the S&P 500 index up 12. That is a gain of 0.2%. S&P at 63.71. NASDAQ Composite Index up 30. That is a gain of 0.1%. A down day for the Bloomberg Mag 7 index, lower by 0.3%. Tesla certainly weighing on that index after earnings. Tesla down 8%. 10-year 4.40% with a 2-year currently yielding 3.91%. Spot gold down $10 the ounce. Spot gold 33.76 down by 0.3%. An advance for West Texas Intermediate crude up 1.5%. 66.20 now for a barrel of WTI. Alphabet shares higher by 1.4%. Alphabet says demand for artificial intelligence products boosted quarterly sales and now requires an extreme increase in capital spending. Stuart Kaiser is U.S. equity trading strategist at Citigroup Global Markets.
The AI trade is just so powerful. Even Google overnight.
Yep.
A lot of moving parts there, but a key of it is they increased their CapEx by another $10 billion. And to the extent that that is still happening, it makes it hard for people not to be in that space.
Stuart Kaiser of Citigroup. Alphabet up 1.2% again after earnings. The Bears repeating. Tesla shares plunging by 8.5%. President Trump will be visiting the Federal Reserve today to tour the construction site he has criticized for cost overruns. Recapping, stocks mix, the Dow lower by 0.3%, S&P up by 0.2. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you, Charlie. You're listening to Bloomberg Intelligence. I'm Lisa Mateo alongside Paul Sweeney. And let's get to Tesla, right? It posted one of its worst quarters in years, revenue falling 12%. And there could be even more tough times ahead. So let's find out more, dig into this with Steve Mann. He's Bloomberg Intelligence Global Autos and Industrials Research Manager. Steve, why don't you start out with telling us what the biggest portion of that revenue drop, where did it come from?
Well, the revenue drop was mainly from weaker sales in Europe. Still the Model Y ramping up. I think on the call, I think the reason why the stock is down the most is really the outlook. Nothing earth-shattering from the outlook. And they also they were kind of cautious about the rest of the year and maybe into the 2026.
Steve, what do we know about the position of the Tesla brand right now? And is it something that can be, to the extent it's been harmed, say, in Europe, where they have seen some weakness, can it be repaired? What's the feeling?
It's tough. It's going to take time. I think it'll be really helpful if Elon Musk stay away from the politics for the moment and really focus on the business and marketing its vehicles. It is a nice vehicle, Model Y. Demand has picked back up after the changeover earlier this year. The volume is not there yet, but the issue here is, they've just launched a new vehicle, but the $7,500 tax credit in the U.S. is going away. So the trajectory, the growth trajectory for that new vehicle and gross margin has been derailed. And look, we're actually looking for 2025 deliveries to be, about 5% lower than what consensus is saying at 1.57. So, and we're probably going to see, the revision on consensus deliveries in 2026 by another 5%. So it's going to be some tough time for the automaker. The one couple bright spot that could offset, it's going to be, the extended version of the Model Y in China. Longer vehicles, more space in the back seat does help sales over there. And there's a new cheaper vehicle that they're supposed to launch in the second half. So hopefully that could offset. But execution is key. Execution is key.
Yeah, people were waiting to hear more about that affordable vehicle. So speaking of which, is Tesla, is it an auto business? Is it an AI robotics company? Is it a tech company? Like, what is Tesla? And could we possibly see it maybe even break up like some of these bigger companies have?
Oh, I think it's a combination. I don't think they're going to break that up. Elon Musk and Tesla is very focused on physical AI. Very different than the LLMs that you hear from Google. They're actually, building robots on wheels, and humanoid robots with Optimus. So it's quite different. For them to actually build out physical AI, they do need the hardware. They need to continue to build cars, right? And cars is a critical component of their success, especially even in early days of autonomy. It's still a cash generator for them. Even though free cash flow has dropped, but it's still an important business for them to generate cash to invest in physical AI. So I don't see that breaking apart. It's a critical component of their entire business.
I don't know, Steve. I'm putting on my banker hat. I spin out that car company. Who cares? Let's focus on all the other stuff that he seems to be all fired up about. But Steve, talk to us about tariffs here. Looks like one of the key aspects of the Japan deal, as we know, is maybe the autos coming in from Japan will have only a 15% tariff on that. What do the U.S. automakers think about that?
Well, I think it's good news. You can see, GM, when they announced their earnings, it was down, I think, 8-9%, and then it kind of recovered a lot of that yesterday on the back of the announcement that U.S. and Japan had come to terms on a trade deal. And what it means is 15%, at least 15% tariff. And look, GM has a lot of, some of the most popular vehicles coming from Korea. And the hopes is that, Korea and U.S. can make the same deal. But look, it's far from over, okay? What Tesla talked about yesterday and how the tariffs are going to impact their sales is not, the impact is not just on them, it's for the whole U.S. auto industry. Don't forget, right, next year, the USMCA, the U.S., Mexico, and Canada free trade agreement comes up for renegotiation in 2026. And, the automakers here depend on that trade agreement significantly to lower costs. So I wouldn't be surprised if Trump comes in and wants to kind of tear that apart and renegotiate the whole thing. There's a lot of uncertainty around that, and we don't have a lot of visibility. So the whole tariff story is not over yet.
So, Steve, Musk also voiced some concerns on the call about the size of his stake in the company, suggesting it should be larger. I mean, how did investors take that statement?
Well, there's been a lot of back and forth between Tesla and the courts on, Elon Musk's pay package. Essentially, he's not getting paid, for what he's doing for the company, as much as he deserves. So I think there's a point, there's a strong argument for him getting paid, but we'll see. There's a shareholder meeting coming up, and I think the shareholders will re-vote on this issue, and hopefully he gets paid for his contribution for the company.
All right, Steve, thanks so much. Appreciate that. Steve Mann, Global Autos and Industrials Research Analyst for Bloomberg Intelligence, joining us from Princeton via Zoom here. Donald Trump was out, President Trump was out on social media, and he was saying, as it relates to Elon Musk, he wants Elon Musk and all of businesses in the U.S. to, quote, in all caps, thrive, and that their success is good for the country. So maybe trying to allay to some extent some of the rift between Elon Musk and Donald Trump. I mean, one could argue it's in both their interests to just kind of chill. Right. But these are two pretty big
No, it's like two
personalities.
alpha males, and it's not going to stop. It's not going to stop.
And so Tesla stock is, again, as Elon was saying, next several quarters going to be pretty choppy for the company as it introduces new vehicles and deals with some real hit to their brand in many parts of the world. The stock is down 8.6% today. It's down 25% year to date. We're going to have more coming up. This is Bloomberg. Good morning.
Listening to Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
All right, Lisa Mateo, Paul Sweeney, live here in our Bloomberg Interactive Brokers studio. We are doing the live thing on YouTube, so if you're into the whole video thing, that's where you go. Go over to youtube.com, search Bloomberg Live Audio, and that's where it happens. All right, I think one of the interesting pieces of news out, Harvard agreeing to a $200 million settlement with the U.S. government. That seems kind of, Columbia, that seems kind of big to me, the White House, to end the clash they have there. So is this a template for the Harvards of the world and for some of these other schools that are being targeted by this administration? I don't know, but I know somebody who does know. Janet Lauren, higher education finance reporter. Yes, we have a higher education finance reporter. I mean, who else does that? I mean, but Bloomberg News, thank you, Matt Winkler. And she joins us here in our Bloomberg Interactive Broker studio. So, Janet, what do you make of this news here of this Columbia, again, writing a check to make it go away? That's how I read it as a cold Wall Street person.
Right. Well, and when we talk about higher ed finance, I think people forget that these are businesses and they need money, they need revenue to operate. They've really changed their business models over the years. One of the sticking points has been international students. And as we know, schools like Columbia, like Harvard, have a lot of shares of international students. Harvard, it's 27%. Columbia, I think I've heard it's been as high as 40%.
Which they celebrate that as a diversity.
Yes, yes. But there's certainly questions of, should we be giving tax benefits? Should the U.S. be giving tax benefits to schools that are serving large shares of international students? So that's one thing when we talk about a business. Schools need revenue to operate. They've expanded. They've gone into master's programs. We were just talking about this as a way to bring revenue in. And there's going to be huge changes next year for student borrowing, especially graduate school degrees.
Whoa, what's that? Because I borrowed to the max when I got my MBA.
Right. Well, but a year at Harvard Law School is $120,000. Wow. 1 year. And of course, if you're going to a place like Harvard, you're getting top jobs. You have the opportunity to get huge payments in your jobs. And oh, well, I could pay that off. But the government is asking questions. Well, why do these programs need to be so expensive? So instead of borrowing what they say up to the cost of attendance, which could be that full $120,000 a year times 3 years or 2 years an MBA program, that's a lot of money.
Yeah,
and do you know what the interest rate is for a Grad Plus loan is?
No.
Take a guess.
I don't know, 10%.
9%.
Oh,
Close.
wow.
Yeah.
The 10-year treasury is only, all right, 4%.
But that doesn't even include your origination fee.
Yes.
Yeah. So what does that mean for, let's say I have a daughter who's going to be a senior in high school, getting ready to, to file for all the paperwork that we have to do? What does it mean for us? If, let's say you have that threshold, and then where do you go once you meet it? Where do you go after that? Or is it just mainly to put pressure on the college to say, well, you know what, you need to lower your costs?
Well, certainly that is aimed to put pressure. But for undergrads, you're actually limited to what you can borrow as an undergrad. $5,500 for the student for the first year, $6,500 second year, and $7,500 for the third and fourth year. But there's also massive changes to Parent Plus loans, which is another option that parents have from the federal government. But those interest rates are also very high, and there's really that's not going to be there anymore. So so you go to the private market, and perhaps the private market will do underwriting and say, well, maybe this school isn't a great option because, only 40% graduate in 4 years. So, there's going to be definitely some pressure on colleges as well.
Part of this is, in addition to writing a check, a lot of these schools are saying, okay, we will in fact look at our curriculum, look at our politics on our campus to make sure that both sides are being fairly heard. What are they doing? What can they do? Is this really a problem?
Yes, it is a problem. And
Okay.
if you hear Alan Garber, Harvard's president, talk, he has said in interviews that one of the things that bothers him the most is students don't feel comfortable speaking in classes because they feel like their professors and their TAs have a certain perspective that's very much to the left.
A liberal-leaning bias.
Yes.
Which we've all heard about higher education forever.
And they're not welcome to express opinions, or they may not be welcome to participate in clubs. And that's something that he's concerned about, and they've tried to have all these different initiatives at Harvard to welcome other viewpoints, to make sure people feel comfortable. Now, a place like Stanford has always had the Hoover Institute.
Yep.
So that's always drawn, a different voice. There's been discussion of other schools adding those. Some have. I think the University of Florida may have had. I know the University of North Carolina added those kinds of institutes. But then again, you can't say we need conservative viewpoints and we're only going to hire conservative viewpoints, because then you're limiting who you're hiring. And that's, that's what all of these cases are about is, civil rights investigations are at Harvard and a bunch of other places saying, they are considering race in admissions in a covert way. So there's a lot going on.
Wow. Just real quick, 30 seconds. Are we going to get a similar type deal, detente with Harvard, do we think?
I mean, it's hard to tell. There's probably negotiations going on right now, but we'll have to wait and see.
All right. Janet Lauren, I mean, I kind of thought this would have been a boring beat, but it is anything but. There's news coming out every day.
She's got a lot of work on her
this
hands.
stuff. Janet Lauren, higher education finance reporter. We could talk forever about this stuff. Loans and the cost of higher education, and it's just gotten crazy. But I've heard that argument my entire life. The cost of college is just crazy.
Of course,
but it just,
you've lived it.
I've lived it. I've got my fourth going out the door as we speak. So we appreciate that. All right, Sirius XM. What are we doing here? Blah 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 blah. Okay, so. Let's talk about this. We're looking at the market here. S&P 500 up 16. The Dow down 148. Sirius XM channel 121. Access the only global audio business network coast to coast. 24 hours a day. Bloomberg Radio. Sirius XM channel 121 is presented by Oracle. Stay tuned. More market news coming up. This is Bloomberg.
is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, coming up in this hour, we'll check in with Ira Jersey, Chief U.S. Interest Rate Strategist here. We got some economic data today. We made the initial jobless claims. Came in, a little bit lower than expectations. I mean, again, the job market seems okay. Let's see what Ira thinks and what the Fed might think about this labor market. Sid Phillip joins us, Bloomberg Chief Correspondent for Global Aviation. American Airlines reinstates an annual forecast. Got a big wide range, though. Southwest cuts $1 billion from its outlook on tariff fallout. So a lot going on with the airlines. We'll check in with Sid on that. David Kudla, founder, CEO, and chief investment strategist at Mainstay Capital Markets, one of our faves, will give us his thoughts on the markets. And then here's a conversation of the day for me, as Tom Keene would say. Lee Klaskow, Bloomberg Intelligence senior transport analyst, going to talk to us about what I think would be an unbelievable deal, creating a truly east-west railroad in this country. We're looking at Union Pacific Railroad and Norfolk Southern potentially getting together. They say they're in advanced talks, and that has not been allowed ever in the history of this country. We do not have an east-west railroad in this country. Maybe it's time. So we'll check in with Lee on that. Right now, let's go to Charlie Pellet and get a Bloomberg news.
Hi, thank you very much, Paul Sweeney. Indeed, shares of Union Pacific on track for a loss today, down 2.2%. Norfolk Southern right now higher by just about 0.7%. This on a day where equities are trading mixed. We have got the Dow Jones Industrial Average down now by 116. That is a drop of 0.3%. S&P looking at a record there, up 1963.78, pushing higher, up by 0.3%, while the Nasdaq Composite Index is up 59. That is a gain of 0.3%. Our Mag 7 index down 0.2%. Tesla certainly weighing on that index. Tesla after earnings down now by 8.7%. We've got the 10-year 4.41%, the 2-year 3.92%. Gold down $14 the ounce, down 0.4%. 33.73 on the precious metal, while West Texas Intermediate crude up 1.4%, 66.16 a barrel on WTI. As I mentioned, Tesla down 8.7%. Elon Musk warning of difficult times ahead for Tesla, saying the company will be in a transition period for the next year or more. Stephanie Brindley is principal automotive analyst at S&P Global.
I thought it was interesting that it was one of the rare quarters where they produced significantly more than they sold for Tesla. It was about 76,000 units more that they produced than they sold. And traditionally, their production and delivery numbers are much closer than that. And I think there's still some softness in the market for the vehicles right now.
And again, worth repeating, Tesla down 8.7% after earnings. Alphabet, parent of Google, up by 1.2%. Intel coming up after the close of trading. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right. Thank you, Charlie. It's time to take a look at some of the stocks on the move. I'm Lisa Mateo alongside Paul Sweeney, and we are joined by Bloomberg's Vildana Heinrich. Vildana, thanks for joining us this morning. Do you want to talk about Google parent Alphabet all over the headlines this morning?
Yeah, of course. That's a big one. And we have shares of Alphabet, that's ticker GOOGL. Rising up 1.5% currently. And the Google parent did report second quarter results that beat expectations. The company said demand for artificial intelligence products did boost quarterly sales and now requires a big increase in capital spending and CapEx. And this is something that's heightening pressure on the company to really justify the cost of keeping up in the AI race, which I know all of us are closely following among all of the tech giants.
Them taking up their CapEx number, I took it immediately as a bullish sign. I mean, they're just ready to spend more on this AI thing. I don't know what the payoff's going to be. Dan Salmon, where is he at Benchmark Securities? He came out with a good note a couple of days ago, really trying to quantify the return on invested capital for all these big hyperscalers. And the returns over time do scale, according to his work. So we'll have to see how that goes. All right, one of my favorite companies, Las Vegas Sands.
Why is that your favorite?
Well, I love going to Vegas.
I love going there.
And I love their property in Singapore, and it's doing well.
It
is an awesome property. You got to see this. Go Google the Las Vegas Sands Hotel in Singapore. The casino is up on the top floor. It's just awesome.
I've not been to that one, but I did come back from Vegas recently from a conference, which is why this stock and its move today was so interesting to me.
Where'd you stay?
We didn't stay on this trip. It was a conference.
It's a Bellagio
No.
And Bloomberg was paying, so it was a cheap one.
No. Redo pays. He pays up. You go to the Bellagio. Don't worry about it. I'll take care of you.
But I was interested in it because some of the floors actually felt a bit empty to me. But we have Las Vegas Sands, ticker LVS, climbing. Shares are climbing today, up some 4%. And the casino and resorts operator, as we just said, reported adjusted earnings per share for the second quarter that beat the average analyst estimates. And analysts were attributing the beat to the solid performance in Singapore, which was offsetting some weakness that we saw in Macau.
And United Health also in the headlines today.
Yes, definitely. That one has been, it feels like, in the headlines for quite a while. Shares are down some 3%. After news that the company is responding to criminal and civil requests from the U.S. Department of Justice about some of its Medicare practices. And the company did come out and confirm reports of these probes that had been adding to, shall we say, mounting challenges for what is the largest U.S. health insurer.
All right. You're in Singapore. You go to the Marina Bay Sands. It's home to the rooftop Sands Sky Park, with the world's largest infinity pool, the Sands Expo and Convention Center, and the Lotus-inspired Art Science Museum.
Brought to you by LVS.
Yeah, absolutely. 2,561 rooms and suites, 1.4 million square feet of gaming and retail space, and 1.2 million square feet of meeting space. It is awesome.
Have you been to one in Macau?
I've been to Macau,
You've been to
and that is also a fantastic place. So, yeah, you can lose your money anywhere with these guys. They're all over the place.
I made $100 when I was in Vegas. I was really happy with myself.
Big spender. I like that. Very good. Keeps you coming back. All right, Vildana, thank you so much. We appreciate that. Vildana Hyrek, she is cross-asset reporter, and she does all the gaming stuff as well for us. For more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. We had some economic data came out here today. Initial jobless claims, building permits, blah, blah, blah. The PMIs came in kind of mixed there. Hey, Ira, we had some eco data here. To me, initial jobless claims look pretty darn solid. Anything jump out at you today from an economic perspective? Or do you think anything jumped out to the Fed?
Yeah, well, the claims were good, right? And this goes to one of the Fed's two mandates, right? They say, okay, you know, we're supposed to look at jobs and we're supposed to look at inflation. And the job side of the ledger, at least from the firing side of things, has not changed and remains relatively robust. But we have to keep in mind that when you look at things like jobless claims, that's only people who lose their jobs and not necessarily how much hiring there is. So, you know, in a theoretical world where 0 people are hired, you'd wind up with 200,000 job losses, right? And if we wound up in a situation where all you had were losses, so that's one reason why it's very important for us to, you know, keep track of all this data and just understand where it's coming from. The PMI data is a little bit worrying because you did see some weakness in parts of the PMIs, and you'd think if manufacturing was being onshored, that some PMIs would go up. But of course, it's very early in that process. It's not like you can, you know, turn a key, open a factory tomorrow. You need permits, and you need a lot of things that are going on under the radar in terms of you know, state and local ordinances and the like need to be complied with in order for you to start onshoring things and start manufacturing. So this is a multi-year process if you're going to wind up seeing onshoring, and there might be a economic cycle that happens in between for sure.
All right, so today was initial jobless claims. What are you looking to? I mean, pretty much the rest of the week is pretty quiet, but what about for next week? What's catching your eye?
Yeah, so next week, not only do we have some data like on the GDP data, and we wind up getting the June personal consumption expenditures report, which includes the FLATR, so the inflation report, but that happens, we actually get that data after the Federal Reserve meeting on Wednesday. So the Fed meeting will happen Wednesday. It should be interesting insofar as we might get a dissent or two, or maybe even three, but potentially. We don't think so, but it's possible that you get 3 dissents this time, because there are some dovish members of the Fed who are looking at things like private payrolls slowing down pretty significantly, and they think that the Fed should be cutting interest rates. But then you have a whole other camp within the Fed right now that is saying, no, look, the inflation data is not too weak. It's not quite at our 2% target, and the job market's okay. So why should we be cutting here? So you do have these 2 camps that are going to wind up debating that next Wednesday at the Fed meeting, and I think that might appear in Jay Powell's post-meeting press conference. And we also find out Monday how much money the government anticipates to borrow this quarter and next quarter. There could be some fireworks and headlines around that too. That's Monday afternoon at 3 o'clock.
Ira, as a close Fed watcher, do you care that our president is touring the Federal Reserve building today?
Well, do I care? Yes, I care insofar as, it is... The Fed maybe needs a little bit more oversight, but at the same time, the Eccles building is a very old building, probably needs to be modernized, and there are questions as to the cost that is being borne by the taxpayer effectively by the Federal Reserve renovating the building. But it's not only that building, there's other things in that plan as well. So you hear this big, $2.5 billion number, and it's more than just a single building. But this is potentially a way for the administration to, force Jay Powell out of office, which is something the president seems very keen on attempting. Because he disagrees with his policies. But, I'd also want to remind the president that, Jay Powell is only the chair of the committee. He's not the whole committee, and monetary policy is voted on by 12 people at the meetings. So it's not like if you put in a new chair, it's obvious that you'd wind up getting the policy response that he would want, just because he has a very uber-dovish chair who wants to cut interest rates. He still has to convince at least 5 other members in order to make that happen.
Well, let's get into that a little bit. So what would happen if he were to resign, maybe, if he decides to go that direction?
Well, first, I think you'd wind up seeing some volatility in markets for sure. I think long-end yields probably go up because there's a little bit, the perception that there's a little bit less Fed independence potentially. So you wind up with a steepening of the yield curve. So longer-term yields go up while shorter-term yields stay the same or maybe go down somewhat. And then, who winds up being the next chair winds up being very important. Is it a Fed insider like a Chris Waller or a Bowman? Or is it an outsider who doesn't have experience within the Federal Reserve itself, so doesn't have the institutional knowledge of the operation? So I think that either way you get market volatility, but certainly who is going to be the chair winds up being keenly important.
All right, Ira, thanks so much for joining us. Ira Jersey, Chief U.S. Interest Rate Strategist, joining us there. All right, I'm looking at some airline earnings here today, and the stocks are not reacting well. I'm looking at American Airlines. That stock is trading down. Love, which is Southwest, that is also trading down. There's definitely some concerns out there about the consumer and flights and demand and all that kind of stuff on the airline front. Sid Phillip joins us, Deputy Team Leader for Global Aviation. Sid, what are you seeing from American and Southwest? Is there a theme out there?
The theme seems to be that there isn't as much bullishness about the recovery that United Airlines and Delta Airlines pointed out last week. Okay. So they're sort of more cautious about the outlook, and they're talking about how they're still having to discount, they're still having to sort of offer incentives, which is crazy in the sort of the busy summer season. Summer is typically when airlines tend to make most of their money. There very rarely, if ever, are discounts on travel. And so it does seem to be pointing towards a sort of consumer recovery still being in the holding pattern rather than sort of out there and everyone sort of back to spending as much.
Can you talk about the difference with American being more exposed to the domestic market?
So American Airlines typically has a lot of flights in the U.S. I mean, they have a much larger presence in the U.S. versus Delta and United, which have more international offerings. And also, I mean, we heard from American CEO saying that business travel isn't yet back as much as they expected it to be. And that's in contrast to what Ed Bastian of Delta talked about last week, where he said business travel is beginning to take off again. So we're seeing contrasting images from the sort of American and Southwest. I mean, Southwest is a leisure carrier, and they're in the midst of adding more fees. They're adding more in terms of offering basic economy. They're offering they're starting to charge for checked baggage. They've started to sell seats. And so they're in a bit of a different situation. But American Airlines, I mean, their bread and butter is flying people around the Americas. And that is sort of still a big question mark as to where that recovery is at the moment and whether it'll hold up, especially the green shoots that they've been talking about.
Southwest Airlines stock really seeing some red here, down 11% here. Symbol is LUV, Love, for Love Field, which is their main airport when they started. Southwest, they called out $1 billion from tariff fallout. Where did that number come from? What's that represent?
So they offered a 1.7 billion EBIT target at the start of the year. That's what they expected to make in 2025. And now they've reinstated a estimate for the year. They expect between 600 and 800 million in EBIT. And they're saying that the decline in that estimate that they had from the start of the year to now, that's the impact of the macro conditions. And
so because I'm trying to think tariffs, I guess tariff on repair parts or something like that, or is it just the uncertainty created by tariffs? They're ascribing that.
Exactly. They're talking about the macro environment.
Are people buying that, do you think?
They are to some. I mean, there has been a slump in travel. I mean, immediately after the sort of the tariffs were announced and the whole trade wars and everything else, people did start pulling back on spending. People stopped buying holidays because they sort of are more concerned about their economic certainty. And that seems to be the trend that's continuing at the moment, where people are still not quite sure if they're going to have the money that they need to spend on holidays. And that's really where Southwest Airlines is sort of seeing a big hole in its finances, because they need people to go on holiday in order to be able to actually make money.
Yeah, no kidding. So did they see, I'm kind of going through the story, I didn't see anything about them gaining passengers from all those air traffic control issues over with United's hub over at Newark. Was there anything that they talked about that?
They didn't talk about Newark, and I mean, obviously, United Airlines had a big impact from the Newark fallout, but typically, given the fact that Newark's a big international hub for United Airlines, and Southwest Airlines typically flies within the US and within the Americas, that business might have gone on to other carriers who operate from Newark as well, or New York airports.
Yeah, I've been flying out of Newark my entire life, and I'll tell you what, it was a dump. But Terminal A,
that's nice.
That renovation is awesome. I mean, and if they can do to the other terminals what they did to Terminal A, then we got something there. So I'll stick up for Newark Airport at EWR anytime, more or less. It's been generally okay. Although they tend to, when you land, you tend to just sit on the tarmac waiting for a gate. That really bums me out, and I let everybody know about it. All right, Sid, thanks so much for joining us. Sid Phillip, Deputy Team Leader for Global Aviation here at Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. S&P 500 up 16 points. This is Bloomberg Morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks hovering near records amid a deluge of corporate earnings, and this Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses, Oracle's offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitments, see if your company qualifies at oracle.com/Bloomberg. We are looking at a record on the S&P 500 index, up another 0.3%, 6377, up an additional 18 points. The Dow, though, lower, weighed down by IBM after earnings. Shares of IBM down 8%. The Dow down 141, drop there of 0.3%. The Nasdaq Composite Index up 69, up by about 0.3%. While our Mag 7 Index is down 0.1%. Tesla weighing on that index after earnings, down by 8.9%. Bonds dropped for a second day. 10-year 4.40%. The 2-year 3.91%. Gold down $13 the ounce, 33.73. Down 0.4%, and West Texas Intermediate crude oil up 1.1%, 65.97 for a barrel of WTI. Are they on track for a deal? Union Pacific confirms it is in advanced discussions with Norfolk Southern about a potential combination of the two rail giants. Shares of Union Pacific, they're down now by 3%. Norfolk Southern up by just about 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right. Thank you, Charlie Pelleton. I'm Lisa Mateo alongside Paul Sweeney. So Charlie's been talking about the markets. Well, the second half of 2025 is setting up pretty nicely for stocks. Let's find out more about it and where are you finding risk, where are you finding opportunities. Let's go to David Kudla. He's founder and CEO of Chief Investment Strategist at Mainstay Capital Management. David, thank you for joining us this morning. I'm sure you're watching big tech names. I want to start there because we've heard from Alphabet, Tesla. I mean, quite a different picture from both of them, but the AI stories, are they similar? What's your reaction to those earnings reports?
Well, yeah, I mean, we have seen some mixed results in those earnings reports, but really when we look at the AI story, that's really what's going to propel growth stocks. We think for several years now, we're looking at a $3 trillion spend for AI, and mostly for the AI data centers and to power them, electrical grid to power them. $3 trillion spend through 2028. And it's not hope, it's not hype. It is a true story, and we're going to continue to see. They are early and known beneficiaries. We're going to have more companies to come, but there is, as opposed to the .com era, we have established companies that are really going to be investing hard into AI. AI is quite frankly, it's going to transform our society over the next decade.
Yeah, that's kind of what they're telling us, and it better, given some of the money they're spending here. Hey, David, you've been around this investment game a long time. You've seen it all. You've got a lot of experience. I have to ask you, what's your view on the valuation of this market? Does a number of like 22 times, is that something that causes you angst here, or do you just mean you have to do some extra work?
Yeah, if you looked at the .com where we were for valuations then, GFC where we were for valuations then, when we're up around 22.5 times, we're at a richly valued area for stocks. But what we know is you can't really use valuation as to make market calls, because stocks will stay overvalued or undervalued for months or years. And the stock market just has a lot going for it right now. We just got a bill passed that will create some fiscal stimulus. We're looking for this monetary policy pivot later this year. President Trump and some others are trying to make that happen a lot faster than maybe Jerome Powell and the FOMC want to. But that's still the expectation. Buybacks at record highs. So you have that financial engineering going on. And, so we look across the map at all the fundamentals and tariffs. That was our real concern in the first quarter, certainly at the beginning of the second quarter. And, most of that is about the markets hating uncertainty. We're seeing more certainty. We're seeing that, the floor looks like it's 15 rather than 10, but that's what we're seeing as the deal for Japan, probably for the EU. There's a lot of our trading right there. And so there's probably more good news on the horizon than bad news at this point compared to where we were 3 months ago on tariffs. So, we look across the board at the fundamentals. Are we richly valued? Yes. But we're still constructive on stocks.
Where are you seeing risk, David? Is it cash-heavy portfolios?
Yeah, I think that, that investors became here a couple of years ago. You could get 5% in a money market account, right? Or with short-term treasuries. And we like short-term treasuries in our tactical asset allocation approach because we're getting a high yield still without the duration risk. And so from a tactical standpoint, we're there. We also have other alternatives to diversify a portfolio like gold, silver, alternatives. So when we look at cash, where the yields come down some, straight cash, or I think where the real danger is, Lisa, is in bonds. And, Japan is kind of the canary in the coal mine. They had an auction earlier this week on their 40-year JGB, their Japanese government bond. It hit an all-time high yield of 3.375%. And so we're seeing, I don't want to call it a meltdown, but we're seeing some problems, certainly some cracking in Japan's market. And what have we seen here? We've seen our bond yields are coming back towards their trading high, the highs they were at in April. And what's this a function of? Governments aren't solving the deficit problems, the debt problems. If anything, OBBBA makes it worse. And look, deficits matter. We know that.
Yeah, we'll see. A lot of folks say, hey, as long as people come up to our Fed window, maybe they don't mean that much. I don't know about that one. David Kudla, founder, chief executive officer, and chief investment strategist, Mainstay Capital Management. Thank you so much for joining us. All right, I've been following the railroad stocks, folks. That's where I started my career covering the railroad stocks. Here's a headline I never thought I'd see, and that's like 1986. Union Pacific, Northern Southern in advanced talks. I never thought I'd see that. Lee Klaskow, senior transport analyst for Bloomberg Intelligence. Lee, putting a Western Railroad, Union Pacific, together with a Eastern Railroad, Norfolk Southern, creating a east to west true railroad. Can that happen? Will the regulators allow that to happen?
I mean, it's possible, given where the surface transportation rules are now as it relates to large acquisitions. We give it a relatively low probability, maybe 25, 30, 35% chance of happening. The STB is actually in August reviewing some of its rules to streamline some of the processes that it deals with. But, it's not impossible. But again, we think that the probability is below 50%. If it were to happen, it would create the first transcon railroad. And that could be good. It could be good because a rail car would be touched less because it wouldn't have to maybe be interchanged with other railroads. And that does, the more time a rail car is touched, the more times something could go wrong. And so that would probably reduce, I would have to say it probably could reduce some accidents. It could also reduce costs for the railroads in general. So it could be a good thing. Shippers might have an issue with it because they might be afraid, even though that Norfolk Southern, Union Pacific don't necessarily compete, against each other directly, they might be concerned that, losing one of the large Class 1 rails would result in less competition. And the railroads for the STB hurdle have to prove that this deal is in the public interest. So, you're going to have a lot of constituents and stakeholders voice their opinions both for the deal and against the deal. And again, that's all assuming that these two parties can come to an agreement. We put out a note last week where we thought, the enterprise value for that transaction could be in the high 80 billion. So we'll see, what kind of a deal the two can hammer out.
All right, Lee, you're kind of going along the track that I was thinking of.
Along the track, I get it.
Oh,
I get
I
it.
like that. Didn't even think
Little
about
railroad
that.
humor.
Railroad humor. What can you go more into the regulations? Because you started talking about that, but what are some more of those sticking points that could cause this maybe not to go through?
Well, you know, we've seen a couple large mergers. The last large one was Canadian Pacific and Kansas City Southern. Kansas City Southern was the smallest Class 1 railroad, and they were exempt from these new rules that went into effect in 2001. And the rules kind of came about because Burlington Northern and Canadian National were looking to merge. And so even though they had a lower bar, it took quite some time for the deal to close. I think it was about 18 months. You know, we suspect that under the current rules, a deal between Union Pacific and Norfolk Southern could take about 2 years to get STB approval. So it's going to be a long process. So even if the two come out tomorrow and say, hey, we're doing a deal, and the shareholders approve it, you know, this could be 2 years until we see an actual Transcon railroad.
So, Lee, I'm going to go get my floppy disk out circa 1988. I got my Union Pacific and my Norfolk Southern earnings models there. I'm going to put them together like they're merging. What cost do I take out? What are the synergies, do you think? What's the reason for doing this deal?
So it's pretty interesting. So, you know, Norfolk Southern went through its own cost-cutting process as it started to embrace precision scheduling railroading. For those that aren't familiar with it, it's pretty much Six Sigma for the rail industry. So it's just about sweating assets. And they laid off people. And so, you know, it's not like there's a lot of fat there. But, you know, what I suspect is that they maybe, you know, they'll maybe be laying off some people in corporate, you know, because you don't need 2 CEOs, you don't need 2 CFOs, you don't need necessarily as many salespeople and accountants. So there's that aspect of it. And also, you know, if they are able to provide a lower cost service, they might be able to, even though they can raise rates, provide it at a lower cost to shippers. So I think that's going to be the big, what can they do for shippers, is can they lower the cost curve because of the fact that, you know, again, the rail car is being touched less, and are they able to pass that on to shippers? I think if they can make a case for that, they'll have an easier time of getting a deal done.
All right, Lee, in the last 20 seconds, second quarter results, anything stand out?
Union Pacific did really well. Their network is operating well. You know, they had some issues during the pandemic. That seems well behind it. You know, their goal is to have the lowest operating ratio, which is an inverse to an EBIT margin, so lower the better. And it seems like they're going to deliver on that.
Lee, thanks so much for joining us. Really appreciate it. This could be a really cool time in the railroad industry if you can get a east-west railroad for the first time in the United States. Lee Klaskow, Senior Transport Analyst for Bloomberg Intelligence. Again, the news for us railroad geeks, Union Pacific, Norfolk Southern in advanced talks. How did they, I mean, if you're in advanced talks, you must have somewhere telling you, yeah, we can pass this thing. We can get this past the regulators. I don't know how that.
But 2 years, he said.
Oh, yeah. Oh, boy. These are railroad people. They're not like the fastest out there. S&P 500 up 15 points. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. Jobless claims hitting the lowest since April. We're off session highs, but stocks still hovering near records amid a deluge of corporate earnings. We got IBM weighing on the Dow. IBM shares after earnings down 8.4%. The Dow down 156, down 0.4%. S&P up 15. That is a gain of 0.2%. NASDAQ up 51, gain there of 0.2%. But our Mag 7 index trading lower now by 0.2%. Tesla weighing on the index. Tesla after earnings down 9.1%. 10-year 4.39%. The 2-year 3.91%. Gold down $13 the ounce, down 0.4%. And West Texas Intermediate crude up 1.4%, 66.15 now for a barrel of WTI. So it is a mixed market right now. Alphabet shares after earnings trading higher by 1.3%. Alphabet says demand for AI products boosted quarterly sales and now requires an extreme increase in capital spending. And Dave Kudla, chief investment strategist at Mainstay Capital, moments ago right here on Bloomberg Intelligence, he says investors must buy in to the AI story.
You know, really, when we look at the AI story, that's really what's going to propel growth stocks. We think for several years now. We're looking at a $3 trillion spend for AI, and mostly for the AI data centers and to power them, electrical grid to power them, $3 trillion spend through 2028.
And you can hear more of the conversation with Dave Kudla on the Intelligence podcast. You can download it wherever you get your podcasts. Briefly after earnings, Chipotle Mexican Grill. Right now, it is down 13% after earnings. IBM down 8.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
You know, I think I may just go to Chipotle today for my lunch, just to signify my support.
Still doing the two taco thing? You won't do a
Yes.
bowl? I have to get you to do a bowl.
Try bowl?
Yes.
All right, I'll give that a shot. All right, Charlie Pella, thank you so much. We appreciate that. Lisa Mateo, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Alphabet, I think that's Google. I can't remember. They reported some numbers last night after close. I thought they were really good. Stocks up a couple of percent. Some people are bummed because they took up their CapEx number a lot. I view that as a positive. I don't know, because I think they're spending money to make money. It's one of those things. Mandeep Singh joins us here. He covers all the technology stuff for Bloomberg Intelligence. Mandeep, what was your takeaway from the Google results?
I mean, the fact that they are able to grow their search business double digit at that kind of run rate, $210 billion plus.
Yep.
Like, think of how many incremental dollars they added just by virtue of that 11% growth in the $210 billion business. And that is where, you know, the real strength lies with a company like Alphabet. They are overlaying Gemini across their family of apps. AI overviews is actually driving 10% more queries. And AI overviews is now used by 2 billion monthly active users. So Google Search has 5 billion monthly active users. Imagine AI overviews being used by 2 billion monthly active users. So they got the UI part right. Gemini as a standalone app has got 450 million monthly active users. Imagine if everyone started paying a $20 subscription like ChatGPT. This could become a $100 billion business, in addition to search. And then YouTube, I'm not even talking about, you know,
I'll talk about it.
all the strength in YouTube and Waymo. So this is a powerhouse when it comes to $400 billion run rate they will be at the end of the year.
So can you explain something to me? Because when the shares dropped, because they said CapEx was a little bit more, well, $10 billion more than expected, a little bit. How is that different for an Alphabet versus if Meta were to say that?
So that's great. So look, let's frame the CapEx. $85 billion at potentially a $400 billion revenue run rate by the end of the year. That's like a 25% CapEx intensity. Meta, on the other hand, is already at a 40% CapEx intensity because their CapEx will be $70 billion at a run rate of close to $200 billion. So that just goes to show Alphabet is still far lower than their peer group when it comes to the CapEx intensity. I mean, that's just the scale of the business that they are operating. And look, I do think the ROI on their CapEx is higher because Gemini's cost is much lower than all the other large language models, including Microsoft, including Meta. They do inferencing at a lower cost. And that's the advantage of having your own chip, having your own large language model that Microsoft or Meta don't have because they rely on NVIDIA chips, whereas Google does most of their inferencing from the TPU chips. So I think that just vertical integration they have, Alphabet has, gives them such a big cost advantage when it comes to running the AI infrastructure.
Where's the company on the various regulatory issues outstanding? What are the 1 or 2 or 3 ones that we really got to focus on, and what's the market telling us?
So that's the biggest risk with Alphabet. Okay. That has been the biggest drag on their multiple, and it remains because we have a catalyst next month where Judge Mehta is going to make a decision on the remedies, and especially that Chrome split. That's still an overhang. Now the base case is there won't be any Chrome divestiture, but we still need to learn about what are the remedies that may come about in terms of proposed by the judge. And that is where if they're asked to share search data or some other type of remedy that's going to hurt their position, I think that is the big overhang.
Boy, this one could be, if you have a firm view on that, you buy the stock here, and there's a ton in this thing. Given what I just saw last night on the earnings, are people doing that? Are people making bets here? Do you think? I bet you they have to be.
I mean, the narrative is still so negative. Right. Everyone is fixated on, ChatGPT, my workflow is changed.
I mean, this is where Bobby Axelrod on Billions would somehow figure out where this judge is going to rule and make a bet one way or the other. Yeah, I mean, know there's the Bobby Axelrods of the world out there.
I agree. I think if you can figure out decisively what the judge's verdict is going to be, the multiple-wise, you could see easily a 25 to 30% multiple expansion. Wow. And numbers will go up, for sure, after print last night. But multiple expansion is like 25 to 30% just on.
And when is that ruling?
That's coming up in August, September timeframe, yeah.
It's hard to keep up with these things. I don't know how you do it, man.
That's why we got Mandeep.
That's why we have him.
Wait. Mandeep's got like a huge team, global team behind him. I mean, all he does is come on radio and TV.
Do you have
and they do all the work. He's got everything.
He's got everything. So you mentioned YouTube before, Google's video site. How is its advertising still going? Still going strong?
So look, YouTube subscriptions is what's really doing well right now. So YouTube subscription growth is north of 20%. Imagine, Netflix growing 16, 17%. YouTube subscriptions actually surpassing Netflix's growth. And then you layer ads on top of that, which grew at a very healthy 13%. So ads is a $40 billion business. Subscriptions is now close to, $20 billion. And that is where you're seeing, combined cloud plus YouTube ARR is close to 115 billion. So imagine when just these two segments growing at north of 20%. I mean, it's just a phenomenal business. These two, both cloud and YouTube, and on a standalone basis, there is so much runway for growing these two segments.
And the one thing I will, one of the initial use cases that made sense to me was advertising for AI, use case for AI. Just you could use AI to really make an ad that much more targetable, and therefore it's much more valuable to the advertiser. And that's what we're seeing from Meta, from Google, from Amazon. I mean, anybody who's selling digital advertising, we're seeing it in the numbers.
Yeah, and ad pricing, I mean, again, it came out at 8% growth, high single-digit growth on ad pricing, especially when everyone was concerned about Chinese advertisers pulling back in the wake of tariffs. 8% ad pricing growth is phenomenal, and that just goes to show these companies know how to target the ads the right way, and AI is augmenting that.
And I always forget that Waymo is a part of Alphabet, too. They've got their hand in everything. How have they been doing? Because I know they've been talking about different partnerships with different ride-sharing apps.
Yeah. So, look, everyone talked about CapEx increase. To me, the CapEx dollars don't just flow to cloud, but also they help Waymo expand. Because you have to remember with Alphabet, everything is powered by that shared infrastructure. That is what's powering search. That's what's powering cloud, YouTube, and now Waymo. And so with Waymo, they obviously need more fleet. They have a fleet of 1,500 right now, so they want to expand to more cities. But the more capex you spend right now, it's a land grab, and they have the best technology when it comes to robotaxis. So capex makes a lot of sense.
All right, Mandeep, thank you so much for joining us. Appreciate that as always. Mandeep Singh, he's a senior tech industry analyst from Bloomberg Intelligence, joining us here in our Bloomberg Interactive Brokers studio. We've got a team behind him. I mean, we have tech analysts all over the world covering this thing because it is a global industry. So Mandeep is just a pretty face we put up here. All right, on Wednesday, the UK Supreme Court quashed the convictions of Mr. Hayes and ex-Barclays trader Carlo Palomino, Carlo Palumbo, stating that the juries had been misdirected by judges at both criminal trials. Mr. Hayes was given an 11-year sentence after appeal for rigging LIBOR in 2015. This morning, Tom Hayes spoke to Bloomberg's Anna Edwards. Here's a portion of their conversation.
Have you found the words? Yesterday you said it was difficult to sum up how you felt outside the Supreme Court. You'd had a lot of time to think about it, but have you found the words to describe how this feels?
Well, I've had 4 hours sleep now. It's sinking in. I actually found out the decision 24 hours ahead of the announcement in court, so I didn't quite have the drama of the announcement in court and going wow, because I knew what it was already. But yeah, I mean, I'm still wondering whether I need to email my probation officer to see whether I should be meeting her next week. But it does feel a little more real today than it felt before. I think actually having the piece of paper in your hand makes it more real. Yeah.
And so this has made a huge difference to you. Clearly, it will perhaps make a difference to others who found themselves in a similar position. Have you talked to any of the other traders who were also convicted at the same time?
Yeah, all of them. I mean. Yeah, all the other 7 convictions, they all need to go. And really, this is a battle in a war, and we've won the first battle. I don't see really how the SFO and the prosecution can contest the appeals of the other 7, because none of them should have been convicted. None of us should have been convicted. So.
And are they going to challenge them in the same way? Do you think?
Yeah, from speaking to them and without wanting to sort of, preempt what they might do, I would be very, very, very surprised if they don't.
All right, that was Tom Hayes, former trader at UBS, speaking with Bloomberg's Anna Edwards. Let's get back to company news here. Honeywell. I mean, Honeywell is one of those industrial companies that's they just crank it out all the time. They raised their outlook after better than expected quarter yet again. It's just one of these great American industrial companies that our next guest has covered for decades. I'm going to out her. Decades, dude. Karen Ubelhart, one of the absolute best on the street, covering these big industrial companies, conglomerates, think Deere and all that kind of stuff, Caterpillar. She's done it all for decades. Karen Ubelhart, Bloomberg Intelligence, Senior Industrials Analyst. Honeywell, you've been talking about Honeywell for a long time. What did you learn in the earnings release?
Well, it was really a bit of a confusing quarter. Organic growth exceeded expectations in 3 of the 4 businesses. They missed in their crown jewel, aerospace, but they raised guidance. But margins were disappointing, and they projected that margins would continue to be modestly disappointing. So the mix isn't right. You know, when you do better on growth, you don't usually do worse on earnings. And a lot of it was known and wasn't communicated. So I think it's more of a communication problem than a, going forward profitability problem.
All right, so Karen, I need you to school me here. Okay, so why was the quarter better than expected? I mean, can you talk about some of those headwinds that Honeywell was facing?
Most of the companies are still having, some organic growth problems because the economy's slow and there's a lot of uncertainty. They have aerospace, and that's been growing like crazy, right, for a number of years. Their buildings automation business has exceeded expectations now for several quarters. That's the stuff that makes buildings run, right? Electricity and other things, automation controls. That's done better than expected because they've been spending money on trying to get that organic growth going. And the other 2 businesses, they're mixed. But that is 3 of the businesses grew at 5% organic growth. That's a lot in this kind of economy. But that aerospace was disappointing, and again, there was a known reason. OEM destocking of new build. We've been having trouble getting build rates up in aircraft, right? And so a lot of the companies were they overstocked in parts because they weren't getting the build rates up, and now there's some destocking. They knew that. I mean, I feel like it was a communication problem more than anything. Some of the margin issue is they're spending more on R&D. They knew that. Integration with the new acquisition, they knew that. And they saw people in Paris only a month ago.
That's right.
And it was an aerospace, show. They could have communicated a little better. So I think that's part of the problem.
Karen, you cover a lot of these big global industrial companies, Honeywell, Emerson, all this 3M, all that kind of stuff. Tom's favorite company, 3M. What are they saying about a world of tariffs? How is that impacting their businesses?
Most of them were saying, that they were going to help with costs and pricing, and different companies have better pricing flexibility than others. But most people are pulling back on the tariff expectations. They gave us estimates in the first quarter. That was in April when the worst case came out. Yep. That's not going to happen. So now people are pulling back on tariff costs. They didn't do that either. So it's kind of out of sync with what we're hearing. In the quarter, it's early, but most people are lowering their expectations for tariffs, and they're not.
And they're not. And the Honeywell breakup, I mean, how much money can that unlock?
Well, the whole breakup is based on getting aerospace to stand alone, as GE did, because that's the crown jewel, that's the secular growth story. It's high margin, and activists have come after them twice to try to get that business out of the conglomerate, and they succeeded this time because the stock was underperforming for a number of years. So that's the real crown jewel. The other stuff, they're all good businesses, but the automation business that they're calling that's a second business they're splitting. It's really a lot of businesses, so they got to split it up again. So, and they actually had announced that they're going to do something with two of the other businesses in automation. So it's really about aerospace.
That's why there are still industrial investment bankers on Wall Street, because they're always buying something or selling something.
And all you have to do is look at GE Aerospace and know that that's going to be a good idea, because that stock has been through the roof.
Yeah, exactly right. So what's kind of your industrial machinery kind of stuff? What are some of the names that you think are doing well?
It's the HVAC guys are doing very well, but they have for a while. But this whole data center thing, when you're doing hyperscalers, you need, you generate more heat, you need more cooling, right? Well, that's the HVAC guys.
And who are they?
And they're JCI, Trane, and Carrier. It's still a small part of their business, but it's growing rapidly, and it's got, and that had a favorable growth rate for a while, up 5% when most of these segments grow 2 to 3%. Now it's even better with aerospace and with data centers. So that's one segment that's doing very well. There's a lot of company-specific stories that are going on. 3M is one of them, new management. JCI is another one, new management. Honeywell, the breakup. All of them have catalysts from, 3M's been an underperformer for a long time, right? New management, that stock's gone through the roof because he's doing things that should have been done.
Karen, how long have you been in this business?
Over 40 years.
Over 40 years in Wall Street, folks. She's worked everywhere, on the buy side, the sell side. I mean, a couple of firms you might have heard of, like Salomon Brothers, like the government of Singapore. I mean, one of the biggest sovereign wealth companies. And then, of course, she capped off her career with 16 years here at Bloomberg. How long are you going to do it for, Karen?
Another 2 months.
Whoa! And then we're going to retirement?
That's it. Yeah.
Fantastic. Congratulations.
Oh,
folks,
well
Karen was our absolute, first hire at Bloomberg Intelligence. We've now got 500 people in Bloomberg Intelligence. Karen was literally one of the absolute first, and it was a marquee hire for us because she is such a well-known name on Wall Street, and with all these, big engineering, conglomerate construction, John Deere, you name it, everybody knows Karen Uberhardt. So when we were able to hire her, it really kind of validated what we were trying to begin here at Bloomberg Intelligence. So it was great, and she stayed with us for 16 years. Go figure. Who would have thought? Now she's riding off into the sunset. So we wish her the best, Karen Uberhardt, one of the absolute best on global Wall Street, and every company she covers over the last 40 years will say the same thing. So we appreciate that. So that's good stuff. All right, looking at it, S&P 500 up 17. The Dow off 155. I'm blaming IBM on this one. Anurag Ran. IBM had some weaker numbers. That stock's trading off, pulling the Dow down. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Stay with us. Your top stories and global business headlines are coming up right now.
is CBS News on the Hour, sponsored by ZipRecruiter.
I'm Steve Kathan. The heat dome has expanded with heat indexes above 100 expected from the Midwest into the South today. CBS News meteorologist David Parkinson.
We are seeing heat advisories that stretch from North Texas to Cleveland. And then we're also seeing the introduction of heat advisories in the Northeast from New England down to Maryland. So it's going to be a hot one today.
CBS News correspondent Lana Zach.
More than 100 million people are trapped under an intense heat dome, with temperatures skyrocketing. Tens of thousands of cyclists pedaled hundreds of miles from one end of Iowa to the other for RAGBRAI, the world's longest recreational bike ride.
No one's racing. And what's the hurry? Get back in your hot tent?
Jeffrey Epstein co-conspirator Ghislaine Maxwell will be questioned today by the Justice Department's #2 official. CBS's Major Garrett says Congress has passed, for now at least, on a chance to vote on the release of the Epstein files.
What leadership is doing right now is deferring to the president and the Trump Justice Department. But as the Speaker said, justice must be served, which means there have to be more prosecutions, more transparency. And if that doesn't manifest when Congress comes back in September, this is going to be a significant and irritating political issue for the leadership.
President Trump stops by the Federal Reserve today, where there's a major construction project and a chairman who has resisted his calls to slash interest rates. CBS's Kelly O'Grady.
This is more pressure undermining what they are doing. He's going to look at the construction. The Federal Reserve did just give us this statement that they're working with the White House to accommodate the visit. The president doesn't feel the Fed is lowering interest rates fast enough, and he is investigating their overrun on their construction.
Overseas, news organizations are sounding an alarm about dire conditions in Gaza affecting their own freelance reporters. The BBC's Hugo Bachega.
The BBC and 3 leading news agencies said journalists were now facing the same dire circumstances as the people whose lives they report on, and that it was essential that adequate food supplies reach people there. The UN and aid agencies say Palestinians face mass starvation in Gaza as a result of Israel's policies, something Israel denies.
There's word the musician Chuck Mangione has died. The horn player and composer had a top 10 hit in 1978 with Feels So Good. He was 84 years old. Union Pacific and Norfolk Southern say they're in merger talks that would create North America's largest railroad. Wall Street, the Dow is lower, the S&P is higher. This is CBS News. NFL teams are revealing new looks for alternates or throwback uniforms, Cleveland among them.
A team video shows 3 Browns players undergoing a high-tech transformation to reveal a monochromatic uniform that includes a new alternate matte brown Alpha Dog helmet with orange stripes. Fans will see them on the field 3 times this season. The Browns are the only team in the NFL that doesn't use a logo on their helmets. The Browns originally wore white helmets when they dominated the All-America Football Conference in the 1940s. They switched to their signature orange in 1952. Deborah Rodriguez, CBS News.
For the first time, an active military base will hold a NASCAR race. It'll be next June at Naval Base Coronado in Southern California. A 3-mile street race course will be designed just for the event. I'm Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Pack up the motorcade. It's time for a presidential field trip. Welcome to the Thursday edition as President Trump brings his standoff with the Federal Reserve to a new level today and in person, announcing a pop-in visit to the Fed's headquarters here in Washington. Later this afternoon, we're going to discuss this with Bloomberg's David Gura. First up today, he's also eyeing the latest on trade and will be with us in just a moment. We'll also take voters' temperature on a range of issues from trade to, yes, Jeffrey Epstein. When we talk with Cliff Young, who has new polling out from Ipsos to talk to us about it. We'll have analysis from our political panel, Bloomberg Politics contributor Rick Davis, alongside Democratic strategist Adam Hodge from Bully Pulpit. Be with us in just a few. Earnings reports, again, driving the trade today on Wall Street. And we start with the markets, as always. Charlie Pellet has that for us at World Headquarters in New York. Hey, Charlie, how we doing?
Thank you very much, Joe Matthew. Happy Thursday. We got a lot going on, a lot of moving parts to this market today. Right now, the S&P 500 index is advancing 12. That is a gain of 0.2%. Alphabet up, Tesla down after their results. European policymakers tempering expectations of policy easing. And treasuries fell as jobless claims hit the lowest since April. NASDAQ pushing higher. The NASDAQ Composite Index up 45 now, up by about 0.2%. Again, the Dow lower, down 191, drop there of 0.4%. Dow Industrials being weighed down by shares of IBM. IBM now lower by 7.7%. 10-year 4.40% with the 2-year 3.91%. Gold is down $15 the ounce, 33.72, drop there of 0.5%, and West Texas Intermediate crude up 1.5%, 66.24 a barrel on WTI. John Stoltzfus is chief investment strategist at Oppenheimer, and on Bloomberg Open Interest this morning, he said he'd like to see more certainty around tariffs.
We'd like to see something with Europe, ideally, something with Korea in addition to Japan and the UK, that would make us feel more confident that there won't be dislocations within the sectors in primary names that could make the end of the year number not look so good.
John Stoltzfus of Oppenheimer. We're keeping an eye on potential deal talks involving two major railroads, with Union Pacific confirming it is in advanced discussions with Norfolk Southern about a potential combination of the two rail giants. Both companies are trading lower. Right now, Union Pacific down 2.7%, Norfolk Southern lower by 0.3%. Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, great to see Charlie Pellet every day here on Balance of Power, and he'll be back a short time from now for an update on the Thursday trade. Thank you for being with us here on the Thursday edition, the early side edition of Balance of Power on Bloomberg Radio, on the satellite radio. We're channel 121, and you can also watch us every day on Bloomberg Originals and on YouTube by searching Bloomberg Business News Live. Catch our live stream. We'll be running this throughout the day here from Washington and New York, as we always do, with the radio on TV. Happy little Friday. This is going to be an interesting one here in Washington, D.C. As House members fly out of town, things get a little quiet around here. The Senate's still got some work to do, but largely the restaurants get quiet when the House leaves. All the staffers are packing up. They're all going away for the August recess, and they're not going to be back for the better part of a month. It's actually a little bit more than that. We'll be talking to them again after Labor Day, when we'll be counting down, it seems, to a government shutdown. So we're left with ourselves here and the President of the United States, who's looking across just a couple blocks. You know, when you go out on the balcony there on the White House, the south side, you're looking at the Washington Monument. You look up, crane over the trees, and you can see the Federal Reserve Building. Maybe if you're really tall. It's on Constitution Avenue, the Eccles Building. You're going to hear a lot about it today, because President Trump, who, of course, is not a fan of Jay Powell, has been calling for his firing, his resignation. Then he says he doesn't want to fire him. He's trying to crank up the pressure and is going so far today as showing up at the Federal Reserve Building. He's actually going to get in the motorcade and drive, I think it's 4 blocks down there to Constitution Avenue, 20th Street, maybe 5 or 6 blocks, which is the better part of a construction site. There's cranes over there, big orange barrels. You can't even walk up to the front door. So it's unclear to us exactly how this is going to go. Reporters are getting their own tour today. Why is this? Because of the renovations going on that the White House says have been overdue and overspent. Russ Vought, in a letter to Powell earlier this month, of course, director of the OMB, talked about ostentatious elements of the overhaul. Serious concerns about the scope of the renovation. He cited specific elements like the private dining rooms, rooftop garden terraces, water features, marble decor, and now the infamous private elevator. I wonder if David Gura has ever been in the Eccles building. He's with us from World Headquarters in New York, Lexington Avenue, and of course the host of the Big Take podcast and our dear friend here at Balance of Power. David, it's good to see you. You ever been in there for a lockup or for any Fed news? It is a pretty nice building.
I've been in the building. I know it has an infamous tennis court as well that William McChesney Martin had put in, and that Larry Summers and Alan Greenspan, Tim Geithner, I think, used to play at. And you bring up the geography. I mean, the president could walk. I think if he wanted to, if he were so inclined. I imagine that it's scorching and horribly humid down there. But as you say, it really is just a stone's throw from the White House.
It's not a good hair day in Washington, but I was blue skying with a friend before the program. It would be some real optics, David, if they didn't take the motorcade, if they walked it, right? You get the entourage, Donald Trump in front, marching down 17th Street to Constitution Avenue, and the hook would be stopping at the hot dog stand there on the corner, right? Eat the hot dog in the suit. This is, I mean, I'm giving you a gift. So what do you make of this? Is it a distraction from Epstein? What's driving this whole narrative?
I think that it is, but it's also clearly him doubling down on what he sees as the best pressure point he can exert on the Federal Reserve Chairman. We've seen in the last few weeks the president and his advisors really doubling down on this notion that the Fed chair has overseen a botched renovation of the Federal Reserve building to the tune of in excess of $700 million, an expensive renovation that's even more expensive. I will say, we've heard from the Fed chairman that he's taking this seriously. He said that on Capitol Hill. He's asked the Inspector General for the Federal Reserve to look into all of this. So it's not as though he's avoiding it. And he's been very studiously careful about indicating what's going to be in this building after it's renovated and what it's not. So he's talked about the water fountains people were discussing beforehand, what might be on the roof, what elevators might be in this new building. So he's being very careful to emphasize the fact there's a new frequently asked questions thing on the Fed website outlining what's in the renovation and what's not. He's standing his ground, but we do see the president here going himself. It's familiar territory for him to be on a construction site. Of course, a longtime real estate developer. True. But I think, as you said, what's he going to get out of this? Certainly some photographs, the opportunity to talk to reporters on the end of this. But you know, I've talked to a few Democratic senators in recent days, and they've both told me there isn't the appetite among members of the Senate, at least, to go down this path, at least at this point, to follow down what the Fed chairman may or may not have done vis-a-vis this renovation.
Well, it's funny. Even Trump says he's going to let him finish out the 8 months. Scott Besson said that on Bloomberg just yesterday. But he's showing up anyway, and this, by the way, is set for 4 p.m. Eastern time. So when we do the late edition of Balance of Power, he'll probably be in the building. To David's point, he's going to make some remarks. You know, Jay Powell, to be clear, and David Gura points to this, he did respond, not only in writing form, but in testimony, saying the rooftop garden terraces they talked about would sit above a parking or common vegetated roof intended to handle stormwater, improve building efficiency. The private dining room refers to conference rooms used for mealtime meetings. The private elevator does not exist. There are no special private, he writes, or VIP elevators being constructed as part of the project. So is this all fake news?
I do admire the senatorial chutzpah here. Senators coming from a building where there are special elevators just for senators to use, saying that there shouldn't be in the Federal Reserve building as well.
And a president surrounded by gold leaf, David.
There you go, and more of it with each passing day. You know, I think that you point out the fact that we've heard a variety of different things from all members of the president's economics team. He of course, is vacillating a lot. Should Fed Chairman Jerome Powell stay or go? Should he force him out? Sounds like the official line is that he should stay in his position here till the end of the tenure. But you know, we had the Commerce Secretary Howard Lutnick on CBS's Face the Nation with Margaret Brennan this weekend, saying that he needs to go. So again, there's this level of confusion surrounding all of this. What is the official message? How content are they to have him finish out the end of this term? All the while, the kind of Kremlinology in the background of who's influencing the president. What is Scott Besson saying to the president about the importance of him filling out that term? I think that's going to continue here. You mentioned the recess is on us here, but I suspect this story will continue. They'll try to make it continue.
Yeah, no doubt. You've You've ridden in the members-only elevators before, right? You sneak in there.
I've definitely yelled at some members from outside the members-only elevators.
Sometimes you find yourself in there, oh, gee, look what I've done. Sometimes a member will wave you in if there's a line. All right, David, I want to talk about some actual news, and we're going to get to the Fed later when the president arrives. But we had a pretty newsy day yesterday when it came to trade, and I know it's something that you've been talking a lot about on the Big Take podcast. The president speaking to the new trade deal with Japan, looming deals that we could see between now and the August 1st deadline. Listen to Donald Trump from late yesterday.
We're going to have a very, very simple tariff for some of the countries. There's so many countries you can't negotiate deals with everyone, so we'll have a straight, simple tariff of anywhere between 15 and 50%. A couple we have 15 because we haven't been getting along with those countries too well, so we just say, let's pay 50, and that's the way it is.
Getting confused. David, we talked to Peter Navarro on the program yesterday and asked him about the 15% baseline, maybe what 15 to 50 meant. Was he just blue skying there? Or is there somebody who's going to end up with a 50% tariff?
You know, I go back to what I was saying about the disconnect among members of this administration when it comes to Jay Powell's tenure. I think you're seeing a similar kind of disconnect here as we've seen the president raise this floor in recent days. It was going to be a kind of universal tariff, 10%. Now it seems like it's going to be 15%. But we've seen the evolution of his strategy when it comes to assigning these tariff levels. I mean, it's now, we're going to send you the letter. That's what it is. And if you're able to make inroads with us and make your case, maybe we'll lower that a little bit here. So maybe we'll see 50%. I think anything. I don't want to say that anything is off the table here, but it does seem like we're moving more in the direction of 15, 20% than we were at the beginning of all of this. And just if you look at the latest frameworks that have been announced here, they all kind of hover around that 19, 24, 25% level.
Mm-hmm. You've been exploring this a lot on the Big Take podcast. And it can be confounding, right? You put the podcast to bed and the stories change before you wake up the next morning.
Yeah, I had a conversation when I was at the Aspen Security Forum a couple days ago, and I was very excited to get two former U.S. trade representatives together. So Mike Froman, who was USTR for President Obama, and Bob Zellick, who was trade representative for President Bush. Immediately evident that they know each other well and have kind of sought advice from one another over the years. Really hit it off once we got into the studio, and we talked about what they're thinking as they watch all of this unfolding. And I think what's so fascinating here is they spent their careers effectively building up this global trading system that we have a president now trying to dismantle or destroy. And so we talked about, how they identify what the motivations are for the president doing this. Also fascinating, we talked about the retaliation that we could see when it comes to what the EU might do, for instance. So I asked Mike Froman about this. I said, look, we've seen this trade war. There hasn't been a ton of retaliation. What would happen? What would it signal if the EU were to retaliate in kind on these 30% tariffs that the president's proposed? And here's what he told me.
Countries thus far have not really retaliated. China, very interestingly, discovered where they had leverage, one of the many areas, I think, where they have leverage, and used it judiciously to send a signal that if the U.S. is intent on raising tariffs, they, too, can take action that could make it very painful for the U.S.
Is this rare earths?
That was on rare earths and magnets and things of that sort, using export controls, just like we use with them.
And so this is the big open question, of course. What would Europe do? And our reporting indicates that Europe has planned to respond if, in fact, that 30% tariff stays in place. Something else these two guys said to watch for, and I think this is fascinating, we've talked about it before, Joe, is sort of what the political implications of this are going to be going forward here. We went all the way back to the 30s and Smoot-Hawley, which cast, of course, a very long shadow on politics and our wider understanding of protectionist policies. Something that Bob Zellick warned me about is this is bound to have an effect that's going to be similar. You're going to see this manifest itself in economic data in people's lives very quickly. He's very curious to watch how this is going to kind of change the way both parties talk about trade, the effects of trade. And he says that's something he's going to be paying very close attention to here as this trade war continues to unfold. I said to them at the beginning of the interview, I said, did anything surprise you about the way the president has waged this fight? And both of them said to a T, no. This is something that he's telegraphed. This is something he's wanted to have happen. But again, the thing that's been fuzziest for them is what's motivating the president. So it's leverage. What's he able to get out of this? Not exclusively when it comes to the economy or trade, but other things as well, as we've seen. Revenue. Mike Froman pointed out they have raised a significant amount of revenue off these tariffs so far. Bob Zellick chimed in to say after that, yeah, but how long is that going to continue if this does weigh on the economy? And the third kind of final piece of that is what we thought this was going to be all about from the beginning, and that is encouraging countries and companies to invest more in the United States and bring manufacturing back home. I think that's the piece where it hasn't played out the way a lot of people thought it would. Certainly a lot of people in the president's base thought it would. Are they going to get the kind of investment and interest in restarting manufacturing in this country that the president promised we'd get while he was on the campaign trail?
This sounds fascinating. Zellick and Froman. This just
I highly recommend it. I will shamelessly and highly recommend it. But it was a very spirited conversation, and it was great to hear folks from two different political parties kind of hashing this out and responding to something that, of course, is so near and dear to them.
David Gura always brings the goods. That is why he is our asset, and great to have David from World Headquarters in New York. Find the Big Take podcast. I'm going to hear this too when we get off the air. Apple, Spotify, wherever you do that, or Bloomberg.com. Many thanks to David Gura. We're going to spend some time with Cliff Young at Ipsos coming up. He's got new numbers on not just trade, but Jeffrey Epstein. And Tyler Kendall will join us for an update on what's happening today at the White House. Let's check markets first. Charlie Pellet has that at World Headquarters in New York. The trade on Wall Street. Charlie, how's it looking so far?
Right now, in a word, mixed. We've got the Dow lower, Joe Matthew, S&P, NASDAQ. They are both advancing. S&P 500 index edging higher. Alphabet, Tesla down after their results as European Alphabet up, I should say. Tesla down after their results as European policymakers temper expectations of policy easing. S&P up 11 right now, up by about 0.2%. But the key takeaway at this hour, well off session highs. Indeed, the Dow lower by 222 points, down 0.5%. NASDAQ up 45 for the NASDAQ Composite Index. That is a gain of 0.2%. Our Mag 7 index trading lower by 0.3%. Tesla after earnings weighing on that index, down now by 9.1%. 10-year 4.39% with a 2-year currently yielding 3.91%. Spot gold down $15 the ounce, down by about 0.5%, 33.71 the ounce. West Texas Intermediate crude up 1.1%, 65.96 per barrel of WTI. Bitcoin up by 0.9% at $119,000. Keeping an eye on some of the meme stocks that are lower today. GoPro down 1.5%. Krispy Kreme trading down 1.8%. Beyond Meat down 11.5%. But Kohl's stores up by just about 8.3%. Florida police and WWE officials say pro wrestling icon Hulk Hogan has died at age 71. Authorities in Clearwater, Florida say they responded to a call this morning about a cardiac arrest. Police say Hogan was pronounced dead at a hospital. Hulk Hogan dead at age 71. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. Back we go to Washington. Once again, here he is, Joe Matthew.
Wow, Charlie, how about that headline? Last time we bumped into Hulk Hogan was at the Republican convention in Milwaukee. Remember when he tore his shirt off up there endorsing Donald Trump in front of a raucous crowd? I think Kid Rock may have played us out that night as well. Look, if you're an old guy like me and you used to actually watch World Wrestling on Saturday morning cartoons, you guys remember the old cartoon? Maybe you remember him from the Mr. T cartoon. Rocky III. Hulk Hogan. There he is now if you're with us on YouTube. If you're listening on the radio, we're bringing you back to the convention. He had trouble tearing the shirt that night, as I remember. I think it wasn't properly perforated or something, but there we go. There we go. Take care of that. Dead at 71. I'm Joe Matthew in Washington. Glad you're with us here on Balance of Power. Where else would you be at 12:30 Eastern Time? That's right, CC brings the goods, I'll tell you. Look at him losing it. The stage of the convention. That's right, brother. We need to talk about what's happening at the White House today. We also need to talk about trade, because the last time we talked, there was a baseline that was moving around, and you might have heard our interview with Peter Navarro yesterday. Following the Japan trade deal, the president last evening said 15 to 50% might be the new baseline depending on the country. We wanted to spend a minute with Tyler Kendall, who, of course, is our Washington correspondent. She'll be back with a lot more in our second hour with the latest on this. Is there anything new today, Tyler? Because it left a lot of people wondering last night what he meant.
Not much new today, beyond if we can capitalize on what President Trump said yesterday during his remarks, that now we're looking at rates between 15 and 50%. Now, we should say that we were likely heading in this direction. We knew that the rates were ticking up from that baseline of 10%, which investors and those watching really did think was going to end up being that flat rate. We did hear from Howard Lutnick a few days ago, who said that some nations might still get that 10% rate. He said Caribbean countries, many countries in Africa, Latin American countries, those countries that we do perhaps less trade with. But when it comes to these bigger trading partners, we have been seeing more of this range. Look at the Japan deal yesterday, 15%, our own reporting indicating that the European Union is trying to get to 15%. And then today I'm watching for any sort of movement around South Korea. That could potentially be another one of these trade deals in the pipeline. We know that there's some high-level talks tomorrow, though the Treasury Secretary will not be attending. That was a headline that broke on the Bloomberg yesterday, but the USTR Jameson Greer will be there. And our own reporting indicates that they're maybe looking at something when it comes to an investment fund to try to get the same sort of carve-out that Japan ultimately got to bring that tariff down, not just on that baseline level, but for autos too, and that's really important here, those sectors
I do wonder if that's the next model that we're going to see employed with other countries. It's been interesting when we asked Peter Navarro yesterday, you get South Korea, like you mentioned, you land the EU, are we all done then? You walk away on August 1st, and you wouldn't answer it because so much of this remains in flux, and it's up to the president, I guess, in the end. President's leaving the building today. You ready for the field trip?
Oh, this is going to be a fun
He's
one.
going to the Fed? What's he going to do when he gets there? We don't know much about this, do we?
A long-awaited visit. We didn't know that the president was going originally. We knew that these other administration officials, right? I don't know where you were when that schedule came out. Producer James made sure to put it to the top of our inbox. Am I allowed to call Producer James?
There's only one producer, James. Yeah.
He was the one that flagged it right off the bat that President Trump was going to be on this tour, 4 p.m. Eastern. He's going to be accompanied by some of these officials that really have been leading the charge here, that they want to see these renovations in person, including the OMB director, Russ Vought, James Blair, the deputy chief of staff, and then Bill Pulte, the director of the Federal Housing Finance Agency, who joined us on Balance of Power last week and said that he wanted to see this tour in
it's
person.
It's going to be quite an entourage.
Quite the entourage. We'll see how it ends up going. Of course, the Fed has called media reports about these renovations that now have a ballooning costs over $2.5 billion inaccurate. But really, what I'm watching for here is whether or not we get any sort of rhetoric around a potential investigation. We heard from Tim Scott, the head of the Senate Banking Committee, sort of flirting with this idea that there could be when it comes to this. Bill Pulte said he's confident, though we haven't seen a tangible investigation or news on that emerge. As you well know, Joe, the legal bar here would be very high to take action against the Fed chair, and Trump himself says that he's going to let him serve out his term.
All right, Tyler, many thanks. We'll be watching this together on the late edition of Balance of Power. It's scheduled for 4 p.m. Eastern Time. He will be in the building when we take air at 5 p.m. later on. We'll find out together. Tyler Kendall, Bloomberg, Washington correspondent, with a lot to talk about today here. Yeah, Tyler just exposed the Balance of Power group chat, which is really something pretty powerful here. It's not on Signal because, well, there's nothing classified on there, but we do talk throughout the day. When James dropped that one on us last night, we got a bunch of exclamation points in the chat. All right, we want to talk polling, not just about trade, but some other issues as well. When Cliff Young joins us, we always learn something. And the headline on the deck from Ipsos today says it all: storm clouds on the horizon, knowing the new America. When you consider the storm clouds, we can count the ways, right? Uncertainty about the economy. That has to do with tariffs. And then there's this guy named Jeffrey Epstein. Cliff Young is president of Ipsos Public Affairs and helps us run the numbers. Great to see you and welcome back.
It's great to be here.
I don't know where to start here. We were just talking trade, so why don't we do that?
Hey, jump right in.
Let's jump right in with the idea of tariffs potentially impacting prices, but also the uncertainty that it's brought to the markets. How does this pan out for the voter?
Yeah, well, first and foremost, Trump is in a good place from an approval rating standpoint. His numbers are better than 2017. He's about at the historic average in terms of decline. Good place, right? Yeah. But we have these storm clouds on the horizons, as we've detailed, perhaps most important of which are tariffs. Americans see tariffs as inflationary. They're worried about making ends meet. But there was a pause, and that pause, Trump implemented a pause that was very important for Americans, for the American household. Actually, his numbers improved because of that. But there's a worry about just generally making things go. Yep. As I said, making ends meet. Obviously, there's a complex view of tariffs. On the one hand, they have a lot of doubts about the short term. That has not changed. A big chunk of Americans believe that will be problematic, at least within the next year. But they see the long-term benefits. You have more than half of Americans believing that it'll bring back jobs, bring back manufacturing. So a complex story, but a lot of unease and trepidation.
How partisan are the results on that? Republicans are buying the message, Democrats are not, or is it more nuanced?
No, it's pretty partisan. Yeah. I mean, once again, the Republicans really give Trump resiliency right now. They're really helping to buoy his numbers at this point. Mm-hmm. That's not to say that independents, for instance, are more like Republicans than Democrats on this issue. But again, overall, there's this worry about inflation and tariffs triggering that.
Sure. The long term versus the short term is an interesting dichotomy. I've got to be honest, Cliff, I'm surprised that many people are thinking as deeply about this because there's been so little hard news. There's a lot of talk and a lot of noise, but we don't have a lot of deals with a lot of countries yet.
No, there's a lot of noise out there. There's a lot of chatter, obviously. Mm-hmm. But when you're talking about making ends meet, counting nickels and dimes, sure, people are pretty sophisticated. Americans are pretty sophisticated. They just came off a really gnarly inflationary high. Right. Yeah. It's improved this year. That's part of why Trump's in a fairly good place. Mm-hmm. But they know how it is. And once again, it's embedded in their mind today that tariffs are equivalent to inflation.
There you have the most important issues facing Americans here. Extremism tops the economy.
Yeah,
how do we interpret that?
It trumps the economy today. I would put it in the context of the economy improving. So even though Americans are worried about tariffs, worried about future inflation, mm-hmm, things have improved over the last year. You see that in the hard numbers. You see that in perceptions of the economy more generally. And when that happens, the economy has an issue, weakens a bit, it tampers down, and political extremism really is a function of all the things that the Trump administration is doing that's causing friction, mm-hmm, whether it be immigration on the one hand or tariffs themselves on the other.
Let's talk about the other big storm cloud, and it's named Jeffrey Epstein. I haven't really invested myself a lot in this story because it doesn't impact policy directly, but you can't escape it, and every time the president tries to change the subject, that becomes the story all over again. How dialed in are voters on a partisan level versus this being some sort of household issue we're all talking about here? How's the White House doing with this?
Yeah, it's still pretty distant for Americans in general, but it cuts to a core of a very existential issue for all Americans, whether they're red or blue or purple, and that's that the belief that the system is broken, that parties and politicians no longer care about the average person. Okay. That elites are colluding against the average American. Yeah. And at that level, there is resonance. Now, they're not paying attention to all the details, but what they're seeing right now is this just more of the same? Is Donald Trump and his government, his administration, just telling us, more of the same like other administrations? Are they going to come clean or not? Mm-hmm. So it cuts this very important sort of, like I said, existential issue.
Look at this chart, though. I mean, Republicans off the chart thinking that the administration is handling this well. Democrats barely register. Is that where we are? When you take the sort of MAGA element out of this and look at this as Republicans and Democrats, that's the story.
Yeah, I wouldn't overread it because we live in highly, highly partisan times.
Yes, we do.
But the fact that we only have 35% of Republicans saying that he's handling it well, we would normally expect that to be 50, 60, 70%. No, this is a problem. That, yes, it cuts to the issue of a broken system, that elites are colluding against the average person. Yes, that's true. But they are not happy with the Trump administration right now. To what extent that affects that weighs down negatively on approval ratings, we'll have to see. Yeah. I think it will be more marginal in its effect rather than more central, but that's a wait and see sort of situation.
Shocked by how many people think that the government's hiding this information. You asked, how many Americans believe the government hiding information about Epstein's death and his clients? Definitely, probably true. 69% on the alleged clients, 60% on the death of Epstein. Yeah, the videotape didn't help at all.
No, not at all. People don't believe anything coming from the government anymore, from elites anymore. Once again, there's a widespread belief, 60, 65, 70%, 75% of Americans, depending on who you ask the question, believe that the system is broken and elites are colluding against them.
What a world we are in, Cliff Young. He's the president of Ipsos Public Affairs. Fascinating research. Thank you for bringing it to us, as always, here on Bloomberg.
It was great being here.
Excellent. I'm still blown away by these numbers. 69% of voters on the alleged clients of Epstein. They think the government is hiding something. Many thanks to Cliff. We're going to get into this with our panel and a lot more later on in the hour here as the President of the United States attempts to change the subject again today by heading to the Federal Reserve headquarters here in Washington. Put your hard hats on. We're going to go with him later on today. It's not for a couple more hours. We'll have our panel next. Rick Davis and Adam Hodge are with us with the view from the left and the right on the fastest show in politics. Stay with us here on Bloomberg Radio, Satellite Radio, Bloomberg Originals, and YouTube.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got treasuries falling as jobless claims hit the lowest since April. S&P 500 index edging higher. Well off session highs right now, but showing a gain of 9 points on the S&P, up by about 0.1%. The Dow down 217, drop there of 0.5%. IBM weighing on the Dow after earnings. IBM down 7.4%. Nasdaq higher by 37. That is a gain of 0.2%. The Russell 2000 index is down, trading lower, down by 1% right now. Our Mag 7 index down 0.3%. Tesla weighing on that index with the stock down 9.2% after earnings. 10-year 4.39%. The 2-year 3.91%. Gold is down $16 the ounce, $33.71, down 0.5%. And West Texas Intermediate crude up 0.8%, $65.75 a barrel on WTI. Investors, meanwhile, are looking for more certainty on tariffs. As for tariffs and the inflation outlook, Shelby McFadden is an investment analyst at Motley Fool.
The deals have come on and off the table. There's still a lot to shake out. And then once those deals have firmed up, we have to actually see it come through the data. So we're only just getting into a point where we're going to see that sort of the effect from the air gap of container ships that sort of stop coming through the ports. We're only going to be rolling into that soon. The higher prices will only be coming in probably around this fall.
Shelby McFadden of Motley Fool. Airline news, specifically earnings. American Airlines Group is trading lower after earnings, down now by 8.6%. Alaska Airlines after earnings down 4.9%. And Southwest Airlines expects economic turmoil to erase as much as $1 billion of its annual pre-tax profit this year. Southwest down now by 13.1%. Florida police and the WWE say pro wrestling icon Hulk Hogan has died at age 71. Authorities in Clearwater, Florida say they responded to a call this morning about a cardiac arrest. Police say Hogan was pronounced dead at a hospital. Hulk Hogan dead at age 71. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And Balance of Power continues right now. Back we go to Washington. Once again, your host, Joe Matthew.
All right, Charlie Pellet, many thanks to Charlie, watching Wall Street for us every day here on the fastest show in politics. Glad you're with us on the Thursday edition. Welcome to Little Friday. We're getting there. And we have some wood to chop before this day is over here, not only on Wall Street, but here in Washington, where President Trump is going to be leaving the bubble, or at least the White House. He's kind of still within the bubble, going all of a half dozen blocks over to the Federal Reserve Building, the Eccles Building here in Washington, the construction site that is quite the eyesore at the moment and is well over budget, which has become a big controversy in Donald Trump's standoff with Jay Powell. There's a shot of it now with the cranes in the air and the construction clearly underway. We don't have a lot of detail on this. We'll, I guess, witness this together. He's set to be there about 3 hours, a little more than that from now. Is he going to wear the hard hat? Do they actually take the motorcade? I presume they do. Over to the Fed building. Does he get a tour? He will be speaking to the media alongside other officials who are going to inspect this renovation that has become the big controversy of the day here. This could be one of the most interesting, if not most expensive, Senate races shaping up in the country here as we look toward the midterms. North Carolina, we've got some real interesting news here because this was going to be the seat that Lara Trump was going to run for all over again. Remember, it was Florida, then it became North Carolina. Now her cohort at the RNC, I guess former cohort, Michael Whatley, who you've heard on this program, who helped to run the Trump campaign in the RNC during the campaign, chairman of the National Republican Party, plans to run for this open Senate seat in North Carolina. This is the one that was suddenly thrown open by Tom Tillis, who decided in a profile of courage to end his Senate career by voting no on the big, beautiful bill. Let's assemble our political panel for their take on this race. We've got two great practitioners with us today, including our good friend Rick Davis, Bloomberg Politics contributor, Republican strategist and partner at Stone Court Capital. Adam Hodge is with us as well in Washington, managing director, Bully Pulpit International, our Democratic strategist. Great to see you both. Rick, I'll start with you on Michael Whatley. You've talked to him along with us here on Balance of Power, and he's been at the helm of the RNC for some time. Is this a good choice? What kind of name recognition does he bring? I know he was a state official, but he's going to be going against a pretty well-known Democrat, it looks like, by the name of Roy Cooper. How does this race stack up in your mind?
Yeah, he's a longtime political figure in North Carolina, was the chairman of the Republican Party there. And as you point out, steered the Republican Party to a victory last November. A lot of people think very highly of him, as a good Paul. He's probably the strongest candidate, bar none, that we could have fielded that wasn't named Trump in the state of North Carolina. So I think it's a good selection for the Republican Party. And he will be able to raise the funds. This will be a very expensive race, but he's got great relationships with donors all over the country. This is, by definition, a nationalized race before it even starts. And that bounty of fundraising goodwill that he already has from being chairman of the RNC will serve him well in this capacity.
Fascinating. So it sounds like we have a race here, Adam. Donald Trump asked Waitlist to run, knowing that Lara Trump, I guess, decided to stay in the TV business here. But Roy Cooper is the big question mark. He says he'll announce his intentions in the coming days. Is he going to do it?
All signs point to yes, and he'd be a huge coup for the Democrats. Former governor, hugely popular governor. We left North Carolina with a very strong approval rating. Obviously, he was considered as a potential VP nominee. Eventually pulled himself out of that consideration. I think he has a lot of strengths across the state of North Carolina. He's very well known in Raleigh and in Chapel Hill in the capital, but also across the state. I think Waitlist getting in the race, truly, as Rick was saying, makes it a real national race, and that could be a problem. There was a recent poll out in the field in early June that showed Trump underwater, 46-53 in North Carolina. And clearly there are parts of the big, beautiful bill that will hit people who are on Medicare in North Carolina. So there are landmines potentially
for Republicans,
in the state of North Carolina. It has been, as a state, Lucy with the football for Democrats for the last couple cycles. Ever since Obama won in 2008, we thought we were on this sort of groundswell for national federal races that hasn't quite materialized. And so the key for Democrats is, can you actually get over the hump and elect a Democrat again?
Rick, when we say this is a national race, does that mean it's a referendum on Trump? And if that's the case, how expensive is this going to be?
Well, Donald Trump will make sure it's a referendum on Trump. I mean, he won't be able to help himself. He's a political animal with no compare. The midterms is going to be a referendum on him in every single district in the House and every state in the Senate. And he will throw himself into it. I have absolutely no doubt. He's probably been itching to go to rallies ever since he got elected. It's one of his favorite things to do on a Saturday night. I think it'll be welcome. I think this is the kind of thing, the challenge that Donald Trump wants, and he loves the fact that North Carolina has gone with him 3 times in a row. He thinks it's a state that helped make him president in 2016 and carried him to victory again this last fall. And so, I mean, I don't think he shies away from being the center of attention or the nature of the referendum. So that's what it is. It's what it's going to be like, and we're going to see a lot of Donald Trump in North Carolina is my bet.
What does this state mean for fundraising and for spending?
Oh, it'll be one of the most expensive Senate races in history, no question. Roy Cooper will be able to raise the money. There's no question. I mean, he's a proven vote getter, and people will be, I think, buoyed by his standing and his success as a governor in North Carolina. So he's got a national profile. He'll raise the money, and Chuck Schumer will make sure he has everything he needs to win that race. I think it is a really interesting test of styles as well. I mean, Roy Cooper has been, I'm a pragmatic problem solver, and he's very much not in the Trump vein, clearly. I mean, nobody else is. So I think he has a real chance to say, look, you may be disappointed still with the way things are working in Washington. I've gotten things done here in North Carolina. Here's what my record is on education, on highways, on everything else. I've made your life better. Put me in Washington, put me in the Senate. I'll bring some common sense to Washington. That, to me, is a strong message. And Michael Waitlist, coming from Washington, being the RNC chair, is a little bit of a harder time. He may have some bona fides in North Carolina, but he's going to own the national Republican mood. And on key issues, even ones that are seen as favorable to Republicans, like immigration. You're seeing the president's standing soften. On immigration, he's down roughly 10 points from a couple months ago. On the economy, we were just talking about it last segment, right? He's having some tough polling numbers there. So right now, snapshot in time, I'd give Democrats a slight edge, given where Cooper is standing, but there's a long way to go.
Tough polling, or clouds, dark clouds, I think, as Cliff Young put it, when it comes to trade, immigration, to Adam's point, and Jeffrey Epstein. Seeing those numbers was pretty remarkable, and I want to ask you both about what took place last night. Before House lawmakers left town, the Oversight Committee approved a motion by Representative Summer Lee, a Democrat, to subpoena the DOJ for documents related to Jeffrey Epstein. 3 Republicans voted for this: Nancy Mace, Scott Perry, Brian Jack, and that may not be a big surprise. But the Oversight Committee is now subpoenaing Ghislaine Maxwell, and you've got a separate effort to bring her in for testimony as well. She's also apparently sitting down today with the Department of Justice. Rick, the president keeps trying to change the subject on this. The Wall Street Journal now says his name is in the Epstein files. Where is this all going when lawmakers return to town?
Well, it's the classic summer scandal. I say it all the time. You bring up Jeffrey Epstein. I'm going to stick to my story. How much this goes into the fall when other issues take precedent is a good question. But it seems the House Republicans are intent on being a burr in the saddle of Donald Trump on Jeffrey Epstein. I do scratch my head sometimes and wonder why in the world, if the Justice Department did this exhaustive, study into the Epstein file, that nobody bothered, heading over and sitting down with Maxwell and actually interviewing her. It took until today to actually have something like that happen. It just doesn't, none of it makes sense, right? And so, like the last segment where you were talking about the polling, it's not a shocker that people don't trust the federal government on things like this. Look, they're still wondering who killed Kennedy, and so, like, maybe this goes into that kind of conspiracy theory lore where our grandchildren are wondering, that guy Jeffrey Epstein, did he get away with it?
The 2 questions I'm thinking that nobody wants to hear in Washington with any scandal in any White House is what did you know and when did you know it? And they're living with that right now. Well, and it seems like they're trying to spin themselves in circles, wrapping themselves in circles. Yeah. And they can't get out of their own way.
Does that include the Speaker of the House? Because he has oscillated a bit in his comments on this, but sat down with Major Garrett at CBS News. This is going to be a big story this weekend when it runs on Sunday morning. House Speaker Johnson says the Jeffrey Epstein case is, quote, not a hoax, unquote. The president calls it that every day.
I mean, there are dozens and dozens of young women who were preyed on by a notorious, convicted sexual predator. So, anybody claiming it's a hoax obviously just hasn't lived and thought about this.
Maybe he means that, I don't know what he's called, that the list is a hoax, but this is a genuine split.
No, it's a genuine. It's a genuine split, but it's of their own making, which is why I think it's just political malpractice. They've been living in the conspiracy theory business on this for years, and now the chickens are coming home to roost a little bit. But I think the news yesterday that the Trump was in the Epstein files and that they told him back in May speaks to just crisis communications 101 failure. Yeah. If you know that this is an issue, you get out ahead of it and you do it on your own terms. To wait for it to drip out this way just seems like it's a colossal unforced error when they could have shaped it on their own way. I mean, that's just the basics. And so it just adds to more fuel on the fire. And I think it's going to burn through the rest of the summer and into the fall.
Rick, we've got about a minute. What do you think of Speaker Johnson saying that the case is not a hoax? Are we going to see these two break up here, or is he just expressing the heat that he's feeling from his own members?
Look, I think that he's feeling heat from his own members. He's feeling heat from his own constituents. And as you say, I mean, it's by their own making. They're the ones who, went out there and talked about this over and over and over again on the campaign trail and subsequently. This administration was going to be the open door administration. We were going to get rid of all these secrets once and for all. And they are directly opposed to where the president is headed on this. And, this is going to be a mud wrestling match before it's over between the House Republicans and the White House.
A summer mud wrestling match, just what Washington is made for here in the swamp. It's great to have our great panel. Adam and Rick will be with us at the top of our next hour, so don't go away. We're going to get into the president's trip to the Federal Reserve and see what they think about this, too. A lot of folks are suggesting that this just may be the latest attempt to distract from the Epstein story. We'll take a check on Wall Street. Tyler Kendall will join us as well here in studio, and a lot more to follow on the fastest show in politics. You can watch us on YouTube as well. Search Bloomberg Business News Live. Stay here on Bloomberg Radio.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
It's a rare presidential visit to the Federal Reserve. Welcome to the Thursday edition as President Trump brings his standoff with Jay Powell to a whole new level today, announcing a field trip, if you will, to the Fed's headquarters here in Washington, but is currently under renovation. A controversial renovation, suddenly. I'm Joe Matthew alongside Tyler Kendall in Washington. And Tyler, this is going to be an interesting pop-in by the president. We don't have a lot of details or even whether Jay Powell's going to be there.
Right, exactly, Joe. Still waiting for details, though we do know it's going to happen around 4 p.m. Eastern, and the president is expected to be accompanied by some of the harshest critics of the Fed in his administration. I'm thinking like the OMB director, Russ Vought, and Bill Pulte, the head of the Federal Housing Finance Agency.
They've been calling out this renovation for being over budget and overly ostentatious. Jay Powell's pushed back pretty hard on that.
Pretty hard, but critics do point to the fact that the budget documents show that the renovations have ballooned to over $2.5 billion in costs. Jerome Powell himself has appointed an inspector general to look into the renovation costs, but importantly, the Fed says that media reports about the renovations have been inaccurate.
That's right. Well, look, Donald Trump's no stranger to wearing a hard hat. I'm deeply curious to see what the optics are going to be. I'm assuming they take the motorcade, they don't walk. It's only a half dozen blocks from the White House. He is expected to address reporters while he's there, and I'm sure that the markets will be listening.
Exactly. This is one of those events that could move the markets, which is why we're now going to check in with Charlie Pellet in World Headquarters in New York for the latest. Hey, Charlie.
Hi, thank you very much, Tyler and Joe. Indeed, looking at a market right now, little changed on the S&P 500 index. To be sure, we've got the Dow lower. NASDAQ is advancing, all about earnings right now, with the S&P higher by 9, up by about 0.1%. Alphabet up, Tesla down after their results. The Dow down 222 now, decline of 0.5%. IBM weighing on the Dow. IBM after earnings down 7.5%. S&P up 9, up 0.1%. NASDAQ higher by 0.2%. Our Mag 7 index down 0.3%. Tesla weighing on that index. Tesla after earnings down just about 9%. The 10-year, 4.40%. The 2-year, 3.91%. Treasuries fell as jobless claims hit the lowest since April. Spot gold down $20 the ounce to $33.66. Drop there of 0.6%. And West Texas Intermediate crude up 0.3%. WTI 65.43 for a barrel of West Texas Intermediate crude. Elon Musk is warning of difficult times ahead for Tesla, saying the company will be in a transition period for the next year or more. Tesla shares down now by 9%. Alphabet says demand for AI products boosted quarterly sales. Alphabet shares up 0.7%. McGraw-Hill first day out. It is lower after the company raised $414 million in its IPO. McGraw-Hill down now by 1.2%. Hulk Hogan, dead at age 71. He was an icon in professional wrestling who turned the sport into a massive business. Authorities in Clearwater, Florida say they responded this morning to a call about a cardiac arrest. They found Hulk Hogan. He was pronounced dead at a hospital. Hulk Hogan, wrestling icon, dead at age 71. Recapping, most stocks higher. S&P up by 10 points now, up 0.2%. Balance of Power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Tyler Kendall.
All right, Charlie Pellet in World Headquarters for us. Thank you so much. And of course, a big focus of today is going to be President Trump's impending visit to the Federal Reserve to tour some recent renovations to their headquarters here in downtown Washington. And administration officials are really latching on to this idea, these allegations that Jerome Powell misled Congress in testimony about this renovation project. The Fed says that he has only been truthful in his testimony, and we actually want to bring you part of what he did tell lawmakers back in June.
There's no VPI dining room. There's no new marble. We took down the old marble. We're putting it back up. We'll have to use new marble where some of the old marble broke, but there's no new, there are no special elevators. They're old elevators that have been there. There are no new water features. There's no beehives, and there's no roof terrace gardens. Other than that, so all of the sort of inflammatory things that the media carried are either not in the current plan or just inaccurate. So, but notwithstanding that, the cost overruns are what they are.
I was personally curious to see the water feature. It is basically a construction site over at the Eccles building, not that far from the White House, around the corner on Constitution Avenue. If you showed up there right now, as the president will a short time from now, you'd see a lot of cranes and orange barrels and the like. There's quite a bit going on there, and it's not a great-looking place. This is a $2.5 billion renovation project, a deep upgrading of the guts of the, in fact, 2 buildings that make up the headquarters there. And I want to get into this, Tyler, with Kate Davidson, who helps to cover the Fed for us here and leads our coverage as managing editor for U.S. economic policy and has spent a bit of time in this building and knows the people who work there. Kate, it's great to see you. Thanks for joining us, as always, here. The building named for Mariner Eccles, who served as chair of the Fed 1934 to 48. This building has been sitting over there since the 1930s. And it was the pride of the Fed to hire a well-known French architect to build this structure and some pretty famous decorators to make this a nice place. What are we talking about here with all of these renovations? Is any of what we're hearing from the administration true?
Well, it's a little bit hard for us to know if any of it is true, right? I mean, I think that it is worth noting that Chair Jay Powell did request that the Fed's Inspector General do its own internal review of exactly what went on with the building project. This is something that has been in the works for several years. It's something that the president likes to talk about Jay Powell, but the entire Board of Governors approved this massive overhaul. I think one of the things that the Fed has been trying to talk about and reiterate is that this particular building, really the 2 main buildings that where the Fed houses its economists and staff in Washington, they really hadn't gotten a substantial overhaul since they had been built. This one in particular, the Eccles building, Powell is quick to remind people, never had a big top to bottom renovation. So there was a lot of asbestos removal and things like that, just bringing the building up to code. I think one of the points he made, and I think we heard him refer to it, the elevator, there's claims of a VIP elevator, and he had said that was actually to accommodate disabled users of the elevator. And so I think there are a lot of things like that where perhaps on paper, they might raise some questions and some concerns. What is the point of this? What's the justification here? And the Fed is starting to share more information about that on this project that, as I said, has been going on for several years now.
Can you talk a little bit more about the backdrop that this pressure from the administration is coming from? Because we have heard some other criticism when it comes to Jerome Powell. What sort of led us to this point? I'm also really fascinated to hear your view on the head of the Federal Housing Finance Agency, Bill Pulte, who seems to be taking a lead when it comes to the renovations, and we know he's going to be on the tour today.
Yeah, I mean, I think we can't overstate just how unusual all of this is, right? The head of the FHFA, I mean, that is a very big, important job overseeing, mortgage markets and Fannie Mae and Freddie Mac. But Director Pulte seems, very preoccupied, very focused on what Jay Powell is doing at the Fed. And of course, that matters to mortgage markets. He had talked a lot previously, before talking about the building, talked a lot about rates being high and how that was harmful to homeowners and Americans can't get a mortgage, and it's Jay Powell's fault was the argument. But all of a sudden, yes, he started talking a lot more about the renovation. We heard, though, even a couple months back, Elon Musk had mentioned it in an interview in the Oval Office. Kind of stemmed from little noticed report that a former Fed economist actually had put out through the Mercatus Center, former advisor there, looking at these costs and the cost overruns, and the fact that it was a potential political liability for them. And as we're seeing, I think it has become one because, it's not just about what's going on with this renovation. It is paired with this criticism at the same time that the Fed is not lowering rates, and the president really, really would like them to be. So, sure you could look at this as, is this just them piling on? It certainly seems that way.
Can I, just to be clear, though, whose money is this?
Well, it's a really good question.
For the renovation.
Yeah, the Fed is essentially self-funded. They have fees that they collect from banks. Their money, though, their appropriations are not approved by Congress like most federal agencies. They were set up in that way by design to be independent from that process, in part because Congress decided many years ago that they wanted the Fed to be somewhat walled off from political influence, right? To make the decisions for the economy. Yes. That are in the best long-term interest in the economy, not short-term. So they have this money. They have a huge portfolio of assets. All the bonds that they have bought through various rounds of QE to support the economy. Those bonds earn interest. They earn interest on the balance sheet, and they cover their operating costs, which could include renovations, include paying staff. Whatever's left over in earnings, they send that to the Treasury. But with rates being so high the past few years, they're not sending any money to Treasury anymore. So that might be also a little bit of a frustration to officials in the government.
Really fascinating stuff.
It's a lot.
Bloomberg's, and you're on top of all of it. Bloomberg's Kate Davidson, our managing editor for U.S. Economic Policy. Thank you so much for being here.
Thank you.
And for more, we want to bring in our political panel. That includes Rick Davis, partner at Stone Court Capital and a Bloomberg Politics contributor, as well as Adam Hodge, managing director at Bully Pulpit International and a Democratic strategist. Rick, I want to start with you, and I want to just talk broadly about the optics here. If there's this big tour at the Federal Reserve, we've heard the administration ramping up the criticism leading up to this. What should we be expecting from the administration when they arrive today that would help advance their argument when it comes to the pressure against Jerome Powell?
Yeah, I think you got to just think of this as sort of today's event in a long-running, sort of attack campaign on Powell specifically and the Fed in general. We've heard it from so many different people within the administration. Donald Trump, obviously, first amongst anybody, leading the charge on Powell as it relates to interest rates. But now, obviously, we have some controversy around the building. I've been in the Eccles building. It's over 100 years old. It's never been renovated until today. When I was in it, there was no renovation. You were a little embarrassed. It was a beautiful, stately building, but the Federal Reserve is in a building that was over 100 years old that had never been fixed up. That seems like a real incongruity. That being said, no excuse for overruns. And at some point, you got to think of it as taxpayer dollars, regardless of who's actually writing the check. And so I think that this is a fair criticism, and I think Donald Trump has just taken advantage of it. He is good at optics, and that's what today is all about. It's all about the optics.
Rick, I don't know if you were with President George W. Bush when he went to visit the Federal Reserve Building. That was in 2006. That's the last time a president of the United States made the trek over to headquarters. And Adam, that means that Donald Trump becomes only the fourth. That's how rare an occasion like this is. What is it exactly that he plans to do there? We don't know that Jay Powell is even going to meet him. Is this anything more than optics?
No, it's clearly optics. I think there's no question that he is just trying to own the moment. And Trump, let's not forget, is a building guy, right? Like he's
going to be right at home.
This is what he loves more than anything else.
Inspect the rebar.
Yeah, I can't help but take a step back and think Trump is also spending a lot of taxpayer dollars to turn over the Rose Garden and make it more like Mar-a-Lago. He's done a lot of renovations in the White House, putting a lot of gold everywhere. So he's done a bit of this himself.
Quite a bit.
But I think the reason why this story actually matters is to where Rick was getting at. It undermines the credibility of the Fed chairman if the president is browbeating him. And I think it really potentially undermines whoever Powell's successor is in 2026. Trump has been clear he intends to appoint someone else. And you got to wonder if he's just going to walk over every time he disagrees with a rate decision to pressure him into making a different decision. That's why this matters.
Well, actually, to build off of this, the Treasury Secretary, Scott Bessent, was on Bloomberg surveillance earlier this week and was asked about President Trump's intention, since he does say that he's going to let him serve out his term through May of 2026. Right. And we want to play you both a little part of his answer and get your reaction on the other side.
The president said he is not going to fire Chair Powell. It would do Chair Powell a favor, and he would be doing the institution a favor if he did an internal review. This mission creep from the Fed is endangering their independence of monetary policy.
To Adam's point before, Rick, when it does come to perhaps threading the needle, or how do Republicans and the administration thread the needle here when it comes to a potential replacement for Jerome Powell, if we know that some of the candidates that they're looking for would potentially come from within the administration?
Yeah, look, I think that that's going to happen no matter what by May. And so the real question is, in the ramp up to the replacement of Powell, under normal order, how much more heat can the president really pile on? And even though the Treasury Secretary was less argumentative about replacing Powell, Howard Lutnick came out the same day basically and said he ought to be replaced or he ought to resign. So the administration is all over the map on the speculations around Chairman Powell. And I would say what's interesting is that clip echoes more the traditional Republican sentiment about mission creep with the Federal Reserve, especially as it relates to DEI, as it relates to climate, issues that the Federal Reserve has dealt with that Republicans felt weren't in their mandate. So we're sort of like, recreating the last decade of debate around the Fed. And as a result, again, more pressure, being put on Jay Powell. He's a tough guy. He can handle the pressure. It doesn't really affect him and his decision-making. It's not the first time, he's been in the cooker. And so assuming that the president is staying the course, a lot of this is just good summer theatrics.
Well, unless they find a shrine to the Grateful Dead that they're building over there, Adam, I just wonder what today could lead to, and if this might blow up in the president's face optically. He's going to show up at a construction site. There's a bunch of broken concrete over there right now. They're not going to find lavish offices, VIP elevators, and fish tanks. So how's that going to play on TV?
I don't think it plays on TV to the broader public, but to his base. This is red meat that
so it doesn't matter.
I think that's where it's important to remember who the audience here is. For Trump, for the White House, it's not the markets, it's not the place, it's his supporters. And so I'm old enough it was years ago, but when I worked at the U.S. Treasury Department in the Obama administration, there was almost a church and state relationship with the Fed. The Fed did their job in monetary policy. We were responsible for fiscal policy.
You couldn't get anyone to even comment on the Fed.
No. And when they talked about the dollar, we'd get all up in arms about it as well, right? So that's the way it works. The fact that they're putting this pressure on the Fed, I think, is really problematic, and it really does, I think, potentially pose problems for the credibility of the Fed and the certainty that the markets will take on Fed policy in the future. That, again, I keep coming back to that. That's why I think this matters. When they make future rate decisions, is it because the White House told them to, or is it because they actually think it's in the best interest of the American economy and the global economy? And if you get to that weakness, that doubt, that is bad news for the U.S. economy.
Rick, just in our last 30 seconds here, Joe brought up next steps. And one of the potential next steps is that the administration is pushing for Congress to actually investigate Powell's testimony. We played a little bit at the top of the show there. Bill Pulte told us on Bloomberg TV last week he's confident Congress is going to investigate. How much sway does Congress actually have here? Could they play a role in this going forward?
Yeah, I think it's a cog in the campaign, but it's not like they're going to have much of a material impact. They don't control the budget for this, so typically they could put hamstrings on the funding. They're going to drag up a bunch of people from the Fed, from the National Capital Planning Commission, folks who are actively involved in the building. Look, it shouldn't have happened, right? There's $500 million that's going to this that wasn't originally budgeted. They should have had a tighter control on that. But we also know there's been inflation and the price of construction materials has gone up. So how much is really going to come about all this? I wouldn't hold my breath for a breakthrough scandal, especially in the midst of all the rest of the things that they're investigating currently. This is not going to show up much in the American public psyche.
We're going to find out together. Great analysis from Rick Davis and Adam Hodge. Many thanks to both of you. That tour is scheduled for 4 p.m. Eastern Time. And of course, when it happens, you'll see it and hear about it right here on Bloomberg TV and radio. Straight ahead, our conversation with the congressman from Virginia, Suhas Subramanian, the 10th District, as we talk about the fallout here in the Epstein case. It's straight ahead on Bloomberg.
1:21 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story out of the Middle East. President Trump's special envoy, Steve Witkoff, says the U.S. is cutting short Gaza ceasefire talks and bringing home its negotiating team from Qatar for consultations after the latest response from Hamas, quote, shows a lack of desire to reach a ceasefire in Gaza. U.S. stocks trading mixed right now, with the Dow Industrials down 192, decline there of 0.5%. S&P higher by 16, up by about 0.3%. NASDAQ up 71 for the NASDAQ Composite Index. That is a gain now of just about 0.3%. Treasuries fell as jobless claims hit the lowest since April. The S&P 500 index higher, with Alphabet up and Tesla down after their results. The 10-year, 4.39%. The 2-year, 3.91%. Spot gold down $18 the ounce, $33.68, down by about 0.5%. West Texas Intermediate crude oil higher by 0.2%, $65.36 a barrel. And Bitcoin just above 119,000, up now by 0.9%. IBM down the most in 4.5 years after the company reported weaker than expected sales. IBM weighing on the Dow. IBM shares down now by 7.5%. It looks like honey chicken and burrito giveaways have not been enough to offset a traffic slump at Chipotle Mexican Grill. The company points to economic anxieties, saying in cutting its outlook for the second time this year. Chipotle trading lower now by 14.3%. Recapping, the Dow lower, S&P higher. S&P up now by just about 0.3%, with the 10-year 4.39%. And Balance of Power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Tyler Kendall.
All right, Charlie Pellet in World Headquarters, thank you so much. I'm Tyler Kendall alongside Joe Matthew here in Washington. And Joe, we should say it's shaping up to be a busy day in Washington, but the House is already out. They're heading out for recess of August, a month long.
You can tell summer's here. All of a sudden, there's no traffic when the House goes on August recess. Last night was flyout night. They decided to leave early, Tyler, as we told you this was coming, following some Democratic demands to get a vote on releasing the Jeffrey Epstein files. Speaker Johnson wasn't having it. No. Sent basically everyone home early.
It appeared that they were trying to avoid some controversial votes here when it did come to the Epstein files, hoping that perhaps this August recess could dissipate some of the outcry that we saw. But of course, lawmakers are in the middle of working on some really other crucial pieces of work that includes funding the government, the appropriations process. And we had the chance to ask Congressman Brendan Boyle of this yesterday, ranking member on the Budget Committee, about potentially the future here of how this could become a showdown come the fall. We want to play you some of that tape now.
There is no question that another rescissions package from this White House is them essentially saying, we want a full government shutdown. Russell Vought, by the way, last week, let's not forget what he said. He said the problem with the budget process is that it's too bipartisan. So he's outright saying that they want a government shutdown and they want to force one.
All right, let's remind everybody, Brendan Boyle is the ranking member on the House Budget Committee. When Brendan Boyle says one more rescission, you've got to shut down, that is meaningful. Remembering the government runs out of money on September 30th. We don't have spending bills ready. There's no agreement on top lines. And as we started here, lawmakers are now beginning to leave town. Senators will go through next week, it looks like, working on nominations. Maybe they'll get a couple spending bills in the works, but that's a far cry from a deal on a budget. And that's where we start our conversation with Congressman Suhas Subramaniam from the 10th District of Virginia. That's not far from here in Washington, Northern Virginia, a district full of federal workers, I will add. And Congressman, it's great to have you with us from your view on the Democratic side of the aisle. I want everyone to know that you're on the Oversight Committee. You're also on Committee on Science, Space, and Technology. And I want to pick through a couple of these things here. I will ask you about what happened on the Oversight Committee with regard to Jeffrey Epstein. But start with us on a shutdown, Congressman. I know Democrats are angry about the rescissions package. Is Brendan Boyle right? One more and you're done?
He is. I think the reality is that it's one of our few pieces of leverage when it comes to being in the minority. And I represent a lot of federal workers. I just talked to a federal contractor who would actually go without pay during a shutdown. And he told me, shut the government down, because they're shutting the government down anyway. What OMB and what Russell Vought is doing, what all these folks are doing is they're basically firing people left and right and moving agencies now out of our region, and which would devastate those agencies as well as the American people who they serve. So we should use our leverage and try to get a bipartisan deal, because otherwise they're just going to continue to do these cuts, and it's basically shutting down the government anyway.
But, Congressman, when Democrats are trying to rally around a message, does potentially threatening a government shutdown, could that backfire here? Because isn't that going to be fodder for Republicans?
No, I think there's a lot of people who are angry at this administration. There's a lot of different reasons why they're angry. Take the one big ugly bill or the rescissions package, whatever you want to point to as why you're angry, even Epstein. And people want us to be a little more forceful, actually. I think people are upset with the Democratic Party right now because we haven't used our leverage when we could have. And so I actually think that people will reward us for trying to fight back at what this administration is doing.
It's been interesting to watch your oversight committee. And part of the reason why you're home right now, as we were just discussing, Congressman, is the Speaker's decision to get out of town a bit early and put off the Jeffrey Epstein situation, suggesting that the administration needs some time and some space to go through some of the documents. It's unclear exactly. Maybe you can tell us a bit more, but I don't want to make this whole interview about Epstein. It's just hard to ignore the headlines today. You've got a senior Justice Department official expected to meet with Ghislaine Maxwell in Tallahassee, where she's in prison. And in Congress here, just as the House was taking its final votes ahead of the recess, a Republican-led motion here on the Oversight Committee, it was a motion, by the way, it was from a Democrat from Pennsylvania, Summer Lee, on this Republican-led committee, in fact was passed with 3 Republicans to release documents, subpoena the DOJ for documents related to Jeffrey Epstein. Is that going to happen when you come back to town?
It should, because the committee voted to do so. So if the committee's doing its job and following the rules, then it should actually happen. The bigger thing is this is a crisis of the president's making. He campaigned on a cover-up of some sort of these files all last year and then said that they had it on the AG's desk ready to give out. And now, given his reaction to some of these things, as well as his reluctance to release the report, I kind of want to know whether the president is in them, and if so, to what extent his relationship was and how complicit he was with what Epstein was doing. And so there's a lot of questions to answer. And this is all the president that brought this up. He's the one that peddled this conspiracy, and he created an administration of people who peddled the conspiracy to get elected.
Well, Congressman, I just want to follow up a little bit more on that, because I know that you wrote a letter to the Attorney General, Pam Bondi, looking for additional information here. What exactly were you seeking, and did you hear back from the administration on your request?
Well, I wrote that letter because Elon Musk tweeted that week a lot of things in opposition to the president, but one of the things he tweeted was he had some sort of special access to the Epstein files, and the reason they haven't been released is because the president is in them. And so I simply said, why does Elon Musk get to see the files or have knowledge of the files, and we don't as members of Congress? And so I simply asked the AG, well, if you're going to share them with Elon Musk, then share them with the rest of the country. I didn't get a response on that. The other thing is, we're adjourning. I'm 40 minutes from the Capitol. I'm ready to go back anytime. But I do think we should be going back and not just working on the Epstein files, but, we didn't do anything to lower costs. We didn't do anything on trying to help people who are losing their access to health care. So there's a lot of things that we didn't do this summer and this past 6 months that we should be doing. And I think recessing this early, is really, a bad look for this Republican leadership.
I know there could be some interesting town halls in the weeks ahead, Congressman. You're the ranking member as well on the Oversight Subcommittee on Military and Foreign Affairs. So I have to ask you about this report from the Washington Post that I suspect you've seen. The Pentagon's independent watchdog says it has received evidence that messages from Defense Secretary Pete Hegseth's Signal account, talking about the bombing raid in Yemen, were in fact from a classified email labeled secret non-foreign, making reference to being off limits to foreign nationals. Is this something you're going to investigate in your committee?
Yeah, absolutely. We've already started trying to investigate. Obviously, we don't have subpoena power being in the minority, but certainly we have to look into this, and it should be bipartisan because this basically contradicts everything the administration was saying, and particularly Secretary Hegseth, that they weren't sharing classified information on the Signal chat. Now, we felt like they were, and it's pretty clear that the information, the kinds of information they were releasing were, in fact, putting our troops in harm's risk. And so this simply confirms what we were saying, which is that this is absolutely classified, and the secretary absolutely should resign, and really created a violation that would get anyone in the military fired. And so I represent a lot of military families and veterans and people who work at the DoD, and they would get fired over this, but it seems like the secretary is above the law, or thinks he is.
Just to quickly follow up on that, will the chairman of the committee, the Republican chair, allow you to pursue this?
I've also asked House Republicans on the committee to pursue this, and they've simply shut it down. And I think they see it as their job to cover up for this administration, even when they don't agree with the administration or when they acknowledge that a mistake was made. And so in this case, it seems like they're not going to do any investigating. They simply want to relitigate conspiracy theories rather than actually trying to investigate this administration and things that it's doing to hurt the American people.
Congressman, I want to pull on a little bit of your expertise here because I know that you served under the Obama administration as a tech policy advisor, and I want to talk to you about some other news that we saw this week, including President Trump launching his AI initiative, looking to perhaps loosen some of the regulations, speed up energy production to meet AI demand. I'd love your thoughts on his plans, including when it comes to the future of artificial intelligence, trying to keep the U.S. ahead of China. Is this an area where you see there could be some sort of bipartisan work going forward?
It has to be bipartisan. I think we do have to make sure that our country is a leader on AI. We also need to make sure that our workforce is prepared both for the jobs that AI has already and may continue to displace, and jobs that will be created by AI. And so, we're talking the AI we have now and will have in the future will need human components and humans to help navigate it and control it, essentially. And so I think the workforce pieces in there have to be bipartisan, and I did like them. There's some stuff in there I really didn't like. I mean, one of the things that places like China are doing is trying to control their people using AI. And there was sections of the report that talked about wanting to stifle certain types of speech and algorithms that might be quote unquote politically biased, but what they meant by that was basically algorithms that were not friendly to the president's viewpoint. And so I'm concerned that this administration, doesn't like truth when it contradicts their narrative, and they're going to use AI to basically try to push a new narrative, and we have to make sure we're vigilant about that.
Congressman Suhas Subramaniam from the data center capital of America, the state of Virginia. We thank you for the time here, only on Bloomberg.
1:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow lower, the S&P, NASDAQ both advancing. S&P trading at a record as Alphabet's results showed solid demand for artificial intelligence. S&P up 16 at a record 63.75, up by about 0.3%. The Dow, though, in the red, weighed down by IBM. The Dow lower by 198 points, down 0.4%. IBM now plunging by 8.1%. NASDAQ up 73. That's a gain of just about 0.4%. Our Mag 7 index, of which Tesla is a part, little change, down under 0.1%. Tesla shares down 8.4%. 10-year at 4.39% with the 2-year, 3.91%. Spot gold is falling $16 the ounce, 33.71, down 0.5%. West Texas Intermediate crude up 0.4%, 65.54 a barrel, and Bitcoin just above $119,000, up right now by 1.1%. Shares in those so-called meme stocks are trading mixed right now. GoPro retreating by 0.7%. Krispy Kreme, which uses the ticker DNUT as in donut, up 2.4%. Beyond Meat plunging 11%. Kohl Stores up today by 9.8%. So again, recapping, S&P up 0.2% with your 10-year, 4.39%. Balance of power continues right now. Back we go to Washington. Once again, your hosts, Joe Matthew and Tyler Kendall.
All right, Charlie Pellet in World Headquarters, thank you so much. And we're always watching for tariff updates here at Bloomberg. Joe, news yesterday, Japan had clinched an agreement at 15% for its baseline rate, but also lowered it to 15% when it came to autos. And our eyes are now looking towards a high-stake meeting later this week with South Korea and whether or not we could see some other framework deals emerge. But something does appear to be emerging, and that's a trend when it comes to the baseline rates that we're seeing implemented. And it appears that it might be ticking higher than previously thought. For that, we're going to play you some sound from President Trump last night outlining the range that these rates could reach.
We're going to have a very, very simple tariff for some of the countries. There's so many countries you can't negotiate deals with everyone, so we'll have a straight, simple tariff of anywhere between 15 and 50%. A couple we have 15 because we haven't been getting along with those countries too well, so we just say, let's pay 50, and that's the way it is.
I'll remind everyone that August 1st is a week from tomorrow. At times like this, we spend time with Edward Harrison. He's the force behind the Everything Risk newsletter and has a keen sense of what's happening in the bond markets and the elements of this whole tariff and trade story. Edward, it's great to have you back on Bloomberg TV and radio, as always. Markets seem unfazed by most of this right now. So when you consider everything risk, it's been pretty risk off, even in the face of this uncertainty. We're a week out, and you wouldn't really know by looking at Wall Street. Maybe a little bit different in the bond market. How are you seeing this?
Yeah, Joe, I think it's interesting because if you look at the economic data, jobless claims in particular, what you've seen is jobless claims go down 6 weeks in a row. And when you saw the CPI that came out recently at 2.7%, basically it told traders, look, you know, everything's fine. Tariffs, they don't matter. You know, we've gone from 2.3% on average to potentially 15% and higher, and nothing's happened. I think that is probably premature, but you know, this is a market that wants to go up, and it's going to go up until the data tell the market that there's a reason to go down.
Well, you write, to build off of this, that only the actual implementation of worst-case tariff outcomes are going to shake this market. What are those worst-case outcomes, and how likely, in your view, could we be teetering towards them?
You know, number one, I don't think that we're going to get those, and two, I don't think that the data, or rather that the data that we've seen so far is representative of what will happen once the tariffs are actually fully baked in. So the worst-case outcome that I'm looking at is sort of more of the, let's say, 20% variety. I think that Trump, he's already signaled that he's not willing to go that far. It's interesting, you know, at one point, I think earlier in this week, or it was last week, he said the baseline tariffs could be 10 to 15%. Yes. We don't know, we haven't figured it out yet. But the market's at new highs, so that shows you that actually my policy is very good. Then markets kept on going up. As a result, he decided, let me go with 15%. So now we're at 15%. I think that's about as high as he's going to go.
Even Howard Lutnick the other day on Bloomberg said, we're right up at the line. 15 seems to be the line, maybe before you start to see some real destruction. But Edward, what's got you more concerned, the tariff rates themselves or the idea of extending this deadline all over again?
I think it's the tariff levels themselves, because ultimately, once the tariffs are at this level, eventually 3-4 months down the line, we're going to get all sorts of impacts with regard to pass-through of inflation, or at least the price level step up that people will talk about. And we're going to see whether or not consumers actually will be able to stomach those higher prices.
All right, Edward Harrison, we thank you so much for joining Bloomberg, and we want to continue with this conversation now with Natasha Sorin from the Yale Budget Lab, also a former senior counselor to former Treasury Secretary Janet Yellen. Natasha, I'd love to bring you into this conversation here as we are seeing that baseline tariff rate potentially shift. It now looks like President Trump outlining that we could see it around 15%. How is that changing your calculations when it comes to a universal tariff rate?
So we put out some estimates yesterday from the Budget Lab at Yale where we took stock of essentially where we are, inclusive of this new Japan framework, and concluded that effective tariff rates, if they were to go into place at the levels that have already been stated for the deals that have been reached, are going to be at over 20% as of August 1st. And so that's a pretty substantial difference relative to the 2.5% when President Trump took office. The result of that is we expect to see prices increase for households on an average of about $2,700 per household. And those increases are going to be concentrated in particular industries where the tariffs really have the greatest bite, right? So they're going to be a 35% increase in apparel prices or a 12% increase in consumer electronic prices. And I think, and to sort of pair off on some of the discussion you were just having, part of the reason you're not seeing that yet to that magnitude in the data has to do with the fact that in a lot of these industries, apparel is a good example, what happened in the lead up to these Liberation Day tariffs was an understanding that the president was going to shift up these rates very substantially. So inventories rose really dramatically. People tried to bring in a lot at lower tariff rates with the cognizance that high tariffs were going to come. So I suspect we're going to start to see some of these price increases over the course of the months ahead. And indeed, if you look into the CPI, you're starting to see a little bit of that already.
It's really interesting when you combine the impact of front running, as you're suggesting, with maybe a reluctance, at least in the beginning, for companies to pass along higher prices. They're trying to absorb this within their profit margins to the extent that they can. This is really interesting, though. You put such a fine point on this. $2,700 more in costs for 2025. Is this then all backloaded to the second half of the year or the fourth quarter? When does it hit?
Well, it's interesting. It's sort of hard to predict exactly what these are. Sort of our estimates are based on trade models that provide the capacity to do that kind of granularity. But of course, it's kind of hard to predict with every twist and turn of this. And ultimately, it's hard to anticipate where exactly these tariff rates are going to land because, of course, you know, Howard Lutnick has said August 1st, it's a hard deadline, but the president has also said countries should feel free to come and continue to talk to us after that date. So in some sense, like timing this and understanding how businesses are going to respond and how consumers are going to respond is like a hard thing to do because it's difficult to know exactly like what the environment is going to be just a few weeks from now, let alone what the environment is going to be a year from now. But one thing I think is like really interesting and important about some of these impacts is that they're going to ultimately have a lot to do with how the Federal Reserve responds to the increases in tariff rates that we've seen over the course of the first 7 months of the administration. Because these price effects could show up in the form of price increases as inflation rises and prices rise, or if the Federal Reserve doesn't look through these tariffs, they could also show up through a decrease in nominal income. So in some sense, we're in like a bit of wait and see.
Natasha, I also want to ask you about growth outlook, something that the administration is very focused on. Your report finds that U.S. real GDP growth over 2025 is 0.8 percentage points lower from all 2025 tariffs. In the long run, you write the U.S. economy is persistently 0.4% smaller, the equivalent of $135 billion annually in 2024. Put this into perspective for us. Just how much is this when we are looking at bigger growth targets from this White House? They say will come with their policies.
Well, what's important to appreciate, and we've talked about before, is like a way to understand the tariffs essentially is that they're a form of a tax. And so taxes, not in all circumstances, but in many circumstances, tend to have distortionary effects and can impact economic activity. What the tariffs are doing is they're shifting activity into sectors of the economy that are less productive than other sectors of the economy where America really has its utmost strength. And so the result of that is going to be a persistently smaller economy, both because we've done this sort of inefficient shifting into particular sectors, but also because we've raised prices, we've lowered demand, we've decreased the incentive for businesses to invest and grow. And so all that is going to come with really substantial economic effects in the medium run and also in the long run, because these aren't tariff rates that are going to kick in just for a short period of time. The idea, at least that some in the administration have articulated, is these are revenue raisers that are going to raise $2.5 trillion over the course of the next decade.
Love your take on the job market here, because you ran numbers on this as well. Remembering this is part of the promise of tariffs, the idea of reshoring businesses, bringing jobs back. You say the unemployment rate would go up by about a half percentage point this year, and payrolls could be almost 600,000 positions lower. What about tariffs bringing jobs home?
You know, it's so interesting because this is also sort of like sector specific in some sense. So as you're trying to reshore in manufacturing in particular in ways that are kind of frankly quite difficult to do in the short to medium run. So some of this has been, we want Apple to be making iPhones in the US. Like they actually physically do not have the production capacity to do anything like that. But let's say even that they did. The result of bringing some of those jobs in is going to be some of these broader economic trends that we've discussed, which is that prices are going to go up and people are going to consume less and demand is going to be lower. So in other sectors of the economy, there's actually going to be less demand for employment and less demand for business investment, such that in aggregate, you're going to see employment at lower levels, even if in particularly favored sectors, you manage to get a little bit of an employment boost. But even that's hard to do because these manufacturing jobs, they use intermediaries like steel and aluminum, so prices are rising on those as well.
Right, just quickly in our last minute here, can you actually speak about the impacts from the sector-specific tariffs like steel, like aluminum? We're talking about car makers, automakers, and how that's phasing in to the picture here, because those tariffs are enacted on a totally separate legal basis from the so-called reciprocal tariffs, yet they still make their way into all of these discussions that we're talking about for the overall tariff rates for our trading partners.
Yeah, and it's so interesting. And at some point, it would be so great to talk through some of the legal dynamics here, because we're kind of on questionable legal footing for a lot of the tariffs that we've described, because in theory, they're supposed to be associated with emergency moments, and it's hard to argue that there's any such exigency at this point. But for some of those sector-specific tariffs, I've thought it's kind of complicated to make the argument for them. If you're trying to say that we need to do more car manufacturing in the U.S., more of the Fords, more of the GMs, well, they're actually very heavily hit by some of those sector-specific tariffs because 60% of car parts are actually imported into the U.S. And so there's a bit of a puzzle with respect to how you aim to accomplish some of these goals and even boost manufacturing, as the administration claims they're trying to do, if what you're actually doing is making it harder to do some of that manufacturing because you're making it more expensive in these particular industries.
Natasha, it's great to have you with us, and we appreciate your insights. Professor at the Yale Budget Lab with new research to share with our viewers and listeners today on Bloomberg. Natasha Sarin, thank you so much for the insights. I'm Joe Matthew in Washington alongside Tyler Kendall as we wind things down on the early edition of Balance of Power. We just heard from the president, Tyler. It's not about Jay Powell. It's about Hulk Hogan. As you might have learned earlier on the broadcast, Hulk Hogan died today at 71. Donald Trump, a big friend. On Truth Social, we lost a great friend today, the Hulkster, he writes. Hulk Hogan was MAGA all the way, strong, tough, smart, but with the biggest heart. He gave an absolutely electric speech at the RNC that was one of the highlights, he writes, of the entire week. Entertained fans around the world. The cultural impact President Trump says he had was massive. Tyler will meet you back here a little later. The late edition of Balance of Power starts 5 p.m. Eastern, only on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And very good afternoon, everybody. Yes, across Bloomberg platforms, I'm Carol Master along with Tim Stenivek, live here at Bloomberg headquarters in New York City. And we've got a little bit of a mixed market, some gains on the S&P 500 and the NASDAQ 100. We could get another record on the S&P. Treasuries are down, yields are up. We are seeing jobless claims in the United States hit the lowest since April. So that's underscoring some strength in the U.S. labor market. And Tim, you know what that means?
What?
Fed probably on hold.
Oh, okay. Well, speaking of the Fed, the president is heading there today to check out the construction site that he has criticized for cost overruns. If we do hear any commentary from the president related to that or anything else of note, we will bring it to you live.
Should be kind of interesting. Plus, the day after, what you need to know about Tesla and Alphabet. Ross Gerber back with us on Elon and EVs and so much more. And then well-known media internet analyst Laura Martin. She has followed this world for such a long time, really closely followed analyst. We're going to talk Alphabet, we're going to talk Apple, we're going to talk Amazon, Netflix, Meta, and more, maybe even some late night TV shows and what's going on.
If we have time, we're going to try to fit it all in. Also, the head of the second largest bank in Florida on Wall Street South with the CEO of City National Bank.
All right, first up, let's get to a check on today's trading. We've got Intel after the closing bell. Lots to come your way. Here is Charlie Powell.
Hi, thank you very much. And ahead of earnings, we got Intel right now down by 2.7%. The Dow lower, down 198 right now, way down by IBM. IBM after earnings down now by 7.6%. NASDAQ higher by 14. That is a gain of 0.2%. And right now we have got the S&P 500 index up 14. Again, to be clear, NASDAQ now up by 0.3%. Our Mag 7 index trading lower by 0.2%, being weighed down by Tesla. Drop there of 8.8% on Tesla. The 10-year, 4.39%. The 2-year, 3.91%. Gold down $17 the ounce, down by 0.5%. West Texas Intermediate crude up 0.5%. And Bitcoin up 1% right now, holding just above $119,000. After earnings, Alphabet up 1.5%. After earnings, Tesla now trading lower by 8.8%. Hulk Hogan, dead at the age of 71. He was an icon in professional wrestling who turned the sport into a massive business. Again, S&P at a record up 14, up by 0.2%. And for on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thanks so much. Well, President Trump, no stranger to touring construction sites as a real estate developer and investor. Well, today he tours the Fed's construction site that has been in the news a lot. The president criticized the Fed construction for cost overruns. All of this happening amid his escalating attacks on Fed Chair Jay Powell for not cutting interest rates.
We have a real terrible head of the Fed. He's a stiff. He's a knucklehead. He's hurting people that can't get houses because they don't have mortgages. And I don't know if he knows it or not. He's either evil or stupid, and either is really not acceptable. But he's not doing a good job. And but he's only going to be there for a short while.
All right, that was President Trump on Tuesday. He will be visiting the Federal Reserve. That's at 4 p.m. Wall Street time. We'll be monitoring and covering that for you. For more, though, on what might lay ahead as the president gets ready to visit the Fed, Bloomberg News managing editor for U.S. economic policy is Kate Davidson. She's in the Bloomberg D.C. News Bureau. Kate, why is the president going to the Fed?
Yeah, it's a good question. It's a pretty rare occurrence. A president hasn't visited the Fed building in many years. I think the last time that we're aware of is in 2006 when George Bush went over. And the reason is because the president and his allies have been raising a lot of criticism over this very costly renovation project that the Fed is undertaking. This is something that's been going on for a few years, and the costs have grown quite a bit. Inflation is a factor. Some changes to the initial design and higher cost estimates than they originally expected are factors. But the president and other administration officials have basically been saying this is way too extravagant. They want more information. So the Fed has been trying to share a lot more details. They've shared video on their website. They've put out an FAQ answering some basic questions. And in fact, this morning, one of our reporters was able to go over with some other members of the media for a tour tour of the site, and we just moved a story on that with some details about, some of the elements of the project that Chair Jerome Powell has said have changed. Some of the things Republicans are mad about, he said they're not even in the plans anymore, and a lot of this is essentially the message was some of this is really overblown.
Well, let's go there now. What did our Bloomberg News reporting team find? Paint the picture for us. Give us some color.
Sure. Well, they were escorted by Fed staff that pointed out some of the reasons why this project is so expensive. So the Eccles building, which is one of the main buildings that's being renovated along with another one, it's very old. It was built in the 1930s. It's never undergone a major renovation. And so one of the things that's so costly is security, bringing it up to security code standards that the Department of Homeland Security set. So essentially blast proofing the building and some other measures. Those are quite expensive. But they also pointed to a couple of elements that were in an original planning document that have seemed to rile up Republicans in particular, like a plan for a rooftop terrace garden. They said that rooftop seating has been eliminated. Some Republicans also pointed out that there's a plan for a VIP elevator. They said the elevator is actually just meant to accommodate disabled users of the elevator, and they showed them that. So in some sense, there was not a ton to see in the way of extravagant features. I think fountains were part of the original design; those have been eliminated. The reporters were told, but it was very much a visit to an active construction site. There are hundreds of workers that come in and out of this area every single day.
Hey, so help me understand. So I'm assuming the U.S. taxpayer is paying for this, right? It's taxpayer funds that go to this. I mean, who approved all of this spending? And anybody who's done a renovation or construction knows you start with one thing and it kind of goes further. But I mean, how long has this been going on? When was it really approved? Like, what do we know in terms of kind of some of the back details?
Well, the question of the financing is a little bit tricky because, as most Americans might not know, the Fed, as an independent agency, is not funded through the appropriations process through Congress, and that's by design. It was meant to be to insulate them somewhat from political influence. So they collect fees from member banks, members of the Federal Reserve System, and then they also have this huge portfolio of assets. We write a lot in our wonky Fed coverage about the Fed balance sheet, which is something markets care about a lot. That they actually earn interest on the securities that they hold, and that is income, and they use that income to pay for their operating expenses. And so, money that they have left over beyond their operating expenses, if they have it, they send it to the Treasury. So taxpayers benefit in a sense from that when the Fed is earning a lot of money on its balance sheet. But the Fed has been recording operating losses, and that's slightly complicated reasons, but has a lot to do with higher interest rates. So that I think is also what has frustrated Republicans. We've heard Elon Musk talk about this, is that the Fed is spending a lot of money on this big project at a time where they're also recording operating losses. So, the project was approved back in 2017, 2018. It's been some years, and of course, since then, we've had inflation. That has also added to some of the costs here as well.
Yeah, we had a lot since then.
Help me understand to what extent the Federal Reserve Chair has control over this renovation. I mean, is he... And has he, over the last few years, single-handedly been the one to make decisions about what goes where, what gets included, what doesn't get included, what construction materials? To me, that seems like the picture that the president is painting.
For sure. I mean, the chair, no doubt sets the direction and the tone, but this was definitely a project that was approved by the entire Board of Governors, the 7-member board. Of course, the folks who are on the board now are not all exactly the same as the people who originally approved the project. And when Jay Powell was a governor before he became the chairman in 2018, he was one of the governors that helps to oversee things like, the buildings and the facilities. And the Fed has control over its own buildings. So in essence, to the earlier question, I mean, they didn't need to seek approval from anybody per se, but the project has continued on, and we don't know exactly, which decisions did Jay Powell make or approve, yes or no, but the broader decision of undertaking this huge project was one that was made by the whole board.
Hey, Kate, at the same time, cost overruns connected to government spending and projects, not a new thing in general, and I understand how you laid out kind of the Fed separate in terms of it being an independent body. Many would agree, though, anything to do with the government where there's cost overruns, at least should be looked at. And a lot of times it can be explained away. Are there nonpartisan observers who are watching this? What do they say?
For sure. I mean, yes, I think that it's it's probably viewed as a positive step that that Jay Powell has asked the Fed's IG, Inspector General, to just do a review of this. We've also seen the Fed in recent weeks post a lot more information on its own website. It seems like they were caught a bit off guard by all the attention that this has gotten and are trying to be more transparent and share more about it. There's clearly a lot of interest in this, and some of the explanations that have been provided for why there are cost overruns seem to make sense. But then in other ways, there are perhaps things that they will have to explain to lawmakers and justify a little bit more than they're used to.
All right, great setup for us as we keep an eye on the president visiting the Federal Reserve at 4 p.m. Wall Street time. Kate, thank you so much. Bloomberg News Managing Editor for U.S. Economic Policy, Kate Davidson, there in D.C.
Well, speaking of the president denied he was seeking to ruin the business empire of his one-time ally, Elon Musk, as retribution for their dispute over the president's signature tax law. President Trump posted on social media earlier today that he wants Musk and all business in the U.S. to, quote, thrive, and that their success is good for the country. This, Carol, on a day when Tesla shares are just absolutely tanking. Elon Musk did warn of difficult times ahead for the company, and that it will be in a transition period for the next year.
That's right. The stock down about 9% as we speak. All right, Ross Gerber was here with us yesterday, getting us ready for Tesla earnings and on the day that they were reporting. He joins us again today to tie up the headlines from Elon's call last night with investors. He's a longtime investor in Tesla, an owner of Tesla cars. He's the president and CEO of Gerber Kawasaki Wealth and Investment Management, and he has about $3.6 billion in assets under management. Ross, so glad you could give us a little bit more time today. So thank you, thank you. Just about 24 hours since Tesla earnings, not quite, but almost. We've had Elon's call with investors. What is or remains your investment thesis on Elon and Tesla? Because you seem to certainly have pulled back and are a lot more cautious.
Right. I think probably my biggest issue is that what I believe is best for Tesla isn't actually the strategy being employed by Elon. And what I think is best for Tesla is to be focused on selling great EVs that can drive themselves versus completely pivoting into this robot and robo-taxi business because they're struggling to sell cars. Because what we're seeing now, which I suspected to be true earlier, is that the deterioration of the EV business is really, really bad for Tesla, and it essentially is an EV business. And so hoping that robotaxi and robotics is going to be a revenue stream and let alone profitable anytime soon is really just not going to happen. And so, as Elon said, Tesla's in for some pretty tough quarters ahead. And with the ending of the tax credits and all this kind of stuff, I mean, this is all bad news.
When you say it's not going to happen anytime soon, what do you mean by that? Give us your own timeline here.
Well, we follow Waymo very closely, and we think that Tesla's 2 years behind Waymo as far as the development of their robotaxi. And now Waymo is scaling and being quite successful at charging, the right amount for rides and generating enough revenue that it's meaningful. So I think it's at least 2 years, right? So where Tesla's at, for them to generate any revenue at all of meaningful ability will take a couple years. And then from a profitability standpoint, we don't even know if that business is going to be profitable with all of the competition that's coming into the robotaxi business.
So you said yesterday, you reminded us that you've been selling shares of Tesla. I think there were reports too in June that you sold about $60 million worth of Tesla shares, and you cited the waning confidence as you're laying out here in the company's future. Are you selling more? What's your exposure at this point?
Yeah, we still have, on my last 13F, we had over 200,000 shares. Right now we're holding a little less than 200,000 shares. So we continue to sell the stock. We have a lot of diehard Tesla clients that you have huge gains because we bought the stock at, like $2. And so, people aren't that excited to pay taxes. And there's still this possibility that Elon could change course and really do the things necessary to fix Tesla, because fundamentally Tesla's a great company. Most, if not all, of Tesla's problems are self-created because of the CEO, Elon Musk. It's not that Tesla's core business has some big problem. It's actually the opposite. The CEO is the problem, which is super unique. So so that's why I'm loath to just be like completely out of Tesla. But on the other side of the coin, with the valuation where it's at, and basically we think they're not going to be profitable next year, you know, the stock needs to move meaningfully lower in my mind before I would buy it.
How low? What's meaningful?
Well, you know, I don't know if any of the analyst estimates for next year are right. I think they're all vastly overstated. But even if you did $3 of earnings next year at 50 times earnings, which is NVIDIA's multiple, you'd be at $150. And then you put some premium on the Elon Musk robot premium. Maybe you put on $50, $100. So you're at, you know, $200 to $250 a share is where I think Tesla should be.
Okay, $200 to $250 a share. Right now at $303 a share, down 8.8% today. Hey, Ross, in the past when we've spoken to you, you've been really critical of Tesla's board. You've been critical of it on social media as well. The board does include folks such as Kimball Musk. It includes James Murdoch. Most recently, it added Chipotle's Jack Hartung to the board. Are you any less critical of the board now? Do you think the board is doing its job?
No, I mean, I think there is no board. I think the board is Elon Musk. And so the board is just, you know, it's like a weekend at Bernie's, you know, it's like a bunch of bodies that they put at a desk and Elon tells them what to do and they do it. This Jack guy they just put on probably had no idea what he was getting himself into, and he's in deep now. You know, so I don't actually think the board of directors cares about anybody but Elon Musk, and I think investors in Tesla know that at this point, and that's why we're ultimately sellers, is nobody actually represents retail investors, which own, you know, still own 87% of Tesla. So it's really a unique situation, and I expect Tesla to buy XAI at some point for probably $200 billion, some outrageous price. And I think that's the next thing that will happen. So, you know, there's no question that the merging of these businesses seems to be on the horizon.
Hey, before you go, I definitely want you to have you weigh in, Ross, on what President Trump put out on social, that he denied he was seeking to ruin Elon Musk's business empire as retribution for the dispute over the president's signature tax law. What's your read on this? Might this be helpful to Elon and Tesla? We just got about a minute 10.
No, you know, Trump's just being the bigger man here and trying to, you know, act like he doesn't have a tiff with Elon, you know, because he's so mature or something. But the truth of the matter is he's already done what needs to be done to destroy Tesla by taking away all the subsidies and making EVs much more expensive. And so, you know, he doesn't have to say anything anymore. Elon's dug his own grave, and he's going to have to figure out a way out of it. So you know, Trump doesn't have any reason to look bad or grind an axe, you know, and Trump's playing Elon like he has the whole time.
30 seconds. We have talked with you about your Cybertruck. We talked about others, you know, that you have owned. Would you buy another Tesla? Do you still like the cars? Just quickly.
I do. You know, this is the whole issue. You know, I've looked at so many other cars to buy, and I want an electric car, and I want a great electric car, and I still think Tesla makes the best cars. And Rivian, I have a Rivian too, so I think they're a close second, and they make a great vehicle as well. But I just haven't been compelled by any of the other vehicles, EV vehicles out there. And so, you know, I still kind of like my Cybertruck, and
I know,
you know, I can't sell it anyways, but Tesla makes great vehicles, and it's a great time to buy an EV before the discounts go away.
Ross Gerber, you're incredible. Of Gerber Kawasaki Wealth. We so appreciate it. Coming up next, we talk Alphabet.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. S&P 500 index pushing higher. We are close to session highs, up another 19 points at a record right now. The S&P at 63.78, showing a gain of 0.3%. Very different story for the Dow. Down 177, drop there of 0.4%. Certainly shares of IBM down 7.5%, weighing on the Dow Industrials. NASDAQ up 84. That is a gain of just about 0.4%. Bottom line here, tech shares leading gains in the S&P, with the gauge extending its surge from April lows. Meanwhile, J.P. Morgan Chase's trading desk expects the furious rally in equities to keep going. 10-year 4.40%, the 2-year 3.91%. Spot gold down $18 the ounce, 33.69, down 0.5%. West Texas Intermediate crude up 0.8%. WTI 65.78 a barrel. Bitcoin up 1.2%, $119,300 on Bitcoin. Tough day for a lot of airline stocks after earnings. American Airlines down 8.5%. Alaska down 3.3%. Southwest Airlines particularly hard hit, down now by 11.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, shares of Alphabet, they are higher today off their best levels. They were up as much as 4% right now, a gain of just shy of 2%. The Mag 7 stock that has been one of the largest market caps out there said demand for AI products boosted quarterly sales and now requires an extreme increase in capital spending. So heightening pressure on the company to justify the cost of keeping up, Tim, in the AI race.
We're delighted to have with someone who's closely followed for her coverage of the media, entertainment, and internet space. With us from Los Angeles, Laura Martin, senior analyst over at Needham & Company. I want to start with Alphabet, where we're going to talk about a lot with you over the next few minutes. You've got a buy rating on the stock at $220 a share, price target trading at $193 as we speak. It bounced around after market yesterday. It's gaining today. What's important to you from this latest quarterly update?
The single most important number to offset the bears is the search number. So search revenue up 12% was well above the whisper number of 10% growth and above the Wall Street consensus number of 9% growth. And they also had 4% click volume, which basically is the same as last year. And that's up from 2% click-through rate in the first quarter, which is positive because the bear case here is that generative AI answers lower than the economics of Google search, which is the big money engine here. So the single most important number was that search grew ad revenue 12%, which was 300 basis points above consensus view. The second most important number is cloud, right? They're still out of capacity with cloud, but their cloud business grew 32% at a 20% margin. So that's fantastic. So they're really pricing up now that they have capacity constraints. And the third most important number is YouTube. YouTube grew 13% of revenue, and we think it's worth $73 a share here if it was separately tradable and not confined within the Alphabet conglomerate. So, but I would say those are the three most important segments that people are talking about. But the bear case really is highly focused on the search revenue growth.
And that's exactly where I want to go right now. Going into this print, there was so much concern about the cannibalization of traditional Google search. Why aren't we seeing that?
So what they're saying is that what happens when you have those answers, when you put in a Google search and then you get an answer, is that people are spending 10 times more time, 10% more time asking the next question, and that the shortfall in clicks per query is made up by the fact that people spend 10% longer, which then lets Google serve more queries or more ads. So that's what they're saying, is that the demonetization is about equal. That's their words, about equal. But I think part of it is the extra time people spend using the answer format is offsetting the actual the downdraft in the economics per query.
Hey, the extra spend, the up again CapEx, initially everyone was saying, well, that's why the stock traded down in the aftermarket. It made some folks, or at least some investors, it felt like, initially nervous. What is your take on that? I think our own Mandeep Singh was saying, well, listen, it sounds like they're getting the demand and they're spending to meet that demand.
Yeah, I mean, I would say that. I would say the other thing that's going on is that I think one of the reasons the stock was a little volatile is the operating income grew 14%, the top line grew 14%, 14%, and it sort of looked like there was minimal operating leverage. But what they told us on the call that was buried in the financial statements is those costs included $1.4 billion fine, legislative fine, regulatory fine. So if you subtract that just to look at costs, the most important point we would make that I think largely is being missed, it doesn't have to do with revenue, has to do with the fact that by integrating generative AI into every aspect of their business, they've got really accelerating revenue, which everyone's focused on, but their costs are going down. Okay, that's not fair. Their costs are just not going up as fast. There's a lot more operating leverage here if you exclude the fine. So I think that's why I think once they said there was this big fine in the costs, people realize that generative AI is really lowering or increasing the productivity here. And so the operating leverage is margin expansion is faster than people think at a time when revenue is also accelerating over consensus view.
One thing I loved in your research, and you put this right up top, Laura, is you said we like Google's strong strategic position as #1 in search, #1 in streaming, YouTube, #2 in mobile, Android, #3 in cloud, #1 in autonomous driving, Waymo, which Tim and I are both in love with. And you say LLMs make data more valuable and Google's data is best in class. Again, your view. Is Alphabet in many ways the one to beat? And why hasn't the stock been, I don't know, doing more this year?
You know, I think Google, so I would say their execution has been very haphazard. It's not. And Wall Street really prefers leaders that lead from the front, like Meta, like Mark Zuckerberg. We like, visible, clear, visionary leaders. And that's not what's going on here at Google. But, Google, sort of despite itself, really does have the human capital and culture and financial resources to fund what will be a retooling of American business, which is the generative AI backbone infrastructure that they're building. And they're leading by executing within their own, they're showing what's possible by executing, implementing generative AI into everything they do, every product they have, and every cost center they have. So this is what's about to happen to America over the next decade, is companies that follow Google's lead will have increasing margins and accelerating revenue. And if you don't, which requires a cloud, by the way, you can't do this without cloud. If you don't, you will go out of business because, in my opinion, because the companies that use generative AI to increase productivity and margins and increase revenue will get higher multiples from Wall Street.
I know you said search,
Search,
cloud,
streaming.
Search, cloud, and YouTube are the three most important numbers, but we'd be remiss if we didn't ask you about Waymo and the expansion that the company said is coming in the, quote, near future. Here's what they said. Alphabet hopes to expand Waymo to all cities in the near future. How do you look at this as an analyst on this company's stock, as an analyst for the company, and material contribution?
So you guys love the service. You just said so. So I don't like it in this sense. That right now, I think the most strategy is what you say no to, and what Google should be saying no to is anything that isn't generative AI related, because this is a race and a war, and they are spending a fortune on generative AI. Good for them, but Waymo is another huge sunk cost or financial commitment. And I would like them to figure out a way to do Waymo. They are ahead. They are #1 in autonomous driving. I would like them to keep the data, because I think data in the real world plus the virtual world is worth more than either world standalone. So I like the data aspect of Waymo, but I do not like the capital commitments, which compete right now with the generative AI capital commitments.
What are the capital commitments? They haven't been totally clear about that. What do you view them as?
Well, they sit in other bets, and I think other bets I'm forgetting, but it like loses typically $3 to $5 billion a quarter, so it's like $20 billion a year, and a lot of that is Waymo, and it's their healthcare initiatives, and so I just think that money, they just upped CapEx by $10 billion. I would like to see them take it out of other bets, but the primary other bet is Waymo. So I think they're unwilling to relinquish their pole position because now Tesla's coming after them. So I think, look. They are number one in all of these strategic segments because they get there early. And so they're early to Waymo. I just wish it wasn't as capital intensive. The losses weren't as big at a time when Google should be spending all of its focus and resources on generative AI.
Laura, we really, really, really like Waymo. I'm just going to tell you, really, I even close my eyes in a Waymo. That's how comfortable
Laura's
I felt.
in LA where they have Waymo.
I
We're
know,
in New York
she
where they don't have Waymo
knows.
yet,
I know.
so.
Hey, listen, we've got about 3 minutes left. There's so many different places we would love to go with you, but you pick, because we've got Apple reporting next week, Meta reporting next week, Amazon reporting next week, Disney in early August, Netflix already out, and then there's the late night wars. What's interesting to you right now that you think the Bloomberg audience and investors really need to be paying attention? And it could be something else beyond that.
Let's do Apple because it used to be the biggest company in the world. Now I guess NVIDIA is. But what I would say about Apple, we have a hold here on Apple, whereas we have a buy on Alphabet, Google. I think Apple is in a box because when you listen, for sure, when we hear Meta, who's spending hundreds of millions of dollars per person to create a super intelligence generative AI group, and yesterday there was no sentence on the Google earnings call that didn't have AI in it. So, these companies are really talking. Amazon will also, because that's being run, Amazon now is being run by the AWS, founder, essentially. He talks about generative AI a lot. So the one that's not the same is Apple. And people really want to see what's happening with their generative AI strategy. And how is Apple either 16, iOS 16, iOS 17, iOS 18 going to keep up with Android, which is Google, who last night told us they're integrating generative AI tools into everything, including Android. So I do think there's a bigger threat to Apple's only business, which is its iPhone business. We think it's a single product company with upsells to other devices. We think the anchor tenant there is the iPhone. So we really want to hear how they think they can compete when they are saying nothing about generative AI. And they're spending $12 billion on CapEx, which is the same number at Apple for the last 3 years. When we just, every single quarter, we show up on the Amazon call, the Meta call, the Google call, they're raising CapEx by $10 billion at a time, every quarter.
30 seconds on Apple. Is Tim Cook the right leader to guide them through the AI era?
Oh, so harsh. I'm going to go with no, but so harsh. No, I don't think so. I think we need a wartime CEO. And I think Tim Cook is great at a lot of things, but I don't think he's not proven great at this technological disruption called generative AI.
Got someone else in mind that you think should lead it? 10 seconds.
It's an impossible job. So no, I have no idea in mind for who could replace him.
You rock. Come back soon. And I think you are coming back soon, which we're looking forward to already. Laura, be well. Laura Martin, senior analyst at Needham & Company, knows this space like no other. So glad we could get some time. Coming up, we're talking to the CEO of the second largest bank in Florida. We're going to talk a little Wall Street South and more. That's coming up on Bloomberg Business Week Daily.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got the S&P 500 index trading at a record right now, up 16, 63.75 where we stand. That is an advance right now of 0.3% Dow. The Dow, different story, down 215 now, weighed down by IBM. We've got the Dow down 0.5%. IBM trading lower by 7.8%. Tech stocks rallying. NASDAQ up 76, up 0.4%. The NASDAQ 100 index also up 0.4%. 10-year 4.40% with the 2-year 3.91%. Gold down $14 the ounce, down 0.4%. And West Texas Intermediate crude up 1.3%, 66.07 a barrel. Briefly, shares in so-called meme stocks trading mixed. GoPro right now down 2.6%. Krispy Kreme down 0.1%. Beyond Meat plunging 11.3%, but Kohl Stores up 10.6%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master, Tim Stenovic, live here on Bloomberg Business Week Daily. So bank stocks have definitely been on a tear this year. They're up 14% as a group year to date, up 40% from an early April low. Bloomberg's regional bank index also up about 7% year to date. Now, keep in mind, this is all happening as President Trump focuses on efforts to deregulate traditional finance and move crypto further into the mainstream. They are moves that some say may be laying the groundwork for a financial crisis or simply fixing bureaucratic overreach stemming, Tim, from the last one.
With a view on banking, everything from personal to international banking, real estate and mortgages, wealth management, and more. We've got George Gonzalez with us, Vice Chairman and CEO of City National Bank of Florida. It's got $27 billion in assets under management. City National Bank of Florida, it's a wholly owned subsidiary, Carol, of Banco de Crédito e Inversiones, one of Chile's largest banks, and has offices in Brazil, Colombia, Mexico, and Peru.
He joins us in studio. Welcome, welcome. Great to have you here. Your bank has been in Florida for about 75 years. A lot has happened in that time. Miami is the biggest market for the bank. Talk to us about what your clients are telling you right now about the state of the economy in your hometown.
Well, first of all, Carol, Tim, thanks for having me today. Listen, we are super blessed. We're super fortunate. We feel like we're at the enviable position to be able to be in an economy, the state of Florida, that continues to be super resilient, super diversified, and continues to experience a lot of growth. If you think about what's happened to Florida in the last 4 or 5 years, we've had significant GDP growth. We've had over 3.5 million new businesses start. Our unemployment's around 3.5%, significantly below the national average. And most importantly, what we've seen is a transformation of the migration into the state of Florida. So whereby in the past, before COVID, you'd see a lot of folks coming in internationally. What's starting to happen pre-COVID and then post-COVID was an acceleration of people coming from the Northeast, from the Midwest, and from California into the state, which has really helped transform the entire economy in Miami, South Florida, Orlando, and Tampa, really the entire state, because it's become significantly less transient. It's become people are starting businesses, raising families, building their futures, as opposed to being more people that were traveling to Florida and South Florida for entertainment, for vacation, or more transient investment. So
and forgive me, it's not just, and I love older people. I'm getting older, but I mean, it's not just a place where people go to retire. As you talk about, it's really become much more diversified.
100%. The amount of working age people that have decided to uproot their families and their kids and move to Florida has really been phenomenal. In fact, at City National, I'd say probably 30 to 40% of our more recent senior leadership and executive hires have come from outside Florida.
Right.
Prior to the pandemic, that would have been very challenging for us to accomplish. And today, it's really been a very strong pipeline of talent wanting to relocate to Florida.
Miami benefits from a lot of cross-border activity, particularly when it comes to Latin America, South America, countries within the region. When it comes to the Trump administration's immigration policies, is that having any material effect on economic activity in the region?
It's not. I mean, obviously, it's on the back of people's mind. I think everybody agrees that immigration is something that has to be done in an organized, legal framework, and I think that's what everybody is expecting to take place here over the next 2 or 3 years. But as of right now, we're not really seeing a lot of impact from that standpoint. But I'm sure
Seriously,
it's on
not
people's
even
mind.
in the hospitality area?
Not yet. Okay. I mean, it's not something that is seeing any real impact. But, again, and I think that's probably due to the fact that there's so many industries that are experiencing so much growth, so much demand, so much, inflow of capital that's taking place. And really, at Citi, we've been on the forefront. As you mentioned earlier, we've been around for almost 75, 80 years. And we've grown this institution from $2 billion to $27 billion, one relationship at a time, one client at a time, and one banker at a time. And it really is a testament to our business model, which is very relationship-driven, very client-centric, and very people-driven, has really been very well received. What people probably don't know is the number of banks in Florida has decreased from 300 to less than 90 in the last 10, 15 years. So the number of banks that are really situated to be able to support small business individuals, international and domestic capital has really decreased significantly. Really puts us at the forefront in the epicenter of being able to continue to support that growth. So we're very excited about the future of Florida.
What would you describe about lending? Like, so many folks come in and say, man, we'd like to see rates a little bit lower, kind of juice in terms of the lending market. What can you give us some insight into what you are seeing? And you play in small business, real estate, you play in a lot of different sectors that give us some really great insight into the economy.
No doubt. And listen, I think the Federal Reserve has done a really good job of navigating some very difficult situations over the last 4 or 5 years. I think the economic data is starting to reflect the fact that there's probably a rate cut or two coming in the near future.
Even though your economy in Florida is doing really well.
It's doing well, but I think we would benefit from a rate cut. I know for a fact our clients would benefit from a rate cut. I think consumer and consumer credit would benefit from a rate cut. So those are all things that I think are geared up to even continue to be drivers to the, not just the Florida economy, but over the overall economy, which is something that, is around the corner. It's just a matter of time.
You mentioned the number of banks in the state has gone down over the last few years. It's not just Florida where we're seeing that. We're seeing consolidation and M&A happen within the industry. When it comes to M&A, for you, are acquisitions of interest to you right now?
Listen, we're always strategically looking for opportunities, but the reality is that our organic strategic business model has been so well received that we don't need M&A to continue the growth. All that growth I talked about from $2 billion to $27 billion, that's been organic. 95% of it has been. So our business model is really something that the market needs, wants, and continues to be kind of at the epicenter of everything we do. If an acquisition comes our way that makes sense strategically, we'll look at it. But the nice thing is, as a CEO, as a management team, and as our shareholders, it's not a necessity. It's more of a luxury.
What part of the business is growing the most?
Listen, we actually we're very diversified. So as you said earlier, we do a lot of real estate banking. We do a lot of small, middle, large corporate, private banking, international. We have a capital markets effort, and we have a wealth management platform. And across the board, we're seeing growth. Where we're seeing the most growth is in markets outside of our Miami market, because we've expanded, a lot more boots on the ground in Palm Beach, in Orlando, and Tampa, because those are also some of the best economic markets in the entire country. So our expansion and our market share is starting to grow and have significant traction in those geographies.
When your wealth managers are meeting with people who relocated to Florida, what are they hearing from the Northeast and from the United States and within the United States? What are you hearing from them, and what are they hearing from them as the reasons?
Well, the first thing we're seeing is people are not going back. There's been some rumors or some gossip that there's been a lot of relocation back to the Northeast, and I can tell you I talk to hundreds of people every month, and nobody's really going back. The reason they're relocating is because of, I think, the pro-business environment in the state of Florida, obviously taxes, some people because of the weather, but really just your overall quality of life in Florida is something that people understood prior to COVID, and COVID really accelerated something that was already heading in that direction. So a lot of times people think that COVID was the only driver to this. It was really happening 2 or 3 years prior to COVID. COVID just accelerated that change. And and really, my hat's off to state leadership and local, political leadership. They did a really nice job of being able to welcome all these people in a very positive way.
All right, George, really quickly, 30 seconds. I mean, every good manager, yep, you sound very optimistic. What's the one risk, though, that you kind of keep an eye on? Or potential risk, real quickly.
Listen, I think if rates stay too high for too long, that does worry me, particularly in a state like Florida, where real estate is a main driver of the economy.
Yeah.
So I think a lot of our real estate clients would like to see borrowing costs come down. So that's probably the one thing that worries me a little bit. But there's so many other factors that are kind of underlying to the economy that I feel really gung-ho about the economy for the next 5 or 10 years.
Definitely feel the optimism. George, thank you so much. Great to have you here. George Gonzalez, Vice Chairman and CEO of City National Bank of Florida, joining us here in studio. When we come back and check on trading, the stock's on the move. This is Bloomberg.